despite the CEO resigning, and PV FinTech has been seeing fresh shots over the last few days, and the expectation is that IRDAI's consultation paper related to commission might come anytime.
All right. Thank you so much, Sudarshan. Nifty expiry day today. But this is a monumental week, the week that we look forward to, Hormaz, as earnings start here in India. And before that, let's get you some market voice. Speaking to CNBC TV 18, Timothy Moe, co-head of macro research in Asia and chief APAC regional equity strategist at Goldman Sachs, told us that they expect India to deliver 8% earnings growth this year. Adds that they are market weight on India. Listen to his views.
Both markets are trading at roughly around 21 times earnings. India, as I checked as of today, is trading at 20.5 times 12-month forward consensus earnings. Taiwan is a tad higher, about 21 times. But Taiwan, we think, is delivering 48% earnings growth this year and 30% next. In India, in our numbers, we think will deliver 8% this year and 13% next. So if you've got both trading at sort of 20 times earnings, but one is delivering much faster earnings growth, then I think that explains why why we're overweight Taiwan and market weight on India at this point.
Timothy Moe of Goldman Sachs speaking exclusively to CNBC TV 18. Plenty of updates came in from Saudi Arabia overnight with regards to some changes in the crude prices. And Manisha Gupta is here with all of the updates, not just from the oil markets, but from the other commodities as well. Manisha, good morning.
Morning, Hormaz. Well, absolutely. The big news, of course, is from Saudi Aramco, where we have seen the Arab light prices for Asia for the month of August being cut by $11 a barrel. I mean, such deep discounts coming in from Saudi Arabia is not very often, and the last time you saw such deep ones was perhaps in 2020, and before that in 2015. Interestingly, the crude oil prices also should be taking support from the fact that the U.S. Strategic petroleum reserves now stand at the lowest since April 1983. And when you look at the U.S. combined commercial and SPRs, well, that is at 1984 low as well. So that should perhaps keep that support going at $70 a barrel for the crude oil prices. Having said that, we also have seen the vessel traffic through Strait of Hormuz continuing to recover, and that is what is keeping the crude oil prices near those very close to 4-month lows. But yes, there's a bit of a rebound when it comes to metal prices. We are looking at investors waiting for the Fed June meeting minutes. The U.S. jobs growth, remember, slowed in the month of June. The lower crude oil prices also seem to be easing inflation concerns, and that has supported the metal prices, where gold yet again gained in the overnight market. We have aluminum trading stronger. Zinc has been an outperformer overnight. Copper prices gained up by 0.5% as well. I want to quickly run you through the agriculture commodities as well, where we're looking at very, very strong gains. Arabica coffee gained up 14% overnight. Cocoa was up 13.5% overnight. So some of these commodities, because of El Nino and weather concerns, seem to be doing very strong.
All right. Thank you so much, Manisha, for that update. But now let's slip into a break. Up next, we get you all the cues from Wall Street. Welcome back. You're watching Power Breakfast on CNBC TV 18. In the US market, Wall Street extended its winning momentum on Monday following a strong week. The S&P 500 and Nasdaq ended higher, while the Dow Jones hit another record closing high, gaining 156 points. CNBC's Brandon Gomez is here to get us a wrap of all the action on Wall Street.
U.S. markets were up across the major indexes in Monday trading as the Dow topped 53,000 for the first time ever. The Dow gained 156 points to hit that milestone. The S&P 500 was up 54, and the tech-heavy Nasdaq added 288 points and was up more than 1%. The official Department of Government Efficiency website is now shut down after reaching the July 4 deadline that President Trump imposed to end all operations. Doge claims it saved $215 billion from its mass layoffs and funding cancellations. Elon Musk, the leader of Doge's efforts, originally set out to save $2 trillion. And Microsoft on Monday said it was immediately cutting 4,800 jobs, representing about 2% of its global workforce. A big part of the cuts coming from the Xbox division, which is losing about 1/5 of its staff, and 4 of its gaming studios will be spun off. Microsoft is one of the worst performing mega cap tech stocks this year, down about 20%. Shares were down about 1% Monday on the news. That's what's happening here in the U.S. Back to you in Mumbai.
That was all the Wall Street action, and here's some opinion from Scott Cronhert, the U.S. equity strategist at Citi, on the recent sell-off in a lot of these chip makers.
I think the response to the sell-off that we've seen in the past couple of weeks is appropriate. That's bound to happen at some point here on the mean reversion side. I think, our issue, and we had downgraded tech a week and change ago from a long-standing overweight to a market weight, and we are just allowing some room for digestion of the second quarter move that we saw, particularly coming from the semiconductor component of tech.
All right, let's also get you some opinion from former St. Louis Fed President James Bullard on the U.S. Federal Reserve's policy outlook. Here's what he said.
Core PC inflation is too high. It's up 0.6 from where it was, over 3%, well over 3% now. Committee doesn't like that. The 3% is a red line. That's a metric that is already smoothed. It's you're looking at the 12-month. You're throwing out some of the more volatile components. So, they don't like that. They want to be more hawkish. That's why the June meeting came out pretty hawkish. And they're, I think, willing to move if they have to. But not right now. They're going to want to see if this oil peak will pick some of the edge off of those numbers. I don't think it will, so I think they'll end up hiking in the second half of this year.
Well, let's now get you the latest on the Donald Trump-related developments. Vinny is here with our special segment, Trump Watch. Vinny.
Hi, good morning. So one more day, a lot of stalking still again done by President Trump. And let's talk about the first commentary that came in. US President Donald Trump rang the NYSE as well as the NASDAQ opening bell jointly at the Oval Office on Monday. This was marking the first day of trading of Trump accounts. What White House also said that $800 million in new capital will be invested in the stock markets for America's children this week. U.S. Treasury Secretary Scott Bessent also added that the accounts create an ownership economy where all citizens become shareholders. Now, more in terms of Trump account, we had President Trump who also prompted Dell Technologies from the Oval Office event. Dell shares actually rose up over 7% as well following these remarks. He referred to Dell's $6.25 billion pledge to seed Trump accounts, and Trump's 2025 financial disclosures also had Dell Technologies in terms of the shares traded. Micron Technology, that's the next stock also that was the company had pledged $250 million to Trump accounts following the post. Following this, Truth Social post came in from President Trump. He said thank you to Micron for putting this pledge as well. And similarly, we're seeing disclosures that Micron Technology also was a part of Trump's holdings in 2025. Now let's move on. And Trump also said on Truth Social post that Walmart would cut prices by a lot at his administration's request to mark the 250th anniversary, citing an almost 15% cut on ground beef. Walmart confirmed that there will be reduction in around 250 items in terms of prices, did not credit a Trump administration in its own statement. Now, elsewhere, Trump said that he's expected to meet with the Chinese counterpart Xi Jinping, and this would be around September 24th is the date that we have as of now, which would coincide with the UN General Assembly in New York that month as well. Moving on to some updates on West Asia front, Donald Trump said that the United States would either reach a deal with Iran or finish the job, renewing the threat of military action again as of now. Now, Trump has departed from Washington for the NATO summit, and White House confirmed that Trump will be meeting Zelensky as well as Syria's al-Shara on Wednesday, followed by the press conference that they'll be holding. Trump also spoke on the phone with both Zelensky as well as Putin on 4th of July, and Zelensky said that they have discussed frontline developments and diplomatic efforts as well.
Vinny, thank you for those updates there. And on to updates from West Asia now. Hundreds of thousands of people have been joined the funeral procession for Iran's slain Supreme Leader Ayatollah Ali Khamenei in Tehran, with further rites set to take place in the holy city of Qom today. Elsewhere, Hamas announced the dissolution of its governing body in Gaza after nearly 20 years in power, paving the way for a technocratic committee to implement a civilian government. However, Israeli forces continued their attack on Gaza, killing at least 6 Palestinians and wounding 20 others.
All right, let's slip into a break. Up next, we get you updates from the world of technology and artificial intelligence, so stay tuned.
Welcome back, getting you the latest from the world of tech in our special segment, the AI Pulse. Rachna is here with all of the latest. Rachna.
Well, first up is Microsoft that has cut 4,800 jobs. That's 2.1% of its global workforce in its latest cost reset in the AI era. The Xbox unit takes the biggest hit, losing 20% of its staff, with 1,600 roles gone Monday and 4 game studios set to be spun out or sold. Xbox chief Asha Sharma told staff, quote, "Our business today is not healthy." Microsoft's stock is down 19% this year. Staying with big tech then, tensions in Alibaba's ban have come in with the ban on Anthropic tools, which has now been confirmed. CNBC has reported that employees must stop using Claude at work from July 10 and delete all Anthropic models, is the advisory given to all Alibaba employees. Now, Anthropic has acknowledged the hidden China detection code as an anti-abuse experiment it plans to remove, while the Financial Times reports it is closing third country access loopholes for Chinese firms. In the UK then, the FCA has published the first regulator-led review of AI in retail finance. It says 11 million British adults are likely to use agentic AI for their money, flags fraud and cyber risks, but also recommends no new rules. Home now, and India's approach may be shifting. Officials told the Economic Times a new AI law may soon come in that will focus on graded risk-based regulation, a change from November's position that no separate law was needed. Meanwhile, Apple has restored Visa and MasterCard payments for Apple accounts in India over 4 years after RBI's recurring payment rules forced a suspension. And InfoEdge is paying 39.9 crore rupees for the remaining stake in Coding Ninjas, taking full control of the company, with Naukri set to build mini AI courses on the platform. And then there's SK Hynix, which will price its NASDAQ listing Thursday. Trading begins on Friday, a deal Bloomberg says could raise around $28 billion. And finally, free access to Claude Fable 5 ends today. From tomorrow, Anthropic's top model moves to usage-based credits, double the price of Opus 4.8, its costliest model yet. That's all that we have from the world of AI.
Well, plenty of developments there as always. Rashna, thank you for that. Now, the monsoon intensity has eased overnight, but the impact continues to be felt across Mumbai. There are waterlogged roads, traffic disruptions and slow-moving vehicles across key routes. The BMC has advised residents to stay indoors unless travel is essential. Schools and colleges remain shut as a precaution. Parts of Thane continue to report waterlogging and congestion, while the IMD has kept an orange alert in place. Meanwhile, traffic on the Mumbai-Pune Expressway's missing link has reopened after an 18-hour disruption. Now, traffic on the Mumbai-Goa National Highway has also been disrupted due to the heavy rains.
Well, that's all we have on Power Breakfast today. Next up is Bazaar Morning Call.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Tuesday morning, we're coming to you live from the CNBC TV 18 Motilal Oswal studios. The rally continues It's a wet day once again, but not as wet as yesterday. Certainly not as wet as yesterday. And lots to talk about in terms of first quarter earnings upgrades, some good, some bad this morning. So all of it coming up. I'm Prashant. With me, my colleagues Mangalam and Reema. Guys, hi, morning.
Hi, good morning. It's been 4 good days on the trot where markets have been inching higher and higher. And for us, I think the big trigger is also going to be crude prices with Saudi Aramco announcing that big cut. And we'll talk more about it. So I think that's going to be a positive tailwind for our markets.
A bunch of positive tailwinds coming for us. And it so appears that, things are now finally falling into place. So the second half of the year, which typically does belong to India, outperforming. Will that happen or not is the big question. Last 4 days, we've gained about 600 points. Let's see what the next few have.
Absolutely. And the overnight handoff was positive as well. Remember, US was not trading on Monday, but it was trading on, last night. So on Friday, beg your pardon. So we had the US session from last night. NASDAQ 1% higher. And tech names led Monday's rise. AMD was the big winner, 6%, 7% actually, third biggest gainer as far as the NASDAQ is concerned. And, talking about tech, AI, etc., the big one out of Asia is Samsung. And Samsung has reported numbers for the second quarter. And numbers are actually pretty strong. Stocks, the last I checked, was slightly lower. But I think if you look at the rise in net profits, etc., it's the order of magnitude, and that's to be expected. Both Samsung, SK Hynix, etc., are the two champions. 60%, by the way, of the Korean stock market are these two names. ISM in the US, ISM Services Index was down a little bit in the month of June, but that's largely in line with expectation. Saudi Arabia, and as we were talking about, they've cut their main crude oil price for buyers out of Asia, and lots of commentary around this. Essentially, there's too much oil now. Suddenly, from little oil, it looks like there will be a lot of it. And that's the reason why you've got Saudi Arabia, which has decided to cut the price for Asian buyers. And of course, it's positive for big oil importers like India who do buy, get a fair bit of their oil from the Middle East. And of course, Saudi as well. NATO summit begins today. There's always geopolitical headlines. So that's basically today and tomorrow. Which we'll watch out for. Now, just to tie in the levels quickly here today, Nifty is, by the way, up over 1,000 points, actually about 1,200 points, I think, approximately in the last 1 month, just under the last 1 month. So lots of halts, stops along the way, but if you sort of total all of it, it's over 1,000 odd points or so. We got past the 24,300 level yesterday, and that becomes a support. Basically, if we manage to keep above 24,300, we are essentially on our way, as we put yesterday as well, to about 24,770 levels. That is the next kind of resistance here. And of course, if 24,300 breaks, the channel support is at 24,160. And if the 24,160 level breaks, we'll talk about it when that happens. That's basically the channel, the upward sloping, the lower bound of the upward sloping channel that we are on. So we'll see if the 24,160 really comes back into play. Then you're looking at slightly lower levels, and we'll discuss it. But for now, since the market's been pretty strong, large caps are starting to participate. HDFC Bank, etc., yesterday came back into the mix, and it's not just small caps and mid caps which are doing well. When people say, well, markets do well in the second half, in a way that they're referring, of course, to is large caps doing well in the second half, because mid and small caps have had no such problems of underperformance in the first half. It's large caps, and that's largely because IT and banks have not done all that well through the course of the first half of this year, actually for the last 1.5, 2 years or so. 65 points higher as far as the GIFT Nifty goes as we begin this session. Mangalam has walked across with the FNOQs and positioning. Mangalam, take it away.
If you're looking for the lucky number 7, today is 7 July, so 7-7 looks like a decent start. The only thing that we'll be tracking in the last hour of trade is the fact that there is weekly options expiry. Will that cause a bit of volatility or not? Yesterday was a 150-point gain, the GIFT Nifty indicating a 65-point uptick. Things are falling into place. Yesterday, the bulls actually gained control of the market. Nearly 2/3% in terms of gain coming in for the Nifty, led by the Nifty Bank. And towards the end, we also saw a big move in Reliance, which crossed past its 20-day moving average. So two heavyweights doing well for the index in absence of any contribution coming in from the IT pack yesterday. Towards the end of trade, the mid-cap index and the small-cap index in particular picked pace as well. That was one of the outperformers yesterday, 0.75% higher. The important part, for the second day running, the FIs are buying in the cash market. So yesterday, the purchase was close to around 243 crores. At add to the 3,800 crore purchase that DII has made, it was nearly a 4,000 crore rupee worth inflow coming into our markets. While the market moved higher, the open interest on the Nifty came down by about 2.5%, and the same on the Nifty Bank increased by about 1%, telling you that the FIs were adding some long positions on the Nifty Bank and covering short positions on the Nifty itself. And that's exactly what data confirmed as well. Nearly 1,500 crore worth purchase in index futures. And if you look at their action out there were nearly 2,900 long contracts that were added, a large part of that attributed towards the Nifty Bank, and 6,600 short contracts which were covered, a net addition of nearly 10,000 long contracts. As a result of which the FI longs, which are still at 11%, over the last 3 trading sessions have increased from 9% to 10% to now 11%. More the market moves higher, more is the case for short covering. In fact, we saw that in index futures, but importantly in index options as well. If you look at it, ahead of weekly options expiry, the FI has covered a lot of short calls. So if you look at the FI index option selling, there were a lot of short calls that were taken out. 24,300 call, 24,350 call. All of them, saw a reduction of nearly 1.1 crore shares in open interest. The 24,450 call saw some writing at a premium of 44 rupees, telling you that maybe at 24,500 thereabouts, we may see some resistance, but support for the market has come higher to 24,400 put, 24,350 put, all of them telling you that around 24,300 is where the support is. And that's interesting because all of last week we were looking at 23,800 as the first support. That moved higher to 24,000 and now 24,300. The only two things that we'll be monitoring, one is the put call ratio is overheated at nearly 1.4, and the second part is that the India VIX also is factoring in some sort of complacency sub 12. So those are two levels that I'll track which may cause a bit of volatility in the market. Were that not to be, the road to 200-day moving average on the Nifty, which is closer to the 25,000 mark, is pretty clear. So bulls are indeed in control.
Thank you very much for that. Let's get to the calls then on the equities. It's Morgan Stanley's Rhythm Desai, who says India's relative derating is cyclical, and with growth accelerating in the pipeline, it has the potential to reverse. With depressed trailing performance and foreign ownership, this could be very positive for Indian equities going forward. Morgan Stanley favors domestic cyclicals over defensives and externally facing sector. They're overweight financials, consumer discretionary and industrials, underweight energy, materials, utilities and healthcare. Rhythm adds IT services may prove to be the dark horse as the world turns to these firms to build AI applications and solutions. So that's a big call. IT perhaps could be the dark horse, according to Morgan Stanley.
It was the same thing, Rima. We had Rhythm on the sidelines of the Morgan conference. That was the headline back then as well. So we sat down with Rhythm, and he's been positive on the markets for a while. And IT dark horse was
the headline from
the headline. Yeah.
So reiterating that as we get into the earnings season later this week. William Lee, Chief Economist, Managing Director at Global Economic Advisors, is now joining in. William, before we get to the U.S. economy, the jobs, the Fed, did you have a look at Samsung Electronics' preliminary Q2 numbers? 130% jump in the revenues on a year-on-year basis. Even on a quarter-on-quarter basis, revenues are up 28%. I'm not talking about what the stock is doing. Stock is down. It's gone up 5x in the last 1 year. But at least as of now, companies are delivering on expectations. So what does this mean for the AI trade?
I think the memory trade is on, and I think Samsung has just given the evidence that really the hardware parts of the AI trade are solidly in place. The infrastructure build out is in place, and the uncertainty that we have, I think, in the AI trade is one where it's not clear where the AI infrastructure really needs to go in the future. There's a big challenge now that's coming from China in terms of what kind of models do you want to use? Is it the more economical and less advanced models, less complex models, less power hungry models that the Chinese are offering? Or do you stay with the leaders like Anthropic and Gemini in the US? And I think that will decide, where it is that the future infrastructure spending will go. If more toward the localized computing and smaller models, then I think we're going to see a lot more expenditures on the enterprise level instead of the data center level, because I think a lot of companies want to say, I want to own the model, I want to own the data, I want to own the infrastructure on which I am computing my AI tokens. And I think that there's a growing cry out there that talks more and more about the need for token security and information security. And I think that is probably what's ahead of us in terms of where the AI trade is going.
So you're clearly in the Alex Karp of the Palantir camp, William, just referencing that interview that took place on CNBC's Squawk Box. But let's get back to the U.S. Markets. And actually, the event I'm going to watch is SK Hynix listing on the NASDAQ later this week, because up until now, all these stocks did very well because there were such few options. There was a scarcity premium. And now you've got that $28 billion IPO, and many of the funds would already be owning them in Korea. And now you've got, money which has to be moved around into the U.S. listed. Just that's going to be a big event for semiconductors. But let's talk about the U.S. market. Now, you've been calling for a rate cut by the Fed. And the jobs data that came out last week perhaps is only adding to the conviction. 57,000 was much, much lower than the estimates. And even the prior 2 months was revised lower. What's the expectation now? And were you surprised how low the number was? We thought, the World Cup would boost the jobs number.
Not at all. In fact, I think that number still overestimates the actual number of jobs that are being created in the U.S. In fact, if you look at the other survey that the Labor Department puts out, which is it asks, instead of asking companies how many jobs did you put in place, the other survey is asking people, are you working or not? And that survey has been showing a decline in the number of people saying that they're working by about 115, 117,000 per month over the last 12 months. So when we look at the employment situation in the United States, it's not a very positive one. Now, I know that many of the FOMC members are really obsessed with the energy and tariff-related price increases that are going through the economy right now. And the hawks, I think, have become even more hawkish, which we'll see in the minutes when they come out later on this week. They've become more hawkish in preparation for the dovish offensive or the rethinking, I think, that the Chairman Walsh would be bringing to the FOMC. So I think that there's a lot of positioning going on right now within the FOMC to try to bolster the case for the hawkish tones. But I think the kind of rethink that Chair Walsh is put in place will I think get people to think more carefully about what data they can rely on. The kind of data that we've been relying on in terms of the employment survey, it's been revised by huge orders of magnitude multiple times, and so you really don't know until maybe the third release where the employment market is. So that means you're 3 months behind already in terms of where the data are showing the labor market. That is not acceptable in the 21st century monetary policy making. So I think those are the kind of thinking that Chair Walsh is trying to put in place, and I think the hawkish tones that we are hearing from the FOMC will gradually start to fade once I think people start to realize they need to reshuffle their frameworks, they need to reshuffle their data sources, and think carefully about how to achieve the 2% target.
But why? So you're saying even the jobs number that we're seeing is actually overestimating what is happening on the ground in the U.S. market, U.S. economy. Why is that? Is it on account of the AI-related productivity, that the headcount is flat, the output is going up? What explains this?
Not at all. I think the AI stuff is just starting to show up now. Most of the weakness in the job creation in the labor market is the post-COVID productivity gains that have been put in place as firms start to become much more capital intensive. They start to rearrange their production models. They rearrange their managerial models to be much more efficient in using labor. And remember, in the post-COVID period, there's a rush to hire expertise. And now that expertise, I think, is shifting in terms of what they really need. So people are starting to be reluctant to hire more people and trying to replace or replace the existing labor force into new positions that are being opened up as the new technology and AI start to put in place. So I think that the shuffling within the labor market is a little bit more nuanced than the gross numbers suggest. And that's why I think the lag in job creation is going to stay with us for a while, which means, by the way, that for the jobs that are being created, they're really in the low wage paying sectors, the service sectors of social services, healthcare, and leisure and hospitality. We're not seeing a lot of job creation in the high paying manufacturing and professional services.
William, thank you very much for joining in. Great conversation.
Thanks for having me.
Thank you. Moving on now, let me quickly tell you the interactions lined up on the show today. Coming up 8:35, we've got Manoj Menon of ICICI Securities to talk about the recent updates from the consumption space. 9 o'clock, Harshit Patel of Equirus Securities will talk on the defense sector and the Defense Acquisitions Council nod for procuring goods worth 52,000 crore rupees. 9:20, Sandeep Tandon of Quant Mutual Fund will be our market master for the day. Following that, we'll bring you a discussion around US tariff refunds at 9:35 with the management of Pearl Global and April Export Promotion Council, Sudhir Sekri. Towards the end of the show, Lata will discuss with Nishin Savate of Kotak Institutional Equities on what to expect from NBFCs in the upcoming Q1 numbers.
Right, a lot of stocks on our radar. We'll take a short break. On the other side, we'll get to the top 10 segment in just a bit. But let's tell you what we're looking at. OMCs, Reliance Industries, Titan, Kalyan Jewellers, Apollo Microsystems, all of them on our radar on the back of positive news flow. Some updates coming in on their quarterly numbers as well. Trent, Cochin Shipyard, Varun Beverages, Jubilant Foodworks, Blue Jet Healthcare are all stocks which are likely to open in the red. Welcome back. A quick check on Asia before we proceed. Kospi once again is selling off. Kospi has been a story of sharp rebounds and drawdowns. Yesterday as well, the Korean markets were weak, and today it's lost another 6%. Again, despite this, the index is still up perhaps close to 80% year to date, following the 75% rally that we had last year, but very, very volatile on the Korean markets. Also, perhaps what's weighing on it is Samsung Electronics, where the preliminary Q2 numbers look good, but the stock, I think, had sold off. Taiwanese markets, Hang Seng for now, holding up in the green, but the gains are not very large. Let's talk stocks then. As promised, our research team is standing by with CNBC TV 18's list of top stocks for the day, and we've got lots of ground to cover. So, Sonal, let me begin with you with the latest on oil and gas and what it means for the companies.
Okay, so it is a big and a positive news coming in for Indian refiners because Saudi Arabia has slashed the August official selling price by $11 per barrel. This is just for Asian buyers, and this is the deepest price cut that we've seen in over 2 decades. So that's the kind of price cut that we are talking about. It is also at a discount of $1.50 per barrel to the regional Oman or Dubai benchmark. So it is one of the cheapest pricing that we've seen in a while. Remember, Saudi Arabia is an important supplier for India. It is the third largest supplier of crude oil to India. If we talk about Q1, the import value is around $2.59 billion, or 16% of total India's crude imports came from Saudi Arabia. The biggest one, of course, is Russia, which is around 50% of total imports in terms of crude sourcing. Now, remember, ICICI Securities last week had indicated if crude oil prices remain at current levels or anywhere between $70 to $74 per barrel, retail margins will continue to improve and earnings profile for OMCs could change meaningfully over the next 12 months. So this is just in addition to those tailwinds that we've been talking about. So oil marketing companies and Reliance Industries could see some green today.
All right, oil marketing companies and Reliance could see some green today, but what we'll definitely see some green today is Titan. Solid first quarter update that is coming. The consumer business revenues have actually grown by 41%. And on Titan's base, if you're growing at around 39% for your jewelry business, it is much higher, and it is a lot higher than Kalyan Jewellers that reported their numbers right now as well. Tanishq, Mia, Zoya, Beyond, all of them growing 39%. Carrot Lane going back to growth ways as well, 42% growth out there. And not too bad from the watches and eye care business, both of them growing 23% each. International business, which Titan has been, pushing for a while right now, has seen 128% growth. And the company says healthy festive and Akshaya Tritiya demand during the quarter did well for them. Portfolio buyer growth has been in early double digits. Average ticket sizes grew in high double digits. Plain and studded jewelry clocked in mid-30s growth. But business was also led by coins, which continued its investment-led strong double-digit revenue growth momentum. The stock very close to its all-time high. But the important part also is that beyond just the revenue, this time around, the operational performance also will have an element of a benefit coming in, an exceptional benefit coming in because of the increase that we saw in customs duty. So all told, it is a pretty sparkling or shining quarter.
All right, Mangalam, thanks very much for that. Well, Trent also reported numbers, Mangalam, and here I think it's a bit subdued, isn't it?
It is a bit subdued. It's slightly softer than what the street was anticipating.
DMart gave us something similar.
DMart gave us around 15% growth. Trent has given us 19% growth. If you look at the others, VMart, V2 or, Bazaar Style, all of them grew in mid-20s and thereabouts. So Trent, the Q1 revenue growth came in at 19%, 5,666 crores in terms of revenue. The analyst expectations ranged anywhere between 20 to 22%. So there's a slight miss on those expectations. They've added one West Side store and 19 Zudio stores during the quarter. And add to that, if you look at the last 5-quarter trend, Trend has been saying that they'll grow around 25% on a compounded basis. The last 4 quarters have been disappointing. We saw some glimmer of hope coming in at 20% in the 4th quarter, but from there as well, it's come down to about 19%. And add to all of this, the stock actually has seen a rally of nearly 22% in the last 1 month. So couple all these factors, we will see some red on Trent today.
Okay, thank you very much. And that point about peers, smaller peers having done better is also well taken. I think VMart had a growth of 23% with an SSG growth of close to about 8%. And V2 Retail too had an SSG, same-store sales growth of 7.5%. Smaller companies, smaller base, but outperforming what Trent has done. Sudarshan now joins in with the latest on Cochin Shipyard.
So remember on 22nd of June, we had done the story about Cochin Shipyard OFS that government might come out with, and that time story was denied, but finally government has come out and launched OFS to sell up to 5.04% equity. Of that, base size is 2.52% and oversubscription option is 2.52%. Floor price, as we had mentioned in the story, it's at a discount of 6 to 7%. Floor price government is set at 1,400 rupees. Yesterday CMP was almost 1,507 rupees per share. OFS for non-retail portion opens today, and for retail portion it will open tomorrow. I'm going with red just because of the higher discount.
Okay, well, so thanks very much for that. Mangalam, it's back to you. More stuff. Kalyan.
Kalyan Jewellers, indeed. Decent quarter coming in for them as well. I mean, jewelry companies, you can't say any of them will have a bad quarter this time around. One, because gold prices are high. And when gold prices are stable, the buyer growth is high. So Kalyan as well, consolidated revenue growth of approximately 38%. Is it as good as Titan? Perhaps not. But then that's Kalyan Jewellers. It trades at a discount as well. Recorded same-store sales growth of approximately 28%. The international business for them grew at 35%. Remember, they have a larger West Asia exposure to some of the other peers, so which is why their West Asia business grew at 30%. The other parts grew a lot faster. Candere, which is the Carrot Lane equivalent of Kalyan Jewellers, the digital first, that also doubled year on year when it comes to revenue growth. So all these factors taking Kalyan Jewellers in the green as well from my side on that list. So good performance coming in. Titan obviously a shade better, but Kalyan Jewellers 38%, not bad at all.
All right. That's Kalyan for you, and busy day for Mangalam this morning. Apollo Micro is the other one. So there was a board meeting yesterday, and they've approved raising funds. Ria is here with details. Ria, morning.
Well, good morning. Apollo Micro has announced a preferential fundraise of 951 crores and also a warrant issue of 2,371 crores. This is both to the promoters and also to other investors of the company. Now, the issue price has been set at 416 rupees per share, which is nearly a 1.8% discount to yesterday's closing price. And in terms of the proposed allottees, the key names in terms of the non-promoters include Saint Capital Fund, Nautilus Private Private Capital, Tata Mutual Fund, Ananta Capital Venture Fund, as well as Opal Global Diversified Fund, which constitutes the key portion of the warrant issue. And there's also healthy promoter participation in the warrants issue. Chanakya Reddy Badam as well as Kanishka Reddy Badam will be taking 1.3 crore warrants each in this issue, which is a total of 2.6 crore warrants, and this is 46% of the total warrant pool. So there is healthy promoter participation in this issue as well. And although the company hasn't mentioned the use of the funds from this issue, there was a story yesterday done by CNBC Awaz wherein they mentioned that Apollo Micro may announce an acquisition of Premier Explosives, which is a company that operates in the industrial explosives and detonators space. And there is a board meeting scheduled for Premier Explosives on the 9th of July. So we may see some further details emerging after that.
Okay, thank you very much for that. Back to you, Jubilant Food and Varun.
Yes, we are looking at Jubilant Foodworks, so it's basically pizza and Pepsi. Let's talk about the update coming in from Jubilant Foodworks. Its consolidated revenue grew at around 14%. The domestic revenue, standalone revenue, is what matters from a street standpoint in terms of SOTP. That grew at 9.2%. And here's where the disappointment is. The Domino's like-for-like growth in the first quarter came in at 2.5%. And remember, the first quarter is typically strong for them because, one, you have the summer vacation, secondly, you have the IPL and all these sporting events. So to that extent, 2.5% growth tells you about the weakness that we've seen on account of gas unavailability and perhaps higher fuel prices as well. They added 58 new Domino's stores in the country and added 8 new stores in Domino's Eurasia. Out there as well, the like-for-like growth was down by about 1.3%. The company is typically guided for 5 to 7% like-for-like growth with 10% store addition every year, which implies a 15 to 17% revenue growth. But this time around, they've disappointed. So going with red on that one. And looking at Varun Beverages, an interesting development there where the company's Kenyan subsidiary, VBL Kenya, has gone ahead and announced that they will acquire Devyani Food Industries Kenya for about 305 crores. It's a promoter company. They will buy it for about 305 crores. Now, this has nothing to do with the listed Devyani International. It is a promoter-owned company, Devyani Food Industries, which is basically into dairy, beverages, juices, and packaged drinking water. It will deepen their Kenya's penetration and East African region business. They're preparing to launch carbonated soft drinks out there. And DFIL Kenya plant has a 52-acre land parcel built over 17,500 square meters as well. So basically, it's a good development from a business standpoint. They've gone ahead and acquired a promoter company. But the only thing that the street may perhaps be a slightly skittish on is the fact that they've gone ahead and acquired a promoter entity, which is not listed, for about 305 crores. So going with mild red, the stock was down 4% ahead of this announcement yesterday already. So let's see how that goes.
Okay, let's go across to Vivek. There is more fundraise and it's for Blue Jet this time.
Well, that's right. Blue Jet Healthcare is in focus. The company, along with its Q4 results, had announced that they had taken a board-enabling resolution to raise up to 1,000 crores. So now they've gone ahead and launched a QIP for a fundraise. So the issue size is what they've currently restricted it to is 600 crores, but there does exist an upsize option in case the demand is good and in case the company does want to go ahead and raise more funds. So now the indicative issue price is what we are looking at is at 506 rupees a share, which implies a discount of almost 10% to yesterday's closing. Going with a mild red, but what we're understanding from our sources is that the demand has been quite good. So it'll be interesting to see whether the stock does make a recovery after a gap down opening.
Okay, I think the Blue Jet, the book seems, from what I understand, is completely full. Enam is the sort of anchor investor, and there are others who have come in as well. So the issue has been oversubscribed. So we'll see how this one plays out. Well, Vivek, thank you very much for that. A quick recap of some of our stocks with positive news flow. So oil marketing companies, Reliance, Titan, Kalyan, and Apollo Microsystems are on one side, and stocks with negative news flow are Trent, Cochin Shipyard, Varun Beverages, Jubilant Foodworks, and Blue Jet on the back of that OFS. Thanks, guys, for it. Commodities in focus and action. Manisha is here with what is top of mind for her. Manisha, good morning.
Morning, Prashant. Thank you. I'll start with the crude oil prices. We're trading at a 4-month lows as the vessel traffic through the Strait of Hormuz continues to recover. Saudi Aramco is what we've spoken about already, where they have cut the Arab light price for Asia for the month of August by $11 a barrel. The last time they did that was in 2020. So after 6 years, and that tells you that the demand actually is weak and we are looking at a higher supply. And that is exactly what most of the oil producers seem to be doing right now. They're increasing volume and ready to sell at a lower price just to get some market share. And that's not just about Saudi Arabia, but we also have seen Iran do that. UAE has been increasing production. Iraq is doing the same. Iraq actually has threatened to leave OPEC on 2nd of August if their quota is not increased. So plenty happening in crude oil prices going forward as well. In the meanwhile, we're looking at the base metal prices as well rebound. This is as investors wait for the Fed June meeting minutes that's going to be coming out today. The U.S. jobs growth has slowed in the month of June, and the decline in crude oil prices have eased inflation concerns, and that in turn has been supportive. So whether it is about gold or silver, copper, zinc actually has outperformed the overall metal pack. Aluminum, for that matter, also seems to be trading in the positive in Asia right now.
Thank you very much for that, Manisha. We'll keep coming back to you since crude is a big story. For now, it's a break. On the other side, Manoj Menon of ICICI Security will join in to talk about the recent business updates in the consumption space and more.
Welcome back. The Kospi is now down about 6%, and the GIFT Nifty is indicating an up move of almost 65 points. This month so far in July, the Nifty is up 2.5%, the Kospi is down about 10%, and the previous week as well, we saw an outperformance coming in from the Nifty. Obviously, notwithstanding the outperformance that we've seen for the Kospi in the first half of this year, the GIFT Nifty up around 50 points. The big movers yesterday, which saw heavy volumes. Hormaz, as always, joins in with that data. Hormaz.
Mangala morning, and start off with the top 5 most traded ones in the Nifty 500. Just for the delivery perspective, you take a look at HDFC Bank. That was the most traded stock on the Nifty 500 yesterday. Close to 70% of those shares were traded that were marked for delivery, as the 20-day average is only 58%. The same is the trend for ICICI Bank as well. 71% of those shares are marked for delivery. 61% is the 20-day average. The Dixon, BSC, Kotak Bank was the only one among the top 5 whose delivery volumes at 61% were lower in comparison to their 20-day average, which is around 64%. And in fact, Dixon Technologies was one outperformer in yesterday's trade. The 5th straight day of gains for the stock, the biggest single day gain in 2 months. The 13,000 call option, that was second most traded option yesterday, 125% higher on the premium front there as well. Close to 13 lakh shares were traded on Dixon yesterday. The 20-day average is only 5.5 lakh shares. A third of those were marked for delivery, so close to 4 lakh shares compared to 20-day average of just around 1.2 lakh. But the stock closed above the mark of 13,000. The first time it did so in 2026. The last instance of that was back in November of 2025. Spoke of Kotak Bank, was among the top losers on the Nifty 500 yesterday. 3rd straight day of losses. In fact, it has now declined in 5 out of the last 6 sessions. The premiums on the 380 put option yesterday were up 124% as well. 3.5 crore shares were traded yesterday. 20-day average of 1.5 crore. 61% of those shares marked for delivery. And the delivery volumes at 2 crore shares too were double of their 20-day average. And the stock from its 52-week high is down around 16%. And lastly, SBI Life Sciences has a double-digit loss that the stock witnessed yesterday. The biggest underperformer on the BSE small cap index. Fourth straight day of losses. And the 24 lakh shares were traded yesterday. The 20-day average of just only 4 lakh shares. 31% of those were marked for delivery. So around 7.5 lakh shares for delivery. The 20-day average of 1.4 lakh shares. And although the stock is down around 20% from its 52-week high, is still holding on to a year-to-date advance of close to 17%.
Thank you very much for that. Helpful as always to find out where the momentum is in the market. Was in the markets yesterday. Mahindra Joshi of MarketSmith India is now joining in. Mahindra, lots of Q1 updates to chew on. Which one stood out for you?
Morning, Ripa. So I think the last 2 days, I think the banking pack has delivered a very strong update across, including the NBFC. And therefore, I think where a large part of the market expectation was that it might be very, very sluggish, I think the kind of growth dynamics that are probably seeping through for the system as a whole makes it very, very encouraging. The other one yesterday, again, I think Titan, very strong update in my opinion. The unorganized jewelry players and the large leadership stocks should, as we have always believed in our thesis, should continue doing well over the next few quarters. And therefore, I think banking and a few of these consumption-driven stocks, including FMCG, I think both Marico and Dabur, in fact, the updates that have broadly given were far better than what probably one assumed and presumed. Therefore, I think these pockets surprisingly have held up as far as Q1 updates.
Mayuresh, for something like a Trent, think some pressure today?
Morning, Prashant, possibly. And again, I think the entire perspective in terms of the whole dynamics of levers that they've probably put out over the next couple of months, probably in line with what the market probably believes and expects. The expansion that they're probably doing in terms of the studio stores, the West Side expansion as well, I think on track. And therefore, I think the market probably believes that Trent should probably outperform not just its guidance, but what the industry probably does by a long, long way. So to that extent, yes, a little bit disappointing, but let's see how it probably goes over the next week.
Interesting one. Mayuresh, I wanted your thoughts on the defense space because yesterday all these stocks were abuzz and, the Defense Acquisition Council approving acceptance of necessity for worth about 52,000 crore worth products. And then this morning, Apollo Microsystems is actually approving a fundraise worth 3,300 crore rupees. You've got decent updates coming in from Zentech as well, the largest drone propulsion maker in India when it comes to capacity. So do you think defense play has more to go from here on? And is there any particular pick that you like here?
Morning, Mangala. So I think structurally it still remains to be a very strong story, right? The order books remain extremely strong and robust, giving the revenue visibility for most defense companies, whether they're shipbuilders or core defense contractors and suppliers. The margins are pretty decent as well. And in a defense company, I think you will obviously find a quarter in an annualized year where I think there is some element of an execution miss or some issues that probably come through for various reasons for that. In that perspective. And therefore, I think from a structural perspective, I think they're very well placed. Let's not forget, Mangalam, kind of export opportunities that are also blowing up for a whole host of these players, where I think the markets are even better compared to what they probably deliver on the domestic front. And therefore, as a space, structurally, the story probably persists. I think a couple of stocks. One, I think solar industries is something that we continue holding in our swing portfolio. Our sense is that the consistency in numbers should probably continue. Albeit a miss in a quarter or two is probably expected. And Bharat Electronics is something that we continue owning in our trading portfolio. So our own sense is that these strong leadership stocks might actually continue their earnings trajectory on a very stable and on a stable state basis over the next.
In defense, it's almost as if many of these early investors, right, and I know a few institutional investors who kind of said, well, this is too much, this is too excessive, most of the ordering has happened. And now it is about execution, but prices. And this is, by the way, even before the latest round of run-up that we've had. But we had about a 1-year period of lull across the Nifty defense space. The index went back to the prior high earlier this year. And now, of course, recently, it's taken that out pretty decisively. So it's interesting what's going on. Mayuresh, any thoughts on Blue Jet? I don't know if you tracked this one. So they're basically two segments, market leader in one, which is dyes for your, CT scans, etc. And they've got a chemicals business as well. They've got a QIP out today. Pretty good response, I'm told, but I don't know if you have a view.
So I had looked at that 2 quarters back, but not really tracking it right now.
Okay, it's a small name in that sense. Fair enough. Got that. The other one, which is a bit of a sort of, it's a stock which did very well and then of course corrected quite sharply, is the solar pump story, right? And Shakti Pumps is the leader there. Has back, not 500, 600 or so. High was 1,000 plus. But again, ordering seems to happen. I think there was something over the weekend as well. Do you have any ownership in any of these names? Because we have a few listed names now.
So I think we don't own that. And earnestly, Prashant, I think the ordering will continue. There are very few players within this entire solar pump ecosystem. The government tendering and ordering happens. They do receive a decent chunk that probably comes through. But again, I think we've really not understood the kind of dynamics that probably go through. Working capital cycles, in my opinion, still remain very, very elongated for most players within the spaces as well. And again, I think the receivable positions, one really needs to track that because a large bulk of these orders are government-linked orders. The second aspect, again, is that the capacities that they're operating out of. And therefore, I think this entire scheme of things in terms of creating that operating leverage on the P&L in a far more consistent manner probably does not come through. And therefore, there is far more earnings inconsistency in a large part of these stocks, whether it's Shakti Pumps, Roto Pumps, as we see.
Okay, sorry. Stay on. Mayuresh, need to slip into a very short break. We'll come back. Continue chatting with Mayuresh, but we'll also be joined by Manoj Menon of ICICI Securities, who will be with us to talk about the business updates in the consumption space. Welcome back. Let's get in some more, stock ideas, news, brokerage views. Sudarshan is now joining in with the brokerage call of the day.
So 2 notes on Varun Beverage. The first one is JP Morgan maintains overweight call and target price is 565 rupees per share. It says acquisition of Devyani Food Industries Kenya implies EV to revenue multiple of 0.9 times, which is consistent with company's historical overseas acquisition range of 0.8 to 1.2 2 times EV to revenue. And it says acquisition provides company with immediate manufacturing and distribution capabilities in Kenya, but its ability to scale up and integrate these acquisitions will remain a key monitorable. CLSA maintains high conviction outperform and target price is 654 rupees per share on one averages. Next one is Mankind Pharma. InCred has initiated coverage with an ad call and target is 2,812 rupees per share. It says company is shifting from a volume and distribution-led generics model towards R&D and niche therapies, and it's a necessary change as the legacy growth engine has matured and BSE buy anchors move into specialty biologics. Last one is JSPL. City maintains sell call and target price is 980 rupees per share. It estimates Q1 volume growth at 11% year-on-year for the company, which suggests potential downside risk to company's sales target of 10.5 to 11 million terms. And also sharp correction in longs prices likely suggests EBITDA per ton should peak in Q1 FY27. It expects consensus EBITDA to be revised lower for FY27.
Right, Sudarshan, thanks a lot for that. So those are the brokerage calls of the day, but a lot of consumer updates over the last 3 or 4 trading sessions. Let's discuss all of them with Manoj Menon, who's the head of research, consumer analyst at ICICI Securities, who's joined us in the studios this morning. Thanks a lot, Manoj, for dropping by to our studio. You know, of all the updates that have come by, at least yesterday, let's talk about 2. Yeah. First, Titan, 41% growth in on that base, 39% in the jewelry business. And the second one is Trent. What do you make of 19% growth as against, you know, the expectations that the street had and the management's own guidance?
See, I think the biggest point, Mangalam and team, actually is that most of the updates I reckon as consensus positive, right? Would have surprised consensus positively.
Yes.
All of them, right, till now, right? And the one which is yet to come as well, right? And which is what our expectation is, right? So,
which is the one?
Kalyan, I think I just came in as we speak, actually, but yeah, it's kind of, you know, so yeah, 38%, right? So again, so it's been I would say an outlier sort of a quarter wherein almost all consumer companies are performing well, even to the extent of a company like Hindustan Unilever, which doesn't give an update, but the consensus expectation is anywhere between 9 to 11%. The important point to note is, if assuming HUL delivers that, this is going to be like almost in 3 years, the first time they deliver a double-digit revenue growth. That's the context to note, right? I mean, so it's been actually good. Now, the 2 companies you mentioned, Titan, very good performance. Trent, I would say a couple of percentage points lower than consensus. So honestly speaking, 19 and 20, there is hardly any difference. But then there's an embedded expectation that Trent will deliver 20-22%, versus that it's a tad, underwhelming.
In context of, the 20% stock price move that we've seen on Trent over the last month or so, versus the other staples which have actually not been crazy outperformers in the past. You know, the outperformance from a business standpoint works in favor of staples versus discretionary. Would you say that?
100%.
So your positive staples versus discretionary over the next...
No, we like discretionary, parts of discretionary, but at the same time, at this point in time, there are more staples which are, let's say, as you rightly mentioned, having got that, let's say, underperformance and the value opportunity.
So of the numbers that have come so far in the staples, what did you like the most? There's Godrej Consumer.
Godrej Consumer.
Okay, you like Godrej Consumer. And in the staples bit...
Just to clarify, it's not that we don't like a Marico, just that from a... see, there are two points, right? One is business, second is stock. Right, Marico, the business is absolutely performing well, but look, the context to note is that today a Marico stock is, let's say, 12% premium to Hindustan Unilever, which has never happened in the history, right? So from a stock point of view, it is Godrej over Marico.
Manoj, hi, good morning, and good to see you in person. So if one wanted to get exposure to the consumer baskets broadly, I mean, it's FMCG. It's one area, but there's so much. I mean, how does one do it? I mean, at this point, I'm saying for someone with zero, how does one do it? See, the consumer theme,
consumer theme. See, we have liked companies like Honasa Consumer, Indigo Paints, right? Without looking at which subsegments, etc. Right? These are all we look at first bottom up and then the top down, right? So, the bottom up, these are the names which are still have got legs to outperform. Second is if somebody wants to play a trend, right? Let's say next 3 years, etc. Liquor industry is one which I would say is currently having sort of a Goldilocks situation, right? A lot of opportunities, a lot of, let's say, rational policy changes by state governments, possibly more in the pipeline, right? If somebody wants to have a value sort of an orientation, the restaurant industry, the QSR, quick service restaurant, is completely beaten down. No one talks about it, And that's another aspect, right? Saying that it's not that we have some visibility that things are turning, but if somebody wants to have a contrarian view, the restaurant industry is something which one can look at.
Which in that pack? QSR?
Jubilant any day.
Jubilant is there.
Any day, because it's been an outlier, outperformer within the underperformance as well. I'm talking business again, not the stock, right? Stocks, everything is down 50%. But the point is, in the restaurant industry, it's kind of had its own sets of issues, challenges versus food delivery, etc., etc. I think there might be a turn in a year's time.
So Honasa, Indigo Paints, there's
Godrej Consumer,
Alcobev as a pack, the entire pack actually.
In Alcobev, the mid-cap Alcobev companies have far outperformed and now are comparable in multiples when it comes to United Spirits as well.
Correct, that's correct.
So how do you then play it? Would you still back the Radicos and Allied Blenders, or do you look at United Spirits now because they also have the optionality of that 18,000 crore coming in?
Yeah. What is 18,000 crore?
The RCB.
FTA, RCB thing. Okay,
RCB
on US.
yeah.
Okay, got it. I think that's a one-off actually. I don't think we're going to value that separately. From an industry tailwind point of view, I think we'll still back a Radico, ABD, and a USL as well. But the pecking order would be that there's See, end of the day, it's all about growth, right? The Indian companies have demonstrated very clearly in the last 3 years that they're able to create brands, and there is a value for it. And that we have seen over the long term that the market actually values anything new which gets created in consumption per se, because it's actually is accretive to DCF. It's still the Indian companies.
Do you think paints are in a Goldilocks scenario? Because they've undertaken price hikes of 12, 15, 10 to 15%, and now the entire raw material basket prices come down. So do you think paints
I wouldn't say Goldilocks, but I think this is an year of paints, which we have kind of had a point of view for a long period of time and no change in that whatsoever. I wouldn't say Goldilocks because the historical context of input correction means you're able to expand your margins. May not play this time, given that there are too many aspirants to be the number 2 here. The JSW Dulux Group, right? Or let's say Berger is already the number 2, or the Birlas, right, etc. Right? I think the ability to retain from a game theory point of view, the margins expansion scenario may not play out. So I don't think it's a case of a consensus earnings upgrade, but still this is a year of a volume recovery. And this is a year of some price growth as well. So which means that we are looking for a mid-teens revenue growth.
So who's the best place then?
In the large cap, it's Asian over Berger. In the smaller names, it's Indigo and JSW.
Sorry, on that Alcobev question, what was the pick, if you had to pick one name, Manoj?
It's Radico, ABD, those names. It's not that we don't like USL, but I think the Indian companies are better positioned from a business momentum point of view to continue to surprise consensus.
And in the consumer tech area, if you go there, what lots happening.
So I don't cover it directly. So my analyst Abhishek Banerjee, he's a perennial bull on Eternal.
Okay.
So and I'll
eternally bullish on Eternal.
I completely back him. So I trust his views and kind of so I respect his views. Completely back Abhishek on the Eternal view.
And what else does he like in that space, consumer tech?
He like he like the thesis of urban company and those sort of names as well. Apart from Eternal. Yeah, so.
Is there any stock which you're negative on or you would recommend and avoid? Because generally this seems to be a good period for consumption.
Yeah, so it's a rarity actually. Colgate has been one name which we not liked for a long time. And things have turned in the fourth quarter.
Yes.
But still, I think the recovery seems to be a weak one, right? So I think, let's say from a hedge fund point of view, you need a funding shot, right?
Yeah.
It's still Colgate.
All right. I wanted your thoughts on one name, which is Britannia, because there's a leadership change. There's, serious underperformance that has taken place over the last few quarters out there as well.
Yeah.
So what do you think of Britannia? And finally, the second-rung FMCG companies. You have the top tier that we speak about, and then there is the Jyoti Labs, the Bajaj Consumers, and the Imamis now increasingly of the world. So in that pack, if you have a thought, and then on Britannia.
Yeah. So see, we have liked Britannia, and we have been wrong. Okay, so stock is down 10%, let's say from 5,800 to 5,300, right? So it's not that we could see it. What's actually happening in the market currently, and part of the business market, I mean, right, on the ground is that parlay is extremely aggressive when it comes to below the line spends, right? And that's something hurting Britannia. Now, we have liked Rakshit, what he has done in the past, right? Because I've known him, from his Nivea days, kind of, so I've seen what he's done in Nivea, then in Birla Opus. Then there is an expectation that he will do magic here, right? And that view has not changed. It's just that the external context of competitive activity, which is uncontrollable from Britannia's point of view, is playing out currently. And we believe that's finite, right? It probably will last for 6 months, 1 year, whatever, right? But there is a problem Britannia is facing, which is, hyper competition from a large player, right? Smaller names, I can't generalize, right? Kind of, for example, you mentioned like Jyoti and Bajaj Consumer.
In the same.
Yeah, so in the same basket, Bajaj, there's a leadership change and kind of they've done well and etc. Right? So, see, Jyoti Labs is getting to zone of deep value, right? But at the same time, it is also faced with a scenario in which the largest competitor for them is Hindustan Unilever, which is currently focused significantly on volumes. And that's a challenge for a small company to surmount when a large player with size and scale focus on volume to outperform. So it's a market situation similar to Britannia, actually.
By the way, I've got a message from someone saying that good to see two Mallu speaking not in Malayalam.
Okay.
But
there's a Mallu, and there's a Malu.
There's a Malu. Manoj, so talking about, sorry, did we chat about Mangalam Bata?
We haven't spoken about Bata.
Because there's management change afoot there. And management changes can be pretty consequential, especially when the business has not done well for a number of years, and there is, the rate of change can be fast. Any thoughts?
See, Bata, to be, when you think about it, right, kind of, they have actually seen multiple management changes for the last few years, and I think it's a classic case of a very difficult business, which even a great management has not necessarily managed to kind of surmount that challenge, right? Kind of, as Warren Buffett says, right? Kind of. So I think the context is that until proven otherwise, we will still maintain a neutral sort of a thought process here.
All right. Just final HUL target for this year?
2800 is our published target, as I recall. I don't exactly know the number, but I think it's still 20% higher than where it is currently. And as I said, so we are bullish on HUL, we are bullish on Asian Paints. We are also bullish actually at the margin on DMart. So there are companies, by the way, at the margin which benefits actually from a slightly higher inflation versus what it used to be. Right? These three players actually got a tailwind.
All right, take that point. Always a pleasure, Manoj. Thank you so much for stopping by in our studios.
Do drop in more often.
Do drop in more often.
Thank you.
Thank you.
Right. We'll take a short break on that note. Come back with the pre-opening. Also with us will be Harshit Patel of Equirus Securities to discuss the Defence Acquisition Council's note for procurement worth 52,000 crore rupees. We'll also have our tech experts Sudarshan Sukhani and Mitesh Thakkar joining in for some trades.
Welcome back. We've got about a few minutes to go before the pre-opening rates come in, and we're in conversation with Mayuresh Joshi. Mayuresh, one stock that you'd like to highlight for today's trade from an investment point of view?
So, Deepa, I think one of the recent additions that we have done is Usha Martin. Our own sense is that the revenue growth has been steady state, mid-single digits, but the margin expansion has been quite significant on the year-on-year basis, 19.1% in FY26 compared to 17.8. So I think there is significant margin expansion happening. The second element in terms of wire rope, which remains the biggest business segment, and wire volumes have also increased quite significantly, seems to be on a steady state basis, and the volume should increase quite significantly. They've managed to navigate the input cost volatility, and therefore I think on an EBITDA per ton, They exited FY26 with 34,100 odd rupees, which should be consistently maintained if we don't see volatility in prices. And again, from a balance sheet perspective, they were in a net debt position in FY25 at 65 crores, turning to a net cash of 332 crores, with leverage playing in. The ROEs are at 17%, which means our benchmark at markets with India, and ROEs at 20%. The end user industries, surprisingly, I think it's engineering, oil and gas, grains, construction. I think that is where all the business elements will come through. Europe is 26%, Middle East 9%, America is 9%. I think significant accretions to order flows with better margin orders might start flowing in the next few quarters. I think Usha Martin is something that we've recently added.
We'll leave the conversation here. Mayuresh, thank you very much for joining in. Usha Martin is a stock that he's looking at. Asia, by the way, continues to slump under pressure. The Korean market's down 7%. Now the Japanese markets too, which had opened up on the flatter side, are seeing a cut of about 1.5%. Taiwan, last time we checked, was on the flatter side and still pretty flat for the Taiwanese market. For our own markets, we've been making higher highs and higher lows for the last 4 consecutive sessions, and generally that's a positive side. And in the last 4 days, markets have added about 550-600 points on the Nifty. Perfect time then to tell you what should you do if we have a gap up opening. Sudarshan Sukhani and Mitesh Thakkar are now joining in. Gentlemen, good morning. Thank you very much for joining in. Markets have been in a good groove. So Sudarshan, you go first. What's the trading approach?
Yeah, good morning. Well, the trading approach is to be on the long side of the market, buy the Nifty. The only question then is, where do you buy the Nifty? And gap ups are not good points to buy. During the day, there are intraday dips and sometimes a process of consolidation. So we wait for that intraday dip and go long. If you have positions, maintain those positions. We are going to likely see a significant outperformance in the Nifty versus world indices. So be on the long side.
Stay long. Mitesh?
Good morning. So, yesterday what was important was that the Nifty finally closed about this 24,300, 350 zone. I think the next target area could be 24,600, which is where the market made a high on the 21st of April. And there's a chance that we might eventually get beyond that to about 24,800 as well. So, again, the idea is to remain positive and trade with more of long highs.
24,800, that's the level Mitesh is gunning for. So that's a good 450 points higher from where we are currently. Mitesh, what stocks would you go with?
Yeah. On the stock side, I have 3 buys and a sell. And on the buying side, a lot of FMCG names. I was just hearing the discussion as well. Dabur has reversed after a correction. So Dabur is a buy with a stop below 440 for targets of 470. Buy on Colgate with a stop at 2055. Look for targets of 2130 here. And a buy on Bajaj Finserv with a stop below 1849 for targets of 1910. One sell call is Kotak Bank. Yesterday, I think there was a negative announcement news flow, and the price also gave a breakdown. So sell if you can get it on a minor bounce, say around 384. Sell with a stop at 393 half for targets of 365.
Got that. Colgate was actually, technically, Mitesh sees strength in it. But when we were chatting with Manoj of ICICI Securities, while he's positive on the entire consumption basket broadly, it's going to be a good year. Colgate is one stock that he is negative on. He's been negative on. And he said that Q4 was looking up. There were positive signs, but he called it a weak recovery. Sudarshan, what are the stocks that you would go with?
Well, it's again, the charts are sometimes different. And I also have Colgate in my buy list. Colgate is a buy with a stop under 2040. Prestige is a buy with a stop under 1665. I have 2 short sells because we are long in the Nifty and want to buy the Nifty whenever possible. So these are essentially hedges. Havells is a sell with a stop above 1205, and Kalyan Jewellers is a sell, but be careful on that. Wait for the opening first. Is a sell with a stop above 390.
Okay, all right. Both Sudarshan and Mitesh, good morning, and we'll speak again at 9:10 with some more calls coming through. Well, I think, defense is one area which continues to do well. The Defense Acquisition Council has given approvals for, acquisition and ordering worth about 52,000 crores across the Army, Navy and Air Force. And the trickle-down effect is at play. At least the market is trying to spot winners in terms of who is going to get these orders. Harshit Patel is Director at Equirus. He's with us now. Harshit, good to have you with us here. Thanks very much. Good morning. Can you talk to us to begin with, specifically on this latest DAC approval at this stage? Where does this go? Which companies benefit?
Yeah, I think India's defense ecosystem has been quite active in this regard. Even in FY26, we saw the AONs worth more than 6.5 lakh crores. And this has been the highest ever, which has been registered in the Indian defense ecosystem. Even the beginning of FY27 has been quite good in this regard. Now, coming to this specific 52,000 crore approval, I think the key one was that anti-UAV, electronic warfare system, which has been named as Akash Taran. Now, here in this regard, there will be many private companies who will be competing along with the PSUs. I think from the PSU perspective, the Bharat Dynamics will be among one of the key beneficiaries who will benefit from at least 3 different names in this 52,000 crore list. The first one would be the man-portable ATGMs, where BDL along with maybe Adani Defense would be a production agency. They will also benefit from this Vishorad. There also, I think they will join forces with Adani Defense. Another key approval from Bharat Dynamics perspective would be the MIGM, which are nothing but the naval ground mines. So from the listed companies perspective, I think Bharat Dynamics would be the one who will be a key beneficiary of this particular round. But nonetheless, I mean, the approvals over the last 4 to 5 years have been pretty strong, and they are going to benefit the ecosystem across Army, Navy, as well as Air Force, the key suppliers of all these 3 armed forces.
Who else is in the anti-UAV electronic warfare, which is basically protection against hostile drones? So Bharat Dynamics, you believe, is a beneficiary, maybe the key beneficiary. But since this is an emerging space, which will continue to get orders going forward as well, can you list out all the players for us? And how significant is it as a percentage of the overall order book?
All these approvals which have been announced, I think these approvals will have a very high share of electronics components, because the way the whole warfare is going, and we have seen how the US-Iran war panned out, what is happening with respect to Russia and Ukraine. I think the whole network-centric warfare, that is the key going forward. And within this kind of warfare, your long-range strike ability, that comes into picture very effectively. So all these plays on unmanned aerial warfare as well as the anti-UAVs and the long-range missile strikes. I think these are some of the key areas which are going to benefit eventually in the long run. The strongest play on electronics content increasing in all these platforms, whether these are fighter jets, or submarines, or electronic warfare systems, or UAVs. I think Bharat Electronics sits at a very favorable area, at a very favorable position. And now they are taking up a role as more and more of a system integrator, and not just a product or a solution supplier. Even the ecosystem around them, including both publicly listed companies as well as a lot of private players, that is building up very nicely. So we have seen companies like Apollo Microsystems, Astra Microwave, Data Patterns. Even these companies are now taking up bigger roles, from just product supplier to a larger integrator like a Larsen or a Bharat Electronics. They themselves have started taking larger orders as well. So I think this whole electronics integration for all these platforms, this is one key area to look out for. And these companies will benefit not just from this particular AON, but whatever has happened in the last 3 to 4 years, because majority of those AONs will now get translated into the confirmed orders over the next few months and the next few quarters.
Absolutely. So, what you're referring to is avionics, right, Harshit?
Yes, avionics as well as electronic warfare systems. So these are the two subsystems we will take more of a central stage.
So here there is, in the PSU space, the best placed is BEL, and the private sector, it's Data Patterns.
Yes, the likes of Data Patterns, Apollo Microsystems, Astra Microwaves, these are the companies I think which should do really well.
I see. Any thoughts on, the Astra Micro, of course, approved raising money, and what we Sister Network reported that they're going to, they are looking to buy Premier Explosives. Any thoughts on it?
No, yeah, we saw that announcement. However, I would refrain from making any qualified opinion on that since we do not have an active coverage on that.
Got it. What about Paras Defense? Do you have any thoughts on the company?
Again, a very similar opinion. We like the product profile, how they have developed the whole solutions portfolio, and how nicely they are placed in the emerging relevant ecosystem. So from that perspective, we definitely like that name. But again, we would not have an active coverage on that company. From our active coverage perspective, we are bullish on Hindustan Aeronautics, followed by both Bharat Electronics as well as Bharat Dynamics.
Bharat Dynamics. Got it. And you have coverage across on the shipping side, Mazgaon and the others?
Shipping, yeah, we follow, but we would not have an active coverage. From active perspective, we would have HL, BEL as well as BDL. These three companies.
I see. And how are broadly? I mean, the stocks under your coverage, but otherwise as well. Are valuations now very high? And what's the sense?
Yes, valuations are now at least 1 or 2 standard deviations above the last 10-year mean. However, we believe Bharat Hindustan Aeronautics is one company where the valuations are palpable, where a lot of negatives, both sentimentally as well as operationally, they have already played out. And we will see a very strong earnings growth, both in FY28 and FY29. Because a lot of large programs like LCA Mark 1A, HTT-40, LCH Prachand, Sukhoi 30, all these programs will be under execution simultaneously. So while FY27 could be an okay year, I think next couple of years will be extremely strong for HL from the execution perspective. And since the stock is available at very reasonable valuations, about 25 to 30 times EPS, FY28 EPS, I think we believe that the risk reward is extremely favorable for that company. Hence, that would be our top pick within the defense space at the current juncture.
Got it. Thanks very much, Harshit. Appreciate you joining us. Good conversation. And thank you for being here. Well, I think 9-10 calls. There's about 4 minutes to go for market open. Sudarshan is back with us, and so is Mitesh. Sudarshan, what's your pick? And I think we've seen the pre-open. Your trades?
Yeah, it's Colgate. Buy Colgate with a stop under 2040. Pre-open is very tepid. Wait for a significant dip, 100-point dip if you want to go long in the Nifty.
Yeah, tepid 14-15 point change on the Nifty. What about you, Mitesh?
I'll go with the buy on Dabur for targets of 470.
Okay, consumer, FMCG, Colgate and Dabur from Sudarshan and Mitesh respectively this morning. 4 minutes to the market open itself. Let's revisit some of the names we highlighted in the morning. Titan, Mangalam, take it away.
Solid update coming in from Titan, no two ways about it. The overall consumer business growth has been around 41%. If you look at the mainstay of the company, that's the jewelry business, that's higher by about 39%. A large part of that obviously would be price-led, but this time around, even the buyer growth and the average ticket sizes have increased. There are, larger contributors out there. Tanishq, Maya, Zoya, Beyond have grown 39%. The faster growth business, CaratLane 2, has grown at around 42%. The other parts of the overall business, watches have seen a 23% growth. We've seen a 23% growth in their eyewear business as well. In the international business side, where the company has been having a strong focus, they acquired D Damas as well, All of that put together has seen a near 128% growth, and the company attributes this to healthy festive season and Akshaya Tritiya demand during the quarter. Portfolio buyer growth was in early double digits. Average ticket sizes grew in high double digits as well. While plain and studded jewelry clocked growth in mid-30s individually, coins continued its investment-led strong double-digit growth momentum. The stock, already at a record high, opens about 1.5% higher. But before we go on further, look at Trent as well. In pre-open, it settled about 7.5% lower, and a large part of that could be attributed to the fact that the stock had rallied about 22% ahead of its fourth quarter's update. And this time around, the revenue growth of the company has been 19% versus street expectations of 20 to 22%. Let's also look at Cochin Shipyard. Sud joins in with the updates there. Sud.
So in 2026, so far, government has raised more than 25,000 crore via stake sale in PSU companies, including Cochin Shipyard. It's the 8th company that government has brought in OFS, and some of those companies are Coal India, BHEL, NHPC, Central Bank, IR, FC, NLC, and GIC. Talking more details about Cochin Shipyard OFS, government is looking to sell up to 5.04% equity. Of that, 2.52% is the base size, and 2.52% remaining is the green shoe option. And floor price, 1,400 rupees per share, which is a discount to 7% to yesterday's closing price. For non-retail portion, OFS opens today, and for retail, it opens tomorrow.
Okay, thanks very much for that, Sudarshan. Let's just take a quick look at the stocks which we have put out over the last 1 hour or so. So these oil companies, HP, IOC, BP, Reliance, I mean, they're all up this morning on the back of that news that Saudis cut their price, which they charge buyers out of Asia. Titan, 1.5% solid update. Kalyan is down 5%, though the update is pretty strong. Cochin Shipyard, the OFS, 3%, 3.5% down. Varun Beverages, 1%. Jubilant is absolutely flat, 0.25% higher. There is Trent, and I was talking about Trent in the morning as being the casualty maybe, 7.5% lower. Let's see if we, after a 7% lower start, it stays that way, or there's buying which comes in. And of course, I think there is Blue Jet and Apollo Micro, etc., which we will get to in just a bit from now. The first rates on your screens, and the market open on the indices and elsewhere. So 24,400, 24,440 on the Nifty. It's 0.06% in the green. Nifty Bank is up 0.13. The small cap index is flat, nothing on it. The mid cap index is absolutely unchanged as well. There's a 10-point change on the Nifty mid cap index at this point in time. So it's a tepid start on the Nifty at least. Let's just look at the Nifty 50 heat map straight up and how stocks are starting before we go any further. There is Trent, which is by far the biggest loser on one end, and JSW Steel and Hindalco are the others. It's kind of evenly split between gainers and losers. On the gaining side, there's Titan Eternal, HDFC Bank. HDFC Bank, of course, with a 3.5% pop, was the top Nifty gainer yesterday, and it's being counted as one of the gainers this morning as well. Prima.
Well, it's a trend. It has a 1% weightage on the Nifty, but it's dragged down some of the other consumer names. So Tata Consumer in the red, Nestle in the red. Other than that, it's metals which are selling off. The Nifty Metal Index has a cut of close to more than about 0.5%. So that's dragging. You've got a JSW Steel, Hindalco, Tata Steel. JSW Steel has a cut of 1.25%, while Tata Steel and Hindalco are down nearly 0.5%. We were all hopeful that perhaps the fact that Saudi Aramco is now selling crude to Asian consumers, buyers at a $11 discount, it's not really helping sentiment for either an Interglobe Aviation or paint companies like Asian Paints. These stocks have opened up in the red. BEL is correcting after yesterday's recovery. But as I said, it's Trent, which is down now 10%. Mangalam was earlier telling us it had rallied 22% in the last 1 month. So that froth is coming off as earnings didn't meet expectations. On the way up, buying is visible in Shriram Finance. That's your big gainer. HDFC Bank continues with its gains from yesterday. So that's up more than half. Eternal, the weakness in some of these consumer staples names is countered by the strength in Eternal. Infosys seeing buying. Eicher Motors, HCLTech, Bajaj Auto, SBI Life, Max Healthcare are some of the other stocks. But it's not quite that bumper list, opening that we were anticipating, Mangalam. In the morning it was 100 points and 60 points, but the gain is just about 25 points, so fairly tepid.
Fairly tepid, but not necessarily a bad one, largely because, if it is fairly tepid, then bulls do get a chance to enter. At the same time, we've already seen a 570-point rally over the last 4 trading sessions. Good times for the put-call ratio to actually moderate before the market moves higher. The good part this morning, however, is that IT is bouncing back. The IT index is up by about 0.9%. And typically, if the IT index bounces back and we see some traction coming in from, or some support coming in from the Nifty Bank, we're probably likely to move higher from here as well. Shriram Finance, obviously the top Nifty gainer. We're seeing some traction on Infosys as well. The interesting part, however, is that the street did not like that Kalyan Jewellers grew slower than Titan, despite it having grown about 38%. This is the first time this has happened in the last 10 or 12 quarters that I remember, where Kalyan Jewellers' reported growth rate has been less than that of Titan, and which is why that stock is down about 6%. We are seeing some decline in Cochin Shipyard as well, down about 3.5%, largely because of the government offer for sale, which has come in. And then alongside that, we are seeing continued traction on the way up on RITES. The order win of nearly $35 million doing well for that stock, up around 6.5%. Kirloskar Oil continues its one-way up move, has doubled this year. Brokerages are positive. The management has given good updates as well. And that stock too, for starters, has gained about 3.5%. Kalyan Jewellers' weakness has actually taken some of the other jewelry stocks lower as well. PC Jeweller, a single-digit stock right now, down about 4% at the open. We are seeing some decline in Cyient as well. And the biggest casualty of the day remains Trent by far. It's down about 9.5%. If one had to look at just one stock that's making the news of the day, it has to be Trent.
Absolutely. And Trent is the casualty, as we're pointing out. 1,200 stocks are higher, about 1,200 stocks are lower. So, by the way, even yesterday, while the Nifty was up, the market breadth on the NSE, on all stocks which traded on the NSE, was negative. This morning as well, we are starting with about a 1:1 kind of a move on the advanced decline ratio. Put up, the stock called AEQUS, AEQUS. They're an aerospace component manufacturer, and it's recently listed. I think not even a year old, definitely not a year old, but 6 months plus. And I think there's a Novama note, and they're pegging 400 plus kind of targets on AEQUS. We covered it pre-IPO. Our colleague Madiha covered it from the ground, and we had them, around the time of the IPO, and it's already doubled, by the way, from the listing, from the IPO price, and there is more which is coming through here. That's the opening at this point in time. Let's just put a Blue Jet as well. There was that block. Blue Jet is should come up. It's nothing, right? I mean, the 10%, as I was saying in the morning, strong demand. The fundraise has been oversubscribed. Enam is the anchor investor here, but there are many others who've come in and put money in as well. So 566 on Blue Jet Healthcare as well, despite a 10% discount, which it got mopped up essentially. Zentech, some of the others which are coming through. Large move in Ramco Systems. That's the only one I can spot with significant gains and significant price moves as well. And what a absolutely stellar mover it's been. 400 rupees, by the way, at the end of May, and stocks basically at 950 in a month and a couple of trading sessions. So from 400 to 950. That is Ramco Systems for you. 1 million shares coming through on this one. Ganesha Housing is another one which is up about 9% this morning. Kirloskar Oil Engines, there was a brokerage upgrade. We had the management with us on they talked about that hyperscaler data center opportunity, etc. 4% yesterday. The stock was up about 1.5% as well. So that's the overall picture right now. Let's welcome in Sandeep Tandon, who's with us, founder and CIO, Quant Mutual Fund. Sandeep, good morning. Great to have you with us here. Thanks very much for joining us. 1,000 points, Sandeep, and from the recent lows, basically in less than a month on the Nifty, and there's always this hope that the large caps will perhaps be able to start to perform and keep and match up with what mid and small caps have done, because the underperformance has been in large caps. You would agree. What's your prognosis as you look ahead?
Frankly speaking, Prashant, we have opinion that worst is behind us. So if worst is behind us, then it becomes a very stock-specific opportunity, because what is happening over a period of the last many quarters lot of negativity is there in the subconscious mind. People are still not convinced about this rally, and everybody's looking for some excuse or other because obviously India has underperformed. Now we have said the beginning April that is a time for India. India is coming back, and if global market corrects further, which we have opinion that US market and even Korea, Taiwan market will correct significantly from these levels. If I have to talk about next 2 quarters or so, then obviously India will be a winner in that. We have to look at both from absolute and more from relative perspective. So relative perspective, I think things have improved for India. We have seen FIS selling exhaustion. The participation level from the various FIS inquiry has increased significantly, which means they are coming back. And again, they have advantage of in putting money overseas. Now, on relative basis, this looks more attractive, so they will sell some of these markets and come to India. But I think the background is more constructive and very stock specific rather than getting too much worried about what is happening in terms of index level. I think index will not give you a real flavor of the market. I think stock specific approach will give you far superior returns.
Which has been the case, right, Sandeep, already, and which is what is happening. I guess in a way the question when we say, well, large caps will they start to do better, is actually just really two sectors which you're kind of referring to. One is private banks, which has seen underperformance, and the other is IT services, because the underperformance in large caps is because of these two areas. So the question really is about those two.
Apart from these two, even energy stocks have underperformed. So it's a combination where basically, if I have to say, the top 10 names have underperformed, okay, and within the Nifty. And that is the challenge. But I think there also I see good amount of bottom fishing opportunities there. They have corrected a lot. Even if you talked about private sector bank, they have corrected a lot. So there could be a bounce from the current level. Answer is yes. In fact, it's going on. But can it sustain? Which I have my own doubts. Okay, so I'm not a very big bull in banking stocks from the current level. These are the game changer thesis. I think something has changed. You have to look at asset heavy businesses where you have cash flow generating ability, large capex is going on. That's where the FIS trend is now. If you look at all the recent infrastructure related QIPs, the buying interest was very large. And we have seen many FPI names are buying these names. Okay, so I think money is actually moving out from these top 10 names to some of the defensive name. And that's the reason I said there's opportunity, whether you talk about ports, airport, roads, or large infra names, power companies, some of the renewable names. So these are the area where FI have a lot of interest in India. So I think let's focus on these segment, and that's one of the reasons we are very skewed toward this sector. Maybe data center could be another story, irrespective of what is happening in Korea, Taiwan in the recent times.
Sandeep, hi, morning. And I think your portfolios across various mutual funds are also reflecting that. I can see the addition of Adani Energy Solutions in the Quant Midcap Fund, Adani Enterprises and Adani Green Energy in the Quant Small Cap Mutual Fund. So you're clearly bullish on the Adani Group in the hard asset space that you were talking about earlier. Where from here now? Is there still more money? Because I remember our last conversation, you clearly said the pecking order is micro caps over small caps, over mid caps, over large caps. And that's been vindicated. In the first half of the year, micro caps are up 12%, small caps up 9% at a time, when Nifty is still down 5-6%. Would you still be bullish on small caps?
So selectively, yes. In fact, I will say mid caps stocks are relatively more expensive because given the nature that only 150 stock qualify for that basket, and hence everybody chases that. And one of the reasons they have been expensive, and they have potential to remain expensive from longer term perspective because of this technical factors. But if you're talking about only small cap and micro cap, I think opportunity is far deeper out there. You have multiple such names available, but we have to look into these companies more closely because we have challenges on the management quality or sustainability of the cash flow. So one has to be very selective, but there are opportunities. So we are also actually looking for some of these opportunities. It's not easy to identify, but there are opportunities.
Right. Sandeep, sectors that have underperformed lately and are suddenly looking either value attractive or maybe the environment is becoming a lot more conducive for them. One of them is IT. Everyone's just now talking about maybe it's corrected far too much for the growth prospects from here on, or at least the earnings prospects from here on. So what are your thoughts here? And the second part is the consumer staples business. 3 years of underperformance. Now, a little bit of inflation, the street believes, could do well for them.
Frankly speaking, now IT sector, which we have been quite bearish for a while now, looks attractive. They are now in the neglected zone, which we typically look for a buying opportunity. And that's the reason we have started nibbling into it, but very selectively. But if you ask me, this is a time to go all in and this is a time to take very big contra and aggressive call in IT, then the answer is big no. Okay, because data points are not suggesting that one should take that aggression. Yes, they have underperformed, they have underdelivered the market, and it's opportunity. You can rebalance your portfolio to a certain extent, but you cannot have a very skewed portfolio towards IT. That's a broader thought process which we have on IT. As far as FMCG is concerned, yes, they have also underperformed for last many quarters. I think something is changing out there. So I think FMCG of the companies also, these are more of a trading opportunity because they are still very expensive. So it's not like they're becoming suddenly very cheap. They are expensive when we buy. Maybe that's the way we can look for only from a trading opportunity in these names. And very selectively, you can buy from a core holding or long-term perspective. Yes, there are few opportunities, but we cannot generalize that because sector is definitely trading at significantly high P multiples also.
Right. So at this point, if the portfolio were to have a skew, according to you, what would lead to the outperformance or at least, alpha generation from here on over the next 6 to 12 months?
I think my thesis still remain the infrastructure is one big theme which we are looking at. We talked about earlier pharma, which has delivered quite well. And I think infra as a theme, power as a theme, maybe some of the energy companies can come back from the current levels. So I think that's an area where we are looking for, where good amount of capex is going on. And this is the only area which we see large capex, both from the private sector as the public sector side. I think capex numbers are reasonably large. I think growth is there. You have to look at growth, not at any price, growth at a reasonable price, grossly under own name, yet to discovered by most of the foreign houses or the brokerage houses. In fact, a lot of people even don't cover some of the names. I think these are the areas where look for opportunity. When it becomes fully discovered, fully valued stock, there is no upside, and which is the challenge we have seen in the banking sector or the IT sector in the past. So I think I'm as a house, we are very clearly looking at under-owned stocks, under research stocks sort of thing. It's very difficult to say everything is under research, but definitely under ownership or hated zone, where a lot of people don't like to participate in some of these names. They say these are untouchable. So I think those are the areas the mindset has to be changed. Wherever you see a cash flow driven opportunity, large capex opportunity, and somebody is able to execute very well, those are the areas which I'm looking at. Even some of the defense companies we like. So it's not like we are only looking at a very skewed structure. Telecom companies also looks very attractive from the current level. So utilities company also looks very attractive. So I would like to play a very different thing rather than all those stocks in last 2-3 years who have been in admired territory, who have given extraordinary returns. I think time has come where they will start underperforming and some of the neglected one will start outperforming, which is the already trend we have seen in last 3 months or so.
Sandeep, I absolutely take your point, but when we are seeing lots of what you described, neglected companies, turnaround stories, where business is being fixed, right? These are kind of special situations or whatever, not special situations in the traditional sense, but basically where there is a fix underway. Is that so? In that sense, what you described as admired companies start to underperform, and this is the less admired, and you use the word untouchables, start to kind of do well. And you are a big follower of market cycles, etc. What does it tell you? Where is this stage when you start to do all of this fit in a market cycle?
So if you really look at Prashant, if I have to take a much larger perspective in 2021, October, November 2021, we said this decade belongs to value as a thesis. That does not mean that entire 10 years value will only outperform. There will be patches where growth will also outperform. But the broader trend for India is the value. Okay, and if you really look at for value for India and Japan, these two markets particularly, which are more known as a value market globally, I think that's the area which we are focusing. So we obviously see some patches when some of the growth stocks also perform. So that's a big picture, a big trend, which is what we are following. And obviously, within the structure cycles, you will get those cyclical down moves or up moves. So we are to ready for that. And that's the reason I'm trying to look for opportunity. See, because you look at India as a growing economy, okay? Irrespective of noise, it is very diversified country, very diversified portfolio you have, number of stock which is listed. So you're not talking about 2 stocks in Taiwan, 6 stock in Korea, or some 10 names in China and some 20 names in US. This is not the case. So when we have seen last 2 years, particularly skewed structure was played extraordinary returns globally. And I think now people will come back and look for diversified opportunity because skewed opportunity has played very well. And that's the way the India fits the bill. So if you really look at, I'm not looking at in isolation, I'm looking at a combination. If you recollect our earlier thing, we talked about how crude will come back to 70. It has come much earlier than most of people expectation. In fact, a lot of people have 150 to 100 targets. Look at rupee, people are looking at 100, 120, all sort of levels were there. When you see these extreme targets coming into picture, best of the houses gave up virtually at the bottom of the cycle. You look at in last 2-3 months, maximum downgrade has come from India. So this is the very classic behavior sign that the bearish mindset is so much deep rooted in your subconscious mind that we are unable to look at the opportunity. And that's the way the opportunity is. So first, you have to remove this extraordinary negativity which is there in the market. Once you remove that, you're able to see with more clarity. And that's the problem which I see in the market. People have too much colored opinion right now, and that's the reason they're not able to participate.
Yeah, that's probably true. But those who are convinced there's extraordinary positivity. those who have stayed away, there is of course all this doubt. And I mean, I can tell you, I've met a few companies who are preparing for IPOs, etc. And the question was, well, is this the right time? Should we do it? Should we go ahead? And the feedback they've got from bankers, etc. Maybe wait a little bit. So that also kind of tells you about the mood out there, which is still a little cautious, even despite the broader markets doing so well, made in small caps, etc. Talking about new issuances, SBI Funds is the first one to go. It's a large one, IPO, 1 lakh plus crores in terms of valuation. There's going to be NSC then in September. Then, of course, during Diwali, I think the Geo IPO will come. Any thoughts around these large issuances?
Frankly speaking, as I've seen that over a period of time, the depth and the breadth of the Indian capital market has increased significantly. So all these 3 large IPO which is coming will actually add, So I'm looking more from a broad-based approach to the market, and obviously it's a great thing which if on regular basis supply keeps on coming, because we need, it's not like an isolation market is growing, it's not only the SIP money is coming, we need to deploy somewhere. So I say it's a very constructive thing. The challenge is obviously at right price you should get it, that the valuations are attractive. I think they will get good response. I think these are very sizable and respectable brands which is coming to the market in next few months. So I think I'm also looking forward to participating in some of these names.
Thank you, Sandeep, for joining in. Great to have you on the show today.
Thank you.
Okay, let's get in on the show. Sudhir Sekhri, Chairman, AEPC, and Palab Banerjee, MD and Group President of Pearl Global. Thank you very much, both of you, for joining in. Palab, let me begin with you. If you could give us the current status of the tariff refunds for April exporters. Have your US customers, begun receiving the refunds? And what could be the potential beneficiary for a company like yours, if at all? Will there be some sort of a pass-through?
Yeah, good morning, Rima. Yes, US had started refunding in 3 phases. And of course, in the month of June, early June, the US government has appealed to the Court of International Trade against these refunding activities. And so after that, I think there is a slowdown. But yes, some of the companies got some kind of refund, not fully, because I told you there were 3 phases. And also what we got to know that only those companies who have filed for the petition, they are the ones only who will be eligible for this refund. Others won't be. Now, in terms of us as Pearl as a company, we do mostly FOB shipments, a very little shipment that we land ourselves and deliver to the customers. For those, we have got the notification of refund, but very, very insignificant amounts. And the big companies has not started refunding to the customers as yet, because as this, the appeal has happened from the US government to stop the refund, and as a result, whatever refund that they have got, they are putting into an escrow account and see like what would be how the hearing goes and what is the final outcome of those appeals.
Right. It's interesting. It's also very confusing. I'll be very honest, largely because business in a situation like this is not necessarily black and white. What I do understand is that every time the tariffs are increased, it is an unsaid rule where you lower the prices to the extent that the buying price remains the same for the client, and the client foots the tariff. The truth of who's actually given the tariff or paid the tariff is somewhere in the middle, because there is some price correction and then there is the absolute tariff which is being paid by either you guys or the client, depending on what the arrangement is. So how do you account for those soft changes in prices that have taken place? And is it also then understood that now that the clients have gotten those tariff refunds, they will pass it on to you, or maybe that will come back to you in a form of increased ordering activity?
Yeah, so as I just mentioned, most of the customers have not got the refund as yet. So only those who were under phase one had started getting that refund. And as the appeal happened, US government, I mentioned, that has appealed against this refund. So that's all these customers are putting that money in an escrow account at this point of time, so that they want to see what happens before they, use that fund. So that's what is happening in US. Now, for customers for the suppliers across the world, we were, in that discussion, in that negotiation, we were offering some kind of discount so that that extra tariff is, minimized for the customers to pay when they import the goods. India was an exceptional situation, because India, we had to pay almost 15% tariff to take away that 25% penalty because of the Russian oil. But then the other countries had a tariff of, much lesser. Like once everybody got into the 20% bracket of reciprocal tariff, that pressure had eased off from the other countries. So naturally, most of the countries were paying about 2%, 3% kind of, discount to the customers, whereas Indian suppliers were paying a higher. So naturally, the expectation in Indian suppliers is that we should get back some of that money. But the good thing is that because these customers suddenly are, in a situation where tariff is not there, there's heavy tariff is not there, so they are in a phase which is a good phase for them. So that's naturally the order book, the order sizes has improved. The mood of the customers and the consumers, end consumers, have definitely been better, as we have seen in the first half of this particular financial year of ours.
So you're saying the demand has picked up now? To what extent? Could you give us an indication how much higher are the orders today, Pallab? And the higher discounts versus peers, that still stays, or is there a change? How is the competitive intensity? So if you could talk about both demand and even how the other countries are doing.
So first of all, the discounts that we are paying, that got waived off in month of February, as soon as the tariff, the IEPA tariff that President had put. So that got declared as not legal. So immediately that discounting system got moved away. So then that's definitely, as the suppliers, we got better price, and even the customers were paying less tariff, only the MFN tariff they were paying. And then, of course, the administration came back by putting a 10% tariff of Section 122. That is valid till July 24th. And after the July 24th, they are now talking about Section 301, the investigations that they have done for all the 60 countries, and they want to penalize again anywhere between 10 to 12.5%, much less than the reciprocal tariff that was discussed. And I think this 301 tariff or the penalty tariff that they are putting, either 10% or 12.5%, depending on which country, like they feel the risk is high, that is being used as negotiation for this bilateral trade agreement that is happening at this point of time with all the countries. This is how US administration is approaching the whole situation. Now, for us as a suppliers, it's immediately the discount got waived off in February. And since then, it's just that whether we'll get some kind of refund or not, we don't know. But yes, the situation of order is better. Now, one thing I must say out here, despite the tariff, we never saw a huge decline in the demand in US. For India, we had a little bit of problem because the Indian tariff was high. But as Pearl Global, when we are supplying from many other countries, what we found is that the demand from US had not gone down. So naturally, your question, if the demand has gone up or not, for India, is definitely it is up. Globally, it's equivalent. I think it's in a stable situation that we are seeing. Very unlike the 2022, when the gas prices had gone up and the demand in US had really stopped. This year, despite all the war and all the negative news that we have been getting, we didn't see any decline in the demand in the US consumers' spending.
Mr. Sekhri, you want to come in on the discussion with your views?
Sure. Yeah. Good morning. Yeah. First of all, a correction. I'm the chairman of the advisory committee of AEPC now. I was the chairman. I stepped down as the chairman of AEPC as a body, but I stepped down in January, and now I'm the chairman of the advisory committee. Yeah, and coming to that question of refunds, which Pallab just answered, we seem to be in a different basket. We being direct exporters, there was this 25% reciprocal tariff and then 25% oil tariff. Now, some of our buyers, when the 25% was imposed, they charged us 5%. And on the second 25%, they again asked for a discount of another 5%. So those buyers have not given us any refund. Whereas the buyers who did not ask for a discount on the first 25%, but asked for a refund discount on the second 25%, they have actually refunded on the reduction of after the reduction of the tariffs. We have already received a refund from the buyers. Now the question is whether whether we get a refund on the 5+5. That is a big question mark. Some buyers have not started. They have not started giving us refunds.
All right. Take that point. Thanks a lot, Mr. Sekhri, for joining in, and Pallab as well. Pallab, just a final word on the margins. The currency is stabilized a little. Input costs still higher, but the view is that it is likely to stabilize going forward as well. So what's your outlook on margins?
Yes, demand is better. From what we had forecasted, definitely we are seeing a good demand, a stable demand at this point of time. So definitely we are looking for some growth. The margins should get better because the kind of suppression that happened because of these heavy discounts that we had last year, so that goes away. Yes, raw material prices, as surprise, I think in the earlier discussion that we were having, the fuel prices or the crude prices has come down to the 70s. So that something was unexpected because most of the experts and even the economists were forecasting that there will be a higher inflation in the second half of the year in US. But yes, now it's anybody's game. So we have to wait and watch. There have been surprises in the market. So I hope the raw material prices doesn't go up or continues to come down now. Right. Of course, what we see is that all the 5 economies at this point of time that we supply to, they are doing well. So demand has been quite stable.
All right. Take that point, gentlemen. Thank you so much for stepping in with your views here. Just before we take that short break, just pull up 2 stocks. We have Titan, which has now moved to the high point of trade, was already near a record high. And now as we speak, it's hit another fresh record high. A 3% up move is what we're seeing on Titan. And on the downside, we have Trent. So 2 Tata Group companies on either side of the Nifty bookending it today. Trent is actually now down 10%, so locked in the temporary freeze of that 10%. 332 rupees lower on Trent. Titan higher by about 3%. Take a short break, come back. We focus on the oil and gas space. Mr. Surana, who's the former CMD of HPCL, and Richard Redoglia of Matrix Global joins in as well.
Welcome back. I think we've got the market, which is flattish. I mean, not running away. Let's put it that way. 20 points higher. Market breadth is negative for the second day in a row. Yesterday market breadth was slightly skewed on the negative side, more down than up, and this morning as well. It's a similar case. Now, the news which we got earlier was, of course, Saudi Arabia essentially cutting the price of their main crude oil contract. To the lowest, and I think by the most they've done in a few decades. What does this mean? And this is largely for Asian buyers out of Asia. We have Mr. M.K. Surana, former CMD at HPCL, and Richard Redoglia is CEO, Matrix Global. So we've got two voices. Richard, of course, is someone who's been calling for oil to fall to 70 for a while. It's finally happened, Richard, so congratulations first up. And Richard, we have Mr. Surana, who used to head one of the largest oil marketing companies in the country. So, someone who is very well versed with the oil economics here in terms of how we operate. Mr. Surana, thank you very much for joining us as well. So let me start with you, Mr. Surana. This, price cut by Saudi, what does it mean in practical terms for buyers like HP, IOC, the state oil companies?
While the total reduction from the OSP may be $11, but actually it is aligning to the market basically. So it is $1.5 below the Dubai Oman average. So it is a combination of the pricing mechanism which the different suppliers follow, and of course a pressure on the oil suppliers to tie up the market volumes in terms of increasing competition. But in addition to that, exit of UAE from the OPEC bloc, that puts an additional pressure. The Russian, American and Venezuelan barrels, and now even maybe Iranian barrels in the Asian market, there's another piece of item. And these all combinations are making a realization on the part of Saudi to ensure that they are aligned to the market. And that is the result of this reduction. And I think that there is a general feeling that the market is oversupplied, and in the short term at least, and there may be more pressure on the oil prices. And there is a standard inventory which is trying to come out of the straits, especially for the countries who are not able to supply at all, like Iraq, Kuwait, Bahrain, etc. So you should see a sudden gush of inventories coming in market, which can put the oil price even further. For the companies like IOC, BPCL, HPS India, it is a good news. Overall, for the country like India, it is good news that there are more suppliers who are vying for this market, and we who are so much import dependent, we will get the cheaper oil.
Sorry. So are we saying that, so you're saying that the Saudi price cut is simply aligning their price to global prices, right?
I will assume that. Or what is going likely to be the future prices in, let's say, the August month. So normally their mechanism is they declare an OSP. Saudi crude is not actually traded, and they don't go in a spot market, except recently they have sold some cargoes on a spot market. Otherwise, that is purely on term contract. They declare a price, and while the others are actually the market-driven basis, they spot contract.
So Oman, Dubai, and all of the others, those contracts are traded.
Saudi is trying to align the pricing as he is forcing in the other.
Yeah. Got that. Richard, come in here. Oil's at 70. You're a happy man. And as I said...
I think we had to go through a lot of trauma. The point I'd been making all along, if we go back until prior to the war, was that the market for crude was oversupplied. That OPEC Plus, as a cartel, was maintaining prices at a level so they wouldn't go any further. Saudi Arabia, UAE, and Russia were the main countries that were curtailing their crude oil production. And as we said on your show a while ago, back in May, I think one of the biggest things to come out of this meeting, to come out of during the war, was the UAE breaking away from OPEC. They're a 60-year member of OPEC. They're one of the leading voices within OPEC, and they decided to break away. And the question is why? And really their answer was they want to maximize their production. They believe, from my perspective, and I think we're seeing it now, because I think their production now is their exports are at the highest level almost ever. I think they reached upwards of 4 million barrels a day, which is about 800,000 above their pre-war levels. The point made by the other gentleman is exactly right. Saudi Arabia is being forced into the breach now. They need to sell crude for two reasons. One, they had barrels that were kind of stuck in the Gulf that are coming into the marketplace, and two, their new production is coming online. I believe that their production or their levels of exports are going to be upwards of 90% of what they were current to the beginning of the war. So really, what we're faced with is a market I believe is oversupplied. Now, saying that, one of the bigger issues is really refined products. The refined margins are the highest they've almost been ever, and this is due to two reasons. One, the damage that was done to the refineries in the Persian Gulf, and two, the damage done to the Russian refiners here in the last few months, which has caused significant problems. So it's really a refined capacity issue. But when we look at this market from a crude perspective, it very much looks like we're oversupplied. I believe we're in a trading range now. You and I have talked about this before. When markets are tight, we have a thing called backwardation, which is the spot price versus the forward price. During the war, the backwardation, 1 year backwardation, was around $24. Today, the price between August of this year and August of next year is $1.50. It is flat. So the market is saying at this point, in my mind, that we've reached a level of stability. We'll have to deal with issues around refined products, but from the perspective of where crude is going, I think we've reached a level that's going to find some support in here, maybe move a little lower. And then as we move through this year, we'll see what happens as it relates to refinery capacity coming back online.
So, Richard, you don't see the possibility of other producers cutting prices even lower to grab market share since oil is in oversupply?
I think it's very possible. Remember what UAE has. UAE has now a crude that is a futures contract, and that's very important. You know, the success of the real success of oil trading over the last number of decades has been its ability to be priced forward using futures. Saudi Arabia tries to price its oil on a monthly basis, an official selling price. The UAE, I believe, is going to start to move more towards a spot price. And when you do that, when you allow your market to float with the world oil price and you have futures contracts to back it up, it gives more liquidity to your crude yourself, it allows it to trade more, and it gives more price transparency forward.
Yeah, no, absolutely. That's an interesting point there. And on refined products, Richard, what's the view? So margins are at the highest ever still.
Highest ever. I believe they're the highest ever. I think they're approaching $50, $60.
Diesel, ATF. Although ATF, I think prices have come off, right?
I think they have. The market's going to find itself. It's going to find itself in balance. But remember, I think 15 or 20% of Russian refined capacity has been taken off market, and I think about 10 to 15% of Gulf Coast of Persian Gulf capacity has been taken off market. We have a much tighter refined capacity market than we do a crude supply market.
Mr. Surana, same question. The crude market, as you also said in the beginning, the general feeling is that there is enough oil there. But of course, on the refined product side, maybe there are still question marks. We keep hearing, right, once in a while, actually every other week, some large Russian refinery which has been hit by a drone, so that's still taking out. So we don't know how quickly these are being repaired and they're back up producing once again, et cetera, et cetera. Just your thoughts, sir.
Yeah, what Richard has said is true, that the product market is much tighter, and that is because some of the refining capacity out of the market, and some of the refining not operating at the full capacity because of shortage of the crude. Apart from India had tied up well, but not many were doing that. So, and the Russian export was not there, the Chinese export was not there to the level it is supposed to be, and so the product market is quite tight. But it will, over a period, it will also get some semblance of sanity, because it cannot continue to be at the margins which they are. And but it is trailing the crude supply market, and the crude is oversupplied because the companies have tied up with the other sources of supply, and now the sudden gush of inventory from Middle East, there are lesser buying appetite for that. But in future, while currently you may see a downward trend for some time, The future pricing will decide based on the appetite of the companies to or the countries to fill up the SPR, their strategic shift from Strait of Hormuz, the Russian sanctions, and of course Iranian barrels in the market.
Yeah. Mr. Surana, so for just a broader zooming out, for India, will we see a big shift in terms of oil sourcing? Because, I mean, we've gone through this and that, right? With over the last 6 months, 8 months because of what has happened.
See, fortunately for India, we had been buying oil from everybody.
Yeah.
So only thing is, it was the techno-economics was deciding at which point of time who is the major supplier.
Yeah.
Like the last month, Russia was the major supplier. Sometime America was also at pitched in. Sometimes Saudi is the major supplier. Somehow Iraq is the major supplier. And now the Venezuela is almost the 4th largest supplier. So techno-economics will decide. But yes, in the overall strategy, a diversification and building in the risk for the marine logistic lines will be a factor going forward.
Right. Thanks a lot, gentlemen, for joining in. Just before we let you go, Mr. Surana, as the former CMD of HPCL, I'd like your views, if you have any, on the ethanol blending discussion which is currently underway.
So just quickly, the ethanol is a national priority. Basically, if a country like India, which has got a high import dependence, we need to find the solution which are indigenous. And there the biofuels, where ethanol is an important part, fits in well. Some of the things which are going on, something is not fact-based and which the equipment manufacturers and the automobile manufacturer, automobile research institute and oil companies have tried to clarify. But I got no doubt that ethanol is an important factor because of 2 reasons. One thing is the indigenous component, emission benefits, the agriculture economic benefit, but more importantly, in our crude slate, the product slate, the petrol is growing at 6 to 7%, while diesel is growing at 3%, and our refineries produce around 45% of diesel and maybe 15% of petrol. So basically, if you do not have the alternative solutions for petrol, you may be importing more crude, you may be exporting diesel, but to meet the demand for petrol, etc., you need to have the alternatives for the petrol-driven vehicles. So EV may be one, your ethanol blending may be one, your LNG may be one, and these are all fitting together to reduce the overall bill. So I would think that ethanol is a solution which no going back. If the problems are there, that can always be solved. But some of the thing which is moving in the market, I don't think they are fact-based. All these are rolled out based on a substantial amount of research, deliberation between the oil companies and the automotive manufacturers.
All right. Good discussion, gentlemen. Thank you very much, Mr. Surana. Richard, great having you with us here on the program as well. Thank you for being here. Thank you. All right. Well, I just look at the market, which is flat, 40 points actually, slightly better actually, 24,470. But Trent is still down, and let's just pull up how much it is down by. The first quarter update, Mangalam, market not liking it.
Market not liking it at all. The reason why the market is not liking it is because there were expectations this time around, because the last quarter showed a 20% growth. The street expected maybe the first quarter we will see an acceleration to that. That hasn't happened. The revenue growth has been about 19%, which is similar as what we saw in the first quarter of last year as well. And if you pull up what the analysts' expectations were across the board, they were looking at somewhere between 20 to 22%, with most penciling between 21 to 22% as well. So to that extent, there has been a bit of a decline or disappointment versus their expectations. The company's added 1 West Side store and 19 Zudio stores during the quarter. If you look at the revenue growth trend as well, from a 20% jump that we saw in the fourth quarter, which the street believed could be sustaining, it's come down to about 19%. And all of this wouldn't have been a big problem had the stock not rallied about 22% going into this update itself. So had the stock been absolutely flat, no problems here. But a 22% rally means that the stock has actually given up about half of that, still trading at around 62 times 2-year forward price to earnings, so not particularly cheap, but growth disappointment is something as compared to expectations that the street does not like. And Trent is known to have reactions, big reactions on either side, so this time around it's on the downside.
Okay, and the gold jewelry companies, you want to compare all?
Yes, let's do that. Let's talk about Titan as well as Kalyan Jewellers. So good performance coming in for Titan, sparkling quarter. In fact, even for Kalyan Jewellers, the only concern with Kalyan Jewellers is the fact that after many quarters, for the first time, it's grown slightly slower than Titan. So Titan's grown at 39% on a very high base, and Kalyan Jewellers growing at 38%. If you look at Kalyan Jewellers, same store sales growth, that's approximately 28%. Titan's Buyer growth has been in double digit. Even the average ticket prices has been in double digit. For international operations, for Kalyan Jewellers, it's grown at around 35%. Titan's been fairly aggressive out there on a low base. They have tall guidance for the international business. They acquired D. Damas as well. So all of that meant that on that base, this business has grown at 128%. Candere, which is Kalyan Jewellers, Carrot Lane equivalent, has been growing fairly fast as well. So 112% growth out there. But this time around, because Kalyan Jewellers has grown softer than Titan, despite growing a 38% mark, the street has not liked it, and that stock is lower by about 7% as against Titan, which continues to gain from strength to strength at a record high for that stock right now.
Okay, thank you very much for that. Kalyan Jewellers is a part of the mid-cap 100 stocks, which is why the mid-cap index itself is down close to about 0.5%. Along with that, the mid-cap index also has a Cochin Shipyard, lower because of the OFS news, a Solar Industries, BSC, CG Power, Cummins. These are all part of the mid-cap index, and today they are under pressure, which is why the mid-cap index is underperforming. In fact, small-cap index too is lower, but that's had a fantastic run-up. The advanced decline ratio as we speak is 2 stocks advancing for 3 in the red. Chandan Taparia is now joining in from Motilal Oswal Financial Services. Chandan, quiet but chugging along, holding up in the positive territory. Any Nifty trade and your stock calls?
Yeah, good morning, Rima Mangalam. Thanks for having me. So, talking about the Nifty index, it has been making high rise, high lows from last 5 trading session. It surpassed an immediate barrier of 24 to 24 and then extended the momentum towards 24,500 marks. On most of the price pattern, the setup looks positive. Today's weekly expiry as well, and we are witnessing put writing even at higher strike. In fact, the data setup indicates the bullish stance to continue. So now till it holds about 24,350, the ongoing momentum could extend towards 24,650 to 24,750. Looking at data internal, we have seen rollover around 25%. We have seen rollover of around 80% from previous series to this series with open interest addition of 25%, which clearly indicates that longs are being carried from previous series to this series. Put call ratio is moving upwards near 1.38, 1.4. India VIX is below 12 marks. FI has turned to net buyer from last 2 days. FI long short ratio is recovering. So most of the data setup are indicating the bullish stance in the broader market. Now talking about Bank Nifty index, which outperformed in the last series, has been consolidating, but supports are shifting higher till it holds above 58,000. Buy on decline could continue towards 58,750 to 59,000 marks. So positive view in both the indices with buy on decline stance going forward.
Got that, Chandan. In terms of sort of individual names, what's on the list?
Yeah, Prasant. So first it will be buy on Zydus Life. Nifty Pharma Index has given a major consolidation breakout and trading at all-time high territory. The trend is quite positive, and here we are recommending to go long on Zydus, which has given a consolidation breakout of last almost 28-30 trading session. It formed a strong bullish candle with build-up of long position. So ongoing momentum could continue with support of 1140. We are looking for an upside target towards 1210. Second trading idea, that is buy on Titan. Slow and steady, this counter really witnessed descent buying from the lower levels and now heading at its all-time high. Major trend of the counter is positive, and the recent consolidation provides the higher base to the stock. So one can buy with support of 45.20 for an upside target towards 4800 level. One more trading idea, that is buy on PZ Electro Plus, PZEL. Positive price pattern, all set to give a consolidation breakout on the daily, weekly, and the monthly chart. Has been making high rise, high lows. Longs are being built. Mechanical indicator are indicating positive stance in the counter. So one can buy with support of 568. And here we have a target towards 600 marks.
Thank you very much for that. Get into a break. On the other side, Manisha Gupta will join in to talk commodities. Stay tuned.
Okay, welcome back. Let's focus on commodities and currencies, and which one is in Manisha's mind this morning. Manisha, take it away.
Thank you so much for that, Prashant. I'm looking at soft commodities right now. We've spoken so much about crude oil prices, but take a look at the food prices, and we've seen very volatile moves coming in for this one as well. Top on my list is Arabica coffee, and if you drink a lot of that, well, let me tell you that it is gained up by 14% overnight. It's trading at a 5-month highs right now. Well, Brazil is a major producer and there is a delayed harvest concerns coming in from there. It also is about the ice inventories, which are now trading at around 2.5-year lows. And not just Arabica, but the Robusta inventories also are at near 2-year lows. And that clearly seems to be taking the commodity prices on the higher side. The second on my list is cocoa. Not just coffee, but cocoa also has gained up by 14% overnight. It's trading at a 24-week highs, and it has gained 48% in matter of last 1 month itself. It has to do with the weather concerns in major producing countries that seems to be keeping the prices on the higher side. And then add sugar to that, and we've seen 3% of gains for sugar on a week-on-week basis. The delayed Brazil harvest and lower crop estimates coming in from the other 2 major producers, which is India and Thailand, is also supporting prices. So much so that we've seen prices actually turn on a positive for a month-on-month and YTD basis as well. Cotton should come in on your screen because that also has seen some gains come in. Again, adverse weather is what you can pin this on. The producing areas are looking at lower monsoons. The cotton prices have gained up 3% on a week-on-week basis as well. Corn should come in on your screen because we're trading at a 1-month highs for corn prices also. The prices have gained up by 7% on week, and major producing areas including France, where you're looking at heat waves in most of Europe, is looking at lower crop and lower yields, keeping the prices on the higher side. Everything in edible oil prices also seems to be surging. So soybean prices gained 4.5% overnight. They're up by nearly 6% on a week-on-week basis. And this is a 5-week highs that we're looking at in sense of prices. Strong Chinese demand is something that is keeping the prices on a firmer note here. Finally, one thing that is not following trend, and that really is rice. And we've seen the prices decline onto this one by 9% overnight. It's trading at a 2-week lows. And when you look at the global rice stocks, global inventories, Indian inventories, all of that has been on the higher side. So the global rice stocks are at 196, which is a record right now. Indian rice stocks, if you look at that, we're looking at back-to-back very strong crop as well. So we're looking at a record number of 63.4 million tons in the start of June for this one as well. And USDA says that India perhaps could be looking to export a record 25 million tons. India as of now is exporting 25% of all of global rice. So clearly in a very, very competitive position therein. Indonesia is looking at very strong stocks. You have Thailand, which is looking at 20-year high stocks as well. So is the reason we're looking at sharp decline in case of rice prices. But as I said, everything else from sugar, coffee, cocoa, cotton, all of that is surging. Only cotton prices have seen a bit of a decline.
All right, Manisha, thanks very much for that. Soft commodities in focus. Lata is joining us on the other side. We'll take a break. She'll have Nischint Chevatle of Kotak Institutional Equities on what to expect from NBFCs in the upcoming first quarter results. Stay tuned, coming up.
Welcome to It's Economy. At the start of the earnings season, one sector that appears to be in a cliched word but Goldilocks clutch is the NBFC sector. Cost of funds as measured through market yields of CPs has fallen by 100 basis points from their mid-May levels. Auto sales has been surging, as we know, so vehicle finance is bound to have grown. Indeed, loan growth, as reported by some of the early bird NBFCs, is over 20% for all of them. So should we expect some extraordinarily strong numbers in Q1 from NBFCs? And is the good news in the price or yet to be priced? Joining me is Nischint Tsawate, the analyst at Kotak Institutional Equities. Nischint, good morning. Thank you very much indeed for your time. Actually, you start your report in a fairly optimistic way. You start by saying we retain positive stance on most NBFCs with the scope of an upgrade. So can you take us through your optimism?
So I think, see, this is a great quarter. NBFCs have been growing pretty fast last year. The sense that we get in is that the momentum of the fourth quarter continues in the first quarter as well. I know the markets have been a little nervous about West Asia war and all that, but looks like at the ground, things have been pretty robust. And I think you summarized it well in terms of, vehicle sales or some of the numbers that have already been put out by the other NBFCs. So it's a strong period going forward. Again, now we don't have an overhang of the war. Yes, we need to be a little bit cognizant about monsoons or inflation or a rate hike that comes in towards the second half of the year. But I think broadly it's still going to be a good year. Companies gave guidances, in the last quarter with an overhang of the war, which is not going to be the case right now. So that effectively means that, management guidances could also see some upgrade. So growth has generally been stronger than what the market expected, the way you would see in NBFC stocks correcting at the peak of the war. And, things are much better now. Even from a margins and asset quality front, typically first quarter does see some weakness in collections. There is a seasonal weakness, which is probably much lower right now, or one can say absent right now. So, that's a good start to the year. And I think finally, from a margins point of view, we saw some tailwinds in cost of funds last year, which sort of, flows into this quarter as well. So, to that extent, I think from all the three angles, it's as you rightly said, it's a Goldilocks scenario.
I agree with you about this asset quality thing. Whether you talk to banks or CIBIL, TransUnion or CRIF or just about anyone, there doesn't seem to be an iota of doubt. I'm just wanting to know how much margins can increase, because the other competitor for NBFCs, banks, are going to get this manna from FCNR flows. So do you think undercutting will take away some margins, if not in the quarter gone by, in the current quarter?
Maybe not the current quarter, but a couple of quarters down the line, yes, you would see competition and some kind of margin pressure. But I mean, honestly speaking, between asset quality growth and margins, margins is a better problem to have, right? Competition is a better problem to have, which is pretty okay. I mean, some of the frontline NBFCs are growing at, 23, 25%. And, in that backdrop, if there is some margin pressure, I think that's perfectly fine. The good part is, or I shouldn't say good part, but towards the end of the year, you will start seeing, some rise in the policy rates as well. That is probably, going to keep a little bit of competition under pressure.
Yep. Okay. The more important question is what is in the price? If I looked at your price to book and PE multiples, they're pretty strong, Say, for instance, for Chola, the historical number is 29 price to earnings and 26 when it comes to the 27 estimates. Likewise, price to book is 5 if you look historical and 4.3 if you look forward. So there seems to be a goodish bit in the price, or no?
Yes, I think the easy part of the rally is done. I think incrementally from year on, you're looking at compounding. It's a pretty healthy compounding, of course. But I think essentially you're looking at compounding from year on. The easy part of the re-rating, where there was a lot of bearishness on the war, and from there coming into the realization that things are not that bad and probably getting better. I think that's already there in the price.
Okay. You are very positive on housing finance companies. I mean, even when you're giving your recommendations, you say you like Bajaj Twins and ABCL the most, though you have a much longer buy list. But you have a bunch of housing finance, Aptus, Aadhar, Home First. Why so positive on housing finance, especially affordable?
See, affordable companies, I think over the last 2 years did see some weakness in growth. Probably there was some weakness on asset quality towards the, in the lower end of the market. Apart from that, some of the MSME companies did report some stress, and, these guys operate in kind of similar markets, which prompted maybe the affordable companies to go a little bit slow. Most of those challenges are behind us, or probably they're already there in the base. We saw some marginal pickup in disbursements for auto companies towards the fourth quarter or so. And with a favorable base and that momentum continuing, or probably getting more assertive with the war coming to an end, and the MSME cycle improving, one can say that disbursement numbers pick up from here on. And which is where, if you're seeing disbursement momentum picking up, I think again these stocks will be back in the limelight.
Okay. Your list again, Bajaj Twins and ABCL, you like most. Again, as I said, you have a longer buy list. But why is not any of the vehicle finance up there? Because we saw strong auto sales, and CV is also picked up lately. Rather strongly, actually. Tractor numbers are excellent. Why is it not there in your best list?
So it is there in the buy list, but not the best list. Let's put it this way.
Yeah, I agree. You are carrying your buy list also, but why is it not preferred? Is it too already priced in?
One can say that, yeah. One can say that, you've seen a very sharp rally in Chola, let's say. So you could say that, yeah, the upsides over there are lower. Versus, and again, keep in mind that many of these are not vehicle finance companies anymore, right? These are also a diversified, set of companies, whether it's Chola or Shriram. So you can't single out as vehicle finance, but it is just the sheer momentum and the valuation. Probably it's a combination of that.
Okay, Nishin, what can go wrong?
What can go? See, I think one is from a margins front. If you see, inflation shooting up and that kind of, having an impact on the cost of funds, I think that is one. Apart from that, obviously, monsoons is something that we all acknowledge. We'll have to see how that kind of shapes up, and that kind of, if at all, poses any risk to, if at all that poses any risk to all the forecasts that we are putting up. Personal loans or the unsecured loan cycle is very strong right now. We have seen a complete kind of a full cycle in the last 2 years. For now, the numbers are very good. These may not remain very good for multiple quarters. So that's also something we are watching out for. But maybe that worries us less, because most of the NBFCs that we're talking about have a fairly diversified book. It's a combination of unsecured loans, housing, vehicles, etc. So that worries us less, but that's also something that we'll always keep an eye on.
Okay, no, that was uppermost on my mind as well. There is a likelihood of large tracts, Central India, Eastern India, not receiving adequate rains, and these are also not the richest of Indian states. So is there an asset quality worry that can come primarily because unsecured loans have risen?
See, very theoretically, yes. But if you look at the industry trends, it's not really showing up in the numbers. We've already seen even the quarterly previews put out by some of the companies, right? So it's not showing right now. So, one could have potentially said 3 months back, okay, there is a war and things can go completely out of control. But 3 months have been pretty good. So, can it potentially? Yes. I think we need to be vigilant. We need to be careful, especially the way stocks have rallied. But I think for now, keeping fingers crossed, things seem to be okay.
Okay. And specifically, would you want to talk about Bajaj Finance? I mean, it's not done much. It's very good in terms of business and very mediocre in terms of stock performance. So is there a catch-up, or is it always a pricey stock?
There is a catch-up, right? I mean, you asked me why are some stocks, on the top of the list in a long buy list. So that's what it is. I think both finance and Finserv, right? Finserv has a fairly expanded holding company discount as well.
Okay. The one set okay, let me just come back to the housing finance a bit. See, housing finance is almost going out of fashion. Even Samman, which started off as a housing finance company, is now telling you that they want to diversify because everyone is coming to terms with the fact that margins don't rise in this space. Then why are you up there on housing finance?
See, I think the names that we're talking about are sort of niche names. These are affordable housing names. Again, the balance sheets of these guys are pretty small, right? They are a couple of $1 billion balance sheets. So that's the difference.
Okay, actually, I concentrated on NBFCs this time, but just a word on insurance, because people, after all, PB Fintech has been an extraordinary performer. And, insurance companies have a large holding, though they have not been top-notch performers. Any word would you say that they are lower in grade compared to NBFCs, or do you find some gems there?
I think from a sector point of view, we are looking at a couple of regulations. The most important one is on the distribution side, probably an IFRS coming in a couple of months down the line. So that's where I think there is an overhang on these names, the distribution reforms being the most important one. Having said that, yes, valuations are attractive. So, HDFC Life below 600, or for that matter, SBI Life, which is, we know, the lowest cost insurance company, affected less by regulations. These are definitely interesting names that one can hold and put it in your portfolio, right?
Okay. Well, just a final question, which is actually a head of research question or something. In your own company, where do banks and NBFCs stand in terms of hierarchy? Which is preferred over the other?
I don't think so. There is a perfect answer to this. It's always we buy the best names in the space, right?
Okay. So. Fair enough. I was just asking as a category. Your point is well taken. Thank you very much. Thank you very much, Nishchint, for giving us a 360-degree perspective on the NBFC space. Right now, very much, with mouth-watering valuations almost. At the moment, the market is having a celebration of its own. It touched the 24,500 mark after a very long time, I think after April. So it's a 2-month high for the market, and it's led by the IT stocks. TCS, Infosys, HCLTech, and Tech Mahindra up there leading the charge. So that's the day of the underdog. Wrap up on Bazaar on that note. Chartbusters coming up after the break.
Street unhappy with the update coming in from Trent. The first quarter top line growth of 19% falls short of expectations of 20 to 22%. Analysts warn of near-term profit booking following the stock's 20% rally over the last 1 month. Morgan Stanley and Bernstein update maintain their upbeat stance, while Citi maintains caution over the counter with a sell call.
Tale of two jewelers. Titan delivers a strong Q1 update with the 39% growth and robust overseas momentum, while Kalyan Jewelers' 38% revenue growth fails to impress the street.
Jubilant Foodworks navigates LPG headwinds. First quarter consolidated revenue rises 14%, with Domino's in India posting over 2% like-for-like growth. The stock up 3% in early trade.
And it's a CNBC TV18 newsbreak confirmed. The government launches an offer for sale to par up to 5% stake in the company for Cochin Shipyard. A green shoe option allows for a larger stake sale basis the demand. Floor price fixed at 1,400 rupees a piece and a discount of 7% to yesterday's closing price. The stock skids nearly early trade.
$35 million order from South Africa's Voluntis for diesel and electric locomotives sent shares of rights soaring. Project to be executed in the next 2 years. Well, we briefly crossed the 24,500 mark, still holding slightly under it. You're watching us here on Chartbusters. We come to you live from the CNBC TV18 Motilal Oswal studio. I'm Mangalam Malu. With me, Vinny Motiwala. It's the mid-cap index, which is left wanting for more. The index is down about 0.2%, with 80% more stocks declining than the number of stocks which are advancing. No problems for the frontline index, which is holding with a gain of 60 points, and that's largely on account of support coming in from the IT pack, which has moved higher, and the Nifty Bank, which is still holding with a gain of almost 100 points. The only concern, the broader markets. So let's see where that goes. Hi, Vinny.
Hi Mangalam, good morning. Weekly expiry, we'll keep an eye out on what happens in terms of the volatility, if there is any sharper moves that we see coming in. But yes, the broader end of the market, a bit of an underperformance, 0.6% of decline for the Nifty mid-cap. As of now, the India weeks is just at down 0.42%. We'll watch out for that small cap trading at the day's lowest point, and we'll also watch out for a lot of individual names, especially coming in terms for the Q1 updates. Watch out for that. IT has made a bit of a comeback today, and it's the top sectoral gainer in trade, while metals on the flip side is trading with cuts of around 0.5 to 0.6%. That's what the market is looking like as of now. But let's shift focus to our special segment, where we will get you ideas of profit from Money Control Pro. Kanchi Shah of moneycontrol.com joined us now to talk about a stock that she's been tracking closely. Kanchi?
Today's stock idea is Tata Motors. So the reason I like this stock is because the domestic CV cycle looks very well placed right now, supported by infrastructure spending, replacement demand, improving freight movement, and also the rising e-commerce activity. More importantly, the company is not just betting on industry growth, it is targeting an increase in its domestic commercial vehicle market share also to around 40% by FY28, which is right now 36%. So this should support both the revenue growth and operating leverages. The second trigger is the Iveco acquisition. So this should bring significant strength to Tata Motors' global commercial vehicle presence through access to new markets, technology sharing, procurement efficiencies, and cross-selling opportunities. Also, the export story is beginning to improve. So the company recently secured a large bus order from Indonesia, highlighting its growing presence in the Southeast Asian market. Also, the management expects the demand to be significantly strong in the Africa and the Middle Eastern market. The company also continues to expand its higher margin businesses such as spares and services, so making earning more resilient and industry cycle. So with the strengthening in domestic cycle and market share gains and improving exports, I believe Tata Motors offers an attractive risk reward for investors for the next 12 to 18 months.
All right, with that, we'll take a short break. Come back on the other side. We have the management of Borosil joining in. They'll talk about business synergies from their new production unit at Rajasthan, but at the same time, we'll speak about the current operational environment as well. Srivar Kheruka, who's the MD and CEO, joins in. Welcome back. You're watching us here on Chartbusters. Let's talk about Borosil. They've recently commissioned a manufacturing unit via their wholly owned subsidiary for vacuum insulated products. Basically, these are flasks that you keep cold or hot beverages in. They're insulated by vacuum, which keeps the hot beverages or the cold beverages hot and cold respectively. What does this mean for their overall business prospects and how the current operating environment is? MD and CEO Shrivar Kheruka joins in. We obviously discuss this production for 2 double wall lines business going forward. We also discuss the first quarter, how demand has been, gas prices and other input costs, and in the medium term, how growth trends are panning across the board with competitive activity picking up as well. Let's talk about, first up, the current operational environment. Thanks a lot, Shrivar, for joining in. The last time you joined us, you did say that there was unavailability of gas. There was a sharp surge in induction cooktops. Gas prices are increased by about 2.5 times, if not 3 times. Now that we speak, we're looking at the fag end of that commodity inflation. Oil prices are back to pre-war levels. Has that reflected in gas prices as well? So if you could give us a sense on how the operating environment is, how margins are likely to pan out?
I mean, clearly, firstly, thanks for having me. Clearly, the shock which we felt with the Iran war was substantial from a gas price and a crude oil price perspective. That's since corrected, and you can see crude oil has come back to close to pre-war levels. However, what goes up takes longer to come down, unfortunately. So we've not seen yet enough correction in the input commodity costs as quickly as they went up. They haven't come down that fast. I suspect it is happening, and I suspect it'll take another month or so for it to fully flow through. So the inflation impact has reduced substantially, although it's still there. And obviously that impact has had an impact on margins because you can't pass on such a large cost increase directly to consumers overnight. So there will be some short-term impact on margins, but we are in the business for long term. So 1 or 2 quarters, if there's some impact, it doesn't really set us back too much. But the important thing is that once the inflation comes back down, customers should be able to buy more of our product.
Okay, so still a bit sticky in terms of the costs that have gone up. Maybe margins could be at the similar levels that we saw in Q4 as well, at least in Q1 FY27, right? Because of these issues.
Yeah, that's right. I mean, we had to take price increases, which I already shared, I think, some time ago. So we have recovered some part of that cost increase, but it's not all of it. On the flip side, we do have, a reasonable amount of growth coming through. So there's some margin uptick on that. So net, I think margins will be flattish, in the short run. But we've given a guidance that in the next couple of years, our EBITDA margin from 16-17% should grow closer to 20%, and we'll stick to that kind of guidance.
Right. What do you make of the demand that you saw for induction cooktops? Has that fizzled out? We've heard similar from people who either make it or sell it, the likes of Vijay Sales, etc. But they said that when they sold in the last 2.5 months, they sold over a year's worth inventory already.
Yeah, that's right. So induction cooktops, of course, is a favorite topic the last couple of months. Look, frankly speaking, if you look at the product itself, it's actually a much better way to cook, in my opinion, because you just depend on electricity. And with India getting electrified, substantially to the last village, I think it's a very clean and easy way to cook. So the demand, while peaked, and of course, there's panic buying, that will obviously has come down. But I think this is a story which is here to stay for a longer term, because to replace gas with electric cooking is just, I would say, logical for the country to do as a whole.
Okay. Shrivar, let's talk about the commercial production for those 2 double-line walled lines that have started, right? 30th of June, it started. You're expecting the third one to come up by Q2 FY27 as well. What is the revenue one could expect, additional revenue for the full year from this?
So I'll talk about revenue. It's hard to say additional or not because we are already selling these products which we source today from domestic players. But now we'll have our own production backward integrated. So the total revenue we can expect from these 3 lines over a year is about 180 to 200 crores. This is just the beginning. We will certainly be expanding this, in the very short foreseeable future. Nothing announced yet, but the demand for the product is substantial. And, we have a very strong market positioning here. So I do expect this to keep climbing as India moves from plastic to non-plastic such as glass or steel alternatives. I think this product category has, a lot of growth potential ahead.
Srivar, I just wanted a quick word in terms of the solar battery storage also. Europe, the commissioning was expected in Q1 FY27. Has that been done, or is there any sort of a delay here?
No, that's actually been commissioned already. That's actually for cost saving more than anything else. So that's, we are a very power hungry unit in Rajasthan. All our glass is melted using electricity, and electricity from the grid, of course, is expensive. So we put up our own captive solar parks. But now with the newest regulation, and rightly so, government has come up with requirements for BESS, battery energy storage systems, and we've implemented that already also in Rajasthan. And I think about 30 days ago, it started working. It's working fine, and the cost savings have already started being driven from the first quarter from that initiative.
All right, just a final question on the overall market share. Borosil as a brand is obviously playing in an industry where a large amount of unorganized players are there. You are also at the same time leading the shift away from the current forms of storage and supplies into the more branded, products. And all of this, while there is a lot of competition from other players who are looking to get in the same place, the kind of stationary players, etc. So in light of that, how's business moved? And what is the updated market share that you can give to us? And if you can also give us some more metrics to track the growth of this business going forward.
So look, we have many product categories and there's different levels of competitive intensity across the different categories. And as far as unorganized is concerned, let's say, for example, in steel, I think it's a reasonably large percentage, probably more than 40-50%, which is unorganized. And in the days of clutter, and our clutter keeps increasing every day with a lot of social media, with lots of input coming into all of us, we tend to default to buying products that we know or brands that we trust. And Borosil kind of sits in that space because we offer a high quality, well-designed product, which is, great value for money and will not, harm your health or rather will be supportive of your health in the, going forward. So I think customers realize that, and therefore, given that they don't have the time to do all the research, they'll default more and more to well-known and well-trusted brands. So we see substantial increase in the market share of organized players over unorganized players, and that's across all categories. We've been growing, at about 20 to 25% CAGR for the last 10 years. Last year was an aberration specifically because of our double wall flasks, which had the quality control order, and we couldn't source this product anymore. So that last year the growth dropped from 20-25% to about 8-9%, which was a short-term hiccup, I would say. We expect that to kind of come back to the 20-25% levels as soon as we stabilize our production of this unit. And like I said, there'll be further expansion as well. So we believe that this is a long-term growth story. There's clear shifts in consumer behavior, and we are, with our glass and steel portfolio, very well positioned to kind of capitalize on that.
Okay. A lot of opportunities, well positioned to capitalize on that, and margins near term, maybe that pressure continues because of the inflation, but long term story stays intact in terms of the margins as well. Srivar, thank you so much for joining us this morning and giving us an indication in terms of what to expect from the company, as well as the commissioning of the new facility. What are we keeping an eye out on there? Thanks so much for that. But on that note, we're going to slip into a very short break. We'll come back after the break, and we're going to be in conversation with Vector Technics Management. Stay tuned in for that. That's a subsidiary of Zen Technologies. Welcome back to Chartbusters on CNBC TV 18. Nifty as of now just slightly below that 24,500 mark from where we started the show. Not much of a move. Trying to make a bit of a recovery, but nothing exciting that's happening there. 24,480 around that mark is what the Nifty continues to trade at. Let's shift focus and talk to the management of Vector Technics. Now, this is a company that has emerged as India's largest fully integrated drone propulsion manufacturer and has expanded its manufacturing capacity to 3 lakh units annually. To discuss more on this, we have Prithvi Raj Pakalapati, who is the co-founder and CEO at Vector Technics, joining us. Hi, sir. Good morning. Thank you so much for joining us on the show. And just for our viewers, this is a subsidiary of Zen Technologies as well. You all have expanded your capacity. 3 lakh units annually is now what the manufacturing capacity stands at. What is the demand right now? What is the on-ground situation? How much of the capacity, that you all had previously was utilized already?
Thank you and good morning. So after Zen's investment, we've been continuously working on increasing the capacity. The main reason is we weren't able to deliver when there was a huge demand earlier within our own country. So that became a shining star for us, seeing that there is a huge requirement, there is a huge demand for us, but we are not equipped to do so. So in the last 6 months, the entire focus has been how can we automate our systems as a factory to deliver the best we can. So right now, the capacity has been 3 lakhs, and we are still working on improvements to increase the capacity. There's a huge demand just within the country for us to deliver. So it's a great milestone for us. That was enabled after Zen's investment, after we become a subsidiary of Zen. And it also propelled us to have more talent working relentlessly to deliver that amount of quality.
So you have enough demand for this 3 lakh, right? 3 lakh units you will be able to sell in the full year, and you need more to expand also.
Oh, yeah, absolutely.
Okay.
Just to understand this a little better, Prithvi, when Zen acquired 51% stake in the company for 25 crore rupees, you had negligible revenue. Do they still own 51%, or was there another fundraise that happened thereafter?
No, they own 51%, and that's quite sufficient for us to do this expansion. And prior to that, we were doing about only R&D volumes, and we were into about 6 years of research into that. So there was hardly any revenue. And the deep tech is hardly funded in this country. So Zen took that opportunity, and we are very happy to be on board with that.
It's great that they took that opportunity and you guys are happy about it. What I wanted to understand is now that you've increased the capacity, the question is, how does that flow into your revenue, right? What's the current revenue potential from your existing capacity?
So the revenue potential is tremendous. Last year, we were able to grow 40x. This year, we are expecting to grow similar. So or even better. So last year, we were able to deliver more than what we can do as a factory with multiple shifts. We were able to deliver twice than what we assume, which is about 10 crore. This year, we are looking at a minimum of 20 to 40x growth.
Wait, so last year, if I get this right, when they invested in you, your revenue was close to around 13,000 rupees. I remember that because it was a negligible research-only company. You grew 40x on that, is it?
We did close to 10 crore last year.
You did 10 crore rupees last year in revenue.
Yes.
And this year you are looking at 400 crore rupees because 40 into 10 is 400 crores.
If everything goes well, yes.
All right. If everything goes well, you're looking at 400 crore. And typically what margins?
We are equipped to do that much revenue. Currently, the order books are mainly with the end customers testing for the government. So we are equipped for the government to place orders to the end users who are the drone manufacturers. So them having a pipeline also demands us to be in that same roadmap. So we are equipped to do that much revenue. So the 3 lakh units per year is equipped to drive me a revenue of 400 crores.
That's interesting because, and somehow the math is a little off as well, it seems like, because the reported numbers that we have, public domain reported numbers that we have, FY20 revenue was closer to 99 lakh rupees or just about 1 crore rupees.
Yeah, wrong. No, that was wrong. I think you're not looking at, you got a wrong number. We did close to 10 crores.
Okay, FY25 or 26 was 10 crores. 26 is not reported yet.
Oh, yeah, then it's 26 was 10 crores. Prior to that, we were absolutely doing nothing. We were only selling few samples to educational institutes.
And what kind of margins does this business typically do? And by when do you anticipate to reach to that 400 crore mark?
So we are, as a factory, we are ready. We are equipped to do so. We are primarily focused on the domestic market itself. Having said that, last 6 months have given me an opportunity to go abroad, and we are also trying to get some export orders. So the one thing which we do very differently compared to the other ones is the product is not the product. The factory is the product for us. So we built the factory so that we are equipped and ready, because the whole industry changes very fast, and I have to equip very fast. Otherwise, I'll be left out in the game. So the factory is ready to give 400 or even 500 crores of revenue for Zen based on the market demand. So only domestic demand itself is close to about 300 crores, and we are expecting 100 crores of revenue as an export sale.
Okay, 100 crores
So the
export
factory is
sales also is expected. This is by this is an FY27 maybe we could see coming in, right?
Yes.
And what is your order book like currently? Domestic or export orders? Export, you just said that you've just started talking with exporters. So order book currently is what as of now?
So we are doing good revenue numbers. We are growing every month. So currently we are doing close to about 3 to 5 crores every month, and it keeps on increasing every month.
So your run rate right now, as of now, is around 50 crores per year.
Yeah, that is achievable.
Monthly run rate. Okay. 3 to 5 crores. And what is the lead time for all these orders? What we're wanting to understand, what you've given us so far is that, okay, this is your factory. This is the potential revenue of your factory. What we need to know is, what are you likely to do, right? So for that, obviously you have the supply which is ready, but for that you also need orders. What is the visibility on the orders? By when do we hear of you tendering in or you winning some orders?
So we don't tender, first of all. The tenders are done by the end customers, who are like Tatas and Idea Forge and other people. So we supply them with components, which is 30% to 40% of their bill of material. So whatever, irrespective of what their tender volume is, we get that volume. And not looking into the overall order book for the year based on only tenders that are required by these domestic partners, based on their tenders. Our run rate or prediction, we will be achieving very confidently close to 50 crores this year, irrespective of what tender comes in.
So currently, as of today, if I have to see, or 30th of June, what is that order book that stands for you? You said that with the partners, yes. What is it for you right now?
40 crores for this financial year.
40 crores for this financial year, which is obviously deliverable, understandably, over the next 10 months, largely because you're doing 3 to 5 crores per month. And what is the competition like for a business like yours? Because obviously, when the demand is 300 crore rupees for domestic demand, and the large clients are bidding for all these things, obviously there would be other players who would be in the similar business, right?
There are a couple of other players who are in the business, but we are the only company in India. We are doing the full propulsion kit. So we do design, we do develop and manufacture, not just the motors for the drones. As I said, it's 40% of a drone. So we do motors, we do propellers, we do electronics, we do power distribution, and we stitch them together as a single package. So the end user makes it seamless for them for certification and for flying. And so that level of integration, nobody else offers within the country.
And what did you say about the margins?
And hardly there are any other players outside the country.
And what did you say about the margins?
Margins are close. Gross will be close to about 70 to 60.
All right.
Okay. Prithvi, thank you so much for joining us this morning, explaining us everything about the business of the company, as well as in terms of the outlook going forward as well. So that was the management of Vector Technics, which is a subsidiary of Zen Technologies. But with that, we're absolutely out of time on this edition of Chartbusters. Thank you so much for tuning in. Up next, your trading hour.
Good morning. It's time for Trading Hour. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I am Hormas Fatakia. With me is Reema Tendulkar. Reema, good morning. The good start to the index yet again today. Fifth straight day of gains, crossing 24,500. And now with this 60-odd point up move in these five days, the index is up over 600 points.
Indeed, 630 if you want to be very precise. But I think it's a bit disappointing the way the mid-caps and small-caps are performing today. Mid-cap index, small-cap index both down over 0.5%. And the advanced decline ratio is also deteriorating. The gap between the two is widening. And right now as we speak, it's one stock advancing for two in the red. And many of the stocks which are a part of the mid-cap portfolio, like a Kalyan Jewellers, a BSC, Aditya Birla Fashion Retail, Solar Industries, Cochin Shipyard, Cummins, these are stocks where you are seeing pretty deep cuts of about 2 to 3%. The good part is IT once again is seeing buying. Remember last week, Wednesday, Thursday, Friday, we had a rally in the IT names, strong rebound. Yesterday, there was a little bit of profit booking, sideways movement. And today, once again, the Nifty IT index is leading from the front with a gain of 2.5%. And today, we had two mildly bullish calls coming through on the IT sector. One of them was Ridhim Desai of Morgan Stanley when they came out with the equity strategy note. They say that IT could emerge as the dark horse. They have an equal weight rating on the stock. It's not that they're going overweight, but Morgan Stanley was one. And the other one was Sandeep Tandon of Quant Mutual Fund, who said that we've started nibbling into IT names, but not going aggressively long. But Hormus, let's talk stocks in the IT basket and outside.
Yeah, beyond that, there is a lot of action that's happening in the broader markets as well. But the index first up, the two big things that happened in the first couple of hours of the trading session. One is the fact that we managed to cross the May 7 high of 24,482. And the other one being the fact that we have managed to touch 24,500 intraday. And we are still at the day's high currently on the index. So the bulls would hope today being the weekly expiry of the Nifty contracts, they would want to defend that 24,500 level on the upside and close above that. And then that opens up the recent swing high of 24,601, which the index had surged to on the 21st of April. The Bank Nifty, after yesterday's outperformance, is taking a bit of a break today as well. So just 100 points higher on the Nifty Bank. But the good part is it is not declining. It's still in a sideways move that you're seeing on the Nifty Bank, still at the higher end of the 57,500, 58,500 range. The IT stocks, as Reema was just highlighting, we mentioned this early morning as well on Power Breakfast, that what kind of price volume action you see on the IT stocks ahead of TCS's results on Thursday will be the one key factor to watch for the market in today's session. And look at this, 3% higher on Infosys, 3.5% on LTM, 2.5% on TCS, and 2% on Persistent as well. So buying seen across the large cap and the mid cap IT space as well. Undoubtedly, the two casualties of the day, the two big ones, Trent, of course, we'll talk about that with Mangalam in just a bit. 11% lower now on the stock, below the mark of 3,000 rupees, and in line with that, Kalyan Jewellers too is down around 6% as well, despite a relatively strong business update which turned out to be lower than the market leader in the category. The capital market stocks are not also having a very good day today. 4% lower on BSC. It's another day of losses for MCX. It's now another 4% shaved off in today's session, and Angel One too following suit with another 3% downtick in today's session. Look at the newsmakers today. Rights after that multi-million-dollar order win is up 7%, still the top gainer on the Nifty 500. Cochin Shipyard's OFS came at a 7% discount. The stock is down 3.5%. Info Edge, very strong results. Business updates, 10% higher now on the stock. The biggest move that the stock has seen since April of 2024. And Apollo Micro, after the fundraise that was approved, 6% lower on that stock. And lastly, at 52-week highs today, Titan, of course, shining bright, 3% higher. IOL Chemicals, with the promoters increasing their stake in the June quarter, 18% higher on the stock. Dhanlaxmi Bank, after its business updates, has continued to move higher. And South Indian Bank too is at a 52-week high today, Reema.
Thank you very much for that very exhaustive list over there. But now let's talk about the big story, and that is clearly the kind of moves we've seen in consumption names, mostly on the way up, but a few on the way down. Let's begin with Trent, and that's on the way down. They've reported a 19% year-on-year revenue growth, but the street is still disappointed. So let's go across now to Mangalam to get more details. Mangalam?
Well, Trent is down 11% in today's trading session after reporting a 19% growth in their first quarter revenue. And here's where context is everything. If you look at Trent's first quarter revenue, 19% growth coming in at 5,666 crores compares with analyst expectations of 20 to 22%, its own historic revenue run rate of over 30%, and the company's own guided long-term range of between 20 to 25% odd. So to that extent, it has disappointed street expectations. They've added one West Side store and 19 Zudio stores. It's not a big disappointment as against expectations, about 200 to 300 basis points. But the context here is that the stock, which had rallied all the way up from 2,100 to 3,000, a 50% rally over the last 2 months, and in just last 1 month, it's up around 20 to 25%. The street expected this up move to continue here. The fourth quarter revenue growth of 20% was a teller that maybe things are likely to accelerate from here on. That hasn't happened, and which is why there is disappointment. And it's not a cheap stock. Trent has never been cheap. Right now as well, as we speak, trading after the 11% correction over 60 times FY28 price to earnings.
11% lower on Trent. Well, that was one side of the story. The other side of the story is the jewelry names, and two completely opposite reactions that you're seeing. One from Titan and the other from Kalyan Jewelers as well. Mangalam, take us through that.
Well, here it is again a matter of relative growth. Titan has done extremely well on the high base that Tanishq already has. They've grown overall business at 41%. The jewelry business has grown at around 39%. We've seen strong growth come by for, a lot of their other parts of the business as well. Tanishq, Zoya, Maya, all of them growing around 39%. CaratLane growing at around 42% as well. So those factors doing extremely well for Titan explains why the stock, despite being at a record high, continues to gain traction and stay above that record high levels as well. And beyond jewelry as well, if you look at their eyewear business, if you look at their other businesses, the likes of watches, etc., they've grown at upwards of 23%. The management has attributed this to strong consumer sentiment that they witnessed during Akshaya Tritiya and festive season. Remember, we had the period of Adhik Mas as well, which played out in towards the end of the first quarter, which is not an auspicious period. Despite that, we saw 40% jewelry revenue growth. And add to all of this, the company said this was led by double-digit growth in portfolio buyers and high ticket sizes as well. While we saw 35% sort of growth coming in both their jewelry and the studded business, it was gold coins that continued to see investor traction because people saw relatively stable gold prices out there. That explains why the stock is higher. No problems for Kalyan when it comes to reported numbers. But here's the thing. When Titan at that base grows upwards of 40% and the overall thesis of jewelry is, the smaller players gaining more market share, then the lack of growing faster than Titan has the investors of Kalyan a little worried. The stock is up, the stock is down about 7%, a 38% revenue growth, same store sales growth coming in at 28%. International revenue, obviously they have a higher exposure to West Asia, so that grew at 30%. International on the whole grew at around 35%, and Candier, which is the CaratLane equivalent, grew at around 112%. But because it did not grow as fast as Titan or the other smaller players like Senco, etc., the street is slightly disappointed, which is why the stock is down 7%.
Okay, we can't let you go just yet. Jubilant FoodWorks. Again, good set of numbers. Clearly, pizzas are in flavor.
Well, pizzas are in flavor, again, depends on context, right? If you look at the numbers, consolidated revenue growth of 14%, the standalone revenue growth is 9%. Here, Domino's like-for-like growth in India has come in at 2.5%. You would say that this is fairly soft given the fact that there were a lot of challenges this time around. We had the LPG crisis, we had, obviously fuel prices increasing, so delivery becoming a little more expensive. But at the same time, we did have the opportunities like the IPL and summer vacations, etc. Typically, first quarter is relatively strong for Domino's India. They've added 58 new stores. The Eurasia business, which is in Turkey, etc., saw a like-for-like decline of around 1.3%. Here, even the context is, on a high base of 11.5%, they've grown 2.5%, which makes the 2-year CAGR between 5 to 6%, which is largely in line with what the management has been guiding. And, the fourth quarter saw a growth of just plus 0.02%. And to that extent, again, a quarter-on-quarter jump is something that the street is appreciating. Remember, these stocks have seen a lot of time or, in many cases, price correction as well. So, slight improvement is something that the street is appreciating, and that explains why this stock is higher by about 3% too.
Not doing well is Jubilant Foods.
If only Nigel was here, he would have said, right, pizzas on you.
Yeah, but then I would have told him that at 2.5%, maybe not, maybe at 10%.
You would have pushed it to 3%, right? I think...
Well, that's Jubilant FoodWorks for you. 3% higher on that stock, back at 450. And while Mangalam gets us some pizzas, we take a short break and focus on the bond markets with Manisha Gupta on the other side. Welcome back. As promised, shifting focus to the bond markets then. Manisha Gupta is here with the latest. Manisha.
Well, thank you so much for that. If you look at the Indian bond markets, they seem to be tracking the US Treasury yields right now, which have continued to react to the weak US jobs data that the markets are looking at right now. So with that, and you have the crude oil prices, which continue to hold around that $70, $72 a barrel range, which is the lowest really in the 4 months therein. What the street will watch out from here is really going to be the India's June inflation data, which is expected on the higher side, which comes in on the coming Monday. And that is what the street is looking at right now. It also has been about the 20% deficiency in sense of southwest monsoon that India is looking at. The Kharif sowing has been much lower, almost 5 to 10% down for various crops there. And that perhaps could be leading to higher agriculture commodity prices and could show its way in case of inflation as well. In the meanwhile, as RBI's statement came in last evening, there are 13 states looking to raise nearly 213 billion via bond sales, which are happening today into the market. It's not just that, there are also various private bond issuances also slated for the day today. You have NTPC Green Energy, which is slated for today. The bidding happens today. They are raising 25 billion and they are doing it via issuances of 10-year bonds. The second company on the list is Share India Securities. They are also into the market. They are looking to raise nearly 500 million. They are doing it via issuances of bonds, which are maturing in 2027. And then today there's one more company, ICL FinCorp Limited, which is also looking to raise 250 million. But there are a couple of companies coming in tomorrow as well. And within that, you have SIDBI, which is looking to raise a big 80 billion rupees. And they're doing this via bonds maturing in 2029. There also is Godrej Finance looking to raise up to nearly 4 billion. And finally, one more company that is looking to raise money is Vedika Credit. 200 million is what they're asking for in the markets. The bidding, of course, is tomorrow.
Thank you very much for that. Let's go across now to Sudarshan, who joins in on Cochin Shipyard. He was the first one to alert that the government could look at an offer for sale in Cochin Shipyard. Initially denied, but now it's going through. Sudarshan?
So it's what we reported on June 22nd is now confirmed. Government has launched the OFS in Cochin Shipyard and is going to sell up to 5.04% stake, and of which 2.52% is the base size. And if government goes ahead and exercises green shoe option in that portion, also 2.52% equity. Why the stock is under pressure? Floor price government is set at rupees 1400 per share, and that's at a discount of almost 7% to yesterday's closing price. Remember, government holds almost 68% stake in Cochin Shipyard as of March 2026. But it's not the first PSU company that government has launched OFS in. In 2026 so far, including Cochin Shipyard, it's the eighth PSU company that government has brought OFS to raise money. So far, ahead of Cochin Shipyard, government has raised more than 25,000 crore. It's the highest PSU mobilization, OFS mobilization in a year that government has done since 2015. So government continues to cash in via OFS. It's another company, another PSU company that we are seeing OFS. And so far, non-retail portion of OFS is open. And for tomorrow OFS retail portion will open and subscription continues in the non-retail portion.
15% so far, the subscription for the non-retail portion for Cochin Shipyard so far. Of course, still early days. Still, we have time till the close of trade for the subscription. So 2.5% of the base equity, 2.5% a green shoe option as well. So looking to sell around 5% stake is the government. So Darshan, thank you for first the news break and then, of course, this update as well. The index now well above the mark of 24,500, looking to sustain above those levels. Some gainers in the broader markets. Info Edge has now moved to the day's high, 10% higher now on Info Edge, the top gainer on the Nifty 500. And a lot of the IT names too continuing to do well, be it LTM, Tech, Mahindra, Infosys, and a lot of other mid-cap names as well, like Persistent Systems. Take a short break. Market technicals on the other side with Vinay Rajani of HDFC Securities and some trading ideas as well. Stay tuned.
Welcome back. Let's talk about Info Edge. That's surging 10%. There's been a strong quarterly business update. Vinny now joins in with details on this one. Vinny, what's driving it? And predominantly, they get a lot of revenue from Naukri. I mean, that's the cash cow. And in that, they've got a dependence on the IT sector. So do we have any numbers?
Hi, yes, Reema. So a couple of news flows that came in. Obviously, today is that Q1 FY27 update. So first, let me take you all through that, right? It's a standalone billings that has seen a strong growth of around 14-15% during Q1 FY27, standing at around 737 crores. That's the billing data that we have. Now, when you talk about the overall segment-wise revenues that have come in terms of a split, recruitment business, that's leading the charts. That's where the Naukri business is what you're talking about. So that has seen a growth of around 17%. Then you have 99 acres, that is real estate side, that's a 16.5% growth. You have Jeevan Sathi, 16.5% growth there as well. While Siksha business, that's the one that's seen a bit of a degrowth. Q4 also wasn't very exciting for that. That was a decline of 21%. But all in all, when you look at it in terms of the revenue trends and the billing trends, that strong momentum seems to have continued for the company. Strong double-digit growth has continued for the company in terms of billings and recruitment. That's the Naukri side of the business leading the charts. Now, obviously, like you were mentioning, right, the Naukri side of the business, we had the Naukri JobSpeaks data that came in this week as well. So that is an important update also, where IT, yes, is important. That growth has not come in for the IT sector yet, but the AI story, that is continuing strong. The hiring in terms of AI trends, that have been strong, and that continues to be strong in the last few quarters as well. Last few months also, specifically, if you look at it, that's continued to do well. So do not forget that that is also something that's keeping the momentum a bit upbeat in the trading session. And overall, when you look at it, the stock has not been performing well. The stock move in the last 6 months, it's seen a decline of around 17%. Specifically in the last 1 week, we've started seeing that uptick coming in. It's 15% up in the last 1 week, and today itself, obviously, it's up around 10% in trade.
Now that 10% up move means that it's now the biggest single day gain for Info Edge since January the 31st of 2022. That day the stock was up 11.25%. So great going for Info Edge, 10% higher on this very strong business update there. Vinny, thank you for summarizing that for us. Strong moves. The top gainer on the Nifty 500 now is Info Edge. Vinay Rajani of HDFC Securities is now joining in for a quick chart check and some trading ideas as well. Vinay, good morning. Thank you for taking out time. We are now above 24,500, looking to stay above it as well. Do you now believe that 24,800 is the next level on the upside for the index, going past the recent swing high of 24,600?
Yeah, good morning and thanks for having me on the show. So fifth consecutive session of rise, and Nifty is comfortably trading above the 200 days exponential moving average, which was placed at 24,420. Now Nifty has secured its positions above 20, 50, 100 and 200 days EMA. That means on all time frame it is looking bullish. The next target and next resistance for the Nifty seems around the 200 days simple moving average. So as I told, the exponential moving average has been taken out, but the simple moving average of 200 days period is placed around 24,860 odd level. So we believe that Nifty is eyeing that level as a target. And now that we can see that large cap stocks have started outperforming the broader markets, that's a good sign. So we can have focus more on the large caps for the, at least for the short term. And Nifty could keep on rising while broader markets can consolidate or show some running correction. We could see some underperformance coming back into the broader markets right now. So yes, right now we are focusing on long positions in the large cap segment, and for Nifty we are eyeing a next level of 24,860. As far as support is concerned, support has shifted up. So with the stop loss of 24,300, one can remain long in the Nifty.
What about specific stocks, Vinay?
Yeah, so stocks today I can see IT and auto. These are the two sectors which are showing strength and momentum is there. So we can generate some alpha returns from this particular sector. So HCLTech from the IT space I like, though it has risen in last 2-3 sessions, but still I feel that before the TCS results announced, I think stocks can extend this pullback rally. So HCLTech is looking good on charts. So around 1158 one can go long. 1140 should be the trading stop loss, and on the upside we are expecting a target 1200. The second stock is from the auto space. So M&M, so Mahindra and Mahindra has started doing well after Maruti. M&M is looking good. So I think around 3200 one can go long in M&M. 3150 should be the trading stop loss. On the upside we are expecting a target at 3330.
Now, Vinay, a couple of stocks that are making some extreme moves on either side. I wanted your views on both of them. Info Edge is one of them. The stock is up 11%. And Trent is the other one. The stock is down 11%. Where do you see Info Edge headed now, considering this up move? And where are the next support levels that come in for Trent after this kind of fall that you've seen today?
First, we talk about Naukri. The Infosys stock is up by more than 10%. Volumes are significant today. Stock has also surpassed the 200 days EMA, so good development. And previously, last couple of months, we saw some sort of consolidation going on in the stock. So today it has shown some participation. So I think we are approaching the result season, and result season we have seen many times that the stocks, well-known stocks which have fallen a lot, have tendency to recover significantly. So this is showing the price and volume data is suggesting that Naukri and InfoEdge should continue to do well in the coming times. The next target or next resistance we can see for the InfoEdge is around 1170, which is very short, near to it. But yes, this overall strength should continue if we take a positional view as well. And support for the InfoEdge is around 1085. So that should be kept in the mind for as far as trading is concerned. Another one is Trent. So Trent was doing well previously. Still, after 11% fall, there is a hope that it could find support near this 200 days moving average, which is placed at 2930. So though it has fallen today because of some news, but the primary trend of the stock is positive. So we can take a chance by hoping that it will find support at its long-term moving average. So I would review it at this point of time. Shorts are not recommended. But yes, around 2930, there is a strong support. And if it bounces back, then there is a good chance of resuming the uptrend.
Okay, thank you very much for that. There was news which was just breaking in that India will be supplying the BrahMos missile system, the Astra air missile, to Indonesia. Remember, Prime Minister Modi is in Indonesia from 6th of July to 8th of July, and the announcements that have come through could be just a part of some sort of framework, some sort of agreements between the two countries to expand their cooperation. Defense stocks have been active. Yesterday, we had the large procurement order acceptance from the DAC, Defense Acquisition Council, and today you've got another leg up. But I suspect exports is still a very small portion, but I guess it's just a strong validation of the capabilities of these Indian missiles.
I can see the recovery as well on Bharat Dynamics, who is actually the manufacturer of the BrahMos missile. So after the initial recovery that got sold into, Bharat Dynamics has now recovered almost all of its losses, is back near the flat line, and nearly almost all defense stocks are actually recovering from the lows of the day. Just saw HAL as well, they're recovering from the day's low, the defense index as well recovering from the day's low. So positive news flow coming in for a lot of these defense names. And he had a note yesterday as well from Motilal Oswal that had highlighted three names that it was betting on, Bharat Electronics, HAL and Astra Micro. That were the three names that it was betting on. Take a short break, continuing our conversation on the markets with Sheshadri Sen from MK Global Financial Services on the other side of this short break. Stay tuned.
Welcome back. The Nifty IT index continues to chug along. It was just last week that the index had hit, I think, a 3-year low. And from that level, we've seen a recovery of 9% on the Nifty IT index. 1st of July was the recent low on the Nifty. That was last week, I think, on Tuesday. And from that level, it's been a very good recovery. Mid-cap stocks in the IT pack leading today, Tata Tech with a 7% gain. LTM has a 3.5%, LTTS 3%. Persistent Systems, which got bashed last week on Monday, making that Nagarro acquisition, has been quietly climbing up. And in the large cap space, today it's Tata Technology leading from the front. That's got a gain of about 4%. Infi, TCS, all of them seeing some buying today. But let's talk about the futures and options trend. Mangalam now joins in with the latest.
Well, it's a good day of trade. The Nifty is doing extremely well, above the 24,500 mark. And as you pointed out, it is the IT stocks which are doing the heavy lifting in today's trading session. But over the last few trading sessions, you've had this alternate moves between the IT index as well as the Nifty Bank, which is above the 200-day moving average and perilously close to its all-time high as well. Then the Nifty Bank is up by about 0.25%. The IT index, as we speak, up nearly 3%. And in today's trading session, the important part is it's gone ahead and conquered the 20-day moving average. Remember, on Friday and Thursday, when it rallied last week, it saw some resistance at the 20-day moving average, which is why it underperformed in the trading session yesterday. And now that it's crossed past that, we'll watch out for higher levels coming in on the IT pack and maybe perhaps a little more support coming in there too. The only thing that bulls would have wanted more this trading session so far is the advance decline ratio to look a lot more in favor of advances than the decliners. In fact, as we speak right now, those lines are far and wide apart, with nearly 1,900 stocks in the red for about 1,000 stocks which are in the green right now, which is what puts a bit of a cap on the gains that we're seeing on the frontline index as well. But that also means that support for the market has moved higher. Ahead of expiry today, we have the 24,450 put writers fairly active in trade. We have the 24,400 put writers equally active in trade as well. And the premium is all but eroded out there, telling you that the supports are very close to the 24,450 mark right now on the frontline index. The 24,500 call writers are still active, premium of around 39 rupees, telling you closer to 24,550, we are likely to see some supply come by. Were that to not happen and the market would sustain at higher levels, then all the 3 crore writers at the 24,500 call will have to cover their positions ahead of expiry today, and that would cause a further pop in the last hour of trade. But amidst all of this, a lot of individual stocks are on our radar, some on the back of strong updates coming in. So Info Edge for one, up 10% right now, a lot of long positions added out there. Jubilant Foodworks is the other one as well. A lot of long positions added on that counter. And finally, we have Titan, a stock that has hit a fresh record high. Good first quarter update. And that too is seeing a lot of long positions being added.
Good way for Titan as well in today's session. A record high market cap back above the mark of 4 lakh crore rupees as well. Mangalam, thank you for that update. Continuing our conversation on the markets with Seshadri Sen from MK Global Financial Services. Seshadri, good to have you back on the show. Thank you for taking out time. It's a very interesting lead that you have put out in your latest note, where you have gone underweight on financials and you have completely exited your exposure to large caps and PSU banks. Take us through the rationale behind this move, and now that you have done this, how are you planning on playing this theme?
Thank you for hosting me. Yes, you're right. We've exited our large cap and PSU bank positions. We have been maintaining for quite some time that the large cap private sector banks are unable to match the growth levels that their valuations demand. When you're trading at 2 to 2.5, your growth needs to be above your ROE, whereas the large cap banks are hitting growth ceilings at about 16 to 18% due to a combination of factors, including a high base effect. To this level, we've seen that when they go to above a certain valuation and we are in that valuation zone, there tends to be a period of time correction. Yes, the cyclical factors are in favor of this sector. We're expecting a sharp margin bounce back. The credit cycle continues to be quite strong. And asset quality remains quite pristine. But there are pricing pressures all across the spectrum in the space. Credit cycle is strong on the growth side, but there are pricing and yield pressures across retail and wholesale, with SME, which is a small part, the only area where they're able to protect margins. So in a bull market, we think that this segment this sector, the large cap banks, will at best be market performers or probably underperformers. You may see some absolute price appreciation, but they are likely to underperform a rising market, which is why we've exited from that position. Our primary thesis in terms of the sector that we are most bullish on is consumption. The GST cut and the strong credit cycle also contributes to that high consumption thesis. So we've reallocated that weight to consumption, on which we are significantly overweight.
So what are fair valuation multiples for private sector banks, given the fact that there is increased competition, but they are in a bit of a tactical upmove, cyclical upmove right now? You said that 2.5 times price to book is overvalued.
1.7 to 2 times is where...
So many of them are at 1.7, 1.8. Many of them are sub 2. So you don't think there is a valuation support?
Yeah, meaning those who are at 1.7 have lower ROAs. So we were quite enthusiastic when the sector was at 1.5 to 1.2 to 2 times. That's when the up move started. During the Middle East crisis. But now they've rallied. I think they've priced in the FY27 cyclical up move, because there is nothing to address the longer term structural competition that is coming from NBFCs, from fintechs on the deposit side. So again, the financials theme, we also prefer small and mid cap banks, which are offering what we call growth beta. If the system growth is X, they are able to grow at 1.4, 1.5X. And that is one segment that we like. And NBFCs, we are neutral because there also we face valuation challenges. And some of the small and mid-cap banks offer better growth beta. And with the SMID banks, valuations are also fairly comfortable at this point.
But Seshadri, you mentioned PSU banks as well. Fair to say that the best of the PSU banks is now past them, considering the fact that they have already wrested market share from their private peers. Their growth they have also seen multiple quarters of steady growth, stable asset quality. But now are the valuations past what the market is already factoring in?
Yes, PSU banks face a tough FY27. Unlike the large private banks, they are facing the next 12 to 18 months. There are multiple challenges. The first is that there's a high profit base, a high treasury proportion in the base profits of FY26. So all of them are facing falling ROEs and very sluggish EPS growth. Secondly, if you take a 1 to 2 year view, we think that credit costs have bottomed out. They're benefiting from recoveries from some of the past, NPAs, which they're recovering from. Once that dries out, credit costs will normalize upwards. And then there will be, we think, some significant impact of ECL provisions which kick in from FY28. Finally, they've all been operating on fairly thin capital bases because they are backed by the government, rating agencies, and the market have been. But I think that period is coming to an end, and most of them will have to raise their capital ratios, which as we know, their ROAs aren't great. Their ROEs are good because of high leverage. That story also may unwind in the next 12 to 18 months. So multiple pressures on the PSU banks. So while we agree that some of them are relatively underpriced with similar metrics as the private sector banks, but the next 12 to 18 months don't look great, which is why we are not taking a position there as well.
Seshadri, you look at the AMC space very closely. SBI Mutual Fund will also be coming out with its IPO very soon. Have you done any analysis, and how would it compare with the listed players? The large ones are HDFC, ICICI Pru. You also have a Nippon, etc., Aditya Birla. What are your initial thoughts on this IPO? And then if you want to tell us which stock is best placed in the AMC space.
No, we haven't done a deep dive into the upcoming IPO, while we do acknowledge that this is one of the strongest franchises. We are very bullish on this space overall. We've written a report some time ago, which our assessment is that the share of equities in household financial savings has moved up from 16 to 30% in the last 8 years. Last 2 years has been relatively stagnant. But we think in the next 5 to 10 years, this number will go even higher. just because, the markets are stable, fixed income yields are barely covering inflation, especially adjusted for tax. And the deepening of the equity markets will continue. So we are bullish on the entire capital market intermediary space. AMCs and wealth management are our preferred routes to capture this. We tactically move around which stock we like. We like all of them, but we tactically move around. At the moment, we've taken a view that, in a high beta market, preferably to go to some of the smaller, turnaround names rather than the big solid franchises at higher valuations. But you could pick any stock in this sector, and from a 2 to 3 year perspective, I think you will get outperformance.
Pleasure having you as always, Seshadri. Thank you for sparing time and joining us on this very interesting analysis that you've done on the banking sector and the financialization theme as well. Take a short break. Back with more on the markets on the other side. Still 80 points higher on the index, so continuing to hold on to the gains is the Nifty. But the big developments that came in from Saudi Arabia last evening was the fact that they've cut the price of its main crude grade effective from August for its Asian customers amidst weakening demand and easing tensions in the Strait of Hormuz. Now Sonal is joining in with more details on how this impacts India's oil marketing companies. Sonal.
Well, yes, the cut has come by on the back of an oversupply. Demand continues to be very robust across the board for crude oil. But yes, it is a big move taken by Saudi Aramco. They have cut their August official selling price by $11 per barrel, which is the biggest cut that we've seen in 2 decades. And now this price is at $1.50 per barrel, lower than the Dubai or the Oman crude, or basically the Middle East prices that we are seeing. And this is only for Asian customers. Now, do remember, this is done in advance. Usually, Saudi Arabia doesn't sell on spot, so it anticipates what the market is going to look like going forward and adjust the prices accordingly as well. Saudi Arabia is the third largest crude oil supplier to India, and the import value was around $2.59 billion, or around 16% of India's Q1 imports overall. Now remember, Russia continues to be the biggest importer at around 50%. It of course is a positive for oil marketing companies who regularly buy from Saudi Arabia. There was a recent note from ICICI Securities as well, where they indicated that if crude remains in the current range, that is between $70 to $74 per barrel, it will ensure that retail margins stay at elevated levels of around 8 to 10 rupees per litre, and earnings profile of OMCs could materially change in the next 12 months. So they continue to be very positive as well. This is also positive for Reliance Industries. So yes, this has come in as a big surprise and a big cut as well. But do remember, it is on the back of oversupply that we are seeing in the market now that things are easing and more Middle Eastern crude is coming to the market.
Well, indeed, thank you very much for that. We caught up with former HPCL chairman M.K. Surana, where he says that this move is a part of a normal pricing mechanism adopted by producers and is in line with expected market conditions. Listen in.
It is a combination of the pricing mechanism which the different suppliers follow, and of course a pressure on the oil suppliers to tie up the market volumes in terms of increasing competition. The companies like IOC, BPCL, HPS India, it is a good news. Overall for the country like India, it is good news that there are more suppliers who are vying for this market, and we who are so much import dependent, we will get the cheaper oil.
That was Saudi Aramco and its impact on oil marketing companies. The other stock that has done well today is RITES, the railway PSU that has won an export order of 341 crore rupees from South Africa-based Volantis Asset Finance. Devyani is here with more details on that. Devyani.
Well, RITES is buzzing in trade today, and that's on the back of another order win. Now, RITES has won an export order worth $35.8 million, which translates to about 341 crores in Indian rupees. Now, this is from Volantis Asset Finance in South Africa for the supply and commissioning of 4,000 horsepower Cape gauge diesel electric locomotives, and the order is expected to be executed within 20 months. Now, keep in mind the order book at the end of FY26 was at around 9,416 crores, which is the highest that the company has ever recorded. And Q1 also saw a strong set of order wins for the company. Now, Q2 also seems to be off to a strong start for them.
Thank you very much for that. Get into a break. More on the markets when we return.
Welcome back. At 24,520 is where the index currently stands. So holding on to gains firmly as we head into the second half of this weekly options expiry session. What's recovering from the lows are the broader markets. The mid-cap index at one point was down close to 380 to 400 points. That has now cut its losses, is down just around 200 points. So it's cut its losses by half as the mid-cap index. So some recovery seen in the broader markets as well. Kalyan Jewellers is off the lows of the day as well. One point was down around 7%, still down 5%. But some recovery from the lows nonetheless. What is not recovering from the lows though is Trent, still down 11.5%, still the top loser on the Nifty and the Nifty 500 as well. So not good going for Trent. And the capital market names too continuing to see losses, with MCX and BSC both down around 4% each. But as we wrap on this edition of Trading Hour, here's some interesting market opinion coming in from Quant Mutual Fund's Sandeep Tandon. He shares his optimism over India's capex and infrastructure plays. Here's an excerpt from that chat while Rima and I take your leave from this edition of Trading Hour. Thank you so much for tuning in. Halftime Report takes the action forward on the other side.
We have said the beginning April that is a time for India. India is coming back, and if global market corrects further, which we have opinion that US market and even Korea, Taiwan market will correct significantly from these levels. If I have to talk about next 2 quarters or so, then obviously India will be a winner in that. I think the background is more constructive and very stock specific rather than getting too much worried about what is happening in terms of index level. I think index will not give you a real flavor of the market. I think stock specific approach will give you far superior returns. You have to look at asset heavy businesses where you have cash flow generating ability, large capex is going on. That's where the FIS trend is now. If you look at all the recent infrastructure related QIPs, the buying interest was very large. And we have seen many FCI names are buying these names. Okay, so I think money is actually moving out from these top 10 names to some of the defensive name. And that's the reason I said there's opportunity, whether you talk about ports, airport, roads, or large infra names, power companies, some of the renewable names. So these are the area where FI have a lot of interest in India.
The markets see a rally in large cap names even as selling in mid cap is broad-based with declines stopping advances. IT and consumer durables notch gains while industrials and realty drag.
The stock of Trent slumps after Q1 revenues failed to meet analyst expectations. Growth in Q1 comes in below the Q4 rate against expectations of a significantly better performance.
Titan grows Q1 sales faster than Kalyan Jewellers despite its significantly larger scale of operation. Even overseas business for Titan expands at a significantly higher price. The stock of Kalyan Jewellers takes a beating while Titan perks up.
After Coal India, Central Bank of India, NHPC, GIC, NLC and IRFC, the government has now launched an offer for sale in Cochin Shipyard to offload over 5% stake. The stock slips on the fresh supply.
Saudi Arabia cuts oil prices for August delivery by $11 per barrel, the steepest cut in a decade. Experts point to oil seeing a surge in global supply even as refining capacity is constrained, boding well for Indian refiners.
Hello and welcome to Halftime Report. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Putra. With me as always, Vinny Motiwala. And what a day it has been. The recovery from the lows and the contribution from IT that we are seeing. Mid-caps too are recovering from the lows of the day as we speak. The advanced decline ratio though continues to be in the favor of declines as we speak. Actually, it's the IT which is doing the heavy lifting that we are seeing today. So the contribution chart should also come up for you on the screen. A lot of these fund managers becoming slightly positive on the IT space and the AI trade that we have been talking about is something which the markets are not looking at anymore. So for now, yes, the Nifty IT is the one which is the top gainer, up around 3% in trade. Realty, which was the top gainer yesterday, has come in for some profit booking. That one is down around 1.5%, followed by metals. Energy pack also not doing so well in trade. Mid caps, as I said, is lower in trade, but is seeing some recovery. But with the advanced decline ratio continues to be in favor of declines. And it is the start of earnings season from Thursday. We have TCS first up, and there's no dearth of Q1 updates. They're coming in thick and fast.
Absolutely, Sonal. And all those stocks are also moving around in the trading session on the back of their Q1 updates. Broader end of the market now, InfoEdge. That's the top Nifty 500 gainer on the back of its Q1 updates. You have RITES, Latent View, Infosys, which is, the large cap IT company, which is managing to hold on to gains as well. And obviously, like Sonal mentioned, IT is the top sectoral gainer. Metals is something that is not doing well in the trading session. But let's talk about what we have lined up for you all on the show today, right? We'll talk about some of the FMCG companies that are reacting to those Q1 updates. And we'll talk about specifically Trent, Titan, Kalyan Jewellers. We'll also be putting the spotlight on some other big movers like Tech Mahindra, LTIM from the IT space, and TVS Motors from the auto pack. We'll also be putting the spotlight on small finance banks. They have released their quarterly updates, and management of Capital Small Finance Bank as well as ESA Small Finance Bank will join us later on the show to talk about the trends that are going around in the space. But first up, let's get started with all the stocks that are moving around in the trading session, and Vivek is here to take us through all of that. Good afternoon, Vivek.
Well, good afternoon. Thank you so much for that. Well, the advanced decline ratio in the broader end of the markets is quite stable, quite strong, and that's led to a bit of a bounce as far as the markets are concerned. In terms of individual stocks, individual sectors, can't look beyond the IT pack. Remember, results will start this week onwards, and we're seeing a bounce across most of the IT names, both large as well as small caps, mid caps too, moving along. So Tech Mahindra, one of the top gainers, almost 3.7% higher. TCS seeing a strong bounce, almost 2.7% higher, and Infosys amongst the highest movers as far as the larger cap IT companies are concerned. InfoEdge or Naukri, Q1 billings after a while seeing double-digit teen growth, so that helped the stock to perk up quite significantly, 10% higher over there. Select auto companies are seeing a bit of a bounce back in today's trading session. So names, especially the two-wheeler names, TVS, Eicher, Bajaj Auto, Hero, all of these stocks higher by 1.5%, even Maruti gaining along with them. And RITES, this particular name, not one we discuss too often, but that stock on very good volumes today, up by almost 6.5%. On the other hand, quite a few laggards as well. Well, the entire capital market companies, so names like BSC, MCX, Angel, and all of these stocks under a bit of pressure. But before we do that, we also saw Apollo Microsystems on the wall, and that particular stock after the fundraise falling. Like you mentioned, the capital market stocks, Angel One, MCX down almost 5%, a significant drop in trading volumes post the implementation of the bank guarantee. Now, talking about the entire capital goods space, a bit of a fall once again. BHEL amongst the top laggards over there. G Vernova, TND, Cochin Shipyard post the OFS, all of them under a bit of pressure. And realty names seeing a bit of profit booking today after a good rally. So names like Brigade, DLF, Prestige Estate, Aditya Birla, all of these names under a bit of pressure.
Okay, all right. So those are some buzzing stocks. Let's thank you, Vivek, for joining us now. Let's get stock specific now and talk about some of the quarterly updates that have come by. There's a lot from the consumption space. Trent is one of them. The stock is lower in trade. Mangalam is joining us now with what the Q1 update looked like. Mangalam.
Well, for Trent, context is everything. The company reported a revenue growth of 19%. The street was working with a number of 20 to 22%. So this 100 to 200 basis points miss as against street expectations has the stock a little worried. And here as well, it wouldn't have been so had the stock not rallied about 20% from the start of this month to now, ahead of this update coming in, or even from April lows of around 2100, the stock has seen a rally of almost 50%. So the street was anticipating some sort of acceleration, especially after the fourth quarter, where the company reported a 20% revenue growth after 3 quarters of doing between 17 to 19%. Remember, the last 5 years, the company's revenue growth has been over 30% on a compounded basis, and the management as well has guided for sustained revenue opportunity, at least between 20 to 25%. So the street had pinned its hopes higher, and to that extent, a slight miss has caused an even bigger dent on the stock price because of the recent outperformance. And add to that, despite the 11% cut that we're seeing, it's not particularly cheap, trading at over 60 times FY28 price to earnings. Now, the results on the margin front will be even crucial to track, given the revenues have grown at 19%.
Absolutely, Mangalam. Thanks so much for the update on Trent. But do wait by, because a couple of jewelers also have reported their numbers. Titan, strong update. Stock is up in trade. On the flip side, you have Kalyan Jewellers. Not so exciting there in terms of numbers.
Well, it's again, to quote a movie dialogue, if your friend fails, you feel bad. But if your friend does better, you feel even worse. That's exactly what happened with Kalyan Jewellers. And if you look at the industry leader, Titan, stellar set coming in, 41% overall domestic consumer business growth, jewelry business growing at 39%, even their mainstay like Maya, Zoya, Carrot Lane, Tanishq, all of them growing between 39 to 42%. The non-jewelry part of the business for Titan as well grew at 23% for both their eyewear as well as the watches business. The companies said that Akshay Tritiya has done well for them alongside the festive season. Buyer growth has been in double digits. The average ticket size has also grown in double digits. Add to all of this, this quarter, when it comes to the operational performance, will have an element of an exceptional gain coming in also, because the customs duty was hiked mid-quarter, and the companies which are sitting on old inventory will see a benefit on account of that. And then the company said that gold coins also led growth for them. International operations, which are a smaller part for Titan, but a recent driver for growth going forward, has also doubled year on year. Kalyan Jewellers, not particularly bad, but it's not grown as fast as Titan. And that's why the street is a little disappointed, because over the last 12 to 15 quarters, Kalyan Jewellers' growth on a relative basis and a much smaller base has been higher than Titan. But this time around, the first time in last many quarters where Kalyan Jewellers' revenue growth has been 38%, and this has been led by 35% growth in their international business and 38% growth in their domestic business itself. We've seen a 28% same-store sales growth for them. Candere, the Carrot Lane equivalent of Kalyan, has grown at around 112%. 38% is not particularly bad, but it's not industry beating this time around. Even Senco grew at around 60% on a much lower base, but Titan at 39% on a much higher base. So it's okay, but not as good as Titan, which is why the stock is lower.
Okay, all right. Comparison is what makes the market, right? It's very subjective, but we are not done yet. The last one for you today, Mangalam, Jubilant Foodworks. What about that one?
Well, consolidated revenue for Jubilant Foodworks grew at 14%. The standalone business is what we track more closely to get a sense of how India has done, has grown at around 9% year on year. Here, the Domino's like-for-like growth has been around 2.5%. Now, on an absolute basis, 2.5% is something that the street would be disappointed by. But remember, here as well, context matters, because if you look at the trend, in the fourth quarter, this number was 0.2%. And then after that, the first quarter, you had a lot of disruptions as well. The LPG shortage that happened. Alongside that, the delivery costs would have increased for the company largely because, fuel costs had increased. So all these factors were negating factors. But despite that, the companies managed to do about 2.5%. And this perhaps could have been led by, higher share of revenue coming in because of the IPL. You had, the summer vacation. So all these factors working in their favor. Add to all of this, the base also of around 11.5% growth plus a 2.5% makes a 2-year CAGR between 5 to 6%, and which is what the management has been guiding for. 5 to 6% growth coming in from like for like, and then them adding another 10% in terms of additional stores. So that would make the revenue growth around 15-16% on a sustainable basis. So despite that 9% growth that has come in on their standalone India revenue, the street is happy because one, it is acceleration quarter on quarter, and secondly, we've seen year-on-year growth, which is largely in line on an LFL basis by the management guidance. And importantly, the stock also has seen time correction, if not much price correction, and going forward with the 58 Domino stores that they've added in India and the outlook for the international business also improving, the street is betting on this one. So let's see how that pans out. The stock is slightly higher on a mild beat as compared to the same time last year.
Okay. Mangalam, thank you so much for that. That's a whole roundup in terms of the consumption basket as of now, from clothes to QSR to jewelers. So thanks so much for that. But on that note, we're going to slip into a very short break. Viewers, don't go anywhere. We'll come back with more in terms for markets, more on stock-specific action as well. Stay tuned in. Welcome back to Halftime Report on CNBC TV 18. Looking at the markets as of now, 24,520 around that mark, day's highest point. Around that level is what the Nifty is trading at, given up a few points in the last few minutes. So let's watch out for that, but still holding on. Today's the weekly expiry as well. We'll see where that's going to be headed, whether there's some volatility that comes in the second half of the trading session. But what's an interesting trend that's been coming up is going to be in the small finance banks, right? And to talk to us more in terms of that, because we have a lot of Q1 updates that have come in from private banks, PSU banks, as well as small finance banks. Seems like an exciting update that's come in, especially from small finance bank. They're doing better. To talk to us more about it, what is the trend on ground? What is happening on ground? We have Sarvajit Samara, who's the MD and CEO at Capital Small Finance Bank, as well as K. Paul Thomas, MD and CEO at ESA Small Finance Bank, joining us on the show. Good afternoon, gentlemen. Thank you so much for joining us on the show. Let's start by talking about the trend. Small finance banks have done better in terms of Q1 updates. You all are seeing good growth in terms of advances. Deposit growth has been well. And there's one important thing is the El Nino condition still persists. So first, let's start talking about the trends that you all are seeing in growth and deposits. Mr. Samra, what is your outlook? Good update coming in right now as well. But is this something that you all are seeing continuing in Q2, this trend of strong growth? Is that expected to continue?
Yeah, but as you have said that the bank has commenced the financial year on a strong footing and with a healthy growth overall in all business parameters. So if I talk about advances, the year-on-year growth is 22% and quarter-on-quarter 4.5%. And similarly, in deposits, a yearly growth of 16.3% and quarterly growth of 5.8%. And for the year ahead, earlier guidance which we have given for the year is 22% growth in advances. And I feel that we are very much aligned with regard to that. Yeah.
So you will continue to see 22% advances growth going forward as well. That's about Capital Small Finance Bank. Let's get in Mr. Thomas in the conversation as well. Mr. Thomas, what is that you are guiding for FY27? And as Vinny pointed out, there are El Nino risks. We are talking about maybe some impact on agriculture. You do have presence across the board. If I look at your geographies, it's Kerala, Tamil Nadu, Maharashtra, Karnataka, Madhya Pradesh, and other states are around 19%. What kind of signs are you getting in terms of demand? What is the percentage of your book that is completely secured?
Thank you for having me in this show. As Samraji said, at Hisar Small Finance Bank also, we have seen very healthy advance growth in Q1 FY27. So we have a 27% of growth compared to Q1 FY26, excluding our the IBPC book. So including the IBPC, it is 32%. The deposit side also, we have seen healthy, steady growth. 18% growth is there on the deposit side also. So overall, we could see the credit demand is there in the market. And the unsecured. So for last 2 years, we have been working to bring down our unsecured portfolio. So we have introduced a marked strategy, MSME, agri, retail, and gold loan. So with that, we have brought down our unsecured book to 38%. 38%. 2 years ago, it was 70%. So we brought down to 38%. So major 42% of the overall book constitute of gold loan. So you asked about the El Nino impact. We are yet to make a real assessment. So we are seeing the signs in different places, especially in Kerala, around 20% less we have noticed. So if that is the case, there won't be any issue. And majority of our customers actually having multiple income streams. So we hope that that will not impact the portfolio quality.
Mr. Thomas, what is the outlook on advances growth for the year and deposit growth as well? What are you guiding for?
Yeah, we have said earlier that advances will grow 25 to 27%, and we are seeing the Q1 also is on that ratio, and we are expecting that will continue in the coming quarters also. And deposit growth with the FCNR deposit also, we are expecting close to 21% growth in deposits also.
Mr. Samra, I want to know more in terms of El Nino and specifically your AUM distribution, right? Agriculture alone as well as MSMEs, that accounts for around 50% of your AUM distribution. What is the trend or impact that you're seeing? Any concerns that have shaped up on that front given the current conditions, or there's nothing much to worry as of now?
As we are into agri, and agri is mostly in Punjab and Haryana. For agri also, we cater to the middle income group farmers. So in Punjab, if you see there's canal irrigation and there's a tubal irrigation where there's slightly less dependence on the monsoons. So we don't witness any concern with regard to these conditions, and otherwise it has started raining. That's a good omen. It rained today also. So we expect that there was the news in the paper also. So we mainly are into agri, into Punjab and some parts of Haryana. And with regard to distribution of loans, where MSME constitutes 25% and mortgage loans constitute 25% for us, and agri is 28%. And with regard to the percentage of secured versus unsecured, we are mainly into secured lending, where 98% plus is secured lending for us. And we cater to middle income group, both for deposits as well as for advances. Both sets of business is coming from the same segment.
So right now, no, borrow repayments or credit demand, no concern on that front in Q1, right?
No, absolutely not. If you see, say, with regard to gross NPAs, in the first Q1, they have further improved to 2.47%. As on the 31st March 26, this percentage was 2.54%. And demand, as you see, that is witnessed from the quarter-on-quarter growth. Relatively, Q1 is slightly slow on growth, but the type of growth that we have seen in Q1 itself, we are very much aligned that, as I'm just repeating that we'll be able to cross our guidance of 22% plus for the current financial year.
Okay. Mr. Thomas, what has the collection efficiency been? And this would be the same question to you, Mr. Samra. Considering that you are talking about strong credit growth, strong deposit growth as well, and El Nino impact has not been seen yet, how has the collection efficiency been so far?
On our micro loan book, the loans disbursed during the last 18 months. So it's showing a collection efficiency of 99.5%. So we are not, that was a more collection oriented we are having. The rest is gold loan is mostly bullet payment. So we are not seeing any stress in our any challenge in our collection efficiency in any of the book.
What about you, Mr. Samra?
Yeah, it's a similar. For us, collection efficiency is 99% plus. And even we have seen reducing the percentage of SMA 1 and SMA 2 have also further improved. So there's absolutely no concern with regard to the collections. Yeah.
Okay. No concerns coming in there. Two small finance banks, interesting conversations there. One more focused on the north side, one on the southern side. So, gentlemen, thank you so much for joining us on the show, giving us a perspective of what's happening across the country in terms for loans, prepayments, and efficiencies in terms of collection as well. Thanks so much for that. On that note, we're going to slip into a very short break. After the break, we'll have Sachidanand Tekar of Trade Bulls joining us to talk to us about his trading strategies. Stay tuned in.
Welcome back. You're still tuned in Halftime Report. It is all about quarterly updates, be it from the consumption space, financial space, or now the realty space as well. That index is the biggest loser today, but we do have, these updates trickling in. TARC is one of them that I'm tracking very closely. The company reported its quarter one update, which looked very strong. Pre-sales are up 3 times on a YY basis to come at 602 crore rupees. Collections are up 80%. The company says they continue to see tenacious demand across luxury developments. This is an NCR-based player, and they are largely into luxury and ultra-luxury projects where the demand continues to be very strong. They say collection efficiency also continues to be strong, and this leads to strong cash flow visibility as well. So even on the balance sheet side, they expect growth to continue, and that's why the stock is high by 6%. In a time when the realty pack is not doing so well. At the same time, the markets have come up from the highs of the day. So the Nifty, which was up around, was up more than 24,500, has come off sharply from the highs of the day. When we started the show, it was up 92 points. It's up just 65 points right now. So what are the charts suggesting now? Let's get in Sachitanan Utekar of Trade Bulls joining us on the show for that. Sachitanan, good afternoon. Thank you so much for joining us. What are the trends suggesting? Will we get a one-way move, or it could be volatile, the way we are seeing a fall from the highs of the day right now?
Good afternoon, Sonal. Sonal, I think when we look at the major trend is well intact. We are expecting that in this particular series itself, Nifty could scale towards 24,950, 25,000 kind of a level. Now, if you look at the overall pattern construct, last week we saw a very strong breakout from a bullish flag pattern, which is again a continuation of trend. And if you look at today's session, probably after 5 days of a rally, we are seeing some kind of consolidation here. The 24,500 call congestion is something which is very significant. So we don't expect the Nifty, to continue its momentum at least for the day. For the day, we may see some consolidation here on the higher side. 24,540 remains a hurdle. We may see some slippages in the second half towards 24,440, 460 kind of a zone. But overall, I think the major trend remains intact. The expiry could shape up within this particular range. There's a good chance that we may not close the day above that 24,500 mark.
Sachitanan, the individual names that you're looking at this afternoon?
Good afternoon, Vinny. Your IT is leading today, and if you look at Infosys, now after a very good consolidation, what we have observed here is that in the last 2 trading sessions, Infosys has started trending above its 5-day exponential moving average. Even today, it made an attempt to cross that immediate hurdle of 20-day exponential moving average, which is somewhere close to around 1,078. But if you look at the developments, the relative strength has been improving. There's a good, strong breakout on the RSI. So we are expecting some more follow-through action to be unfolded in the coming session. And that's why we are recommending building fresh long positions in Infosys. One can keep a stop loss at around 1,062 on closing basis and expect a rally towards 1126, where it's a 50-day exponential moving average resistance is placed. So we are expecting further legs for the entire IT pack, including Infosys. The second stock on our radar, which we have also recommended to our clients, is LIC insurance futures. So if you look at the overall pattern construction here, again, there's a bullish pennant formation wherein we have already seen a good, strong breakout above that 435 mark. What we are expecting is a quick run towards 455, and hence we are recommending building fresh long positions, keeping a stop loss at around 432 on closing basis.
Okay, all right, take that point. But Sachinaran, we do have some individual queries which are coming in from our viewers. Puneet Jain is writing to us from New Delhi. He holds 200 shares of Yes Bank at 20 rupees. He asks if he can exit the stock. He bought it at 20. The stock is at 24. What do you suggest?
Well, the major time frame depends, but if you look at the overall, trend construction, we are expecting that going forward, the relative outperformance that we have seen in the last, few months, it may continue, and we may see Yes Bank scaling towards 29.5, 30 kind of a zone. So I think even right now, if we have seen some decline here, I think this decline is again a good opportunity. I would rather, advise him to hold on to his positions, keep a stop loss at around 2250 on weekly closing basis, and ride this particular trend towards 29.
Okay, Sachitana, one more query that we have coming in this morning. Umesh Yadav, who is writing to us from Pune, he's asking about UCO Bank for the short term. Is that an interesting chart right now?
Not really. In fact, if you look at the overall performance, it has been an underperformer. And if you look at last 3 weeks, there has been a declining sequence. The stock is unable to, sustain above its 200-day exponential moving average resistance. And if you look at the immediate support, it is around 26, where its 50-day exponential moving average support is also placed. So I think the stock is more in a consolidation mode. We may see some further slippages. The level at around 22.5 could be very significant. I think if he is holding it for a long term, then probably he can keep a stop loss there. But from a short-term perspective, we may see an oscillation move between 25 on the lower side to 28 on the higher side.
Okay, take that point, Sachinandan. Thank you so much for joining us with that advice and a couple of these individual queries. Before we go across to Sudarshan, let's take a look at what the markets are doing. The Nifty, as we pointed out earlier, has come up from the highs of the day. It is up 50 points. And a couple of these names, be it Tech Mahindra. Tech Mahindra has come up from the highs of the day. It is still higher by 3%, but seeing some fall from the highs. Trent, of course, continues its downfall. We do have TCS as well, which is coming off from the high, leading to the fall that we are seeing on the Nifty. There is Hindalco, which is at the day's low. We have Max Healthcare, which is at the day's low as well. Indian Hotels has put out a Q1 update and the stock is higher by 1%. We'll discuss that in greater detail. But for now, let's go across to Sudarshan. He's joining us with what the F&O setup is looking like at noon. Sudarshan.
So while the overall tone of the market remains bullish, but I'll be a bit cautious at this level because there are few indicators which are indicating that market kind of has entered overbought zone. So first talk about at this point, benchmarks are outperforming. Nifty continues to trade around 24,500, but mid caps are underperforming. That's the reason market breadth is firmly in favor of declines. Why I'm saying we need to be cautious? Two reasons. First, Nifty PCI, it has risen to the levels above 1.60 versus yesterday's level of 1.36. So once it crosses the level of 1.30, normally we get to know or we see that it's in overbought zone. Second, India VIX remains below the level of 12. So these are the two main indicators why we need to be cautious at this point. Now, two major segments which are supporting the market, IT and Nifty Bank. So first, Nifty IT. So support you'll have to see around 20 DMA of 27,640. Resistance will be 28,500. That's your 50 DMA. Coming to Nifty Bank, support would be your 58,000. That is Friday's low. And as far as resistance is concerned, it would be 59,000. Now come to the options data of Nifty. So what we are seeing, major put writing between 24,400 to 24,500. But on the call side, what we are saying, even for the 24,500, premium has come down. So in the immediate term, it's very unlikely that Nifty will go to the levels of 24,600 or above 24,700. So support for Nifty, 24,300. First resistance would be 24,600. If we manage to cross that, then next resistance of 200 DMA of 24,866 will come into the picture. Some of the stocks that are in focus, first one, Infosys, I would say Naukri, because after Q1 update has been very strong and stock has moved sharply higher, currently up almost 11%. All the capital market names are under pressure, not only today, over the last few days. And today also both MCX and BSE have been seeing fresh shots.
Okay, all right, Sudarshan, thank you so much for joining us. So as Sudarshan pointed out, there are certain triggers which are indicated that this bullish view couldn't continue, and we are seeing that on the Nifty. The advanced decline ratio has turned in favor of declines. So that chart will indicate how markets have fallen from the highs of the day. Time for a break now. On the other side, Manisha Gupta will join us with Ajay Kedia, who's the director of Kedia Advisory, to decode trends in the metal space. Stay tuned for that conversation.
Welcome back. Joining us now from KD Advisory is Ajay KD. Ajay, hi, thank you so much for joining in. First of all, your sense on the metal prices, because we're looking at pressure coming back when it comes to gold. It is looking at a stiff resistance at $4,200 an ounce. Every time we see the gold prices go there, there is profit taking. How are you looking at the prices for the very near term, and longer term investors, what should they be doing?
Very good afternoon, Manisha. Yeah, definitely. We have seen last week there was a strong reversal from $4,000 to almost $4,200. I think this week is going to be more important because we have to see Fed minutes, how it will be following the Fed chairman's statement. But yes, the probability has been dropped from odd 66% to 50% of a rate hike in September, which is going to be supportive for gold. In last couple of days, market is trading in a very narrow range, but I think prices seems to be trading with a positive bias only. We may see price taking a pullback towards the level of 41, 41.20, but that could be a great level to buy. Again, we are expecting prices to bounce back to the level of 40 to 50 on the expectation of ease in inflation. And however, dollar index is consistently holding 100 level mark, but it's a consolidation range. So overall, we are expecting a bounce in gold. Similarly, we can see in silver also.
You've mentioned the levels for gold where you expect 4,100 to 4,250. How are you looking at the prices in silver? Because here as well, 62 is a resistance on the lower side. We've almost done 56, 57 there.
Actually, we were expecting 48 as an immediate support, but 53, 54 was a level where one should look for a collective buying. But we have seen market making a low of 56. As of now, the important concern was the Fed statement, and we have already seen the statement has been not so much hawkish, and that is why it was a good reversal. Technically also market was giving a very good rebound, but important was gold silver ratio, which has made a high of 72 and now reversing. That means silver has to outperform gold. Currently prices are very well placed above 60 level mark. We can see a bounce to the level of 64. On a breach of that, 68 should be level, because the numbers, consumption numbers should improve from recent weakness. So we hope prices can go to the level of 64 as an immediate target. But for July month, we are bullish for a targeting $68 for silver also.
Coming on case of zinc, because Ajay, that clearly has been the most bullish of metals in the last few trading sessions. I'm assuming most of the metals are now looking at individual fundamentals, and of course they continue to react to larger macros as well. How are you looking at zinc prices from here on?
So recent report from ILZSG that has clearly told that the surplus has narrowed down to 26,500 metric ton in the month of April from 56,000 nearby. So I think that was the major point where the zinc is getting support. Even from the China side, we have seen the production was slightly improved. But overall, technical charts showing a very strong as long as prices are holding about 360. So I think if we talk about the July overall month, we can retest the high of, we can say we can cross 390 to 395 level also. One should try to take a position around 365, 366. As long as prices are holding 358, we may see prices moving towards 359, 390, 395 level also.
Ajay, as you mentioned that the dollar index seems to be consolidating, the chances of a rate hike in this year have kind of gone down. The US jobs data is not so great. So a lot of factors which really are supportive for metals, but we haven't seen run-up rally in the way the markets would have anticipated. How are you looking at the money moving for many of these metals? And zinc, as you said, you're bullish on. Are you equally bullish when it comes to copper, aluminum, those metals?
Surely for copper, yes, we are bullish because dollar index, no doubt the gain what we have seen in dollar index was purely because of uncertainty that was been there in the month of April, May, June. And with the ceasefire news, we have seen the demand for dollar has been slightly deprived. So I think dollar index should consolidate in the range of 100 to 102 as of now. Coming on the copper, we have seen data released by China, Europe, US, the manufacturing strength has been seen despite of higher inputs. But now as crude prices are coming down and dollar index are being stable, we expect prices should get support, particularly for copper, where output in Chile has fallen by 12.9% year on year, which is going to great support for copper. Maybe on domestic side, we can see prices holding very well at 1260, 1265. But for July month, we are expecting 1320 as an immediate target for copper. On LME also, prices are consistently holding about 13,000 level mark. Maybe we can see jump toward 13,800 to closer to 14,000 as demand from China, or we can say demand from AI chip making set, is continue to be robust for next half of this year. So overall seems to be very much positive. Coming on the aluminium, where we have seen a good gains because of supply disturbance, but now things have been cooling off. That is why prices has corrected, but we don't expect prices to go below 320 level. Maybe some consolidation would be there. However, with the start of Norex hydro smelters, we may see some consolidation between 330, 345 zone. But if we count, zinc should be the first preference, then copper, and least would be the aluminium.
Point taken. Before we let you go, Ajay, a final question on crude as well. Saudi Arabia cutting prices for the month of August. Maybe because they have heavy storages, want to get done with that. The prices are declining, might as well sell more, get some more market share. There are various conversations behind that move. But what's your sense on where are the prices going?
So we were expecting 80 could be a good support for Brent, but we have failed because oversupply is the now situation going on. OPEC has clearly mentioned that they will be increasing their production. In fact, the demand scenario for next 6 months is going to be slightly sluggish only. So I think for next 6 months, the supply is more, because of that prices are under pressure. However, SPR holdings are lowest since 1983. That is why prices are holding very well at 70 level mark. Maybe for July, we can see a consolidation between 70, 76. But overall, as we head towards Q3, Q4 end, prices might come down to the level of 60, 62 also. And we don't expect much gain in crude oil prices unless and until some new story comes in the picture, like Russia, Ukraine. Till then, yes, some consolidation would be there between 70, 75 for Brent. For WTI, 68 to 71. On domestic also, rupee weakness is getting supported, and that is why on MCX, a range between 6,400 to 67 is possible range as of now. But overall, we are oversupplied as compared to demand, and prices slowly and steadily will come to the range of $60 to $65 for Brent for next coming quarters.
All right. So near term can be choppy, but for the month of July, by the end of it, most of the commodities could perhaps be increasing, including silver, zinc, crude, for example, as well. Ajay, as always, thank you so much for joining in.
Thank you.
Okay, all right. Manisha, thank you so much for taking us through that conversation. That's all about the commodity space. With that, we'll slip into a short break. When we come back, we'll get you more on the markets and focus on Info Edge. That is buzzing in trade on the back of its Q1 update. Stay tuned for that. Welcome back. Well, markets continue to sulk from the highs of the day. It's the bank Nifty which has fallen sharply from the highs. Look at that. It's very close to the day's low. The mid-cap index is also off 400 points from the highs of the day. It did attempt a recovery but then failed to hold on to that. But despite that, there are a couple of stocks in the broader markets which are buzzing on the upside. We do have IOL Chemicals, which is logged in upper circuit. That stock is up 20% in trade as we speak. The other one is RITES, which is up around 10.5%. The recent listing on the stock exchanges, Waterways Leisure is the other one, which continues its up move, 7% higher on that one. And we did see Eternal's outperformance in last week. Swiggy has joined that party, and Swiggy is also up 4.5% in trade as we speak. So a couple of stocks which are bucking the trend when it comes to the overall market mood that we are witnessing currently. But the stock which is doing really well on the back of Q1 updates is InfoEdge. Winnie, tell us more. What did the street really like?
So, Sonal, couple of things that have come in, right? While we say Q1 updates, good update that came in from the company. We're seeing a standalone billing growth of around 15%, 14.4% to be exact, that came in during this quarter. Now, segment-wise also, recruitments, that's leading the charts. That's most of the portion, right? That's the Naukri jobs data for them. That's the Naukri business for them. And that is up 17%. You have 99 acres, that's doing well, 16.5% growth. You have Jeevan Sati, that's seen a 16% growth as well. While Shiksha, that's the one that's not done too well. That's down 21%. In Q4 also, there was a bit of a muted performance that came in from that. Now, overall, standalone billing trends also, when you look at it over the last few quarters also, they've managed to see good growth, consistent growth that has been happening for the company in terms of standalone billing. Quarter on quarter basis, we're seeing a bit of a decline in terms of the billing growth. But what's interesting is the job speak data that came in a few days back also, Sonal. While IT is the major portion when they are talking about this data point, IT is okay. But AI in that trend has done well. AI has continued to do well over the last few months, and that's the trend that's been picking up. And do not forget, the stock has been underperforming. In the last just week that we've seen that it pick up some bit of a pace and momentum, and that's what has continued today in the trading session as well. Today, now it's 12% growth coming in for the stock, most of the gains coming in, but that momentum is something that has continued after the job speak data and today's Q1 update as well.
Remember that conversation with the team leads where they had indicated that these specialized jobs not only are they growing, there is less supply, they are being paid very well as well. So that's about InfoEdge. Let's listen to a short break now. When we come back, we'll get you more on markets and stock-specific action on the other side. Welcome back. Well, it's the ID pack which is supporting the market, though even that has come off from the highs. When we started the show, the IT index was up around 3%. It's up 2.5%. But increasingly, we are getting some commentary coming in from experts indicating that maybe the valuations are supportive and they could see selective uptick in some of these IT names. So as we wrap up this edition of Halftime Report, here's some interesting market opinion coming in from Quant MF's Sandeep Tandon. He shares optimism over India's capex and infra plays. He also finds Indian IT sector attractive but selectively. Here's an excerpt from that conversation.
We have said the beginning April that is a time for India. India is coming back, and if global market correct further, which we have opinion that US market and even Korea, Taiwan market will correct significantly from these levels. If I have to talk about next 2 quarters or so, then obviously India will be a winner in that. I think the background is more constructive and very stock specific rather than getting too much worried about what is happening in terms of index level. I think index will not give you a real flavor of the market. I think stock specific approach will give you far superior returns. IT sector, which we have been quite bearish for a while now, looks attractive. They are now in the neglected zone, which we typically look for a buying opportunity. And that's the reason we have started nibbling into it, but very selectively. But if you ask me, this is a time to go all in and this is a time to take very big contra and aggressive call in IT, then the answer is big no. As far as FMCG is concerned, yes, they have also underperformed for the last many quarters. I think something is changing out there. So I think FMCG of the companies also, these are more of a trading opportunity because they are still very expensive. So it's not like they're becoming suddenly very cheap. They are expensive. Maybe that's the way we can look for only from a trading opportunity. And I think infra as a theme, power as a theme, maybe some of the energy companies can come back from the current levels. So I think that's an area where we are looking for, where good amount of capex is going on. And this is the only area which we see large capex, both from the private sector as the public sector side. I think capex numbers are reasonably large. I think growth is there.
The market sees a rally in large cap names even as selling in mid caps is broad based with declines topping advances. IT and consumer durables notch gains while industrials and realty are the big drags.
The stock of Trent slumps after Q1 revenues fail to meet analysts' expectations. Growth in Q1 comes in below the Q4 rate against expectations of a significantly better performance.
Titan's first quarter sales grow faster than Kalyan Jewellers despite its significantly larger scale of operations. Even overseas business for Titan expands at a significantly higher pace. The stock of Kalyan Jewellers takes a beating while Titan is at a record high.
After Coal India, Central Bank of India, NHPC, GIC, NLC and IRFC, the government has now launched an offer for sale in Cochin Shipyard to offload over 5% stake. The stock slips on the fresh supply.
Saudi Arabia cuts oil prices for August delivery by $11 a barrel, the steepest such cut in a decade. Experts point to oil seeing a surge in global supply even as refining capacity is constrained, boding well for Indian refiners. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I am Hormuz Fatakia. With me as always, Arundhati Ramanan. Arundhati, good afternoon.
Good afternoon, Hormuz. You know, we started off the day on a strong footing, but now the market's coming sharply off the highs of the day. It's still in the green, the Nifty and the Sensex, but flat. The mid-cap's not doing so well.
We're on expected lines. There's around about a 600, 650 point up move over the last 5 days. And on expected lines in the sense that supply coming in at that 24,500 level, we did manage to cross that. We did sustain above those 24,500 levels for at least 60 to 80 minutes. But since then, the indices have come off the highs, at least around about a 70 point downtick from the highs of the day for the Nifty, led lower by, of course, ICICI Bank, which has been fairly resilient over the last few days. IT stocks are the ones that are keeping the index in the green. We mentioned this in the morning as well. The price action in the IT names will be key ahead of the results from TCS. So that is one stock, one index that is keeping the index in the green. But the broader markets, though, that's where the pain lies. And over the last couple of days, the broader markets have been underperforming. The mid-cap index had seen a bit of a recovery from the lows, but that recovery too has been sold into, so around 300 points lower on the broader markets. But there is plenty of stock-specific activity, even though the index has cooled off slightly from the highs.
Absolutely, and we'll be bringing all that stock-specific action soon. But IT stocks, as Hormuz pointed out, is doing well today. It came in for a bit of profit booking yesterday, but is now the top-gaining index, up nearly 3%. Infosys rallying 3.5%. TCS up nearly 2%. HCLTech up nearly 3% in trade. On the downside, we've got those realty names, DLF, Phoenix, Prestige, all of them down between 1 and 2.5% in trade. Metals also under pressure. Hindalco, Nalco, Sale, all of them seeing cuts of over 2% in trade as we speak. So that's how the markets are set up this afternoon.
You know, so a lot of business updates have also come in, and most predominantly so on the consumption side. And for both, for all the updates that have come in, there have been divergent reactions as well. Sentiments have stirred a beat across staples, retail, jewelry and discretionary names. That is because of easing input costs to strong revenue momentum in the retail and jewelry and a sharp turnaround for Nykaa. There is a lot to unpack in the consumption basket. Mangalam is here with a detailed breakdown. Mangalam.
Well, if you look away from the stock market and how the stock prices have reacted, the headline this time around is there is consumption recovery. Two big words, and that's exactly what the first quarter so far in terms of updates have suggested. The sentiment is upbeat across in terms of reported numbers. You know, it's one of the best quarters that we've seen in the last many. Price growth has been added to, volume growth, and that's led revenue growth as well. And there is some margin pressure, but because of the cooling off of oil prices and, there being peace, there is a fair amount of, prospects, margin improvement prospects going forward as well. So let's break it down into staples. We have Marico, GCPL, Dabur, all of them reporting good revenue growth. Low 20s for Marico, high teens for GCPL, Dabur double digit, and all of them have been, backed by good volume growth as well. Double digit volume growth for Marico, high single digit, mid to high single digit for GCPL and Dabur. On the input cost front, for Marico, copra prices down about 45% from the peak. Gross margins will increase quarter on quarter. Godrej Consumer also has said that the EBITDA will grow double digit, and margins have been impacted by higher input costs, but they will progressively improve as we move to the year. And Dabur, they've said that margins will remain stable because they have taken calibrated price hikes itself. Now let's move on to the retail space as well. We have Avenue Supermarts and Trent, both of them growing between 15 and 19%. Realizations may be slightly lower for Avenue Supermarts because of pantry destocking destocking that took place in the first quarter and some price cuts because of GST as well. They've added 3 stores. Trent has added 26 stores. If you look at the broader retail space, however, the value retail, V-Mart, V2, Bazaar Style, all of them have shown stellar growth between 29 to some even 58%, and all of that backed by strong store addition and same-store sales growth. So 15 stores added for V-Mart, V2 has added 57, Bazaar about 18 as well. Gold prices are relatively stable, and that's meant that jewelry growth has come back with a bang. 39% revenue growth for Titan's jewelry business, 38% for Kalyan Jewelers and Senco as well, 60%. First quarter also had the benefit of Akshaya Tritiya and the festive season. So this is doing extremely well for them. And then you have the discretionary space where Jubilant FoodWorks consolidated revenue grew 14%, standalone revenue about 9.2%. But here too, from the fourth quarter to the first quarter, we've seen a sequential uptick in like-for-like growth, as you can see, from 0.2% to 2.5%. That explains why the street liked these numbers. And finally, we have Nykaa. The deal with Nike doing very well for Nykaa. The consolidated gross merchandise value seeing growth in early 30s. Net revenue growth, has accelerated to near 30s as well. Beauty business is doing fairly well for them, growing in late 20s. But here's where the fashion business comes in. And the growth out there has been in 50s at a multi-quarter high. And that's largely because of the encouraging response that they've seen to the partnership with Nike. So across the board, we've seen consumer sentiment upbeat, be it staples, discretionary, retail, or jewelry.
All right, Mangalam, many thanks for taking us through those details. Now, Saudi Arabia has slashed its August official selling price for Arab light crude to Asian buyers by $11 per barrel. This is the steepest price cut in over 2 decades. The reduction prices the crude at $1.50 discount to the regional Oman-Dubai benchmark. Earlier today, we also spoke to industry veteran and former HPCL chairman M.K. Surana about the price cut, and he said that the move is part of the normal pricing mechanism adopted by producers and is in line with expected market conditions. Take a look.
It is a combination of the pricing mechanism which the different suppliers follow, and of course a pressure on the oil suppliers to tie up the market volumes in terms of increasing competition. The companies like IOC, BPCL, HPS India, it is a good news. Overall for the country like India, it is good news that there are more suppliers who are vying for this market, and we who are so much import dependent, we will get the cheaper oil.
But the consumption names are seeing some divergent moves, but the stock that has seen a one-way move in the day today has been Info Edge, and that is on the back of a very strong quarterly business update that has come in. Let's go across to Vinny now for all the details as to why the stock is up 12%. Vinny.
Hi, a strong move coming in after the Q1 update for InfoEdge, right? 12% uptick as of now. Now, what are the numbers looking like? Standalone billings have gone up by around 14.4% for Q1 FY27 versus last year. We're comparing on a YOY basis. Now, when you look at the segment breakup, recruitment business, that's a Naukri business, a Naukri.com business, that's the one which is doing well. Most of the revenues obviously come in here, and that's done very well. A 17.5% growth is what Q1 FY27 update indicates. 99 acres, that's indicating a 16.5% growth. Jeevan Sathi, a 16.5% growth as well. What's not done well is the Shiksha business, which is a smaller part of the business. That's seen a degrowth this time versus last year, and that's come in at 34.6 crore in terms of the revenues. So that's where a bit of a muted performance that came in. But apart from that, strong performance. In terms of revenue trends, whether you look at it in the past few quarters also, they managed to see strong double-digit growth this time also. That growth is continuing, and even the billings growth, that has continued as well. So the trend for billings also has seen an improvement versus last year. And last quarter, we're seeing a bit of a muted growth if you compare on a quarter-on-quarter basis, but strong performance. Now, apart from that, do not forget, just a few days back, we had the Naukri job speaks data that came in from the company as well. While IT is a significant portion of that business, right? When you look at it, IT has not been doing well in terms of hiring trends, but the AI side of the business, that has continued to do well. We have commentaries that have come in even from team leads who have mentioned that, AI is the segment that has been picking up pace, has continued to do well in the last few months as well. And that's the trend that's continuing for InfoEdge as well in their Naukri job speaks data. And that's a key update. And that is why the stock has managed to do well this week. Last few months, it's not been doing that well. But this week and the last week, we've seen it pick up pace, and that's continued.
Absolutely. That stock up 11% as we speak. All right, Vinny, many thanks for those details. Now, Cochin Shipyard under pressure. The government launches an offer for sale to pair up to 5% stake in the company. Let's go across to Sudarshan Kumar, who first broke that story. Sudarshan?
So our news break of June 22 is now confirmed. Government has launched an OFS in Cochin Shipyard to sell up to 5.04% stake, and of that base size is 2.52%, and if government goes ahead and exercises green shoe option for that portion also, the size is 2.52%. If government manages to sell entire 5.04% stake, it will raise up to rupees 1900 crore. Now for non-retail portion, OFS is open today, and for retail portion, OFS will open tomorrow. Remember, government currently holds almost 68% stake in Cochin Shipyard, and the stock is under pressure. Now, if you go beyond Cochin Shipyard, and this year in 2026, so far, including Cochin Shipyard, government has launched OFS in total 8 companies, including Coal India, NSPC, and others. And ahead of Cochin Shipyard, government has raised more than 25,000 crore. So government is going becoming very aggressive in raising fund via OFS way. That's what they are looking at, the preferred means to raise fund. We'll have to see if after Cochin Shipyard, which company is the next. But so far, government has launched OFS in Cochin Shipyard, and non-retail portion is subscribed almost 20% so far.
Well, Sudarshan, thank you for that update. As of last check, around about 105, the total subscription currently stands at around 31%. So seeing some interest from the non-retail portion is Cochin Shipyard, and that possibly also explains why the stock has not had a bigger fall, even as the OFS price is at a 7% discount compared to yesterday's close. Take a short break then. More news and updates follow on the other side. Stay tuned.
Welcome back. You're still with us on Business Lunch. On to updates from West Asia. Then hundreds of thousands joined the funeral procession for Iran's slain Supreme Leader Ayatollah Ali Khamenei in Tehran, with further rites set to take place in the holy city of Qom today. Elsewhere, Hamas announces the dissolution of its governing body in Gaza after nearly 20 years in power, paving the way for a technocratic committee to implement civilian government. However, Israeli forces continue their attacks on Gaza, killing at least 6 Palestinians and wounding 20 others.
Well, the markets have come off sharply from the highs of the day. The Nifty is now absolutely at the flat line, almost on the verge of slipping into the red now as we speak. So back at 24,430, a 100-point down move from the highs of the day, led lower by the Nifty Bank. And that was the one that was keeping the index higher yesterday. But today's session, the Nifty Bank has now cooled off almost 300 points from the highs of the day. But the one sector that is still holding on is IT. And as we take a short break, here's some interesting market opinion that came in from Quant Mutual Fund Sandeep Tandon, where he shared his optimism over India's capex and infra plays. He also found the IT sector attractive, but selectively. Here's what he had to say.
We have said the beginning April that is a time for India. India is coming back, and if global market corrects further, which we have opinion that US market and even Korea, Taiwan market will correct significantly from these levels. If I have to talk about next 2 quarters or so, then obviously India will be a winner in that. I think the background is more constructive and very stock specific rather than getting too much worried about what is happening in terms of index level. I think index will not give you a real flavor of the market. I think stock specific approach will give you far superior returns. IT sector, which we have been quite bearish for a while now, looks attractive. They are now in the neglected zone, which we typically look for a buying opportunity. And that's the reason we have started nibbling into it, but very selectively. But if you ask me, this is a time to go all in and this is a time to take very big contra and aggressive call in IT, then answer is big no. As far as FMCG is concerned, yes, they have also underperformed for the last many quarters. I think something is changing out there. So I think FMCG of the companies also, these are more from a trading opportunity because they are still very expensive. So it's not like they're becoming suddenly very cheap. They're expensive. Maybe that's the way we can look for only from a trading opportunity. And I think infra as a theme, power as a theme, maybe some of the energy companies can come back from the current levels. So I think that's an area where we are looking for where good amount of capex is going on. And this is the only area which we see large capex, both from the private sector as the public sector side. I think capex numbers are reasonably large. I think growth is there. You have to look at asset heavy businesses where you have cash flow generating ability, large capex is going on. That's where the FIS trend is now. If you look at all the recent infrastructure related QIPs, the buying interest was very large. And we have seen many FCI names are buying these names. Okay, so I think money is actually moving out from these top 10 names to some of the defensive names. And that's the reason I said there's opportunity, whether you talk about ports, airport, roads, or large infra names, power companies, some of the renewable names. So these are the area where FI have a lot of interest in India.
Welcome back. Even as the markets have moved into the red, shifting focus to the world of technology, Rachna is joining in with all the updates from the world of tech. Rachna.
Well, first up is Microsoft that has cut 4,800 jobs. That's 2.1% of its global workforce in its latest reset for the AI era. The Xbox unit takes the biggest hit, losing 20% of its staff, 3,200 roles through the fiscal year, with 1,600 gone, and 4 gaming studios set to exit. Xbox chief Asha Sharma told staff, quote, "Our business today is not healthy," end quote. That's the update from Microsoft. But let's go to Seoul now, where Samsung has guided a 19-fold jump in second quarter operating profit to 89.4 trillion won. That's about $58.4 billion. This will be third straight record quarter. On soaring AI memory demand, revenue is up 129%. It is expected to be up to 171 trillion won, yet shares have fallen as much as 6.8% as profit taking after a 5-fold run in the past year is taking place now. Staying with the economics of AI, CNBC has reported that Chinese models are winning over US companies as costs are surging. Open source rivals run 60 to 90% cheaper than OpenAI and Anthropic. Startup Lindy has moved all its traffic from Claude to DeepSeek and Z.ai GLM 5.2. It's the fastest adopted model on Vercel this year. In Washington, Reuters has reported that the U.S. cyber agency CISA is using Anthropic's Mythos to scan government code for vulnerabilities, bugs that spies and criminals could exploit. The audits have already found a significant number of flaws. Neither Anthropic nor CISA has commented on this. And finally, free access to Claude Fable 5 ends today. From tomorrow, Anthropic's top model moves to usage-based credits at $10 per million input tokens and 50 on output, double the price of Opus 4.8, which was its costliest model yet. So it's the last day today to enjoy Fable 5.
All right, Rachna, many thanks for taking us through those details. Now, Prime Minister Narendra Modi has received a grand ceremonial welcome in Jakarta as he begins his official state visit to Indonesia, the first leg of his 3-nation tour covering Indonesia, Australia and New Zealand. Abhimanyu Sharma joins us now with all of those details. Abhimanyu?
Well, several MOUs have been signed between India and Indonesia during Prime Minister Modi's official visit to the country, and it remains to be seen what more is going to emerge from his official visit, since till now both the countries have agreed for larger cooperation in several sectors like agriculture, technology, maritime cooperation, and also in the field of higher education. Now, India has indicated plans to open an IIM campus in Indonesia. India has also agreed to supply BrahMos and Astra missiles to Indonesia, and India is going to help conserve the Prambanan temple in Indonesia too. Also, India is going to invest largely in rare earths, in manufacturing of steel, nickel and magnets in Indonesia. So a large-scale cooperation being looked at, and also more importantly the issue of maritime cooperation, the issue of maritime security and a free Indo-Pacific is also being looked at between both the sides. Now, this becomes important at a time when the global supply chains continue to be constrained, and we've already witnessed the kind of constraints which have been seen in the Strait of Hormuz since early this year. And Indonesia and Malaysia form two ends of the Strait of Malacca, which witnesses the transit of 40% of global trade, and India lies on the western end of the Strait of Malacca, that is via Nicobar Islands. So both the nations are going to jointly develop the Sabang port, which is near the Strait of Malacca and 100 miles away from India's Great Nicobar project. So maritime security, maritime defense is being looked at between both the sides. Now, a few days back, India and Malaysia had also reviewed bilateral military cooperation while reaffirming the freedom of navigation in the Indo-Pacific region. So India is largely looking at securing its supply chains and also securing maritime routes for not just its own benefit, but generally for the benefit of global trade and transit. And the Strait of Malacca, of course, continues to be an important issue due to the high degree of transit which happens through the strait, which is just 3 kilometers wide at its narrowest point. So clearly, maritime cooperation continues to be an important aspect which is being discussed between India and Indonesia.
Abhimanyu, thank you for those updates there. Now, Mumbaikars woke up to overcast skies and strong winds with no significant rainfall recorded in the morning, offering a temporary respite after 2 days of intense downpour that disrupted normal life. However, the Indian Meteorological Department has issued an orange alert forecasting heavy rain and gusty winds in the metropolis. In view of this, the BMC has declared a holiday for all government, private and civic-run schools and colleges in Mumbai today. The BMC has also urged citizens to venture outdoors only if necessary and advised them to contact its helpline in case of any emergency. Now, traffic on the Mumbai-bound carriageway of the Mumbai-Pune Expressway's missing link bypass has also resumed after being shut for over 18 hours due to a landslide that was triggered by heavy overnight rain.
And the last 2 nights have been heartbreaking for millions of football fans. First, Neymar and now Cristiano Ronaldo have seen their World Cup dreams come to an end. Ronaldo's final World Cup ended in heartbreak as Spain edged Portugal 1-0 with Mikel Merino's stoppage time winner sending the Spanish side into the quarterfinals. Portugal coach Roberto Martinez also confirmed he is stepping down. Meanwhile, co-host USA bowed out after a 4-1 defeat to Belgium in Seattle. Belgium now face Spain in the quarterfinals, with all 3 host nations eliminated in the round of 16.
Well, it's been a tournament of upsets, right? This World Cup has
big upsets, especially with Brazil and Portugal now out of the running.
There's possibly the tournament of the underdogs as well. And you take your leave on this edition of Business Lunch from Arundhati and me. Thank you for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Mid-Cap Radar. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, Vivek Iyer. It's a sharp fall from the highs of the day. We do have the mid-caps, which are sulking. Bank Nifty, which is in the red. Nifty is off a big time from the highs of the day, and that is something that we'll be tracking closely.
Right, good afternoon. Remember, it's a weekly expiry as well as far as NSE indices are concerned. So some amount of volatility is what the market is pricing in. But a lot lined up on the show, so let's start off with the top headlines. Nifty slips below the 24,500 mark to trade at the day's lowest point. Broader markets under pressure with declines outpacing advances in the Nifty mid-cap index. IT and consumer durables are the only pockets of strength, while industrials and realty lead the losses.
Cochin Shipyard Tanks and Traders government launches an offer for sale to pair up to 5% stake in the company, and it's a CNBC TV 18 newsbreak confirmed. A green shoe option allows for a larger stake sale basis demand. Floor price fixed at 1,400 rupees a piece.
Infosys, the parent company that owns and operates Naukri.com, is buzzing in trade on back of strong Q1 business update led by the recruitment solutions business, while standalone billings grew over 14%.
Apollo Microsystems falls more than 4% today as its board approves fundraise to the tune of 3322 crore via preferential shares and convertible warrants.
Varun Beverages Kenya arm to acquire Devyani Food Industries Kenya Dairy, Juice and Packaging Water business for 305 crore rupees. The stock under pressure currently, but CLSA and JP Morgan are bullish on the company.
All right, those are the top headlines that we are tracking. Market, of course, being the big one. As Vivek mentioned, it's the weekly options expiry for NSE indices. So some volatility is what the markets are factoring in as well. The Nifty off 90 points from the highs of the day, absolutely flat with some positive bias for now. It did slip into the red as well. It's the IT pack which is keeping things afloat. That's the top gainer on the Nifty today. We do have autos which are contributing, but other than that, the entire sectoral pack is in the red. The Nifty Realty, that's the one which is the top loser, followed by metals. Small caps are down 0.7%, and so is the mid-cap index, which is not doing so well. A lot of broader market movers on the back of quarterly updates, and we do have earnings which are kicking in with TCS on Thursday, so it's going to be a very heavy month going forward.
That's right. So July and August, expect a lot of earnings to come through, and we'll keep you updated with all the top mid-cap movers and top mid-cap companies that come out with their results. But a whole host of mid-cap and small-cap stocks is what Upasana has on her radar. She's standing by the big wall with all the mid-caps that are moving around in the session.
Well, certainly the market is off its day high seen in the starting session. Now, if we look at the mid-cap index, that is also under pressure, down nearly about 0.4%. But first, let us focus on some of the top gainers in today's trading session, coupled with some of the volume buzzers. First up is NIIT Learning, certainly one of the key volume buzzer today. Volumes up 41 times the weekly average, followed by Ganesh Housing, which is also up nearly about 5%. And volumes are seeing a sharp uptick, up nearly about 21 times the weekly average. Sign DLM is the another one on our radar. The stock is up nearly 14% in this month and up nearly about 7% as we speak right now. Bellrise Industries is the next one on our radar, up nearly about 4%, and followed by Tark Limited, which has reported its Q1 update, and the pre-sales is up nearly 3 times on a Y-on-Y basis. So certainly that is leading to a sharp surge in the stock. Now let us look at some of the stocks that has hit 52-week high today. L&T Finance is the one. Next up is GMR Airports. It's up nearly about 1.5% and followed by Granules India, which is nearly flat as we speak. Now on the flip side, let us look some of the top losers in today's trading session. Now defense stocks and cables and wire stock are seeing some selling pressure today. Now coming to Cochin Shipyard, continue to remain in focus throughout, but Phillip Capital is of the view that the OFS is a right time for the investors to accumulate this stock as it offers a long-term opportunity for the buyers. Data patterns also beaten down, nearly down about 5%. RR Kabel, KEI and Phenolix Cable, some of the top players in cables and wires space, also seeing a sharp fall of nearly about 3%.
Well,
All right. Thank you so much for joining us with all those names, Upasana. So those are some mid-cap movers that we are tracking. We'll also discuss some more in greater detail through the course of the show. But it's a good time to get a technical check on the market. Shrikant Chauhan, Executive Vice President and Head of Equity Research at Kotak Securities, is joining us now. Shrikant, good afternoon. Thank you so much for joining us. Do you expect volatility to worsen or at least see more volatility in the last hour of trade? We are almost at the day's low. What are the next important levels on the Nifty?
Good afternoon, Sunil. Good afternoon, Vivek, and everyone. So while looking at the entire setup of the market, we can very clearly see that the market is crossing all its important levels gradually. But the most important level is 24,600. And on the dismissal of that, we can expect good amount of short covering in the market. So you can right now see FIs have good amount of short positions in the FNO segment. And in case market crosses this 24,600 decisively, then in that case, we can expect a sharp up move in the market. Till then, I'm expecting market to remain in a range and buy on dips should be the strategy. Now the supports have shifted from 23,800 to 24,000, 24,200. So in case in next 1 or 2 days of time, if we see the market is dropping to 24,300, 24,200, there we should look for taking some long bets in the market. Instead of participating in the breakout, try to buy if there is any correction in the market. And yes, in case market crosses 24,600, then in that case, I'm very much sure that market may even cross the level of 25,000. Bank Nifty is under pressure, but Nifty IT is supporting to the market. So till the market is not crossing 24,600, I am of the view that the market will remain into sectoral rotation, and accordingly, we are going to see the uptrend in the market.
Well, thank you so much for your views there, Shrikant. Expecting the uptrend in the market to continue. But in terms of individual stocks and sectors, where does your preference lie?
So at this level, while looking at the weakness or maybe downward trend in the crude prices, I am of the view that this auto stocks, there we can expect further more activity. And in that specifically, we like TVS Motors. Today it is down from the highs of 3,800 to almost 3,700. But while looking at its entire technical pattern, I am of the view that the stock has been consolidating in the range. And on the dismissal of 3,800, the stock can even hit the levels of 4,000 or maybe 4,100. So it's a buy at current levels, more on dips. The other stock on which we are bullish is Bale Rise. There also, the stock is consistently forming higher top, higher bottom. Today, the stock is up. It has taken support at important level, and it is again bouncing back above the levels of 225, which is positive. Based on its formation, the stock can move towards the levels of 245, 250 in the near future. And finally, few pharma companies. I think there we can see good amount of participation and more participation from all the traders. So in that specifically, we like Sun Pharma. The stock has spent a lot of time within the range of 2,000 and 1,700 on the downside. Now the time has come where the stock start moving above its mark of 2,000, and the next level to watch out for would be 200, 250.
Take that point, Shrikant. What about the consumption space? Anything that you like here, particularly maybe in the Nifty pack, maybe in the broader markets? We do have jewelers reporting their quarterly updates. It's across the board, actually.
Yeah, from the consumption space, we need to be extremely selective. We need to focus on those companies which are into, we can say, either into new age platform like Eternal or Nykaa, Honasa sort of companies. There we are expecting further more upward activity in the near future. And most of these companies have crossed their important levels. We also like few paint related companies. In that we like Grasim, Asian Paints. I think these are the stocks where we can expect good amount of participation or some more attraction during this quarterly result season, as well as based on their technical formation. So Asian Paints, Grasim, I think these are the stocks to buy for.
Okay, thank you so much, Shrikant, for joining us, giving us a view on the markets, individual trading calls as well. Well, we now slip into a short break. We'll get you more on the markets, and we will be focusing on InfoEdge, TARC, as well as Apollo Microsystems, all of which were reacting to news flow. Stay tuned. Welcome back. Well, amidst a very weak market, especially as far as banks are concerned, one particular stock that's clearly standing out is IndusInd Bank. That particular stock, yesterday was one of the top movers, and today has built onto those gains. That particular stock high by almost 2.7%. But on the other hand, Bandhan Bank, that particular stock continues to witness weakness. But one stock from the realty pack, Sonal, that you've been tracking is Stark. Not so often discussed, but what's the update there?
Quarterly update that has come by. It's an NCR player and is gaining in an otherwise weak market. The stock is doing well and the update was strong as well. And the realty companies have reported good numbers in the quarter gone by. Pre-sales are up 3 times to come at 602 crore rupees. We do have collections which are up 80% on a YOY basis to come at 300 crore rupees. They say they continue to see strong demand. Tenacious is the word that they've used here. Across luxury development. So they are in ultra luxury and luxury portfolio is what they have in the NCR region. Collection efficiency continues to be strong as well as what the company says, and this will lead to strong cash flow visibility going forward. Good commentary, good numbers is something which the street is liking. So in a weak market and at a time with Nifty Realty is the top loser in terms of sectoral indices, this stock continues to do well. It was up around 14% at a point in time, but with the market fall, we've seen some fall in this stock as well. But good numbers, and that's what we are seeing in the moves for the stock as well. But we are also tracking Apollo Microsystems. It has fallen more than 4%. The board has approved a fundraise. Let's go across to Ria, who's joining us with more details on the number and what it means for the company.
Well, yes, Apollo Micro has certainly been in focus today. The company has announced a fundraise which includes a preferential issue of 951 crore rupees and also a warrant issue of nearly 2,371 crore rupees. This is both for the promoters as well as other investors of the company. The issue price is 416 rupees per share, which is a discount of nearly 1.8% to yesterday's closing price. The stock, of course, has fallen a lot post that. In terms of the participants in this issue, in the non-promoter group, we have big names like the Saint Capital Fund, Norcus Private Limited, Tata Mutual Fund, as well as Opal Global Diversified Fund, which will be participating in this issue. And there is also healthy participation from the promoters as well. There are 2 promoters that will be participating in the issue, taking nearly 1.3 crore warrants each, which is a total of 2.61 crore warrants. And this is 46% of the total warrant pool. So very healthy promoter participation coming in as well. Now, the company hasn't disclosed what the proceeds of the issue will be used for as of yet, but the word on the street is that Apollo Micro is on track to acquire Premier Explosives, which is an industrial explosives and detonators company. This is as per a story done by CNBC Awaaz, and there is a board meeting which will be held on the 9th of July for Premier Explosives. So we may see some more details emerging on that front once that board meeting convenes.
Well, thank you so much, Ria, for joining us, giving us all of the updates as far as Apollo Microsystems is concerned, and also the update as far as likely acquisition of Premier Explosives. But one stock that's surging away in the session today is InfoEdge, or Naukri, the parent company that owns and operates Naukri.com, and it's buzzing on the back of a strong Q1 business update. Let's go across to Winnie for all of the details on this particular name.
Hi, absolutely. The stock is holding on to very strong gains in today's trading session, and that up move started after the Q1 business update came in. Now, Q1 business update, when you look at it, the billings have grown by around 14.4% on a year-on-year basis. For the segment revenue also, recruitment business, which is the most in terms of the contributor for the revenue, that's coming at 552 crores versus around 470 crores last year. That's a 17.5% growth over there in terms of revenue. 99 acres has seen a 16.5% growth. Similar for Jeevan Saathi as well. The only one that in terms of segment that has not done well is a Shiksha segment, which has seen a degrowth of 21%. Q4 also wasn't that exciting on the Shiksha front. But apart from that, the revenue trends are very strong. The billing trends are very strong, even if you look at it in the last few quarters as well. Versus last year, we've seen the billing trends that have seen a growth as well. Versus last quarter, yes, a bit of a decline. But nonetheless, overall trends are very strong. Double-digit growth has continued in terms for the revenue as well. So that strong growth is expected to continue even now. In terms for other updates, we had the Naukri Jobs Peaks data that just came in a few days back, and that also indicated that yes, IT obviously is a major chunk in terms of the hiring trends that they report. IT is not doing well, but in that specifically AI, ML hiring, that continues to do well, and that's a trend that they're seeing an increase in terms of hiring. So that's also something interesting, and that's why the stock has picked up momentum in the last week or so specifically, and today obviously that momentum has continued. Do not forget there was an underperformance before that in the last 6 months, and now that it seems like they're seeing a pickup there.
Okay, that's Info Edge, up and away on that stock today. Thank you, Winnie, for joining us with all those details. With that, we'll slip into a short break. When we come back, we'll get you more on the market, stock-specific action on the other side of this break. Stay tuned. Welcome back. You're still tuned into Mid-Cap Radar. A lot of stocks on our radar. Cochin Shipyard is one of them. It is under pressure. The government has launched an OFS or offer for sale to pair up to 5% stake in the company. Sudarshan is joining us now with the latest update on the response that the OFS has seen in the non-retail portion as well. Sudarshan.
So non-retail portion of the OFS of Cochin Shipyard is fully subscribed as we speak. Remember, yesterday government had launched OFS in Cochin Shipyard to sell up to 5.04% stake, of which base size 2.52%. If government goes ahead and exercises green shoe option, that portion also is of 2.52%. And if government manages to sell entire 5.04%, it will end up raising almost rupees 1900 crore. For non-retail portion, OFS is underway. For retail portion, OFS will open tomorrow. Floor price government is set at rupees 1400 per share, and that was at a discount of almost 7% to yesterday's closing price. Now, remember, government currently holds almost 68% stake in Cochin Shipyard. Now, going beyond Cochin Shipyard, just in 2026 so far, government has raised, if you exclude Cochin Shipyard, government has raised more than 25,000 crore via OFS in 7 PSU companies like Coal India, NHPC, GIC and others. Now we'll have to see if government remains aggressive and launches OFS in more companies. But so far, there are 8 companies that government has launched OFS. And if you include Cochin Shipyard, they have managed to raise more than 27,000 crore.
Well, thank you so much, Sudarshan, and congratulations on that news break getting confirmed. Well, moving on, here's some interesting market opinion coming in from Quant Mutual Fund Sandeep Tandon. He remains bullish on India's capex and infrastructure story, while also finding selective opportunities in the Indian IT sector. Let's listen in.
We have said the beginning April that is a time for India. India is coming back, and if global market corrects further, which we have opinion that US market and even Korea, Taiwan market will correct significantly from these levels. If I have to talk about next 2 quarters or so, then obviously India will be a winner in that. I think the background is more constructive and very stock specific rather than getting too much worried about what is happening in terms of index level. I think index will not give you a real flavor of the market. I think stock specific approach will give you far superior returns. You have to look at asset heavy businesses where you have cash flow generating ability, large capex is going on. That's where the FIS trend is now. If you look at all the recent infrastructure related QIPs, the buying interest was very large. And we have seen many FCI names are buying these names. Okay, so I think money is actually moving out from these top 10 names to some of the defensive name. And that's the reason I said there's opportunity, whether you talk about ports, airport, roads, or large infra names, power companies, some of the renewable names. So these are the area where FI have a lot of interest in India. IT sector, which we have been quite bearish for a while now, looks attractive. They are now in the neglected zone, which we typically look for a buying opportunity. And that's the reason we have started nibbling into it, but very selectively. But if you ask me, this is a time to go all in and this is a time to take very big contra and aggressive call in IT, then answer is big no. As far as FMCG is concerned, yes, they have also underperformed for the last many quarters. I think something is changing out there. So I think FMCG of the companies also, these are more of a trading opportunity because they are still very expensive. So it's not like they're becoming suddenly very cheap. They are expensive when we buy. Maybe that's the way we can look for only from a trading opportunity. And I think infra as a theme, power as a theme, maybe some of the energy companies can come back from the current levels. So I think that's an area where we are looking for, where good amount of capex is going on. And this is the only area which we see large capex, both from the private sector as the public sector side. I think capex numbers are reasonably large. I think growth is there.
All right, that's the word coming in from Quant AMC's Sandeep Tandon. For the markets, we're absolutely flat on the Nifty, but there is some positive bias. The advanced decline ratio is in favor of declines as we speak. The Bank Nifty is an underperformer. From the broader markets, DCM Shriram is one stock which is doing well, up 3%. There's JK Paper as well, which is doing well. Of course, it's not a big move, but it is a decent move that we are looking at. ITDC is the other one, which is logged in upper circuit, 20% higher there. Sign DLM is also doing well, 8.5% higher. TBZ is the other one, seeing gains of around 6.5%. With that, it's curtains down on MF Corner, but stay on Midcap Radar. Stay tuned, MF Corner, when we return. Hello and welcome to MF Corner. I'm Sonal Putra. With me as always, Vinny Motiwala. This is a fresh edition and there are going to be a couple of things that we will discuss to make your mutual fund investment journey smoother. And over to you, Vinny, to tell us what we are going to be discussing today.
So we always discuss for aggressive investors, portfolio investors who normally look at it on an aggressive point of view. Today we are talking about investing opportunities that come in for an investor who is more conservative. How should they approach the market in different cycles? What kinds of funds are available? Debt mutual funds, obviously that's there. But what is the strategy that maybe you could go around using it to get maybe the best returns in the conservative form? But to discuss all of this today, let's bring on board Tarun Virani, founder and CEO at TBNG Capital, advisors joining us right now. Tarun, good afternoon. Thank you so much for joining us on the show as always. Let's start by talking about this, right? The investor who doesn't have the stomach to take the volatility in equity markets a bit too much, where should they start? What should they start by looking at? We know there are liquid funds, short duration fund, corporate bond funds. How should they start their journey if they're a conservative investor?
Yeah. Good afternoon, Vinny. Good afternoon, Sonal. I think it's a very interesting topic, and I know we have spent too much time and energy on equities over the last many years, and debt has been a little ignored segment. So I'm glad that you've taken this segment as your topic today. So let me tell you, debt large focus is it helps you get liquidity. It helps in getting the liquidity. It helps you in getting fixed income allocation and stability. Stability is one of the very most important part of the debt allocation. Unlike equity, which are meant for long-term growth as well as and it carries a lot of volatility. So this is one of the most important feature of debt funds. Starting with debt funds, we have three different categories, and for as you mentioned, it is for the starters. For starters, important part is start with liquid funds because that is one of the most which carries the lowest volatility in the debt universe, and the portfolio maturity are less than 91 days. It carries very limited interest rate risk, and this tracks the short-term maturity of the money market rate. One caveat worth knowing is liquid fund carry a small graded exit load on redemptions, usually within 7 days. So they are near instant liquidity, not literally penalty free. That investor need to be aware of. The real value of starting here is behavioral because it lets a first time investor experience mutual fund. According to me, the first time investor experience need to be correct. Once the experience is correct, I think then their ability to take risk and everything gets better. So once they are comfortable with the liquid fund structure, daily NAV movement, expense ratio, taxation, without any meaningful drawdown, I think then in next 6 to 12 months, we can graduate them to the short-term fund category. Again, with a modest pickup of accrual. Again, corporate fund should come last, and after investor understand the credit spread, duration volatility, all these factors they will understand once they start with liquid fund. So these are two, three things investor can start with. Another very interesting category which is doing the rounds because now debt funds are taxed similar to your slab rate, right? So that is one area due to which post-tax returns of debt investors are in line mostly around fixed deposits and other instruments. So arbitrage fund is also one category which can be explored because it gives you advantage of less than 1 year 20% taxation, more than 1 year 12.5% taxation, which again is a very interesting category one can explore provided the investor has almost 1 year plus horizon. That is the minimum I would recommend to the investor.
That's right. Arbitrage funds do have a taxation advantage over liquid funds, and that's something that we've been highlighting. But other than that, just to follow up on that, since you said start with liquid funds, now assume somebody started with liquid funds and they kept that money beyond 91 days. What happens then? How do the returns differentiate between, say, liquid funds versus short-term funds versus a duration which is much longer? What happens to that investment when the investor doesn't redeem? Does it automatically get redeemed, which happens in a longer duration fund? Just wanted to understand the process there.
So process from the it's very simple. Liquid fund is an open-ended fund, right? So it doesn't get closed or redeemed automatically. So what happens is the portfolio is reset, right, regularly in the portfolio. 90 days maturity is what is kept by as per investment objective of liquid fund, right? They are not supposed to take any higher duration risk. So every time the portfolio duration will always be 90 days in the portfolio. So for an investor who has invested for 90 days, after 90 days, it will continue to give you yields aligned with the 90 days treasury yields right now, which is running, right? The short term yields, whatever are running, right? So the reset of rates keep happening. But compared to that, if you invested in a short term fund or a duration fund, it gets aligned with the duration. So if you have a 1 year horizon, 2 year horizon, or 3 year horizon, then you should pick up a duration aligned with that because you lock the interest rate aligned with that. Unlike liquid fund, where every time the interest rate will be aligned with the current treasury yields.
Mhm. Tarun, a point taken there. You know, what we also want to understand is that your time period as a conservative investor, if it's a 1 year time period versus a 3 year time horizon, how does it differentiate what sort of debt funds or categories that maybe they could look at given the time period of their holding?
Right. So for 1 year kind of less than 1 year category, I would strongly recommend to keep it in liquid funds, short-term oriented fund only, not to venture into any kind of high duration strategy or corporate bonds category, because there is a very good chance in case of interest rate changes. At that time, the investor can get volatility in their returns. So to get a good experience, less than 1 year, my strong suggestion would be closer to liquid funds as well as short-term fund. More than 1 year and maybe around 3 years, one can look at funds with duration-oriented strategies or short-term oriented strategy, as well as corporate bond categories. So plus arbitrage funds from a taxation point of view also looks very efficient in the same category.
Okay. We have the other category, which is target maturity funds. Is that a good option for conservative investors? How big can it be a part of their portfolio?
So, as I mentioned before, debt funds, if taken with a defined maturity, it gives you benefit of locking the interest rates today, right? So, let's say if I know that I need the money, let's say in 2029, and if I'm getting a 2029 yields available at, let's say, 6.5% or 6.75%, so I can lock that interest rate today if I pick up a target maturity fund. And I feel target maturity fund has a relevance in the investor portfolio because it gives you a laddering opportunity. Because let's say if I am saving for my kids' education and I know 29 I have to pay the first installment, 2030 I have to pay second installment. So I can plan my target maturity fund aligned with that payments what I have to make. So it's a very good cash flow planning tool for investor, and it helps you block the yields today because you don't know tomorrow. Let's say tomorrow, this recently the Iran-US war, Israel war happened, and after that we have seen a lot of volatility in the currency and the debt market. So if you don't want to get in that, you can start blocking that through target maturity funds.
Okay, just a quick one, Tarun. For how should an investor split between debt funds and other safe instruments that they have, PPF, FDs, bonds? How should that division be for a conservative investor?
Yeah, so a genuinely conservative portfolio often ends up 60 to 90% across fixed income buckets, with the balance in conservative, hybrid, and equity. But let me tell you about other safer instrument. If I talk about PPF, PPF is a very good instrument if you are looking at a genuinely long-term debt, which is like 15-year plus tax efficient source. So PPF is one of the best instrument in that space, according to me. Again, large fixed income allocation like your direct G-Secs, as well as a lot of other instruments like RBI retail debt products available, as well as a lot of bonds available directly to be picked up. Those again could be picked up based on the investor risk appetite, because let's say corporate bond do carry a credit risk, right? So based on the investor risk appetite, that can be selected. But if you are looking at, let's say, something less than 1 year, 3 year kind of space, again, mutual funds gives you that advantage, or fixed deposit in that similar category, because it gives you liquidity in that period.
Okay, take that point. This has been a very interesting conversation, but we have a lot to ask you. Before we do that, let's take a quick break. And up next, we'll talk about paying off loans using mutual fund investments and what works there. Stay tuned for that. Welcome back to MF Corner. Still have with us Tarun Birani, founder and CEO at TBNG Capital Advisors. And it's time to talk about how investors can utilize their mutual fund gains to pay their loans. Tarun, does it make sense to redeem mutual funds to prepay a loan? That's the most basic question that we need to answer.
Again, there is no direct answer to it, and I think it depends on the investor's situation, right? So let me give you some thoughts on that. So when the after-tax cost of a loan exceeds the realistic after-tax risk-adjusted return you expect from the investment over the same period, or when the non-financial case, like non-financial case is very critical, the cash flow relief, peace of mind, etc., right? These are very relative thing, and you can't get it from numbers, right? And when that genuinely outweighs the arithmetic, I tell the investor that yes, please go ahead and pay off the loan, because if that is interfering in your peace of mind, because everybody is a very different from a risk tolerance level, right? I think let's say you invested into the stock markets through mutual fund, and you have a running loan, and tomorrow market goes down, and if the investor reaction to that is not appropriate, or at that time that entire benefit goes away, right? So for them, peace of mind is more important, then one should look at changing that. What really makes sense is to disturb the long term compounding of long term equity investment to prepay a low cost tax advantage loan. Redeeming growth asset to prepay should be deliberate, number first decision, never an impulse decision, because it requires a lot of deliberation, lot of thought process on cost versus benefits.
You know, Tarun, you said that it shouldn't be an impulsive decision. It should be a thought-out decision. Math is something that is important right now when you're making such a call. But how should an investor decide between maybe, looking at which type of loans do you have? Does all of that matter when we are, maybe booking out and prepaying these loans? So home loan, car loan, personal loan, does all that make a difference in times of the prepayments?
Right. So let us review all these three category of loans you just mentioned. So home loan is normally the cheapest debt most household ever hold, right? Currently, the rates of home loans are anywhere between 7.5% to 9%, right? For borrowers, and cheaper still on an effective basis, because if you are in a old tax regime, you can get the tax benefit also. It's a long tenure appreciating asset where you have invested from that loan, right? So for most investor with a stable income and a long horizon, continuing this loan and investing surplus in a diversified portfolio is a stronger path, unless being debt free before a particular life milestone is itself a goal for them, right? In terms of personal loan, which are typically anywhere from 10 to 20%, right? And they are unsecured, no tax benefit. Prepay as aggressively as cash flow allows, no conservative investment, reliably, that hurdles that kind of rate, right? So my strong suggestion is to get off the personal loan as soon as possible. In terms of car loan, roughly rates are between 8.5 to 11-12%. Again, this is secured against a depreciating asset, little to no tax benefit. Prepaying usually makes sense since the rate generally exceeds what conservative debt investment can deliver post-tax. But again, it's very subjective based on investor situation and many other factors. So one must clear high-cost unsecured debt first, then evaluate home loan on case-to-case basis. That is my advice.
Okay, so what would a smarter strategy be, Tarun? SIP or STP into debt funds to build the prepayment corpus? Is that something?
Yes, according to me, that is one of the most smartest and the most efficient and strategic route investor has available. Instead of redeeming long-term equity holdings, one can direct their monthly surplus and bonuses into a dedicated short duration or a target maturity fund SIP, a purpose-built prepayment corpus. Once it reaches a meaningfully size, deploy it as part of the lump sum prepayment. If de-risking existing equity holding is also something which investor is intending, a systematic transfer from equity to debt funds ahead of the planned prepayment window achieves it gradually. So that is also a good option. This preserves your long-term asset allocation, avoid crystallizing equity gains and taxes prematurely, sidesteps the regret of selling growth assets, right, at the wrong time, and keeps behavior discipline high. So according to me, this is SIP STP into debt fund is a very smart strategy investor can employ.
Tarun, also let's just talk about this, right? What role does the loan tenure also play in terms of while you're making prepayments to this? How should they go about it? Early years versus later years, the repayment. Is there a difference in that? And is there a different strategy that maybe they could apply?
Yeah, so in the initial years of amortizing loan, the bulk of each EMI is interest. Every rupee of principal reduced early compounds into disproportionately large interest saving and can shorten your tenure dramatically. In the later years, EMI are mostly principal anyway. So the interest saved per rupee prepaid shrinks. So the decision then tilts towards whether that money earns more elsewhere on a risk-adjusted basis. So from a rule of thumb basis, if prepayment makes sense at all, earlier is always the most better alternative available to the investor rather than paying later.
Okay, so, emergency funds is what we ask investors to create in order to ensure that they have liquidity in times when they need it. Should investors ever touch their emergency fund or even equity SIPs to prepay faster?
Yeah, so my strong suggestion is emergency fund should not be touched come what may. It exists for genuine medical or other family emergencies. Depleting it to prepay a loan simply swaps one
risk for a larger one. And I have seen this cash flow mismatch affects the household much more and make them to take decision to take personal loans and all high credit. And I think it creates an overall tension and the negative energy, right? So avoid getting into that. Long-term equity SIP, generally my suggestion is no. Over long horizon, broad Indian equity indices have historically delivered meaningfully above the home loan rates. And interrupting SIP breaks compounding, and it may trigger capital gains and risk exiting at a market low. There are rare exceptions. Example, a high interest rate personal loan or with no other funding route available, one can look at that. Instead, one can step up the EMI modestly, channel the bonuses and the windfall for the prepayment, or build a separate debt fund prepayment corpus for making this part. So better levers are step up your EMI modestly, because this is again can help you prepay faster and channel your bonuses and windfall. That's the better strategy.
Okay, point taken there, Tarun. But Tarun, thank you so much for joining us today on the show, talking to us about a couple of points, important points for conservative investors, as well as how an investor maybe could use mutual funds to pay their debt as well. So thank you so much for joining in this afternoon. And viewers, thank you so much for tuning in as always. Don't go anywhere. Last hour of trade is still left, and you have closing bell up next to take you through all of that.
market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
The region's attention fixed on Samsung's preliminary second quarter earnings.
We had the US session from last night. Nasdaq 1% higher, 24,400, 24,440 on the Nifties.
So I think FMCG of the companies also, these are more of a trading opportunity.
Mood of the customers and the consumers, end consumers, have definitely been better.
Last quarter showed a 20% growth. The street expected maybe the first quarter we will see an acceleration to that. So good performance coming in for Titan. It's a sparkling quarter, in fact.
Government has launched the OFS in Cochin Shipyard and is going to sell up to 5.04% stake.
They have cut their August official selling price by $11 per barrel.
Standalone biddings have gone up by around 14.4%.
The sentiment is upbeat across in terms of reported numbers. It's one of the best quarters that we've seen in the last many.
It's a sharp fall from the highs of the day. We do have the mid-caps, which are sulking. Bank Nifty, which is in the red.
Okay, well, gains have disappeared. The markets are flat, at least at an index level. The Nifty is in the green, but nowhere close to what it was trading up by. So quite a session. Remember, we've done quite a bit recently from the lows. I think 600 points in a few sessions, 1,000 points over the last 1 month. So that's where we find ourselves. Market breadth is also slightly negative, more down than up. This is Closing Bell coming to you from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, Rima. Rima, hi.
Hi, the problem is real estate, defense, metals, and then a few consumption names like Trent, which is down close to about 12%. On the other end of the spectrum, it's IT and IT alone. The Nifty IT index has moved to the day's high, and it's got a gain of nearly about 3%. So IT going strong ahead of numbers. The top three Nifty gainers are IT heavyweights like Infosys, HCLTech, Tech Mahindra, with a gain of close to about 3%. But in terms of news flow, it's all come through in the consumption names where the Q1 quarterly updates have come through. We'll unpack all that in the final hour of trade. Let's quickly tell you what we've lined up on the show today. Markets give up early gains, trade flat with the Nifty above 24,400. Mid-caps, small caps playing on the back for today. Real estate, metal counters are the top sectoral drags amid a lackluster trade. The IT pack is standing tall. The top gainers in the benchmark index today are Infosys, HCLTech, Tech Mahindra. We decode the shift in stance. The top movers on the back of the Q1 business updates are Trent, Titan, Kalyan Jewelers, Info Edge, a detailed roundup coming up. A steady up move seen in Blue Jet Healthcare. The company has launched a QIP to raise funds. We'll tell you what the demand is looking like and how the funds will be utilized. But for now, let's begin the show on a few technical trading ideas, as always, with Mitesh Thakkar. How should you position yourself? Mitesh, is it disappointing that the gains have dissipated, or we've had 4 good days on the trot, so therefore this is just consolidation?
See, good afternoon. So I think, we've had a good rally in the last 4 or 5 days. It still looks good to me. I think it's just that today is a subdued market, doing well despite the fact that the global indices are not very good. But I think I mentioned targets of 24,600 and 24,800. I think we might pick those levels. The only thing is that we've kind of slightly moved away from the 10-20-day averages. So maybe a day or two of pullback might play in, but that'll be buying opportunity. Anything now, if you get the Nifty closer to about 24,300, 250 zones would be an area where I would want to buy slightly aggressively and then take a stop below levels of 24, 150, 160 odd zone. So that's the approach on the index.
So basically buy slightly, buy on dips basically, right? A deeper dip.
Yeah.
Around 24, you said 150, 24, what levels?
Around 24, 250. Yeah,
okay.
That's the broad.
So about 200 points lower from where we are right now. So got that. In terms of stocks, Mitesh, what's on your list?
On the stock side, I have a buy on PG Electroplast with a stop at 565. Look for a target of 615 on the upside. And Paytm is a buy as well. Keep a stop below 1214 and 1285, 1290 should be the first target.
Any thoughts on these insurance companies, ICICI and SBI and Max and HDFC, the life insurance companies? A few are doing well.
See, the one which I like obviously is LIC of India. I've been tracking that closely, and if you look at the charts, I think it's heading towards 450 as the first target, possibly 465. The other one is Max Health Insurance. That's giving a pullback, and Max Life is the third one, which I've not actually tracked it. So that's the idea.
I see. Max Health is the insurance company. Max Life is a hospital company. Healthcare and Life is, of course, the insurance name out there. By the way, I think the last I checked, the Nifty IT index is up. It's up about 2.5%. So, did very well on Thursday and Friday. Monday, it continued. And yesterday it just sold off, gave back a little bit, not much, and it's back up about 2.75%. We'll talk more about this space. Lots of stocks actually coming with gains. Videsh, thanks for joining in with that. Well, yeah, Rima, so tell us why.
Well, I don't know why, but let me just reference there have been two mildly bullish calls that have come through. So one of them is Rhythm Desai of Morgan Stanley. And this is in the equity strategy note that he put out, where he's saying that IT could emerge as the dark horse. That's the word that he used. That said, they have an equal weight rating on the sector. They are approaching a barbell strategy. Basically, they're playing both ends of it, but it's a neutral. And they're saying the AI debate is hurting the sector's multiples, but it may not hurt the earnings in the medium term. So that's one bullish note from Morgan Stanley, mildly bullish. At least it's not negative. They've got an equal weight. And the second one is Sandeep Tandon of Quant Mutual Fund. When we chatted with him earlier on Bazaar, he said that they have started nibbling in IT. IT is in a neglected zone. But again, when asked that, how bullish would you be? He said it's not the time to be aggressive, but the words he used was nibbling in. So I guess, people are taking cognizance of the fall, and at least some people are emerging on the buyer's list. In fact, let's hear out what Sandeep Tandon had to say with his views on the sector.
IT sector, which we have been quite bearish for a while now, looks attractive. They are now in the neglected zone, which we typically look for a buying opportunity. And that's the reason we have started nibbling into it, but very selectively. But if you ask me, this is a time to go all in and this is a time to take very big contra and aggressive call in IT, then answer is big no. As far as FMCG is concerned, yes, they have also underperformed for the last many quarters. I think something is changing out there. So I think FMCG of the companies also, these are more of a trading opportunity because they are still very expensive. So it's not like they're becoming suddenly very cheap. They are expensive. Maybe that's the way we can look for only from a trading opportunity. And I think infra as a theme, power as a theme, maybe some of the energy companies can come back from the current levels. So I think that's an area where we are looking for where good amount of capex is going on. And this is the only area which we see large capex, both from the private sector as the public sector side. I think capex numbers are reasonably large.
Ramesh, is it time to start nibbling in at a broader level? I know you can always make selective bets, even if the sector has been in a downtrend. And you've been doing that with Orient Pro. But is it time to look at the sector more holistically and start maybe making an investment, a basket investment of mid and large cap IT stocks?
No, Rima, I don't think so. I mean, it's very safe to have a tactical pre-positioning on the IT companies at current levels. So just before the earnings, if some stable commentary is there, you will definitely see a good upside, maybe 10-15% kind of a surge from these levels can always be there. But tell me one analyst on the street who has a number, who can confidently come up and say this is a business trajectory, this is how things will evolve, and this is the growth numbers which will play out for the IT company. So I haven't come across any analyst where it's an opinion and a hope trade which has been playing out there. People are saying, I mean, you may use the word dark horse and all those stuff. But as to the clarity on the trajectory, how the businesses are going to evolve, as of now, the street seems undivided. And even if you go wrong from here by calling it a buy at current levels, you lose nothing. Because anyways, it's a very vague and future which is hard to predict as of now. So we are not nibbling in. definitely, I mean, if some stable commentary is there, a trading bet is always on the IT stocks, given the current levels, and the hope trade will pay out. But we are staying out. Other than Orion Pro, the other stock which we have entered into was Tata Technologies. So again, KPIT Technology came out with a guidance which was, unnerving, least to say. But let's see how the numbers pan out for Q1 as far as Tata Technologies are concerned, and then we'll see take it from there.
Got it. So yeah, I mean, absolutely. Not clear, absolutely not clear the road ahead, but there will be people, and I think there are people who are taking a bet and sometimes it's just about taking a bet and believing that, there's always the other side, pretty much in everything you do. And I think some are making that bet that this is it, and perhaps time to nibble. And Sandeep, of course, said that. Sandeep, the other Sandeep, who is, of course, the veteran IT analyst who we had day before yesterday on the channel, also believes that IT perhaps will do well from here. That's some of the view coming through. Well, the other big mover today, some of the big movers are Titan, Trent, Kalyan Jewellers. Some all are sort of reacting with forceful reactions coming through. Mangalam is here to wrap this up for us. Mangalam, take it away.
Well, we start with Titan versus Kalyan. Kalyan is lower today. Titan has hit a fresh record high, and it only reminds you of the old movie saying that if your friend does badly, you feel bad, but if your friend does better, you feel even worse. And that's exactly what's taken place with Kalyan and Titan. For the last 16 to 17 quarters, every time these companies would report numbers, Kalyan would do a shade better on a lower base. So reported growth was higher than Titan, but Titan being Titan on a higher base and with a kind of multiple that is enjoyed over all through its life, would always contend with that. This time around, however, things have changed. Titan's done extremely well. 39% growth in their jewelry business on a fairly high base. Kalyan Jewellers, on the other hand, has grown at 38%, so which is a shade softer than Titan, and which is where we see the vehement reactions on both sides. So Kalyan Jewellers down about 6.5–7%, whereas Titan's hit a fresh record high. Across the board, there has been growth, actually. If you look at Titan, Zoya, Maya, and Tanishq, the key brands of the company, have grown at around 38%. The growth brand of the company, Carrot Lane, has grown at around 42% as well. And international, which is a smaller part of their business, but a major growth driver as per the management, is up 128%. Beyond jewelry as well, their eyewear business, watches, have grown upwards of 23%. So that's a positive. It was, the overall sentiment that did well for them. Relatively modest gold prices as well, or stable gold prices that led to double-digit buyer growth alongside, studded growing at mid-30s too. And all of this added with the, investment interest that people saw in gold coins did well for Titan by and large. For Kalyan Jewellers, the same store sales growth has been 28%. They have a slightly higher exposure to West Asia than the other companies, and as a result of which they've seen 35% growth out there. And there too, the lower end of the jewelry business, which is Candier, has grown at around 112%. But if you put Kalyan in context, not just with Titan, but a much smaller peer like Senco as well, it's been an underperformer. So Senco has grown at 60% on a very low base, and which is why the street is particularly disappointed with Kalyan Jewellers. On Trent, it's just literally 19-20 ka farak. Trent's revenue has grown at around 19%. The street was working with a 20 to 22% sort of growth. So there has been a mild disappointment. But remember, going into these numbers, the stock from its April lows was up 50%. In fact, in the last 1 month, it was up around 20–23%, and not particularly cheap, trading upwards of 60 times even after the 11% correction that we're seeing out here. The street was anticipating that given the sort of run-up we've seen in the stock price, the management commentary, alongside the growth that it had shown in the fourth quarter of 20%, things will only look better from here on. That wasn't the case to be, which is why we are seeing that violent reaction on the downside for Trent.
Yeah, no, absolutely. Mangalam, thanks very much for that. Pretty comprehensive look at all three companies here. Dharmesh, you want to pick one, talk about all three? Anything you're noticing here?
Yeah, Prashant, I mean, a very classical case study as far as, Titan and Trent is concerned, both from the same house group. So Trent, in spite of the big, size they are sitting on, they were able to clock 40% plus kind of a growth trajectory. And to highlight, just last 10 years back in 2016, same time, if you bought gold at $1,300 an ounce, it's up 3.5x. Titan stock price was 400, it's up 11x from that time. So better than buying jewelry. If somebody would have invested into this company, it would have returned a humongous kind of a gain. At the same time, the ROEs are very strong, almost 38–39 percent kind of an ROE and 40% kind of a growth, usually you can stretch to 2 times PEG ratio. So that still leaves a scope of 15-20% on the upside as far as Trent is concerned, a good value buy considering the way they have been, evolving and growing their businesses both India and abroad. As far as Trent is concerned, I mean, one thing is very clear, unorganized to organized play is on. If you look at V2 retail or V-Mart or even Bajaj style retail, everybody has been growing in higher 20s. Bajaj style was 29%, V-Mart was around 23%, and V2 retail was around 58% kind of a growth in the quarter gone by. In comparison to that, Trent is 19% kind of a growth, almost the same value chain. If the merchandise which they sell, the pricing is almost the same out there, and then their Trent has been losing market share to these guys. And valuation front, all these are trading at around 50 to 60 times. Bajaj style is expensive, but if you look at V2 and V-Mart, they're around 55 times trailing multiple, whereas Trent is still 80-90 times on a TTM basis. Forward it may be 70, but again, if less than 20% kind of a growth is there, this kind of a correction has to happen. So, I mean, it's, for Trent, it may still be a trading play, but if one has to go into this space, I think merchandise exports, then V2 and V-Mart is a better option out there.
And Kalyan Jewellers, with the correction today, is it a buy or it's an avoid? You'll wait to see if it continues to underperform its peer.
I really want to answer that. I mean, a basket buy on all jewelry stocks. I was just going through all the stock price action, be it Kalyan, Thangamil, PN, Gadgil and all. So if you're buying a basket of all these stocks and keeping it for say 3 or 4 years, the returns could be far superior than pure gold buying can give you or a silver buying can give you.
Okay. We'll ask you about Info Edge. Before that, let me go across to Vinny, who joins in to tell us how did the numbers look in Q1, the business update shared by the company, because the stock price is on a tear. Vinny?
Hi, absolutely. The stock is buzzing away in today's trading session. The Q1 update looks very interesting. Strong double-digit growth is what the company has managed to see even in Q1 FY27, especially in terms of billings, 14.4% growth. So standalone billings have come in at 737 crores. Now, segment-wise, recruitment business, which is most of the part of the business, that's the Naukri.com business. That's the one which has seen a 17.45% growth. 99 acres, 16.5% growth. So strong double-digit growth there. Jeevan Sati, that's also seen a strong growth of 16.5%. Shiksha, that's the one which has seen a bit of a muted growth and a decline that we're seeing there of 21% versus last year, but that's a very small portion of the business. Now, obviously, overall in terms of revenue trends also, they've managed to see strong double-digit growth and seems like that's something that will continue in Q1 FY27. Do not forget the Naukri job speaks data also came in earlier this week as well, and that was something interesting, right? IT covers most of the portion in terms of IT hiring trends is what the main indication comes in, which has been a bit muted, but AI hiring trends, that has been very strong, and that's a trend that has continued in the last few months as well. So that is an interesting trend. We've seen the momentum pick up for the stock in the last week, especially last month as well. And before that, it was underperforming. So now that momentum has picked up and seems like that's continuing today as well.
Thank you very much for that. And I remember in the prior quarter in Q4, the numbers were a bit of a miss. The recruitment business, which is the key business, had seen a muted 1.2% quarter-on-quarter revenue growth. Margins had come under pressure. But this quarter looks like the company has bounced back, double-digit standalone revenue growth. And even on a quarter-on-quarter basis, there has been a pickup. Ramesh, interested in this because this also gives you an indirect play to the startup ecosystem in India with the kind of investments that they make.
Yeah, definitely. I mean, there are two parts to the valuation of Info Edge. One is the investment book, which is around 55 to 60% of the entire market cap, depending upon which side you want to give a weightage. But usually 55 to 60% is that, and the balance is 40 to 45% is the operating business. So the fear was that because of the IT slowdown, which has been feared, there will be lesser growth on the recruitment side, but they have done pretty well. 60% kind of a growth is there. Internals would be more interesting in which areas and which pockets this growth came by. That would be more interesting to know about, whether it is GCC-led growth or normal recruitment growth has been there. So that will happen in the phone call. And that business, we are valuing it anywhere around 30 to 35,000 odd crores on the market cap basis. So based on SOTP based valuation multiple, I mean 5-7% kind of upside scope is still there on Info Edge. See, investment is the only upside which you can get by value unlocking. Otherwise, this 15-16% kind of a compounding on the balance part translates to basically 7-8% kind of a stock price growth on an annualized basis. So not very bullish on it. We will be interested in the con call when the details of the number come through.
But Dharmesh, despite all the IT, no hiring, negative, all that, right? 14% growth in hiring, which is the most profitable part of the business, despite, this is not the IT segment, but overall hiring, which is the most profitable segment. And of course, then there is Eternal, PB Fintech, which is, 65% of the value of InfoEdge. By sheer holding in those two companies. So I think, but you're still saying that you'd kind of hold back on this one.
Yeah, Prashant. I mean, as far as PB Fintech and Turner is concerned, so best of the valuation has been priced in.
Okay.
So that's the reason why what we can see 5-7% more upside can still be there on the SOTP based valuation, but beyond that, it's difficult to take a call as of now.
Got it. What else, Dharmesh, are you kind of focused on right now? Any other names? Anything else?
Prashant, I mean, we are right now looking into the results, and I think metal gives you a good opportunity to nibble back into most of the companies, because Hindustan Zinc, the numbers I was looking at closely, so there has been a volume growth out there. And aluminum businesses also, the volume growth, the companies have been reporting volume growth out there. So the Vedanta update I'm talking about. So I think with the kind of correction which this metal companies has seen, there's definitely made a case for a trading or tactical buy. It can come down because it's a high frequency trades happens out there. So 5-7% kind of a correction may still happen. But I think one should start labeling into that, and Hindustan Zinc, Hindalco, JSW still looks better as headwinds ease out, and we will step into more of a construction activity going forward into second half of FY27.
A quick word on Swiggy. The stock is surging today, and it's attributed to the fact that the company's aggregate foreign investment holding in the company has gone below 50%. So the domestic shareholding has gone up above 50%. This is an exchange filing which was made earlier today, and the stock is moving up. What is the implication of this? The fact that domestic holding now in Swiggy is above 50%.
Riba, difficult for me to comprehend the implication of percentage holding, how it's going to change the nature of the business and the environment in which they have been functioning. Quick commerce, to our mind, is a very competitive space, and the cash burn will heat up more from here than coming down. So with Jio and Amazons of the world, Walmarts of the world coming with full force, so second half would be very difficult for most of them. Having said that, among the entire basket, what I think can still survive the game is Eternal. But again, there is a valuation concern. So to us, the upside on Eternal stock price can be 300 or 310, and the floor is 240, 230. So this is the range in which the stock price is likely to oscillate going forward. So we are not buying any of the quick commerce space, please, as such.
Okay, all right. Dharmesh, we'll leave it there. Thank you very much for joining us. Good speaking with you, and appreciate your time here. We'll take a break. We're back. Shiv Sehgal of Nuvama Capital Markets on the other side. Just take a quick break. See you in just a bit.
Welcome back. As always, Hormus now joins in to put the spotlight on the top movers in the market. Hormus.
Well, unsurprisingly so, used to start off with Trent, considering the casualty of the day is the 12% fall, now the biggest since April of 2025. And Mangalam was also mentioning the fact that the stock had had a very significant run-up before today's session. It snapped a 6-day winning streak today. And the 3,000 put option on the FNO side is the most traded one as well. The premiums have gone up 440% on the 3,000 put option in today's trading session. The volumes also are the highest since the 6th of January this year, and 80 lakh shares have been traded on Trent today. The 20-day average is only 15 lakh shares. Almost half of those are marked for delivery, and after breaking key levels on the downside, it's now at the 50 DMA level, which is at 29.12. So that is the first level to watch on the downside, and in fact the stock has not closed below its 50-day moving average since April of this year. So Trent is something that should be on your radar. Swiggy is the other one that is doing well, in fact, in today's session. It's the biggest single day gain in volumes that the stock has seen in over a month, so 6% higher on the stock today. It's gained in 5 out of the last 6 sessions as well. Volumes are decent, 2.5 crore shares traded. The 20-day average is 1 crore. 40% of those shares are marked for delivery as well, and the stock is back above its 50-day moving average, which is at 257.5. The next level on the upside is the 100-day moving average, which is at 277, but the stock is still down 33% from its issue price, which is 390 rupees. And lastly, a news flow driven name, Rights, after the order win, still holding on to gains of 11%, snapped a 3-day losing streak today. In fact, the stock had declined in 5 out of the last 6 sessions before today. It's among the top performing PSU names. Volumes are the highest for the year for today's session and July, the 1st of July, when the stock had gone up by 13%, though the volumes of those 2 sessions are the highest this year. 8 crore shares have been traded today. The 20-day average is only 50 lakh shares, and 9% of those are marked for delivery. The stock, from its February 2024 peak of well over 400 rupees, still down around 45%, and the third most traded stock on the Nifty 500 today.
All right. Thanks very much for that, Hormus. So interesting list as always. By the way, advanced decline is now clear, 2:1, 2 down for every 1 up. And the Nifty's got about 30 odd points in terms of gains. Shiv Sehgal is with us, President and Head of Nuvama Capital Markets. Shiv, good to speak with you. It's been a while. Thanks for joining in. So what's been keeping you busy, Shiv? What pockets of the market, and I mean, just give us a sense of what you've been doing.
Hi, Prashant. Always good to see you guys. Hi, Rima, as well. I think it's important to understand, in the context of what's happened in India over the last 18, 24 months. The Indian market was completely out of favor for several factors. A lot of that has been discussed in your show as well. The key important ingredient there is this, none of which originated within the domestic economy, right? We've had, lots of discussions about the FPIs pulling out, the maximum amount of dollars out of India in the last couple of months, and chasing the AI hardware trade in the rest of the region. And then, of course, we have had the Iran war-driven energy shock, which has amplified the correction in the overall stock market. But if you look at even last year, we were discussing, post-Trump, the US-India trade deal had been kind of stalled and exports were getting hit. So there's been a multitude of factors which led us to, this energy shock that transpired a couple of months back. And that's why foreigners have pulled out 31 billion this calendar year, which actually is the maximum India has ever seen in any calendar year. And we have, this is only for the first half. What I would like to tell everyone is that, if you look at in the last 24 months, September 24, India's, MSCI India share in EM was almost 21-22%. And that's dropped down to almost, below 11%. And of course, we've all talked about the fact that, the INR USD has been the worst performing currency. That's the story we all know, right? What I would like to, bring to the fore here is that Indian markets, yes, been flat for 2 years. Last time they were flat was in 2018 and 19. However, there are some differences between then and now. Predominantly, this time around, metals and PSU banks, led the rally. They've been the best performing sectors, up 15-20%. While we have had the traditional defensive FMCG and IT, you were just speaking about that, leading the downside down 12 and 20% respectively. This time around, however, if you see, both mid caps and small caps have performed better than the Nifty, suggesting that the cyclical weakness is not an issue at the moment, right? And I want to tell everyone here in your audience as well that the oil headwinds, which amounted to a temporary drag on growth, are not a structural impediment, right? And if you look at what India has done, and hats off to what has transpired in the last few months, the government has diversified crude sourcing to almost 40 countries, right? For instance, India has become the largest oil importer from Venezuela in May. We have entered into new term contracts with Brazil, US, West Africa to reduce dependence on any single corridor. And the rest of the world has done the same, right? So the reliance on the Hormuz Strait has become lower and lower, which is great. The point I'm trying to make, I think the second half of this year, you're going to see inflation expectations ease. And as that happens, the inflation surprises, that central bankers anchor expectations of cuts are going to materialize in real rates. And as a result of which, I think global liquidity is going to be a lot more in the second half. And as a result of which leads to the crux of the matter, is that I think the dollar is peaked, and that's going to be very beneficial to emerging market countries and currencies, and India is going to be a big beneficiary.
Yeah, I was no, that macro backdrop is useful, but it's also well understood, right, Shiv? I mean, it's not new. So I was hoping you'd dive straight into when I asked you what are you doing, you dive straight into kind of themes and thematics and sectors and subsectors, because look, who knows, right? I mean, who thought this entire Hormuz thing will happen? We were expecting all of it in the first half. Now something may happen tomorrow. We don't know, right? So you got to work with whatever is thrown your way. So in that sense, what are you focused on?
So I think, just to your point, Prashant, I think that's, yes, anything can happen geopolitically. But I think if you look at what oil is doing and, markets look at prices, I think it's very clear that the market is no longer worried about the US-Iran conflict. The markets are showing that, yes, you might see some little bit more volatility, but just from a price perspective, and market has adjusted to that volatility as well. Coming to India and the sectors, I think, yes, last quarter earnings, the war was, literally 4 weeks into it. This time around, I think, yes, there will be volume drag, there will be margin compression in some particular sectors as they report earnings for July. But I think it needs to be the audience needs to be aware that the market has already factored that in, and we are going to look at, how it's going to transpire over the next 2 or 3 quarters. And from that perspective, if you look at, Nifty at 18.3 December 2027 forward earnings, it's almost at a 5% discount to your, 15-year average multiple already, right? So the forward multiple of roughly 17 times on FY27 estimates is actually the lowest since the COVID-19 pandemic. The valuation compression that has happened at the index level, and that is going to coincide with the earnings recovery that is just about to happen. That's a combination that historically has defined good entry points. So we are very cognizant that, if you look at certain sectors, as you rightly said, so I think there's a large dispersion that's happened. And I'll give you some examples. Like if you look at industrials, they're trading at a premium to IT on a 1-year forward sales basis, which is unprecedented, right? Private banks today are cheaper than metals on a price to book basis. FMCG dividend yield is now higher than that of power sector. So there are, opportunities that are presenting, and I think the market will start looking at that, given the macro backdrop. And I think I have turned extremely bullish in the second half of this year, with the thesis that the dollar has peaked and the liquidity is going to become a lot more available, not only for credit growth and the RBI deposit raise, what they've done for NRIs is a masterstroke. If you look at any of the estimates floating around, India is going to get about anywhere between 70 to 100 billion dollars, and I think that's going to flow back into the economy from the bank's perspective, and NBFCs and banks and insurance companies. You were talking about that earlier as well. I think all these elements are going to come in play, and we are quite positive on that. So I think cyclicals and AI proxies, which is industrials, metals, and power, we have seen a leg up there. I think that rotation will happen, and the defensives like private banks, IT, consumer, which look cheap, are going to see a lot more rotation into the second half of this year.
Will India attract flows in the second half of the year if, assuming Kospi, Taiwan continue to deliver on earnings expectations as they have up until now? In that scenario, say for the next 12 months, will global liquidity find its way to India?
Rima, great question. I think, see, one thing to be aware of is that the market is already factored in and a lot of allocation has happened. Portfolio managers, global asset allocators already made money and the momentum trade has happened, right? Now we can call it whether it's a bubble and things are going to correct. As we speak, Korea is already down 18-20%. SK Hynix is now talking about an ADR listing and all that stuff will happen. You know, everyone, if there's a fad, there's a momentum, they're going to, try and bask in the sun when the sunshine is there. Coming to India, it's important to realize that global asset allocators, especially emerging market data that you look at, right? As we speak today, they're running a 50 basis points underweight position in India, right? And which is a sharp reversal to the 10-year average of emerging market hedge funds. If you look at their allocation in India, right, that was about 2.2 to 2.5%. Even a small shift there, given where valuations today are, where liquidity today is, I think it will see a monumental shift. And that in the last 10, 15 days is starting to happen in institutional desks where, for the first time, I'm seeing foreigners come back and ask us, ideation. They're asking us, where do you think we can actually deploy money? Till about 3 months back, 4 months back, that was not even a question. All that money was flowing into Korea and Taiwan. I think that rotation is bound to happen. Also because there is a little bit of euphoria that is placing in the AI and the semiconductor space as well, right? The rally in semiconductor stocks is not being supported by the hyperscalers. In fact, if you look at the US and some of the region, the hyperscaler stocks are down about 15% in the last 1 or 2 months. And chip shortages could result in capex moderation, which I think will derail this thesis. And that's the reason I'm quite bullish in India in the second half.
Shiv, we'll leave the conversation here, out of time. We've got less than 30 minutes to go to wrap up today's trading session. Thank you very much for joining in. Mangalam is now joining in to get us the latest trends from the futures and options space. It is weekly Nifty expiry today.
Yes, and the 3 p.m. move has actually happened on the downside, but it was pretty much on the expected lines for the simple reason that the market had seen a bit of an extended move on the way up. And we pointed out that maybe, the put-call ratio, which was at higher levels, would suggest so. And right now, as we speak, the Nifty Bank as well as the Nifty are off highs. The Nifty IT is holding fairly above the 20-day moving average. So it's just down, not necessarily out for the frontline index. In fact, the mid-caps have actually come off low. So that was one of the bones of contention this morning. Mid-cap index has actually curtailed its losses. And if you look at the advanced decline ratio as well, at one point we had 2:1 in favor of declines. And now as well, those lines have come noticeably closer. So we have about 1,500 stocks which are in the red, for about 1,200, 1,300 which are in the green right now. So those lines have come closer. So no real problems, so to say. The put-call ratio too has moderated a little bit. So we've at the day's high was 1.65 and ahead of expiry it's moderated to 1.16. So that's making more room on the upside for bulls, so which is exactly what the market's done after a near 600-point rally over the last 4 trading sessions. Just right now for the expiry, the Nifty is between the 24,400 and 24,450 mark, and that's where smart money is placing their bets right now. 24,400 puts very active right now, and these are ones that expire in just less than 20 minutes from now, and we have the 24,450 call equally active as well. So on both sides there are option writers placed telling you that the market may expire in this very narrow range of 24,400 to 24,450 itself. Remember, the other reason why we also saw a sell-off from 24,500 is because going into trade today, the 24,500 call had the maximum open interest, so bears would have liked to defend that mark itself.
Okay, we'll leave the conversation here, but that point is taken about how markets are turning negative in the last 30 minutes given its weekly expiry. So we'll keep tracking that. Very sharp sell-off, and it's only accelerating now. Get into a break. On the other side, we'll get you a few BTST calls from our technical experts.
All right, 20 minutes to go for market closing, and we are down once again, 30 points lower, so 24,396. So, there has been a bit of a sell-off which has appeared in the last couple of minutes of trade once again. So, that's the overall picture that we have going. So, yeah, I think 256, the market was at about 24,470, and we've lost quite a bit actually, 80, 90 points from just 3 o'clock, a little before 3 o'clock, about 90 points gone. Well, Mitesh is back with us with what she wanted to do. You were saying that, the opportunity comes in at about 24,250 or so. Just thoughts on price action so far, Mitesh, and your trades?
24,250, 200 is my buying zone. And on the stock side, PNB Housing is a BTST. Keep a stock just below of around 1100, so 1098 is what I recommend, and target of 1130 can possibly be achieved. And the other stock which I have is RBL Bank, which after pullback seems to be getting momentum on the upside again. So BTST here with a stop at 371.5 for targets of 380, 382.
Okay. Thank you very much for that. Moving on now to Blue Jet Healthcare, which is in the spotlight on the back of a QIP. Vivek joins in with what he's learned. Vivek.
Well, that's right. As per the term sheet that we managed to access last evening, Blue Jet Healthcare went ahead and launched a QIP, for which we understand from our sources has been fully subscribed. So the issue size for this particular QIP is at 600 crore, and there is an upsize option which remains to be seen whether it has been exercised or not. Indicative issue price, the company gave a discount of as much as 10% in order to go ahead and attract investors. Now, talking about the company itself, it's almost the second coming as far as Blue Jet Healthcare is concerned. Remember, it's a specialty pharmaceutical company, and it operates across three key business segments. The one that it is most known for is the contrast media intermediate segment, and it supplies a key intermediate drug for a bempedoic acid, a lipid-lowering drug. So that is one of the main business segments that Blue Jet actually operates in. The other ones, of course, are high-intensity sweeteners and pharma intermediates, as well as the APIs. Now, remember, at the end of FY26, the company actually gave some good guidance as far as FY27 is concerned. They said that they expect 3 to 4 new launches as far as the contrast media intermediate segment is concerned, and they also said that they had gone ahead and initiated lab supplies of peptide building blocks to innovators as well as large peptides as far as CDMO space is concerned. However, when you're looking at the company itself, the company in the past has actually flattered to deceive. Company was listed in November 2023. It had a listing high of 1,028, and this was on July 21st, 2025. But that day onwards, which the company actually saw a significant fall, a single biggest day fall of 10% that particular day. In that particular month, the stock lost over 20%, and this was after the Q1 FY26 results. In fact, JP Morgan are disappointed with the performance that actually downgraded the stock to from a neutral to an underweight rating in Feb 2026, almost a second coming, but the QIP seems to have been subscribed well, so it'll be interesting to see how the company's performance actually improves fundamentally Q1 to Q4 FY27.
As Vivek was talking about the company, the stock's made a bit of a move, $20 higher. It's about 3.5% in the green, 582 on Blue Jet coming in at this point. Well, Jay Bala is with us, CMT, cashthechaos.com. Jay, good to have you with us here. Thanks for joining in. Have you had a nice rally, 1,000 points from the lows about a month ago, Jay. What's the view now? Nifty.
Hi, Prashant. Thanks for having me on the show. The view remains the same. It's just a matter of time before the Nifty large caps turn bullish. See, for a very long time, the undertone has been bullish. And, we have the Nifty small cap index at record highs today. And we have had several other sectoral indices at record highs. And we have the Nifty Next 50 at 52-week highs. And so it's just a matter of time before the large caps also join the broader market. So what is dragging the large caps is the IT names, and that's also starting to perk up a bit. But the recent low on the Nifty IT is not a convincing low. Perhaps it's got a revisit or slight push below the recent low. So that's the only thing. So if the Nifty crosses 24,602 directly, we are getting price expansion straight away. But there is a possibility that Nifty might pull back first due to the Nifty IT index and then break out. But in either case, the Nifty is heading higher, and there's a very bullish move that lies ahead for the large cap Nifty.
Sorry, what's the setup for Nifty IT? What are you recommending? We're at 27,948.
Yeah. See, the recent low of the July 1st, that's not a convincing low that can pick a bottom for me. So I would want somewhere about 24,500 or 24,600 to come through. Then there is a possibility that structure-wise and form-wise, Nifty IT completes a corrective decline. And then from there on, it might be able to put in a stronger bottom.
I see. So basically a revisit, right? The July 1st low was about 25,700. Yeah, 25,700. You're saying that maybe a retest and then a bounce from there. That would basically complete the structure, and that will be more believable.
That's right. So yeah, a bare minimum would be a revisit, and there are some factors that. But even the mid caps, some of the mid cap IT names, they've started powering ahead. But the large caps IT, that they need to go back and revisit the lows. That will put in a more durable bottom, or slightly exceed the recent low of July 1st. Then that will complete a price structure. So we're waiting for that to happen. And and the large cap, within the large caps, HDFC, which was dormant, that's crossed 820. So that's a positive for the large cap names.
I see. And sorry, so similarly for the Nifty, what is the structure? What's the setup?
Yeah, 24,602 across above that in an intraday print would also be enough for me. That will convince me that a powerful leg up has already commenced. And but if it were to pull back closer to something about 23,800, then that will closer to the gap area. Then that will complete a very short-term price structure. And anyway, the markets are heading about 24,602 in my opinion. Whether it does it straight away or does pulls back to 23,800, that's the only question that remains.
Okay. Now let's talk about the Nifty names. You said HDFC Bank is perhaps leads this leg. Is that the view?
Yeah, no, I wouldn't come to that conclusion yet. Yeah, but the fact that it's been a laggard and been an elephant in the room, and it started moving now above 820, that's the first sequence of higher highs that's come through. On June 16th, I was here and said bond yields are heading to 6.6 and 6.4. We got 6.6. Now, that should help most of the banks here. And private sector banks could also be major beneficiaries. Yes, the fact that HDFC Banks has crossed its 820 with bond yields dropping to 6.6. That's a positive sign, and the bond yields still have lower lows to come through. So let's see if the private sector banks will capitalize on this softening of bond yields.
Got it. So do you buy the banks individually? Do you buy the Nifty? Is that the better way to go about it?
Yeah, within the large caps, you got to get individual, Prashant, and you need to have key triggers. And Reliance is the other one, other elephant in the room. It needs to cross 1345, and once it crosses, and that's going to power the market ahead. And within banks, you got to. I think ICICI and Axis and HDFC, you need to be focused on these three.
Got that. Kotak has been under pressure. Are you sensing more downside?
Yes, Kotak's key support is about 372, and it looks like once that's broken, there's a probability that it's going to revisit the recent low registered in April. So what's 372 is a very important support, and in all probability it might break that 372 support, but we don't want to preempt the market. If it breaks 372, there's possibility of another decline to about 340, 350.
Okay, we'll ask you about your own picks and ideas. You have a few always, Jay. There's about 10 minutes to go for close. Let's take another quick commercial break here. See you in just a bit.
Welcome back. In conversation with Jay Bala of cashthechaos.com. Jay, what would your stock recommendations be that you can share with us today?
I have two today, one from the cash space, one from the F&O space. The cash stock is Cabra Extrusions Technique. It's putting in what we call as a W bottom on the weekly time frame. And yesterday it broke out above the resistance line. So a stop loss at about 225. The height of the W pattern is about 100 rupees. So it could easily travel 100 rupees from the current levels. And the second one is from the F&O space, Swiggy. It's probably putting in an important low at 235. But because of the limited history, price history, I'm not able to put my finger on where it is heading in the medium to long term. But we can treat this as a short-term sharp reversal and expect a move about 20% from current levels. Stop loss are about 235. If you're an elite wave fan, it has all the ingredients from the post-listing high to the recent low of 235. And it's also putting in a micro double bottom. So, the technical structure is looking very interesting. Let's see how this pans out.
Stock is down 30% year to date and about 45% from its recent 52-week highs. Jay, stay on. We want to just quickly get the conversation that Prashant you had with Ravi Dharamshi.
It was an interesting one. It's basically it's Ravi Dharamshi of Value Quest, and they come out with a new report, and the basic sort of crux of it is that when you look at the AI capex spends in India, what do you do, right? I mean, you can look at all these overseas companies doing well. He says, well, it is the picks and shovels, which is the physical infrastructure which is supporting this AI capex, which is what you need to buy. And there too, you got to go 1-2 layers lower because the top layer has done quite well already. So this was an interesting conversation. He also, of course, says that because growth is so strong and it may be durable for the next few years, just looking at P multiples would just leave you dissatisfied because they'd remain high and you'd keep waiting for a correction. Listen in.
The broader themes are that we keep bumping into every now and then is defense, aerospace, nuclear, energy transition, which includes from renewables to battery storage systems, hydrogen. Then there are AI data center, power grid capex. Now, in the foundational layer of AI, India has no play. Like the memory chips, the servers, the GPUs, everything is probably based out of Korea or Taiwan. But what are the other bottlenecks? So we need we need connectivity to the grid. We need cooling system. We need a lot of power cables to be laid out. We need switch gears. But for these companies, AI is only one theme. Energy transition is the other theme. Even just the higher exposure to renewables requires that we have a far higher and better, bigger, modern grid, and which requires that you put in the money behind more transformers and cables and all those kind of things.
Jay Bala is with us, of course, and he's been running us through what he likes. Jay, so yeah, your stocks, Jay, what's on your mind?
Yeah, we went through that Prashant Cabra Extrusions and Swiggy. And when it comes to the AI play, I think the semiconductor index in the US, it's still got higher highs to come through. But in the very short term, we could see a sharp pullback in the form of a short-term correction. So when it comes to picks and shovels here, we're going to be looking at things like NetWebs, Anantraj, and related plays.
Yeah. By the way, Swiggy has been such a huge underperformer, right? Why do you like it? I mean, I think there's an IIFL note on it, and there's some solid commentary. So fundamentally, sure, but technically, I mean, you'd buy strength, right?
That's right. See, if this had been having a further price history, I would have turned extremely bullish. But the stock has got limited history from just about from 2024. But the first leg of the down move from the all-time highs to the second leg of the down move has reached equality. Invariably, fundamentals tend to follow what the price does. So I'm sure the stock is likely to rally at least 20% from current levels, and there should be some news flow triggers that comes through and pushes the stock higher. I'm not. I mean, if it had had longer history, I would have said the stock is headed for fresh all-time highs. But due to the limited price history, I'm keeping this as a corrective bounce.
Okay, IFL on Swiggy recommends a buy. Their target price is 480. That's a significant upside from current market levels, And they did a couple of roadshows even in London. And on quick commerce, IFL note says the company remains focused on achieving profitable growth through better monetization, network utilization. Dine out is at 1% margin. Their target is 5%. They're comfortable with their balance sheet. They believe the working capital intensity should decline in quick commerce. And they expect the food delivery profitability and treasury to offset the investments they're making in quick commerce. So that is the other bit of news on Swiggy. Stock is up nearly 7%. Jed, just before we run out of time, any thoughts on Kospi and Taiwan? Increasingly volatile, particularly Kospi.
They still got a lot of room to head higher in the medium term. But in the very short term, both Kospi and Nikkei, which have a lot of exposure to the AI names, they are due for a short-term correction. Then we could see further decline. But if you include the semiconductor index, Philadelphia Semiconductor Index in the US, or the Kospi or the Nikkei, they are all moving in tandem. So they all point to a short-term decline. And they are not done in the medium term. We could see fresh all-time highs come through in the region of about 80,000 for the Nikkei, but first a pullback possible to about 54,000 to 52,000. And Kospi, I don't have the levels on hand. So SOX index will probably hit to something like 16,000 and beyond.
Okay, Jay, we'll leave the conversation here. The Nifty ending at 24,350, sharply lower. Sell-off accelerating in the last 30 minutes of trade as the Nifty weekly expiry played out. But from 9:30 to 3 o'clock, markets were largely consolidating after a 4-day up move. The net result is 76 points lower on the Nifty, snapping a 4-day winning streak. The Sensex lower by nearly 200 points. Mid-caps have been seeing some profit booking from the start of trading session, and they're ending with a cut of about 0.3% with a negative advance decline ratio. On the way down, it's Trent, which disappointed the street with a 19% revenue growth. The street wanted more. Adani Enterprises corrected. Adani Ports under pressure. BEL was weak in trade. Metal names were subdued. Reliance Industries was a drag today with a cut of more than 1%. On the way up, the top three Nifty gainers are IT names. So large cap IT seeing buying along with that mid cap. Titan did well. Eternal was higher along with that Swiggy, and HDFC Life, SBI Life, so life insurance companies also on the gainers list. It's a wrap and closing bell. Thank you very much for watching. Don't go anywhere. Markets Forward comes up next.
A volatile session saw Dalal Street end lower. Nifty snapped its 4-day winning streak to end below 24,450. Mid-caps underperformed.
Trent slumps after first quarter revenues failed to meet analyst expectations. Triton grows first quarter sales faster than Kalyan Jewellers despite its significantly larger scale of operations, even as overseas business for Titan expands at a significantly higher pace. The stock of Kalyan Jewellers takes a beating while Titan moves to record high.
Right soars 11% after a big order win. Infosys soars on a strong Q1 business update. Cochin Shipyard falls after the government launches an OFS to pair up to 5% stake.
Good evening. You're watching us here on Markets Forward. This is your go-to show where we aim to get you all the key data points to get up for the next trading day while recapping how trade played out in today's trading session. It was volatile. The Nifty ended off highs, but snapped just a 4-day gaining streak. Over the last 4 days, we've actually seen a near 600-point up move on the frontline index. Despite the drop that we saw from today's high, the Nifty still holding very close to the 24,400 mark, led higher by the IT pack, but buoyed lower as we had the weekly options expiry play out as well. Hi, Vivek.
Good afternoon. Well, a very choppy trading session, maybe you could call it that, cooling off quite significantly from the intraday highs and snapping the 4-day streak. The Nifty IT, like you mentioned, managed to hold out, but a whole host of other sectors actually saw quite a bit of selling pressure. Nifty Bank too cooled off quite significantly. But well, here's a lineup of what we have in store for you today. We'll start with the top movers and shakers of the day with Sudarshan. We'll decode the Q1 updates of Trent, Titan as well as Kalyan Jewellers. We'll put the spotlight on Cochin Shipyard's OFS and tell you why Info Edge surged in trade today. Last but not the least, we'll delve into the key market events to watch out for in tomorrow's trading session. And now on to our first segment of the day. Sudarshan now joins us from the big wall with all the top movers and shakers.
It was a pure expiry day play that we have seen in the market. It closed at day's low, Nifty below 24,500, and it was a day of the big reaction to the quarterly updates. On top of the list is Trent, closed with a cut of more than 12% after company has reported revenue growth of 19%. That was below expectations. On the other hand, Titan saw a huge gain and closed at day's high, also at record high after healthy quarterly updates. But again, the peer stock Kalyan Jewellers saw a cut of almost 7% despite reporting a healthy growth, but it did underperform Titan. Info Edge closed with a gain of more than 13% after company reported a strong billing growth of more than 14% for Q1, and that's the reason stocks see an up move of 13%. Jubilant Food too reacted positively to quarterly updates. At the end of the day, stock was 4% higher. One segment that continues to do well and has been supporting the market is IT stocks ahead of quarterly earnings. You can take a look. Infosys, HCLTech, Tech Mahindra, LTM, and Persistent, all these stocks have moved somewhere higher in the range of 3 to 5%. But another segment that has been under pressure over the last few days is capital market name. BSE closed with a cut of almost 3%. Similar move was seen in Angel One, closed with a cut of 3%, and MCX2 saw a cut of almost 3%. Some of the stocks that have reacted to news flow. First on the list is Swiggy. Company has announced that FI's shareholding has slipped below 50%. We are not sure if the stock has reacted to that, but also we are hearing that commentary in the recent roadshows has been positive. Stock closed with a gain of almost 7%. Cochin Shipyard government has launched OFS to sell up to 5.04% stake, closed with a cut of 4%. Varun Beverages, because it's acquiring a promoter-owned company, stock closed 2% lower, and rights on a big order win closed almost 9% higher.
Well, thank you so much, Sudarshan, for joining us and giving us all of the top movers and shakers of the session today. Well, one particular stock that stood out was Info Edge. It rallied 13% on the back of a strong Q1 business update. Let's go across to Winnie for all the key highlights. Winnie, over to you.
Hi, absolutely. The stock is buzzing away in today's trading session. The Q1 update looks very interesting. Strong double-digit growth is what the company has managed to see even in Q1 FY27, especially in terms of billings, 14.4% growth. So standalone billings have come in at 737 crores. Now, segment-wise, recruitment business, which is most of the part of the business, that's the Naukri.com business. That's the one which has seen a 17.45% growth. 99 acres, 16.5% growth. So strong double-digit growth there. Jeevan Sati, that's also seen a strong growth of 16.5%. Shiksha Yeah, that's the one which has seen a bit of a muted growth and a decline that we're seeing there of 21% versus last year, but that's a very small portion of the business. Now, obviously, overall in terms of revenue trends also, they've managed to see strong double-digit growth and seems like that's something that will continue in Q1 FY27. Do not forget the Naukri JobSpeaks data also came in earlier this week as well, and that was something interesting, right? IT covers most of the portion in terms of IT hiring trends is what the main indication comes in, which has been a bit muted. But AI hiring trends, that has been very strong, and that's a trend that has continued in the last few months as well. So that is an interesting trend. We've seen the momentum pick up for the stock in the last week, especially last month as well. And before that, it was underperforming. So now that momentum has picked up and seems like that's continuing today as well.
All right, to discuss this forward, now we are joined by Jay Bala from Cash the Chaos and Sudeep Bandyopadhyay from Indicate Capital. Thanks a lot, gentlemen, for joining in. Let's go across to Jay first. Jay, last few days we've seen a bit of an up move. Today was obviously volatile, can be attributed to maybe a bit of profit taking after a solid 600-point up move that we've seen over the last 4 trading sessions. How do you feel about the market right now, the Nifty Bank, and in particular the IT stocks which have staged a stellar comeback?
Yeah. Hi, Mangalam. See, I'm a bit bullish on the markets, and the key level to take out on the Nifty is at 24,602. Once that's taken out, the market confirms what I've been saying for the last few weeks, that a powerful bullish move lies ahead. But in the very short term, it's not clear if it's going to take out 24,602 directly, or it's going to pull back one more time to 23,800 or slightly below that. So that's the only question. So in either of those cases, the markets are poised to stretch their move higher. The fact that HDFC Bank is stirring up and it's crossed 820, the previous swing high, that's a positive for the banking names. And we have I've spoken about the Indian bond yields clocking a short-term double top on 16th of June, and that's come to the first objective of 6.6 that I had. And the second objective is about 6.49. So we can see further up move as bond yields soften for the Indian markets. So the banking index is expected to push further higher. So focus on private sector banks, HDFC Bank, ICICI and Axis are the better ones within the space.
Okay.
So when it comes to IT, I think we need one further revisit or at least a break of the July 1st low. The July 1st low is not a convincing low for me. So perhaps some more weakness lies ahead for the Nifty IT space.
Okay, Jay, thank you so much for your views, especially on the private banks as well as the IT space. Sudeep, good afternoon and thank you for joining us. We are going into this particular week with a few IT results that will be upon us soon. Any of the stocks stand up for you? There's been a significant PE deflation on account of the AI worries, but post the parental CEO comments, most of the stocks have bounced anywhere between 5 to 8%.
Well, I think I will be a little careful and little skeptical on the IT performance. I don't think you'll have a stellar set of numbers or anything like that. Of course, they will benefit because of the rupee depreciation in the last quarter, and some amount of that will flow into profit and loss account for the IT majors. But beyond that, I'm not expecting anything great. Amongst the frontline IT companies, we do like HCLTech. I think they have been trying to do a lot of right things, and some of the recent contract wins in the Europe was a landmark really. And I think we will watch HCLTech very closely. I think that's one company which has probably pivoted very well in the new AI world. They also have taken a small shareholding in India's only AI company. So they are trying to position themselves rightly. I'm not saying that TCS, Infosys, or Wipro aren't trying. They're trying. They're tying up with AI, Anthropic and others to kind of become partners with them for servicing and for implementing their AI tools. But I think their revenue and other things from AI is some distance away. So I will maintain my cautious stand on IT.
Okay, Sudeep, thank you so much for your views as far as the IT space is concerned. But remember, consumption stocks are back in focus this earnings season, with sentiment turning upbeat across staples, retail, jewelry, and discretionary names. From easing input costs to strong revenue momentum in retail and jewelry and a sharp turnaround for Nykaa, there's a lot to unpack in the consumption basket. Mangalam has skipped across to the wall to break all of that down for us. Mangalam, over to you.
Well, if there's one thing that stands out in the first quarter updates so far, it is loud and clear. there is consumption recovery. In fact, if you look at all the companies that have reported their first quarter update so far, there are three things that really stand out. Sentiment has been upbeat across the board. There has been price growth, which has led revenue along with volumes as well. And finally, there is some margin pressure, but that too is transitory. So to understand this further, we've divided that into staples, discretionary, jewelry, and retail as well. So if you look at the staples, Marico, Godrej Consumer, Dabur, low 20s to high teens, and in some cases double-digit revenue growth, which is the highest that we've seen in the last many quarters. Volumes, double-digit for Marico, high single-digit for Godrej Consumer, Dabur as well, mid to high single-digit that we've seen, the highest in the last many quarters. Yes, there are some margin pressures, and we've heard from the companies as well. Case in point, Marico, they've seen gross margin improvement recovery, quarter on quarter, and that's largely because their key raw material for Parachute, copra prices are down 45% from the peak. But barring that, for Dabur, they've actually taken calibrated price hikes, so which is why EBITDA margins would remain stable. Godrej Consumer has said that margins are impacted by higher input costs, but that's just transitory. They expect them to progressively increase as we move towards FY27, and EBITDA growth itself will be in double digit. Now, if you look at some of the larger retail players, there's been 15 to 19% revenue growth. Avenue Supermarts 15%, Trent about 19%, slightly shy of analyst expectations, but definitely higher than what we've seen in the past as well. And then you go down the curve, a lot of these value retailers have done extremely well. Anywhere between 23 to 29% for V-Mart and Bazaar side. V2 retailers up 58%. All of this led by 7 to 8% same-store sales growth, and store additions have been fairly strong for them as well. And add to all of this, if you look at the jewelry space, some stability, relative price stability in gold prices has led to a big surge. Senco on a low base doing 60%, Kalyan doing 38%, and Titan itself on that high base of Tanishq, Zoya, Maya, all of them seeing a 39% growth. And then finally, we move on to discretionary, where Jubilant FoodWorks has reported a consolidated revenue growth of 14%, standalone revenue growth of 9.2%. And if you look at the like-for-like growth, that too is 2.5%. Yes, on an absolute basis, seems a little soft, but if you look at it on a high base, it is actually mid-single digit CAGR over the last 2 years. And obviously, if you compare it to the fourth quarter, there has been a noticeable uptick, and that's something that the street is fairly hopeful about going forward too. And then you have, Nykaa, consolidated gross merchandise value seen in about early 30s as far as the growth is concerned. Good performance from their beauty business. Obviously, late 20s is the growth that we've seen out there, and that's been a driver for the company. But this time around, what really stands out is discretionary consumption. Their tie-up with Nike has done well, and their fashion vertical has seen net sales value grow in mid-50s, which is actually at a multi-quarter high. So the message is fairly loud and clear across the board. The first quarter is marking a bit of a turn in consumption, and there is indeed consumption recovery.
Well, thank you so much, Mangalam, for giving us all of those details as far as the entire consumption Q1 updates are concerned. Well, Jay, let me come across to you quickly. You heard Mangalam. Which are the stocks that are looking good on the charts as far as the FMCG or discretionary pack is concerned?
Yeah, the India Nifty Consumption Index itself is breaking out. So, we've been bullish within that space on Indigo, Maruti, and also DLF. And the new age consumption stocks like Swiggy, they also seem to be bottoming out, and I've turned bullish on it today. So Swiggy might have put in a important low at 235, but it's got limited price history from only 2024. That's a slight disadvantage for a technical analyst like me. So I'm anticipating Swiggy to rally about 20% from current levels. So keep a stop loss of 235. And look at all the CNX consumption names and be selective about it. And I've given 3 other names from the large caps.
All right, take that point back on the chair from the wall, only to toss it across to Sudarshan now, because the CNBC TV18 newsbreak has been confirmed. Cochin Shipyard fell over 3% in today's trading session after the government has launched an offer for sale to pair up to 5% stake in the company, while RITES was the other one, which rallied in double digits after a big order win. So, take it away.
So it's been busy last few days or few months if you talk about fundraising by government is concerned. So the recent one is the Cochin Shipyard OFS. Yesterday, government has launched an OFS to sell up to 5.04% stake, and of that base size is 2.52%, and the green shoe option, if government goes ahead and exercises that option, that portion is also 2.52%, and if the entire 5.04% stake is sold, government will be able to raise almost 1900 crore. Floor price, if you talk about, government had set at 1400 rupees per share, and that was at a 7% discount to yesterday's closing price. Talk about non-retail portion of the OFS, it subscribed 250%. For the retail portion, OFS will open tomorrow. And also remember, government's total holding as of March 2026 is almost 68%. Now going beyond Cochin Shipyard and talk about how many OFS government is launched in 2026 so far. So government, including Cochin Shipyard, total 8 companies in which government has launched OFS, and if you consider Cochin Shipyard's 5.04% stake sale, government will be able to raise more than 27,000 crore. Let's see which company would be the next after Cochin Shipyard. But as of now, government has been going very aggressively on the OFS front to raise funds. Now coming to our rights. The stock see a sharp gain, closed with a gain of almost 9% after managing to win the order of more than rupees 2,200 crore, and that's achieved from, or that's secured from, a South African company to supply locomotive engine, and because of that, see a sharp gain up almost 9%.
Well, thank you so much, Sudarshan, for joining us and giving us all of the updates as far as these PSU companies are concerned. Well, Sudeep, let me come across to you first. Especially in terms of some of the OFSs that have come so far. You heard so many names, that Sud just spoke about. Any of the names stand out? Coal India is a very large OFS. Cochin Shipyard too. The stock has done very well, but fundamentals may be lagging?
Well, it is lagging, but at this stage, and I read the document and the commentary of the management, I think they are trying to smoothen the volatility of lumpy shipbuilding earning by focusing to a great extent on ship repair and strengthening the ship repair vertical. I think that's a very good step. Their new facility in Gujarat, in Vadinath, for the new ship repair facility should come on stream in a couple of years, and I think that should help them smoothen the earnings going forward. So I think it's a good company. They have a good order book. Aircraft repairing is a unique skill set which they have. So from a long-term investor's point of view, Cochin Shipyard is good. Amongst the other OFSs which the government did, I think Bharat Electronics and Coal India both stands out, and both we like from a long-term perspective.
All right, thanks a lot for joining in, Sudeep and Jay. We'll take a leave on that note. You've helped with a lot of perspective on individual sectors as well as stocks. We will continue our conversations on the channel going forward. But as we take a short break, let's get you some of the key top corporate voices and the key events to watch out for. But as we do that, let's leave you with some market opinion of the day. We had Sandeep Tandon who joined in, and he weighed in on his opinion specifically on the IT pack, which did well today.
We have said the beginning April that is a time for India. India is coming back, and if global market corrects further, which we have opinion that US market and even Korea, Taiwan market will correct significantly from these levels. If I have to talk about, let's say, next 2 quarters or so, then obviously India will be a winner in that. I think the background is more constructive and very stock specific rather than getting too much worried about what is happening in terms of index level. I think index will not give you a real flavor of the market. I think stock specific approach will give you far superior returns. You have to look at asset heavy businesses where you have cash flow generating ability, large capex is going on. That's where the FIS trend is now. If you look at all the recent infrastructure related QIPs, the buying interest was very large. And we have seen many FCI names are buying these names. Okay, so I think money is actually moving out from these top 10 names to some of the defensive name, and that's the reason I said there's opportunity, whether you talk about ports, airport, roads, or large infra names, power companies, some of the renewable names. So these are the area where FI have a lot of interest in India.
Welcome back to Markets Forward. Well, it's now time to take stock of all the big corporate voices of the day. Capital Small Finance Bank's MD and CEO Sarvajit Samra told CNBC TV18 that the bank remains on track to meet its FY27 guidance, with advances going 22% and deposits up 16.3%. He said that the bank's agri portfolio is focused on middle-income farmers with limited dependence on the monsoon. Samra added that MSME and mortgage loans account for about a quarter of the loan book each, while agriculture contributes 28%. He also said the bank's focus on secured lending has helped maintain collection efficiency of over 99% with no asset quality concerns.
Right, and we had Borosil as well, who joined us on the channel. Well, oil prices have retreated to their pre-war levels. The company continues to face short-term margin pressure due to elevated input costs. It said that it's taken selective price hikes, but not passed on the entire cost increase to consumers over the long term. However, Borosil expects EBITDA margins to improve to around 20% from the current 16%, held by cost savings from its own power sources and greater operating efficiencies.
Vector Technics told CNBC TV18 that demand for its products remained robust with enough order flow to fully utilize its annual capacity of 3 lakh units. The company said it had earlier struggled to meet demand due to capacity constraints, but is now seeing a revenue run rate of 3 to 5 crores a month, compared with negligible revenue before FY26. It also estimated that the domestic market opportunity at around 300 crore rupees and said it does not participate directly in tenders, as its products typically account for 30 to 40% of the total tender value.
All right, and before we wrap, let's get you some key market events that you need to track as we move into tomorrow's trading session. Devyani Vibhute standing by with those.
Well, let me start with the global events first. The US FOMC meeting minutes for the monetary policy that was held on the 16th and 17th of June is set to come out tomorrow, along with the crude oil inventories data as well. Now, from a domestic perspective, the Cochin Shipyard offer for sale opens up for retail investors tomorrow, as does the Kusumgar Limited IPO worth roughly around 650 crores. Now, in other news, tomorrow marks the final day of PM Modi's last leg in Indonesia in his 3 nations visit and his transition onto Australia going forward.
Well, thank you so much, Devyani, for joining us. And with that, it's a wrap on this edition of Markets Forward. We will be back with more news and updates on the other side. Thank you for watching.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Sensex and Nifty snap a 4-day losing streak to end with marginal losses. Mid-cap suffer sharper cuts. Rupee gains over 40 paisa against the dollar to move below the 95 mark. An LNG tanker catches fire after being struck by an unknown projectile off the coast of Oman. No casualties have been reported so far. Iran warned ships to only follow designated routes but stopped short of taking responsibility for the attack. NATO leaders gather in Turkey for the annual meeting. President Trump expected to pressure allies to increase defense spending. Ukraine's President Zelensky is also in attendance. Indonesia agrees to buy India-made BrahMos and Astra missiles as both nations expand defense ties. India and Indonesia will jointly develop the Sabang port near the Strait of Malacca, deepening wartime cooperation. Government steps up the divestment drive with 5% stake sale in Cochin Shipyard. Stake sale in PSUs has hit the highest level in 11 years with more than 25,000 crore rupees in proceeds so far in 2026. India's consumption engines rev up in the first quarter. India's FMCG giants see healthy revenue growth powered by steady volume gains and timely price hikes despite higher input costs. Jewelry brands report a revenue hike in the range of 30 to 60% for the first quarter. Samsung surpasses Nvidia as the world's most profitable company. Second quarter profit crosses $58 billion thanks to soaring semiconductor sales, but stock declines amid concerns over spending and future demand. One person is dead and 7 others are missing after a landslide in Kerala's Wayanad. The incident occurred due to torrential rains near a tunnel project site. And Belgium knocked the US out of the Football World Cup following controversy over a withdrawn red card for a US player at the insistence of President Trump. Spain also beat Cristiano Ronaldo's Portugal to enter the quarterfinals. All right, let's start with the day's market action. Sensex and Nifty snapped a 4-day winning streak with Nifty holding levels below the 24,400 mark. Mid-cap index underperformed and declined over 300 points from the high point of the day. Nifty IT emerged as the top gaining sector. Prashant Nair is here with the market wrap. Prashant.
Well, midweek, the market just decided to take a bit of a break. Nothing more than that. In less than a month, the Nifty has done more than 1,000 points. It's come up 500 points very, very quickly in the last, I think, a week and a half or so. A break is just part of the game. 50 points, so neither here nor there. 24,380 or so, just under 24,400 is where the market finally closed. Nifty Bank was sideways. The mid and the small cap part of the market was sideways as well. Market breadth was negative as well. That's the day. Now, if you want to go sectorally, what did best recently? Pull back and give back a little. Real estate was down 1.7. Defense was down 1.7. Capital markets was down about 1.5% as well. On the upside, the IT index, after a break yesterday, was back to winning ways, about 2.5 higher. Actually, the Nifty IT index was the only noticeably large gainer as far as sectoral indices go. I'll get to the large cap sort of stocks. HCLTech, Infosys, TechM were the top gainers on the Nifty. There was SBI Life, which was up about 2.25. There was Eternal, and there was a HDFC Life, which did pretty well also. Trent was down about 12.5%. Lots of these first quarter updates coming through. And Trent, the Trent reported market did not like. Adani Enterprises, Adani Ports were the other losers, which we really saw today. Now to the broader market. As I said, more down than up. And on the downside, there was BSE, which was down about 3%. As far as exchanges go, MCX lost about 3% as well. Cochin Shipyard was down 5%. Aegis Logistics, DLF, NetWeb, Loris Laboratories, Data Patterns, Paras Defense, KEI. Don't go looking for reasons except the fact that stocks across the board have done quite well. And on the upside, there was InfoEdge quarterly update here. Market liked what it saw, 13%. There was Policy Bazaar, which was up about 1.6%. There was Adani Energy Solutions, which was up about 1.6%, and a whole host of IT mid-cap names, Coforge, Persistent, etc., which participated on the upside as well. So a bit of a break. We've had a good run in a pretty short time span.
All right, thank you, Prashant, for that. In the money market, the Indian rupee gained more than 40 paisa against the dollar. The currency is now trading below the 95 mark against the greenback. 10-year bond prices also gained in trade, with the yield crossing 6.7%. Let's also talk about the big global story this evening. An unknown projectile has hit a tanker near the coast of Oman in a suspected Iranian attack. This comes just days after traffic at the Strait of Hormuz started to pick up pace. Here are the latest developments. According to the UK Maritime Trade Operations Centre, a tanker travelling off the coast of Oman caught fire after being struck by a projectile overnight. No casualties have been reported so far. The tanker was carrying LNG from Qatar, raising fears over fuel supply once again. Iran's Revolutionary Guards issued a statement saying, and I quote, "The Strait of Hormuz is not a playground. All vessels must use the route designated by Iran for safe passage." End of quote. However, the IRGC did not claim responsibility of the projectile attack. Officials from Tehran's negotiating team also hit out against US President Donald Trump's warning that Washington will either make a deal or finish the job. In a social media post, Iran's Foreign Minister Araghchi said negotiations on a final deal will not commence if threats continue from the US. In Iran, the funeral procession of former Iranian Supreme Leader Ayatollah Ali Khamenei passed through the city of Qom as part of the week-long event. The late Iranian leader will be buried on 9th of July. Millions of Iranians are taking part in the procession, which the regime is projecting as a show of strength. In the oil market, prices of Brent crude edged higher. According to shipping data from Kepler, 108 vessels crossed the Strait of Hormuz between 3rd and 5th of July, even as security and insurance risks remain elevated. Here is President Trump on negotiations with Iran.
And our great Navy, which did the greatest blockade anyone's ever seen, not one ship got through in 2 months. And we then freed up the blockade because we're close to maybe making a deal. I don't know. We'll make either. Look, we're going to win one way or the other. We're either going to make a deal or we're going to finish the job, okay? And it won't be tough to finish the job. I'd rather make a deal because I don't want to affect 91 million people. We can knock down their bridges in 1 hour. We can knock out their energy supply, all of those big plants that they built, big, beautiful, modern plants that had a lot of money. They don't have any money now.
All right, let's also talk about the other big global headline. NATO leaders are gathering in Turkey's capital for what is shaping up to be a challenging summit. European allies face mounting pressure from Washington, with President Trump demanding a rapid increase in defense spending. On the sidelines of the summit, NATO members are expected to unveil tens of billions of dollars in new arms contracts at a major defense industry forum in a bid to demonstrate they are following through on their spending commitments. But will these pledges be enough to satisfy President Trump? My colleague Steve Sedgwick reports from Ankara on the accelerating global defense race.
I look at it like this. Back in The Hague last year, everyone agreed on a race, and we're going to have this race, and everyone's got to get to the end of this race by 2035, okay? And the race is to get to 3.5% defence spending, plus another 1.5% of infrastructure spending to get to 5%. It's a marathon, okay? We've agreed an ultra marathon to get us to 2035, where everyone's got to get to the end by that. Every single person's got to finish and get there. Well, now it's like the US has kind of ripped up the rules in the last year and said, you know what? We're not going to make it a marathon. We're going to make it a sprint. We're going to make it a 100 or a 200-metre race. So all these nations who have been preparing themselves like Kipchoge for a really long run have suddenly got to turn themselves into Usain Bolt and run to the line a lot quicker. That's the analogy I kind of want to use to get people to think about how the conditions have changed. The US is splitting NATO, isn't it, rather than bringing it together?
It is not. It is, I think, bringing NATO closer together, and having a review regularly, I think, is only wise. And the way it will be organized with the Supreme Allied Commander being center stage in the review, the fact that the Americans have declared very clearly that they will do this in close coordination with all allies, I think is absolutely important.
The amount we spend on these submarines and the cruise missiles to have that defence capability means there isn't money available for other areas as well. So it is a race, and it's a race that the Europeans have had to change their tactic on in the last few months.
All right, Prime Minister Narendra Modi hailed a golden era in India-Indonesia ties during his visit to Jakarta. The PM was conferred Indonesia's highest civilian honour, the Bintang Adipurna, by President Prabowo Subianto. The two leaders held delegation-level talks and reviewed bilateral relations. They also oversaw the signing of a series of agreements covering defense, space, technology and critical minerals. Indonesia agreed to procure India-made BrahMos and Astra missiles, marking a major boost to defense cooperation. Abhimanyu Sharma joins us with the details of the MOUs signed.
Prime Minister Narendra Modi and Indonesian President Prabowo Subianto have announced MOUs across several areas as both the nations are looking to deepen cooperation in agriculture, technology, maritime security and several other domains. India is going to open an IIM campus in Indonesia. India is also looking to supply BrahMos and Astra missiles to Indonesia. Both the sides are also looking to deepen cooperation in maritime security by virtue of higher collaboration between coast guards of the respective countries. Also, Indonesia has conferred its highest honor of Bintang Adipurn in terms of a medal on PM Modi. Both the sides are also looking to work on cross-border QR payment linkages, and they are going to jointly develop the Sabang port near the Strait of Malacca, which is 100 miles away from India's Great Nicobar project. Now, maritime cooperation is something which is important in view of the fact that the world has been facing constraints in the Strait of Hormuz, and Malaysia and Indonesia are located on both the ends of the Strait of Malacca. Now that strait witnesses the transit of 40% of global trade, and a few days back India and Malaysia had reviewed bilateral military cooperation while reaffirming the freedom of navigation in the Indo-Pacific region. It remains to be seen what further announcements are going to be made as part of PM Modi's official visit, even as maritime security, maritime cooperation and a free Indo-Pacific continues to be the cornerstone of the talks which are taking place between India and Indonesia, and several other issues are likely to be discussed in course of PM Modi's visit.
All right, thank you, Abhimanyu, for that. CNBC TV 18 news break confirmed the government has launched an offer for sale in Cochin Shipyard. The divestment drive has been in full swing this year. In fact, stake sale in PSUs has hit the highest level in 11 years, with more than 25,000 crore rupees in proceeds so far in 2026. Sudarshan Kumar joins us with more details on Cochin Shipyard and the divestment drive.
So non-retail portion of the OFS of Cochin Shipyard is fully subscribed as we speak. Remember, yesterday government had launched OFS in Cochin Shipyard to sell up to 5.04% stake, of which base size 2.52%. If government goes ahead and exercises green shoe option, that portion also is of 2.52%. And if government manages to sell entire 5.04%, it will end up raising almost rupees 1,900 crore. For non-retail portion, OFS is underway. For retail portion, OFS will open tomorrow. Floor price government is set at rupees 1,400 per share, and that was at a discount of almost 7% to yesterday's closing price. Now, remember, government currently holds almost 68% stake in Cochin Shipyard. Now, going beyond Cochin Shipyard, just in 2026 so far, government has raised, if you exclude Cochin Shipyard, government has raised more than 25,000 crore via OFS in 7 PSU companies like Coal India, NHPC, GIC and others. Now we'll have to see if government remains aggressive and launches OFS in more companies. But so far, there are 8 companies that government has launched OFS. And if you include Cochin Shipyard, they have managed to raise more than 27,000 crore.
All right, thank you, Sudarshan, for that. Meanwhile, shares of Tata Group fashion retailer Trent declined over 12% in trade after the firm's first quarter sales growth missed estimates. Trent reported a standalone revenue of over 5,600 crore rupees for the June quarter, marking a 19% increase annually. But this was below analyst expectations. Brokerages have also flagged concerns over rising competition and the impact of store expansion. Trent operates brands including Westside and Zudio with over 1,300 stores across India. And shifting focus now, Titan reported strong business update for the first quarter, with its domestic business growing 37% annually. Company's jewelry segment continued to be its biggest growth driver. Watches and eye care businesses also posted healthy growth of 23% each. Titan further expanded its retail footprint, adding 76 stores in India and 1 international store, taking its total store count to 3,680. Now, India's consumption engines are revving up in the first quarter. FMCG giants report healthy revenue growth powered by steady volume gains and price hikes despite higher input costs. Jewelry brands are also reporting revenue growth in the range of 30 to 60%. Mangalam Balu is here with the consumption report card. Mangalam.
Well, if there's one thing that stands out in the first quarter updates so far, it is loud and clear. There is consumption recovery. In fact, if you look at all the companies that have reported their first quarter update so far, there are three things that really stand out. Sentiment has been upbeat across the board. There has been price growth, which has led revenue along with volumes as well. And finally, there is some margin pressure, but that too is transitory. So to understand this further, we've divided that into staples, discretionary, jewelry, and retail as well. So if you look at the staples, Marico, Godrej Consumer, Dabur, low 20s to high teens, and in some cases double-digit revenue growth, which is the highest that we've seen in the last many quarters. Volumes, double-digit for Marico, high single-digit for Godrej Consumer, Dabur as well, mid to high single-digit that we've seen, the highest in the last many quarters. Yes, there are some margin pressures, and we've heard from the companies as well. Case in point, Marico, they've seen gross margin improvement recovery, quarter on quarter, and that's largely because their key raw material for Parachute, copra prices are down 45% from the peak. But barring that, for Dabur, they've actually taken calibrated price hikes, so which is why EBITDA margins would remain stable. Godrej Consumer has said that margins are impacted by higher input costs, but that's just transitory. They expect them to progressively increase as we move towards FY27, and EBITDA growth itself will be in double digit. Now, if you look at some of the larger retail players, there's been 15 to 19% revenue growth. Avenue Supermarts 15%, Trent about 19%, slightly shy of analyst expectations, but definitely higher than what we've seen in the past as well. And then you go down the curve, a lot of these value retailers have done extremely well. Anywhere between 23 to 29% for V-Mart and Bazaar side. V2 retail is up 58%. All of this led by 7 to 8% same-store sales growth, and store additions have been fairly strong for them as well. And add to all of this, if you look at the jewelry space, some stability, relative price stability in gold prices has led to a big surge. Senco on a low base doing 60%, Kalyan doing 38%, and Titan itself on that high base of Tanishq, Zoya, Maya, all of them seeing a 39% growth. And then finally, we move on to discretionary, where Jubilant FoodWorks has reported a consolidated revenue growth of 14%, standalone revenue growth of 9.2%. And if you look at the like-for-like growth, that too is 2.5%. Yes, on an absolute basis, seems a little soft, but if you look at it on a high base, it is actually mid-single-digit CAGR over the last 2 years. And obviously, if you compare it to the fourth quarter, there has been a noticeable uptick, and that's something that the street is fairly hopeful about going forward too. And then you have, Nykaa, consolidated gross merchandise value seen in about early 30s as far as the growth is concerned. Good performance from their beauty business. Obviously, late 20s is the growth that we've seen out there, and that's been a driver for the company. But this time around, what really stands out is discretionary consumption. Their tie-up with Nike has done well, and their fashion vertical has seen net sales value grow in mid-50s, which is actually at a multi-quarter high. So the message is fairly loud and clear across the board. The first quarter is marking a bit of a turn in consumption, and there is indeed consumption recovery.
Right. Thank you, Mangalam, for that. Ola Electric Mobility's shares came under pressure for the third straight day. This after two suppliers approached the National Company Law Tribunal seeking insolvency proceedings against Ola Electric's wholly owned subsidiary. Now, vendors Sterling and Anevolve Bando alleged unpaid dues of over 40 crore rupees. This is the second time Ola is facing an insolvency in more than a year. A similar petition was filed by one of its registration agencies in 2025. Now, shares of food delivery and quick commerce major Swiggy surged over 7% after the company announced that domestic ownership had crossed the 50% mark. In a stock exchange filing, Swiggy mentioned aggregate foreign investment stands at nearly 49% of its fully diluted paid-up equity share capital as of July 6th. Now, fitness chain Cult Fit has filed its draft papers with market regulator SEBI for an initial public offering. The proposed IPO comprises a fresh issue of up to 950 crore rupees and an offer for sale of nearly 18 crore shares. Investors including Temasek, Tata Digital, Axel and founder Mukesh Bansal are looking to sell stake. The Bengaluru-based company may also consider raising up to 190 crore rupees through a pre-IPO placement. The time for a short break. Coming up next, Samsung surpasses Nvidia as the world's most profitable company. More details on that when we return. Welcome back. A quick look at some more headlines. A massive landslide struck a tunnel construction site in Wayanad, trapping at least 7 workers beneath mud and debris. The collapse followed days of heavy rain in the region. Work at the site had been suspended because of the weather, but some workers were still present when the landslide hit. Rescue teams and Kerala police are continuing operations to reach those still trapped. Delhi High Court has ordered the unblocking of the Cockroach Janata Party's X account. This after the government told the court it has no objection to restoring the handle. The ruling comes after the account was blocked in May, with the government citing national security concerns during today's hearing. Centre said the block was meant to prevent confusion among students and parents during the NEET examination. The auto component manufacturing industry has weighed in on the E20 fuel debate. ACMA President Vikrampati Singhania told CNBC TV18 that there is no conclusive public data to suggest E20 fuel causes damage to vehicle components. He added that it's too early to conclude whether E20 requires a different set of auto components.
Like you rightly said, there's not enough data at this point of time to say whether this will damage or how much it will damage and what will happen. From an auto component perspective, as we see more data, as we work very closely with the OEs, and the OEs will be the first to bear this brunt in some ways. As and when there is these needs evolve and we start realizing that there is a need for different materials to go in, the industry will continue to be able to respond to that.
Right, let's talk about Samsung now. The company has surpassed Nvidia as the world's most profitable company. Its second quarter profit has crossed 89 trillion won or $58 billion thanks to soaring semiconductor sales. However, despite its preliminary earnings report, the stock declined amid concerns over spending and future demand. Rachna Dhanrajani is here with the details. Rachna.
Samsung Electronics has dropped its preliminary earnings guidance for the April to June quarter of 2026, and the figures are truly record-shattering because the company is guiding for consolidated sales of about 171 trillion Korean won. That's over 129% growth year-on-year, and an operating profit of 89.4 trillion won. That's a nearly 19-fold surge compared to the same period last year. But to put that in perspective, this single quarter's expected profit is higher than what Samsung made in its entire 2025 fiscal year in some estimates. And the star performer here is the Device Solutions division, particularly memory chips. Explosive demand for high bandwidth memory, HBM, and advanced DRAM, driven by the global AI infrastructure build-out, has supercharged these results. Now, this comes on the back of an already record first quarter, where Samsung posted 57 trillion won in operating profit. However, here's the twist. Despite these blockbuster numbers, Samsung shares fell sharply in trade today. Analysts are pointing to profit booking by investors who had built up big positions ahead of the results, along with some concerns over heavy capital expenditure plans and whether the AI boom might be peaking. Now, July 30 will be the day, and more than numbers, the management outlook would be the one to watch out for, because it would give a sense of this AI race, but more importantly, what happens to phones and other devices that need these chips and are seeing a price rise as a result of it. But for now, one thing is clear. Samsung is riding the AI wave, but is also feeling the weight of expectations from the street and its investors. So we'll have to see how it goes for Samsung.
All right, thank you so much, Rachna, for that. Moving on, Alibaba will ban Anthropic's Claude code for its employees from July 10th. The Chinese giant has listed Claude as a high-risk software, citing Anthropic's alleged use of a hidden code that could detect if a user was based in China or linked to a Chinese AI lab. The move comes after Anthropic accused Alibaba of training its AI on Claude's answers and carrying out what it says was the largest known distillation attack. Alibaba is reportedly telling staff to delete all Anthropic apps and switch to its own tool called Coder. All right, before we wrap, let's do a quick recap of the top headlines. Sensex and Nifty snap a 4-day winning streak to end with marginal losses. Mid-caps suffer sharper cuts. Rupee gains over 40 paisa against the dollar to move below the 95 mark. An LNG tanker catches fire after being struck by an unknown projectile off the coast of Oman. No casualties have been reported so far. Iran warned ships to only follow designated routes, but stopped short of taking responsibility for the attack. NATO leaders gather in Turkey for the annual meeting. President Trump expected to pressure allies to increase defense spending. Ukraine's President Zelensky is also in attendance. Indonesia agrees to buy India-made BrahMos and Astra missiles as both nations expand defense ties. India and Indonesia will jointly develop the Sabang port near the Strait of Malacca, deepening maritime cooperation. Government steps up the divestment drive with 5% stake sale in Cochin shipyard. Stake sale in PSUs has hit the highest level in 11 years with more than 25,000 crore rupees in proceeds so far in 2026. India's consumption engines rev up in the first quarter. India's FMCG giants see healthy revenue growth powered by steady volume gains and timely price hikes despite higher input costs. Jewelry brands report a revenue hike in the range of 30 to 60% for the first quarter. Samsung surpasses Nvidia as the world's most profitable company. Second quarter profit crosses $58 billion thanks to soaring semiconductor sales, but stock declines amid concerns over spending and future demand. 2 people are dead and 7 others are missing after a landslide in Kerala's Wayanad. The incident occurred due to torrential rains near a tunnel project site. And Belgium knocked the US out of the Football World Cup following controversy over a withdrawn red card for a US player at the insistence of President Trump. Spain also beat Cristiano Ronaldo's Portugal to enter the quarterfinals. And with that, it's a wrap on this edition of Business 360. News and updates continue right here on CNBC TV.
Hello and welcome to Commodity Champions. I'm Manisha Gupta, and the past month has been a reminder of just how quickly sentiment can shift across commodity markets. As geopolitical tensions in West Asia ease, the Brent crude prices have cooled down by nearly 24% over the last 1 month, while the metals are down anywhere between 3 to 12%. Despite the recent volatility, Citi remains constructive on several key commodities over the medium term. It expects Brent crude prices to average $70 next year, while forecasting gold to climb back to $5,000 an ounce in 2027. So has the recent correction created fresh opportunities, or are commodity markets entering a new phase? Joining us today is Citi's Global Head of Commodities at Max Layton to help us understand making sense of all of those commodities across board. Max, hi, thank you so much for joining in. It really has been a difficult time. The West Asia conflict, market impact, the high crude oil prices leading to inflation, and the interest rate cycle turning in some sense. How have you grasped the macro to begin with?
Well, the macro has been very difficult. It's been very political, I would say. The disruption to the Strait of Hormuz has been front and center in driving the commodity markets over the last couple of months. And the political deal that happened, the memorandum of understanding, it was a really important moment, obviously. But I've got to say, we just at that point, before that, we just didn't know what the Iranian regime, what they wanted, whether they were willing to deal. And so them, the Supreme National Security Council of Iran, the 12 or 13 members running the country, them signing this MOU, them being, I would say, heavily involved in drafting the MOU, that carried a lot of weight, and it sent a major bearish signal to the energy markets over the last 3 or 4 weeks in particular.
It clearly has, Max, the kind of short positions that we've seen being created in crude. How have you seen prices come off from 120 off a high to 70, 72 right now? And what's your sense on how the prices will move from here on?
Yeah, it's an amazing move. I mean, so we're down $50 from the highs a couple of months ago. I mean, the most of the move happened before the MOU. So the MOU kicked in at around $82. And that's when we shifted bearish, because obviously the MOU meant a lot. At that point, we were still thinking that Iran might drag this out a little bit, that President Trump might even be trying to negotiate around the edges of this MOU, and it'd take a bit longer. But in any case, there's been a dramatic shift in the balances as the Strait of Hormuz have opened up, in combination with China reducing its imports. So we're seeing flows through the Strait of Hormuz go from practically nothing a couple of months ago to 12 to 13 million barrels of crude. Add on the fact that China's reduced its imports of 4 million barrels a day, and a little bit of demand destruction, a little bit of supply surprise to the upside outside of the Middle East on the crude side. And you've got crude balances being really heavy right now. You've also got the SPR selling into the market on the US side still this month. So the crude balance has shifted from a massive deficit to quite a substantial surplus. You've got to contrast that with the products market. In the products market, you've got a roughly equivalent deficit. So the aggregate crude and product markets is roughly balanced, maybe a small deficit, but there's a really big divergence between what's going on in crude and what's going on in products. In terms of the outlook, you asked me about the outlook. I mean, it all depends on whether this MOU turns into a deal. It could be a rolling MOU that turns into a deal. Our base case is that it's going to result in a deal. The logic behind that base case is that the regime appears, and this is our assumption, but it appears that they have figured out what they want. They put it in the MOU. It's not just an MOU, it frames a future deal. And President Trump signed it. He is marketing the deal. $300 billion is nothing compared to $2 trillion of infrastructure losses. Trying to kind of make the situation in Lebanon not derail the deal, and actively marketing the deal. So President Trump, we think he probably wanted to do some kind of a deal over the last couple of months, not just recently leading into this. Sure. And on the Iranian side, it's not just about them kind of figuring out what they want, getting it in the MOU, having President Trump signed it. They could have dragged this out for months, if not actually years, but they didn't. So there's some information potentially in that they were willing to accept the deal that they were obviously heavily involved with drafting, to put it mildly. So I think the base case is that both sides want to make this happen. There's a lot of things that can be question marks, a lot of issues that can come up. So I don't want to make out like it's some high conviction view, but it does look like both sides are going to work this out, and that we're going to end up with a deal. And in that scenario, you go from a 2 million barrel oil surplus before this conflict globally. It's a 100 million barrel a day market, normally grows about 1 million barrels a day in demand and supply. So a 2 million barrel surplus was already really big coming into this. You had people before the war talking about 60, 50, even $40 Brent, right? So 2 million is quite big. Post-war, in a deal scenario, on paper, you're looking at a 3 to 4 million barrel a day surplus in this market. You've got extra spare capacity, whether it's Iran or UAE or some of the other Middle Eastern countries that can ramp up significantly in the short run to help the world rebuild its buffer stocks. So I think, you're talking about quite a big surplus hitting the market over the next, let's call it 3 to 6 months.
Okay.
And it's very important to say as well that, we kind of shifted our view on energy quite a bit in around mid-May when we figured out that there was actually a lot of oil around, a lot of inventory. We've been building inventory actually for 30 years, since the 30, 40 years since the second oil shock. So we figured out that to get down to 1970s oil inventory levels, to get down to that kind of late 70s oil shock, you would have to have that strait closed for 9 to 12 months. And when we kind of realized that, it gave a lot of room for there to be time to make a deal happen. So I would say the desperation, the urgency from the inventory standpoint is not really there.
Okay.
And that helps to frame why we're suggesting that people sell any rallies. So there will be volatility in this thing most likely. And it's probably going to be a little bit like 2025, where you get 2024, 2025, when you get $5, $10 spikes and then $10 to $15 moves lower over the following 2 months. This kind of really difficult to trade, grinding lower environment, that's what we're looking at in the next 6 to 12 months. We actually, at the turn of the year, have published that we see Brent down at 60 to 65 based on that big surplus and that deal in that base case scenario.
Point taken. I want to shift gears to gold now. And even in the thick of the West Asia conflict, we did not see a safe haven buying come in for gold. The money basically was going rather in US dollar index or then crude itself for that matter. With the kind of correction that we've seen now in gold, it's finding it difficult to move up from here. Are you looking at that ETF, retail, central bank buying coming back in case of gold? What is your best case scenario now from these current levels?
Yeah, I'm really excited you asked me about gold because, I just think this market's super fascinating. It's had one of the biggest bull markets in its history over the last 18 to 24 months. Came from 2,500 when President Trump was inaugurated, all the way up to $5,500 in February of this year. It was a colossal move in the gold market. That move resulted in colossal wealth creation. Especially in India and in many countries that have been accumulating gold for hundreds, if not thousands of years, they saw massive increases in their on-paper wealth, whether it was central banks or countries that have been stockpiling jewelry. This gold mine supply, the wealth that was created was in the vicinity of 15 to $20 trillion. In any case, some of that's been given back over the last few months. I would characterize what's happened as there's been for maybe the first time since 1979. I wasn't around then in 1979, so I couldn't say for sure whether it happened back then. But what's certainly happened in the last 18 months is that there was a retail and institutional investor frenzy for gold, for physical gold. This frenzy was the primary driver. So people talk about central bank, but the spend on physical gold went from $400 billion per year at $2,500 start of 2025, went to $1.1 trillion by February of this year. So of that $700 billion increase, only like 50 was central bank, 650 was investors. So what's happening in the last 3 months is you've had an unwind, or at least a partial unwind of that frenzy. The momentum, I would say, is broken. This is why gold is trading heavy, is because the momentum in the physical market for bars, coins, and jewelry is extremely weak. It's extremely weak compared to where it was in February. It's still quite high by historical standards.
Sure.
So at the moment, so we were spending 1.1 trillion. Roughly now on the physical gold, we're spending about 900 billion. That compares to normal of 200 to 400 billion. So I would say that, we're quite cautious here in the next month or two. I think gold's trading really heavy. You get small increases in real rates, small increases in the dollar, and the price is down dramatically. So I feel like the risk skew in the very near term is, just be very cautious, I would say. But coming, when we get into September, October, November, December, I think it's going to have a strong end to the year. I just think there's a real risk we could trade down to 3,500 in the next 4 to 8 weeks. This thing needs a lot of physical buying, 800 billion just to keep it flat. Normally, there's only 200 to 400 billion. So I feel like we've been very concerned about it now for about 6 months since it got above 5,000. We've been the kind of bears in the street. And we didn't predict the war, so I didn't predict what would catalyze it to turn around, whether it was the war which raised real interest rates or it was Fed Chair Warsh. Warsh was appointed mid-February, and since then, it's correlated with the $1,500 move down in gold. So it's a combination of Warsh raising real rates and the war. Neither of those things are changing probably in the next month or two, and the physical market's super weak. I actually think demand is way below 800 billion. So there's that pressure on the price from that. In any case, I think you want to buy the dip over the next 2 months.
Okay.
So coming out the end of this summer, I think you want to be buying gold into the fourth quarter, but just not yet. Just wait a little bit.
All right. I am taking that advice on, Max. But what about silver? Because we've seen even larger volatile moves coming in for this one. $120 an ounce and then 60, 56 of a low is also what we saw. And that's exactly the kind of profit taking that we've seen in various base metal prices also, barring aluminum, but copper has gone through a similar thing. But silver absolutely topping the charts with all that volatile move.
Yeah, silver is, this is a commodity that we produce for at most $15, $20. And a bull market for silver historically is $20 to $30. So very strong producer margins at their levels. And we're up in the 50s, and we've just seen 120. When you ask why that is and what the outlook is, it's because of the investor move into gold and silver. And look, there's a lot of underlying drivers to that. There's a big long list of them that I probably, we don't have time to go through on this segment, but long-term and short-term risk. But at the end of the day, the bulk of it was an investor-led bull market in gold, which attracted the investors into silver. And so all that's happening is people are willing to pay a certain ratio to gold. So I would say the outlook for silver is tethered to gold. That is normally true, but it's even more so true today because this is a very investor-led, investor-dominated market. The physical market for silver, I think, outside of maybe solar, and that's a stretch, is extremely weak. So for me, this is a commodity that's has a lot of downside risk in the next month or two, and you want to be buying it towards the end of the summer, just like gold, for a rally into year end on lower real interest rates, on the deal resulting in deflationary pressure, and hopefully a bit of deflationary pressure from AI towards the end of the year.
Max, what kind of lower levels are you looking at in case of silver? For gold, you said 3,500 to watch out for. For silver, are we looking at 50, sub 50 before we start buying?
Whatever today's ratio is at 3,500, that's the level you should be worried about silver reaching. But, I wouldn't. The thing is, it's very sensitive to Fed Chair Warsh and how he talks over the next couple of months and on the outlook for real rates. So I guess I wouldn't say I'm high conviction that gold and silver are going to go down in the next month or two. I'm just very concerned that it could happen. And therefore it makes the risk reward of being bullish on a 6-month view.
Okay.
It doesn't make it a worthwhile trade.
I get that.
Towards the end of the summer, whether the price is flat or down 15%, whatever, I think it's that's when the risk reward starts to look a lot better.
But Max, would you say that even as the investment demand in silver is not so much around, the industrial demand, is that as elastic?
Whatever demand is left after it moved from 50 to 120 in the last 3 or 4 months is pretty inelastic.
Okay.
This is a phenomenal silver price. But I would say that what this move has done has incentivized incremental, there was already a huge push to substitute away from silver to things like copper in the solar industry in China, or to just substitute away from metals altogether. That's just going to accelerate that push.
That point is well taken. Max Layton, as always, thank you so much for joining in and taking us through all of those commodities, analysis, fundamentals, and of course the outlook as well. Very, very helpful for our Indian audience there. But with that, it's time for a short break. But don't go anywhere. We will get you an exclusive conversation with the CEO of Dubai Multi Commodities Center on the other side of this break. Welcome back to Commodity Champions. And Dubai sits at the heart of global trade, making it one of the best places to gauge how political or geopolitical tensions and shifting trade flows are reshaping commodity markets. Joining us now is Ahmed bin Sulayem, who's Executive Chairman and CEO at Dubai Multi Commodities Center. He also chairs the Dubai Diamond Exchange, the Dubai Gold and Commodities Exchange. Ahmed, hi, thank you so much for joining us. I was reading an interview given by you where you said that the global trade is run by deals and not rules. What did you mean by that statement? And we clearly have seen Dubai and DMCC grow stronger with the kind of launches and newer initiatives that you have been taking.
The trade will find its way. Think of it as a river. There may be rocks on the way, they'll go a different direction. One of the reasons that Dubai has been a proper hub for the international community is sometimes a reflection of other countries that don't provide the full facilities. We've become, in some ways, India's Hong Kong, if you will. It's a hub for everyone. A lot of the successes for DMCC, especially in the early days, was due to the Indian diamanteers, the Indian trade, the Gem and Promotion Export Council, the Bharat Diamond Bourse, and now the Surat Diamond Bourse. The entrepreneurship is so strong in India, but they're big that they expand abroad, and Dubai has become their connection to the GCC market, to the Far Asian market, and the West. It's the same for China. It's the same also now we see with Vietnam and other places, also Korea. Today, the Dubai Multi-Commodities Center, I believe, is the leading free zone representing businesses from China with over 1,000 companies. I hate to say this, I don't know the number of Indian-related businesses, but I have to say something. Some of them come with Belgian passports, some of them come with Swiss passports, some of the Indian community comes with American passports. The Indian community is a bit different. A lot of the big tech hubs in the world, tech companies in the world, are led by some of the, how do I say this? Some of the most impressive executives whose origins are from India. You have Google, you have MasterCard and all that. And that has played also a big role as far as our tech hub goes.
Ahmad, let's also talk about the recent regional conflict. How has that impacted commodity trading volumes in Dubai? Have you been able to make use of that, benefit out of that in some sense in what all you have launched therein?
Personally, I'd love for this conflict to end yesterday, but in some ways, it did open doors for the MCC. In some ways, we've seen more trade. We've seen more volumes on DGCX, which is a natural reaction from the market, going more into gold, trading on gold. And that inspired us also to launch the first gold spot contracts on DGCX. And that's a product that's going to stick with us for a while. There is a gap in the market. There is a gap in the time zone. Now, when it comes to maybe the first few weeks of the war, we didn't see a lot of dip. We have DMCC Phoenix, our own financial center, which is closing into 2,000 companies today, representing 16 banks, insurance, reinsurance. We're also rolling out foundations. The demand to set up financial related businesses and within Phoenix and DMCC didn't stop. When it comes to diamonds, we were hosting rough diamond tenders. Transatlantic continued. They had two tenders coming in March and then in April. I remember visiting them at Al Mas Tower. And the gentleman, before his tender started, he said, maybe you should bring your guest in April. He wasn't sure how March would go. Nobody knew what would happen. But coincidentally, I had a VIP guest at Uptown, took him to see the diamonds at least. And you know what I witnessed were buyers from multiple regions, but mostly from Surat, sitting outside the offices of Transatlantic because inside they were full, they were busy. So the March tender looked very promising and April was good. I believe if the flights are there, the trade is there. And that's, if you recall, when Surat had their first ever flight to the United Arab Emirates, it was a big deal for that region, for that market. But also, we saw the numbers increase at the Dubai Diamond Exchange, and it didn't stop then. So rough diamond trade is still happening. Another matter that we noticed is that Dubai is becoming also polished diamond trade. I believe Paul Rapps tells me about his partner, Paul Rapps from New York. They used to come to Dubai to make one polished diamond transaction a year. A few years ago, he tells me what changed is that they have this every month. And Paul Rapps doesn't do 3 or 4 carats. He talks 30 to 80 carat diamonds, some big transactions. So it's a convenient place. Whether some of the countries around the world admit it or not, I see them do the trades here. We have representations from the European market, whether it's the UK, Belgium, Switzerland. They all have either offices here or businesses that represent their interest in Dubai and DMCC.
Ahmed, I was also reading the DMCC Future of Trade 2026 report. I glanced over it, and some experts, nearly 60% and more, believe that the global trade will slow from here. How are you looking at that, and how are you strategizing on the structural changes that perhaps would be needed?
It depends what lens you're looking at it from. So, the expectation, for example, when the conflict started, is that tourism will take a bit longer to pick up. But if you come to Dubai's airport, it's pretty busy. It looks like things are picking up faster than expected. The shipments coming through the strait, that's been impacted, but the United Arab Emirates is a resilient country and it's utilizing Fujairah for the other shipments. Now, I intentionally announced DMCC Maritime Center. If you look at the time frame, it was around the time where some in the West, I don't want to use the word bashing, but we're making headlines about how the maritime sector is dead. And I announced the DMCC Maritime Center with over 160 members. Now, mind you, some of these companies are part of our oil and gas and renewable energy sector that represents 3,700 companies. But this is a growing business. And some of these shipping and businesses don't have the Strait of Hormuz in their business plan. They do shipments all over. They don't go through Strait of Hormuz. So, and to access the UAE, it's Fujairah, and that's a good port, and I expect it to grow. I expect it to grow. Now, it's anyone's guess how the future will be, but I do anticipate that the region will calm down and things will get better than it was even before the war. That's my take on it. Now, the comment from the Future of Trade report is likely also talking about the AI boom, which could be also a bust, with some analysts saying that. But the fact is, the prices of these microchips have gone up. It has impacted the sales of computers. It has impacted or delayed projects like PlayStation, Xbox, and handheld. That's a big sector, whether people know that or not. We have a DMCC gaming center. A lot of our gaming developers have worked at EA projects like Battlefield and stuff like that, and you'll see that growing. I think it's across the board. It's not just the geopolitics. Obviously, the conflict in Ukraine is not helpful. Sudan has an impact. Sudan supplies 90% of gum that's attached to so much of the food industry. So if that's disrupted, it's an impact. It's an impact. I mean, Pepsi Cola probably has a stockpile for the next 10 years, but sooner than later, it will catch up. So unless there's a replacement for what Sudan contributes to the global economy, it will cause some issues. Now, how does China react to it? How does India react to it? You know, we've heard a lot about sanctioning diamonds, sanctioning gold trade. We've heard a lot about the oil side. You will never hear any person talking about sanctioning potash or nitrate, or I think potash mainly, or talking about fertilizers, because they're not going to hurt their agri sector, even if they know that they depend on the likes of Uralkali and Eurochem. So there's a lot more to that statement than just the Strait of Hormuz. The Strait of Hormuz is one issue. It did impact Japan. It did impact the AI sector, Taiwan and all that, because the energy prices go up. And that had a knock-on effect, again, on the tech industry, the handhelds and all that. Now, how much does the world need the AI? I think the demand is increasing because it is that convenient. If it wasn't working, you wouldn't see the big five consultants firing so many employees. Microsoft, Xbox, Oracle, they're all on a tear of restructuring. But that's the reality. You know, I don't believe they're using one AI tool. I personally use 6 AI upgraded tools from China, US, Sweden, just to avoid the censorship that they may apply, just to get a better result. So I anticipate the others are doing something similar.
I am so sure of that. But Ahmed, thank you so much, as always, for joining us with all of those insights. And with that, it's all the time that we have on this edition of Commodity Champions. But stay tuned for more news and updates on the other side.
Hello and welcome. You're watching News Center. I am Ashmit Kumar. Now, crude oil prices edged higher after an unknown projectile hit a tanker near the coast of Oman in a suspected Iranian attack. Now, this comes just days after traffic at the Strait of Hormuz started to pick up pace. No casualties have been reported so far. The tanker was carrying LNG from Qatar. Now, raising fears over fuel supply once again. According to a shipping data coming in from Kepler, 108 vessels crossed the strait between the 3rd and the 5th of July, even as security and insurance risks remain elevated. Iran's Revolutionary Guard issued a statement saying, and I quote, "The Strait of Hormuz is not a playground. All vessels must use the route designated by Iran for safe passage," end of quote. However, the IRGC did not claim responsibility for the projectile attack. Earlier, President Donald Trump warned that the two countries would either make a deal or the US would finish the job. All of this as Iran continues to mourn the death of Supreme Leader Ayatollah Ali Khamenei. Meanwhile, in a sign of just how much this standoff is rattling markets, Saudi Arabia has cut the price of its main crude grade for customers in Asia in August by the most in at least 26 years. A Reuters report suggests that UAE's Abu Dhabi National Oil Company has also been selling crude through tenders at a discounted price. Well, joining us now to help us decode some of these developments coming out of West Asia and what that means in terms of energy prices, energy stability going forward. Joining us now is Kepler Senior Crude Oil Analyst, Ms. Muyu Shu. Also with us, Anju Gupta, a geopolitical expert and author, and of course, Mr. Narendra Taneja, energy expert. To all of our guests, thank you so much for joining us. Ms. Shu, let me come to you. Some of these developments that we've seen, a projectile attack aimed particularly at a tanker that had taken the Omani route, not the Iranian route. Any impact that it has had in terms of movement of tankers, movement of energy, of oil through the Strait of Hormuz in the last 24 hours?
I think it's still a little bit too early to say because we're still waiting for the latest data to come back to us. But I would expect that some ship owners might got deterred. But I do have to say here that previously, after these MOU signed, this is not the first incident. In fact, we already also saw the previously a container got attacked and also another vessels, and among the ship owners, some indeed they halted for a day or two, but then the transit volumes picked up again. So we will have to see what happened in the next few days. But overall, the oil continued to flow, although the daily number fluctuate, and that's part of the reason why the oil prices haven't gone back, let's say, to 90s.
Right. Mr. Taneja, let me come to you again, just taking a cue from what Ms. Shu was pointing out, that there have been similar attacks in the past as well, which didn't quite disrupt the flow of oil. Can you give us a sense? The oil markets, I mean, it's edged a little higher, but it's not quite as volatile as one would expect after such an attack. To what would you attribute the stability in the oil markets as of today?
Yeah, because the markets, I think, is taking the view that, such incidents are minor in most cases are going to happen because IRGC has got its own agenda. And at the same time, the oil markets have realized that as far as the Strait of Hormuz is concerned, for quite few, maybe about 6 months, maybe 1 year, these kind of happenings are unavoidable. In the majority of tankers, whether LNG or crude tankers, they actually are passing through what is known as the Omanese channel, hugging very close to the Omanese coast, avoiding the Iranian coast to the extent possible. And of course, Iranians are not liking it because they feel, majority of tankers, they feel that the Omanese side or Omanese channel is safer. However, IRGC at the same time, I mean, look at Iran. Iran is not like the United States or Republic of India in the sense where everything is so centralized and there is very strong command and control center. There is However, at the same time, there are pockets of IRGC, especially working in the Persian Gulf area. They work quite independently sometime, or sometimes they get the orders late, or sometimes they really ignore the orders from Tehran. So I think we should basically be factoring all those things as well. However, as far as the markets are concerned, markets response has been rather, mature, and I think the markets are prepared, whether LNG markets or LPG markets or crude oil market, they're prepared that these kind of things are going to happen. And part of the response in terms of the oil price also been with the statement by American President Donald Trump. So that's also has been one of the reasons that oil prices, didn't like the kind of noise that has been created over this area. But markets are mature. I think they're factoring in all these things.
Mr. Taneja, again, just continuing with that same point, you mentioned Donald Trump as well. He's posted as well on Truth Social that if the MOU does not come through, if all the parties don't comply, then he'll finish the job. But given as how that he's just landed in Ankara for the NATO summit, he's, of course, looking to apply pressure as far as Russia, as far as Putin is concerned. Do you think he'll take the chance to rock the apple cart, so to speak, at this stage, especially when it comes to West Asia with respect to Iran?
You see, the President Trump cares only about the United States. He doesn't really care beyond a point about the Middle East or even NATO for that matter. Yes, he's attending NATO, but his heart is somewhere else. In the sense, he's there only, he thinks he needs to protect only the interests, geopolitical interests, strategic interests, economic interests of the United States. You're seeing that even at FIFA, the World Cup. Now, that said, my sense is that, President Trump is almost desperate to exit the Persian Gulf. He wants to exit the situation. And Iran knows it very well. While Iranians are very good negotiators and tough negotiators, while from the American side, negotiators are not so smart. They're not professional negotiators. They're mainly people who are very close to him, and they may not necessarily be very good at negotiating with a mature country like Iran. And Iran knows it. They're taking the full advantage of it. They're in no hurry to exit. They're in no hurry to sign a kind of final deal. So they are going to do what they want. In the eyes of Iranian people and many people in other parts of the world, Iran is the winner, is emerging as the winner. What they want is to extract the maximum possible, knowing very well that President Trump is desperate. He wants to exit the war. So Iranians are playing their game, and they've got time on their side. If need, they may wait even for 1 year, 1.5 years, but they're not going to sign the final deal unless they think it's absolutely in their interest. That help them mainstream their oil and gas industry in particular.
Mm-hmm. Well, of course, speaking of Iran coming out on top, one of the key demands that has been there from Tehran has been to levy some kind of, if not a toll, then some kind of administrative fee as far as passage of ships through Strait of Hormuz is concerned. Ms. Shud, let me come to you. Again, the IRGC not claiming responsibility for this latest attack, but nonetheless reiterating that there is only a safe lane that they've prescribed, which is, of course, neighboring, which is bordering the Iranian coast, and that ships should actively avoid the Omani coast. Is that Iran laying the groundwork for some kind of levy, if not a toll, some kind of administrative fee after the 60-day period of the MOU expires?
I think that's definitely something Iran is pursuing, but whether or not they can achieve it is still a question, because they will continue to face strong pushback from the GCC countries and also from their own allies like China and India, because that's essentially adding the feedstock cost for the buyers, and also from the oil producers' perspective, is also undermining their competitiveness of their own barrels. So it will be a difficult negotiations were asked, but nonetheless, Iran is using this tactic to remind the world that the Hormuz is still under their control, and they will continue to use this as a leverage in the upcoming negotiations.
Right. Also joining us now is Ms. Anju Gupta, geopolitical expert and author. Ms. Gupta, thank you so much for joining us. First questions. This latest report of attack that we've seen, the markets don't seem very rattled by it. What is your reading of the situation? Is this more posturing by Tehran, or does this set the ground for some kind of escalation going forward?
Good evening, Ashmit. Thank you for having me on the show. Good evening to my co-panelist. I think it's an ongoing competition between the Iranian route and every other alternate route. That's how I see it. And that is why you have not seen much of an impact on the flow. If I could give you some figures between July 3rd and July the 5th, 108 verified vehicles passed through the Strait of Hormuz both ways, and 44 used Iranian route, 30 Omani, 10 IMO, and interestingly, 24 have been designated or labeled as dark, which means maybe their transponders were off and it's not known as to which route they took. That means the contestation between the Iranian route and the Omani route through the Strait of Hormuz is very much live. And I think every time we see such an incident, it should be seen in that perspective. This is how I will read it, and I believe that the traffic that we have seen for some few days is still continuing. It is resilient.
Sure. Ms. Gupta, again, another follow-up question that, of course, this is the interim situation that we're looking at as far as the MOU is concerned. Both sides have allowed themselves 60 days to work out some kind of final agreement. Do you see that final agreement being reached, or do you see the 60-day period being extended? And if it is extended, will that cause more volatility, more uncertainty, especially when it comes to energy passage through the Strait of Hormuz?
Well, at the rate it's going, it doesn't appear that in 60 days there would be a deal. My sense is that this rate, I think it's going to extend, and maybe they'll initially extend it by 30 days, but I don't see it happening within 60 days. Doesn't look likely.
Doesn't look likely at this stage. Ms. Gupta, do stay on with us. But Mr. Taneja, let me also get your perspective on another important development that we saw, which was, of course, Saudi Arabia slashing their prices for especially Asian customers. What do you make of that in terms of where we're headed with respect to energy pricing? Have we seen the worst of things? Are we now looking at a time of perhaps energy price wars between the West Asian oil suppliers? Do you see that benefiting India? What do you anticipate in the days, weeks, months to come?
Well, that's an interesting question. I think, Saudi Arabia has done what they've done in terms of this policy initiative is to convey to Asian markets, big Asian buyers like India, Japan, South Korea, and China that, look, they understand what happened or what you have gone through the last 4 months. And however, we are now, want to kind of refresh our relationships and re-strengthen our bridges. Don't forget that China has emerged as the kind of the swing importer, very important player. At the same time, when it comes to the demand, incremental growth, that's driven by India now. So both India and the China are very important. So I think it's the messaging. Number two, don't forget this, their stores, so the storage capacity, tanks are overflowing. They need basically market, they need to kind of, refill them with the production, full-blown production which they've started. And it's a temporary measure. I don't think we should be reading too much into it. It's not any discount which is, let's say, is going to sustain for a very long period of time. Let's not forget one thing. Saudi Aramco is probably the most smart and sophisticated national oil company in the world. They know what has happened. So they're basically preparing for their further strengthening the Look East policy. Look East policy is basically cultivating even deeper ties with countries like India and China in particular, and also Japan. So they are going to do it, and just wait for some time. They are going to land in Delhi very soon, or Bombay. They'll say, all right, we want to even invest more in your country, maybe in downstream, maybe in midstream, who knows, even in upstream. So I think it's just basically post-war situation where you will find Saudi Aramco in particular trying to get even closer and building deeper ties with countries like India, China, Korea, and Japan.
Sure. Ms. Shu, just want to get your perspective. The price cuts that we've seen by Saudi, the steepest in 26 years. But even after those price cuts, it still remains more expensive than Abu Dhabi crude, than Iranian crude, than as far as Kuwaiti crude. Does that then perhaps make for a situation where we might see a price war? Are you working with any estimates as to what this could lead towards, say, by the end of this year, end of 2026?
I think a price war is a very strong word, but we are standing at very dedicated timing because we're talking about August loading cargoes. Again, you just mentioned about the 60-day truce. It will end around mid-August. Nobody really knows what would happen after that, although the market consensus is that this truce will get extended. But however, I think from the oil producers' perspective, they need to prepare to a situation where what if like their cargoes are unable to send out. So for now, maybe their priority is to get as much as oil as possible to the international market, and one way is to cut prices, make it more competitive. But again, with that $11 per barrel month-on-month cut, Saudi crude remains more expensive than the others, simply because right now there are too many oil in the market. So I do feel like there are price competition in the short term in this month, next month, but whether we will see a prolonged, a real price war is still too early to say.
Sure. Ms. Gupta, I just want to get a geopolitical perspective on that. India, of course, having burnt its fingers on account of this West Asia crisis, is looking to diversify its crude basket. Will cheaper oil now coming out of West Asia perhaps make it slightly more challenging for Indian crude buyers to look away from West Asia, to not look at some of these price cuts, these deals being offered by West Asia?
In my sense is there's so much has been lost through this war that everybody will try and make up for the losses. I heard a statement from somebody very senior in the GCC country who said that we will go back to the pre-war situation, maybe by end of first or second quarter of 2027, which means the suppliers are in a mission mode to get the supplies out, and I think so are the buyers. So my sense is that India would, given our dependence on oil and gas, I think India is going to really use the opportunity to buy from wherever it's getting the cheapest. Why not?
Wherever they're getting the cheapest deal, the best deal. But slightly looking away from West Asia, even as we speak, one quick question to you, Ms. Gupta. Indian Prime Minister Modi is on a three-nation tour, beginning with Indonesia. He'll then be heading towards Australia. Do you see any deals being cracked out of Australia, especially when it comes to gas supply, to LNG supply? That is an important subset of India trying to diversify its crude basket, its energy basket.
Absolutely, a very real possibility. And I think Prime Minister has said, I've seen the statement, that through this crisis, India, I think, turned to 40 different sources, not just one or two, 40. And all those 40 are not from the West Asia. So most certainly, I think that'll be on the table and it'll be as a priority.
Right, Ms. Gupta, I'd like to thank all of our panelists for joining us for your perspective on this developing story. Ms. Shu, Mr. Taneja, Ms. Gupta, thank you so much for joining us, giving us the benefit of your insight. But that's all the time that we have. We're slipping into a very short break, but don't go anywhere. Coming up, the Delhi government wants to phase out petrol and CNG 2- and 3-wheelers, but is the city ready for electrification of 2- and 3-wheelers? We get you a special report on the other side. Welcome back to News Center. Now, the auto component manufacturing industry has weighed in on the E20 fuel debate. ACMA President Vikrampati Singhania told CNBC TV18 that there is no conclusive public data to suggest that E20 fuel causes damage to vehicle components. He added that it is too early to conclude whether E20 requires a different set of auto components. Take a look.
Like you rightly said, there's not enough data at this point of time to say whether this will damage or how much it will damage and what will happen. From an auto component perspective, as we see more data, as we work very closely with the OEs, and the OEs will be the first to bear this brunt in some ways. As and when there is these needs evolve and we start realizing that there is a need for different materials to go in, the industry will continue to be able to respond to that.
Well, staying with the mobility space, Delhi has approved one of the country's most ambitious electric vehicle policies, targeting a phased end to registration of new petrol and CNG 2 and 3-wheelers. But CNBC TV18 Shivani Bajaj reports that the capital's charging network may yet derail this massive transition. Take a look.
Delhi has set the stage for one of India's most ambitious electric mobility transitions. Under the newly approved EV Policy 2.0, registrations of new petrol and CNG 2-wheelers and 3-wheelers will be phased out in favor of electric vehicles over the next few years. But while the policy lays out an aggressive roadmap, its biggest challenge may not be selling electric vehicles. It may be ensuring that Delhi has enough reliable charging infrastructure to support them. As Chief Minister Rekha Gupta announced her government's ambitious vision, the need for a robust charging network was not lost on her.
पॉलिसी जो है वो ईवी इंफ्रास्ट्रक्चर और चार्जिंग इंफ्रास्ट्रक्चर पे बहुत फोकस कर रही है, क्योंकि इस पॉलिसी को सक्सेसफुल बनाने की एक इम्पोर्टेंट रिक्वायरमेंट है. इसके लिए 32,000 ईवी चार्जिंग पॉइंट्स का टारगेट रखा गया है.
The government says these will expand on the existing 10,000 odd public charging points, but there is a problem. I'm standing right now in one of the prime areas of the national capital. I'm standing just in front of the Constitution Club, and there is an EV charger over here. Interestingly, only 2 of these chargers are actually working. This one is in a working condition. As you can see that there are lights on this. The second one has absolutely no screen, so this is clearly not working. This is also in a non-working condition. The screen is absolutely gone in this one. There is no switch, so clearly this charger cannot be used. And among the 6 charging points over here, only 3 are functional. A little over 3 kilometers away lies Khan Market, one of Delhi's busiest and most premium commercial hubs. Public chargers and battery swapping stations were installed in parking lots like these so that EV owners could conveniently charge their vehicles while they shopped. I'm currently standing in the parking lot of the busiest markets perhaps, and one of the posh markets of the national capital, which is the Khan Market. And in this parking lot, huge parking lot by the way, there is one charging station which is by NDMC. This charging station, however, in the middle of the day, right now it is 2:33 p.m, is not working. While the battery swapping station was operational, there was nobody present to assist users looking to swap a battery. So while the infrastructure may have been installed, keeping it functional appears to be a bigger challenge. This problem is not all pervasive. 7 kilometers away at Minto Road, these EV charging stations have been installed at a petrol pump. Unlike standalone charging stations, these locations have dedicated staff, and this makes it easier for EV operators to charge their vehicles. I'm standing right now in Minto Road. The Bharat Petroleum petrol pump has these 2-wheeler chargers, which are very rare to find, by the way. The 4-wheeler chargers are spread across the city. Definitely, I've seen them working, non-working, but they are existing. This kind of chargers are rare to see. Ola, Ather, and a lot of other OEMs have put these chargers either in the petrol pumps or in their flagship stores. So there are 2 of these, both of them are working. There is also a 60 kilowatt charger here in Minto Road, which is also in working condition. Similarly, this EV station inside the petrol pump at Pragati Vihar CGO complex was both operational and had staff who were willing to assist drivers. A hop, skip, jump away lies Lodhi Road, which houses this fast charging station. These chargers are known to remain operational through most hours of the day and even at night. making them a preferred choice for many EV owners.
If I take reference of Connaught Place, CP being the central, there some of the charging points are not working. They say default. Then like you will have to keep hopping to one, to second, to third, and then the fourth one that you find, then it's a luck if it is available. Otherwise, you'll have to wait in the queue or else find another one.
ESL chargers are never working. So somebody steals the cable. It is showing working, but the cable is not there. Somebody stole it overnight. So that is the biggest issue with third-party chargers. And even in static, sometimes it is a big problem to like get a parking spot.
We have been standing here for 15-20 minutes. It's still not, even though we've connected the charger, it's not working.
So where the infrastructure works, EV owners are left purring in contentment. But when it doesn't, people say owning an EV can be a nightmare in Delhi. One thing everyone agrees on is that a lot has to be done across the city to make the switch to EVs worthwhile. Because the success of this policy won't just be measured by how many electric vehicles are sold, but whether every commuter can find a reliable charger when they need one. In New Delhi, this is Shivani Bajaj.
Well, that was a ground report on the state of readiness with respect to electrification in the national capital. But with that, it's a wrap on this edition of News Centre. More news and updates will continue right here.
Well, if there's one thing that stands out in the first quarter updates so far, it is loud and clear. There is consumption recovery. In fact, if you look at all the companies that have reported their first quarter update so far, there are three things that really stand out. Sentiment has been upbeat across the board. There has been price growth, which has led revenue along with volumes as well. And finally, there is some margin pressure, but that too is transitory. So to understand this further, we've divided that into staples, discretionary, jewelry, and retail as well. So if you look at the staples, Marico, Godrej Consumer, Dabur, low 20s to high teens, and in some cases double-digit revenue growth, which is the highest that we've seen in the last many quarters. Volumes, double-digit for Marico, high single-digit for Godrej Consumer, Dabur as well, mid to high single-digit that we've seen, the highest in the last many quarters. Yes, there are some margin pressures, and we've heard from the companies as well. Case in point, Marico, they've seen gross margin improvement recovery, quarter on quarter, and that's largely because their key raw material for Parachute, copra prices are down 45% from the peak. But barring that, for Dabur, they've actually taken calibrated price hikes, so which is why EBITDA margins would remain stable. Godrej Consumer has said that margins are impacted by higher input costs, but that's just transitory. They expect them to progressively increase as we move towards FY27, and EBITDA growth itself will be in double digit. Now, if you look at some of the larger retail players, there's been 15 to 19% revenue growth. Avenue Supermarts 15%, Trent about 19%, slightly shy of analyst expectations, but definitely higher than what we've seen in the past as well. And then you go down the curve, a lot of these value retailers have done extremely well. Anywhere between 23 to 29% for V-Mart and Bazaar Style. V2 retailers up 58%. All of this led by 7 to 8% same-store sales growth, and store additions have been fairly strong for them as well. And add to all of this, if you look at the jewelry space, some stability, relative price stability in gold prices
has led to a big surge. Senco on a low base doing 60%, Kalyan doing 38%, and Titan itself on that high base of Tanishq, Zoya, Maya, all of them seeing a 39% growth. And then finally, we move on to discretionary, where Jubilant FoodWorks has reported a consolidated revenue growth of 14%, standalone revenue growth of 9.2%. And if you look at the like-for-like growth, that too is 2.5%. Yes, on an absolute basis, seems a little soft, but if you look at it on a high base, it is actually mid-single digit CAGR over the last 2 years. And obviously, if you compare it to the fourth quarter, there has been a noticeable uptick, and that's something that the street is fairly hopeful about going forward too. And then you have, Nykaa, consolidated gross merchandise value seen in about early 30s as far as the growth is concerned. Good performance from their beauty business. Obviously, late 20s is the growth that we've seen out there, and that's been a driver for the company. But this time around, what really stands out is discretionary consumption. Their, tie-up with Nike has done well, and their fashion vertical has seen net sales value grow in mid-50s, which is actually at a multi-quarter high. So the message is fairly loud and clear across the board. The first quarter is marking a bit of a turn in consumption, and there is indeed consumption recovery. On that note, what we'll do is we'll probably invite experts as well on our show, and we have Lalit Bhise, who's the co-founder and CEO at Bizom. Along with him, we have Karan Torani, obviously the consumer sector expert at Elara, joining us now. Thanks a lot, gentlemen, for joining in. Karan, coming to you first. You've seen a lot of these consumer sector updates that have come by. What does that tell you about the consumer sentiment on the ground? You've traveled across the country as well, spoken to a lot of primary retailers, secondary retailers. What has been the sense out there? I mean, is consumer sentiment actually turning, or is it just a one-quarter low base, high price phenomenon?
Hi, Mangalam. I think definitely the consumer sentiment is turning towards the positive. I think most of the companies, if you see in terms of growth rates, whether it is the food segment or the alcohol segment, month of April and May was extremely strong. June was slightly muted. So what you're seeing in terms of numbers right now, even for a DMart for that matter, June was relatively not as good as compared to the month of April and May. So yes, given where we are right now, given the West Asia crisis largely kind of behind us, we will see an uptick and revival as far as consumption is concerned. And Q1 is that way seasonally not a very strong quarter for many of the retail and the consumer discretionary companies. And as we head towards the festive, some bit of gain because of price hikes, some bit of volume of take in terms of increase in consumption. And the bigger trend here is the premiumization companies or the premium-led companies are doing extremely well. So take the example, case in point here, Nykaa, which is reported close to 25-30% growth in their online DPC business. They're a premium DPC platform. Take the example of a company like Radico. Their P&A volumes are growing in the range of 25-30% led by 40% growth in Magic Moments volume alone. So I think very clearly, the premiumization trend is here to stay. It will see acceleration towards the festive season. I think another trigger for most of these companies is commentary on H2 margins. Obviously, you will see negative surprise as far as Q1, Q2 margins are concerned for many of the discretionary and the retail companies. But given where we stand, given the kind of cool-off issue in the crude prices, most of the managements will talk about better margins and strong margins in H2. And we have factored in a margin decline on a YY basis for most of the consumption companies versus last year because of pressures in terms of commodity and inflation. If this sees a cool-off, they upgrade most of the companies, right from alcohol to beauty, personal care, to even QSR, to even the likes of a barrel like Trent.
All right, we take that point. We have Lalit as well with us. Lalit, obviously the co-founder and CEO at Bizom. Lalit, you track household consumption and consumption data fairly closely. What do the recent trends tell you? Has there been a noticeable pickup, or is this just on a low base or price-led growth that we've seen from larger companies?
Right. So there are few things that have been sticky and consistent. I think they continue to do. Like, for example, rural is growing faster than urban. The rural growth story still continues and so that's both volume as well as value-led growth. Similarly, premiumization is another trend that we have seen. It continues to go strong. The actual pack sizes as well as the prices of the things consumers are buying continues to be more and more premium. What is though noticeable is that the urban part of it is primarily a price-led growth. The growth of it is the actual volume underneath it is not growing as much as rural, so to say. So if there is any weakness in terms of growth, that's primarily limited to urban. Otherwise, we have a great consumption story overall.
Right. So you're saying that urban weakness is still there, and is that prominent in only the large FMCG brands, or do we see urban consumption actually having shifted to some of the new age brands, and that's exactly why maybe there is no volume growth? Do you have any data on that, Lalit?
Absolutely. I mean, I think you hit the nail on this thing. So a lot of that. There's actually a combination of both. What you see as that one side, the consumption itself is not really growing as much as rural is. And to be honest with you, it also depends a lot on what we call as urban as well as what we call as rural. The traditional definition of urban itself is no more valid, because even the suburban part of large cities actually behave like a little bit urban. So that's a contributing factor as well. But you are right, some part of that particular hit is also because some of the new age direct to consumer brands are essentially taking away some of the growth from the existing brands. So newer products, more innovations are also taking away some part of that particular growth. But having said that, even then, if we even factor that, largely still consumption is not growing as much as it's growing in rural, which includes both suburban as well as the actual rural growth.
Yeah, and the graphic which is on the screen right now denotes that as well. For companies, retail companies like V-Mart, V2 and Bazaar, which are more into tier 2, tier 3 and tier 4, are growing a lot faster than say ones who are primarily in metros or beyond that. So we have Avenue Supermarts, which is growing only at 15% as against Trent, which is growing at 19%. Karan, do you have a comment on both Avenue Supermarts as well as Trent? It's good, but shy of what the street was expecting. 15% growth for DMart. It's a little lower than maybe what the street was anticipating. And even Trent, the street was working with a number between 20 to 22%. What does that tell you?
So I think as far as growth is concerned, firstly on DMart, as mentioned that in the month of June was not very great in terms of offtake. Also, I think DMart, the coming 2 quarters are going to be strong in terms of price hike. So FMCG price hikes were implemented only towards 3rd week of May. And most of the inventory, most of these companies have got a 1-month inventory. So the positive impact of price hike will come in Q2 and Q3. Also to note, the point here is that DMart is opening a lot of the new stores in the new markets where they were not present earlier. So the reason for the growth rates being lower is also this, that the throughput for the new store is not extremely high right now. And DMart additionally, it is 95% led by the offline channel, and online channel is growing very fast with, Amazon, Flipkart coming to QCom, Blinkit, Instamart, Zepto going aggressive on the scale. So I think very clearly DMart has seen some bit of pain because of QC kind of eating into the other market, and plus their own internal issues also going into new markets, which is taking us some bit amount of time for getting the higher throughput therein. I think as far as Trent is concerned, I think definitely Trent seems to be at a better state right now as compared to what was 3 quarters back. Again, Trent did see that cycle wherein they were expanding into newer markets. Throughput for the new stores was taking time for them. But I think for Trent, what is happening is there's a consistent recovery in LFL. They haven't lost out on margins or return ratios. I think store growth has been strong. If you look at the LFL growth rate also, slowly and steadily, we start seeing recovery on that as well. I think from a competitive intensity standpoint, the number of competitors are largely capped right now. And except for a few competitors like a Style Union or maybe a Max Fashion or maybe one or more new competitors, most of the other competitors, which is your Intune, Ustar, are not expanding very aggressively in the market. So I think there's a likelihood that Trend, you will see acceleration growth rate, both because of better store additions and also because of improved LFL in the studio business.
All right. Just a final question to Lalit before we take that short break. Lalit, do you have any data on the way channels have evolved and the kind of pickup we've seen in particular channels, or is it just offline data that you're tracking?
So we primarily track offline data, but obviously we get a sense in terms of how the online is impacting the overall offline as well. And generally what we have seen is offline still continues to grow. Some channel like standalone modern trade, which is like a multi-store, but 2-store, 3-store, 10-store kind of a channel, is one of the largest growing channel in India after quick commerce. So if quick commerce is growing at 30-40%, standalone modern trade is growing at about 20% plus in general. And the Kirana itself is growing. So the way you look at channel evolution is like this. In a village where there was no store, now you are getting a store, which is like a traditional Kirana store. a town which had typically led by Kirana stores is now getting upgraded to modern trade or a standalone modern trade kind of ecosystem, which is where you mentioned some of the growth of rural supermarket is coming to. And the towns which were, or rather the cities which were already well served by modern trade kind of an ecosystem are moving towards quick commerce. So essentially it's an upward trajectory for the entire India, moving or rather upgrading channels across the ecosystem, and that's essentially how we look at it. So India, everything grows, and one of my favorite author, Rama Bijapurkar, says India is a and country, it's not or country. So pretty much everything grows.
All right, we take that point, Lalit. Karan, just hang in there. We'll take a short break and come back after a short break to continue our conversation on the consumption trends in India so far. Welcome back. You're watching us here on India's consumption trends. We've looked at all the updates coming in for the first quarter from the staples, discretionary, jewelry, and across the board. It's been fairly strong, telling you that there has been a bit of an inflection in India's consumer sentiment. We've decoded that with both Karan as well as Lalit Bise. Karan obviously from Elara and Lalit Bise from Bison joining in too. Karan, coming back to you. Now, most on the street were not particularly chuffed about consumption stocks over the last 3 years or so. Most of them actually, having underperformed the Nifty, if not given negative returns as well. So from this standpoint, and given the sort of outlook that we have right now, what is your call on the stocks and what are your top picks?
I think amongst the stocks, we are positive on companies which have got a very strong pricing power and an advantage in terms of the product portfolio and probably market leaders in their respective category. So that's the first way to filter out the best quality companies. Second, I think most of these stocks or companies rather should have a reasonable share in terms of their online channel because as a faster growing channel, one really cannot ignore the kind of growth we are seeing online. Obviously, omni-channel is the way ahead, but being entirely offline will kind of have a negative impact on overall growth rates from a near-term perspective. So I think we like to, and third, of course, is premiumization. So I think we like names in discretionary which have got premiumization trends, and in terms of the product portfolio, they've got a premium customer because these are the safest bets that one can take. Even in a high inflationary environment where we are. So I think putting this into the basket right now, the 3-4 names in terms of top picks, one of course is Eternal, the market leadership in the QCOM side. 60% plus growth rate is what management is guided for. I think that largely factors in the on Flipkart. If they maintain 60% growth rate with improvement in profitability consistently, you will see rating or valuation multiple in that stock. That's one pick. Second, of course, we like Nykaa. Again, the valuations are expensive, but the internal competitive intensity in the BPC category is very low. And they've got a very rapid premiumization trends wherein their AOVs are 2 to 3 times as compared to Amazon Flipkart in the beauty personal care vertical. So I think that's one stock. The second name which we like. Third, of course, from a tactical trade standpoint over the near term is Jubilant as an idea, because in the second half of this year, we will see margin improvement in a very sharp manner because of potentially LPG prices kind of seeing a reversal and food inflation concerns also being behind us. And valuations are, kind of fair over there as well. But companies like Trent and DMart are the ones we'll play in a narrow band as far as valuations are concerned because they are primarily offline channel driven. But the only thing we'll watch out for is the Trent LFL growth rate for Zudio. I think there is some likelihood of LFL improving because of competitive intensity largely behind us in terms of store expansion. So if that were to improve, then Trent also from current levels after today's fall will see rating or valuation multiples from here on.
And none of the staples you like, Karan?
Nothing with the staples as of now. I think looking at more of the discretionary names so far.
All right, we take that point. Lalit, what about you? What are the categories where you're seeing specific growth and what categories, according to you, are struggling? Where is it that, the next $500 million opportunity is for a lot of these large players?
Right. Let me just give you some quick insight. I think this is actually not yet published in our Kirana report as well. So let me give you a quick insight on how June went, so to say, just the last month by itself, right? So beverages continued to grow because it is, I think summer it got extended. I think monsoon started a little bit late. So beverages continued to grow at about 18%. Commodity that I was smiling when talking about staples. Commodities, our packaged commodities are actually grown at about 15.6%. Dairy products continued to grow at about 16% odd. Packaged food, which is actually an interesting thing that we saw during the war, that packaged foods consumption went up because cylinders were so expensive and stuff like that. That continued even in June, about 16% kind of a growth in the packaged foods as well. So packaged foods, dairy products, packaged commodities, beverages were the ones were growth leaders in June. Whereas if you look at softness, I think home care as a category was a little bit soft. To be honest, I cannot put a finger on why, but looks like towards the end of the summer or beginning of monsoon, people weren't really looking at cleaning their houses or investing more in the home care products. So that's generally the category-wise insight into the month of June itself.
Right. Karan, is there any near-term risk that you see to this upbeat sentiment? I mean, one of the things that I can think of right now is the fact that all these companies that have taken price hikes, maybe because of going ahead and wanting to boost volumes, because raw material prices have come down, they'll give back those price hikes as well. So that may then again reduce the revenue growth.
Yes, potentially that could be. I think the bigger risk that we need to build in is also the fuel prices, and the commodity inflation. So, things like LPG, even after globally the crude has kind of come off, we have not seen LPG come off to that extent, even the likes of fuel prices and even other commodities as well. So I think if inflation or inflationary pressure on these commodities does not come down in the second half of the year, so what we're expecting in terms of a good margin improvement led by stronger demand, kind of may not play out or probably be like a risk, for most of these companies.
Point. Lalit, I just wanted your thoughts on a couple of other forms of consumption as well. Now, when we generally speak about consumption, the basket that you track versus the consumption that people make, it's widened a lot. People think of, increasing financial services as consumption, content as consumption. People think of, something like telecom, data services as consumption as well. So would you have any, data or any intel on how that entire basket has shifted?
To be brutally honest, Mangalam, we don't track anything beyond the actual packaged goods or consumer packaged goods in general, which means that I can give you beyond, like, let's say, some sort of a sense on how the packaged commodities are grown, but or some sense on some of the things like oils and stuff like that, auto parts and things like that, which are grown. But I really don't. I would be speculating if I would talk about stuff like telecom or let's say real estate and stuff.
All right, let's look at it this way then. Let's look at it this way. Let's try and the consumer packaged goods as a share of wallet, what it was say 5 years ago versus what it is right now. Would you have data on that? Because then
absolutely,
yeah.
And that is what I'm saying. So largely, India is a great growth opportunity. As a consumer products, even in the month of June itself, overall as a basket, grew at about June 25 to June 26, growth was about 11.5 to 12% overall as a consumption basket, so to say, which is actually much higher than GDP growth overall, if you look at it that way. So point you are trying to say about the whole wallet size growing share, and this has been a consistent trend, after, except for that 1 year of COVID, it has been a very consistent trend. Last 4 years, we have seen that only accelerate. And within that also, as I said, the sub-trends are premiumization, which is essentially going for better quality products, and natural ingredients, organic. These are some of the sub-trends that we have seen, along with rural essentially driving the growth, which means India is growing secularly, not just limited to urban.
All right, and just a final word before we let you go, Lalit, the GST impact, the government having over the last 12 to 18 months done a lot of things like reducing income tax, etc. in the previous budget, and just generally trying to boost consumption. Do you think all of that is now beginning to show, or this was just imminent irrespective of what the government would have done?
Not really. I mean, I think so. GST, we actually we spoke about it. I think on the same channel around December after post GST. GST contributed significantly in terms of clearing out some of the old inventories and actually getting fresh inventory in the market, making stuff more affordable across for consumption, and putting more putting more money in consumer pocket in general. And that's something that we have seen clearly. If I look at AMJ as a quarter, large part of the growth driving, as you correctly said, can be also attributed to some of the stuff on income tax, which is put more in consumer products. So at least from the data we track, we can clearly correlate those two events as the ones which have driven growth, at least in the last year, so to say.
Karan, is this secular or is it cyclical?
I think definitely.
Karan, go ahead.
Yeah, I think GST definitely has had a positive impact. I think if you look at profitability, inventory, as what the other panelists have mentioned very clearly. But I think we're somewhere kind of behind that. I think another quarter of GST impact, and that's how about it. I think going ahead, one more trend to identify would be the D2C brands, because a lot of the D2C brands also have been struggling for growth. So I think inflationary pressures hit them the hardest. I think we were supposed to see consolidation if the inflation cool-off did not happen in terms of packaging material and also raw materials. Now with this kind of reversal trend playing out in H2, many D2C brands also will start to scale up aggressively across various channels. So the competitive intensity could actually come back in the broader consumer FMCG business in the second half of this year.
All right, take that point. Lalit, Karan, thank you so much for joining us and giving us your insights. So we married that with the data, and what we understand so far is that the consumer sentiment has shown recovery. Staples are doing well largely because of rural. There is still some pain in urban, even though incremental share is going to a lot of these new age companies. Margin pressures, if at all, are transitory, likely to improve in the second half of this year. From an investment standpoint, however, it's still the discretionary industry leaders and premium players who are better investment bets as per Karan Torani. Some of the top picks include the likes of Nykaa, Jubilant Foodworks, and some of the other companies that have reported good performance as well. But with that, what we'll do is wrap up on this edition of Decoding India's Consumption Trends. Q1, if the preview is something to go by, looks like an inflection point. The only question post monsoons, how does that recover in the second half?
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Sensex and Nifty snap a 4-day losing streak to end with marginal losses. Mid-caps suffer sharper cuts. Rupee gains over 40 paisa against the dollar to move below the 95 mark. An LNG tanker catches fire after being struck by an unknown projectile off the coast of Oman. No casualties have been reported so far. Iran warned ships to only follow designated routes but stopped short of taking responsibility for the attack. NATO leaders gather in Turkey for the annual meeting. President Trump expected to pressure allies to increase defense spending. Ukraine's President Zelensky is also in attendance. Indonesia agrees to buy India-made BrahMos and Astra missiles as both nations expand defense ties. India and Indonesia will jointly develop the Sabang port near the Strait of Malacca, deepening wartime cooperation. Government steps up the divestment drive with 5% stake sale in Cochin Shipyard. Stake sale in PSUs has hit the highest level in 11 years with more than 25,000 crore rupees in proceeds so far in 2026. India's consumption engines rev up in the first quarter. India's FMCG giants see healthy revenue growth powered by steady volume gains and timely price hikes despite higher input costs. Jewelry brands report a revenue hike in the range of 30 to 60% for the first quarter. Samsung surpasses Nvidia as the world's most profitable company. Second quarter profit crosses $58 billion thanks to soaring semiconductor sales, but stock declines amid concerns over spending and future demand. One person is dead and 7 others are missing after a landslide in Kerala's Wayanad. The incident occurred due to torrential rains near a tunnel project site. And Belgium knocked the US out of the Football World Cup following controversy over a withdrawn red card for a US player at the insistence of President Trump. Spain also beat Cristiano Ronaldo's Portugal to enter the quarterfinals. All right, let's start with the day's market action. Sensex and Nifty snapped a 4-day winning streak with Nifty holding levels below the 24,400 mark. Mid-cap index underperformed and declined over 300 points from the high point of the day. Nifty IT emerged as the top gaining sector. Prashant Nair is here with the market wrap. Prashant.
Well, midweek, the market just decided to take a bit of a break. Nothing more than that. In less than a month, the Nifty has done more than 1,000 points. It's come up 500 points very, very quickly in the last, I think, a week and a half or so. A break is just part of the game. 50 points, so neither here nor there. 24,380 or so, just under 24,400 is where the market finally closed. Nifty Bank was sideways. The mid and the small cap part of the market was sideways as well. Market breadth was negative as well. That's the day. Now, if you want to go sectorally, what did best recently? Pull back and give back a little. Real estate was down 1.7. Defense was down 1.7. Capital markets was down about 1.5% as well. On the upside, the IT index, after a break yesterday, was back to winning ways, about 2.5 higher. The Nifty IT index was the only noticeably large gainer as far as sectoral indices go. I'll get to the large cap stocks. HCLTech, Infosys, TechM were the top gainers on the Nifty. There was SBI Life, which was up about 2.25. There was Eternal, and there was a HDFC Life, which did pretty well also. Trent was down about 12.5%. Lots of these first quarter updates coming through. And Trent, the Trent reported market did not like. Adani Enterprises, Adani Ports were the other losers, which we really saw today. Now to the broader market. As I said, more down than up. And on the downside, there was BSE, which was down about 3%. As far as exchanges go, MCX lost about 3% as well. Cochin Shipyard was down 5%. Aegis Logistics, DLF, NetWeb, Loris Laboratories, Data Patterns, Paras Defense, KEI. Don't go looking for reasons except the fact that stocks across the board have done quite well. And on the upside, there was InfoEdge quarterly update here. Market liked what it saw, 13%. There was Policy Bazaar, which was up about 1.6%. There was Adani Energy Solutions, which was up about 1.6%, and a whole host of IT mid-cap names, Coforge, Persistent, etc., which participated on the upside as well. So a bit of a break. We've had a good run in a pretty short time span.
All right, thank you, Prashant, for that. In the money market, the Indian rupee gained more than 40 paisa against the dollar. The currency is now trading below the 95 mark against the greenback. 10-year bond prices also gained in trade with the yield crossing 6.7%. Let's also talk about the big global story this evening. An unknown projectile has hit a tanker near the coast of Oman in a suspected Iranian attack. This comes just days after traffic at the Strait of Hormuz started to pick up pace. Here are the latest developments. According to the UK Maritime Trade Operations Centre, a tanker travelling off the coast of Oman caught fire after being struck by a projectile overnight. No casualties have been reported so far. The tanker was carrying LNG from Qatar, raising fears over fuel supply once again. Iran's Revolutionary Guards issued a statement saying, and I quote, "The Strait of Hormuz is not a playground. All vessels must use the route designated by Iran for safe passage." End of quote. However, the IRGC did not claim responsibility of the projectile attack. Officials from Tehran's negotiating team also hit out against US President Donald Trump's warning that Washington will either make a deal or finish the job. In a social media post, Iran's Foreign Minister Araghchi said negotiations on a final deal will not commence if threats continue from the US. In Iran, the funeral procession of former Iranian Supreme Leader Ayatollah Ali Khamenei passed through the city of Qom as part of the week-long event. The late Iranian leader will be buried on 9th of July. Millions of Iranians are taking part in the procession, which the regime is projecting as a show of strength. In the oil market, prices of Brent crude edged higher. According to shipping data from Kepler, 108 vessels crossed the Strait of Hormuz between 3rd and 5th of July, even as security and insurance risks remain elevated. Here is President Trump on negotiations with Iran.
And our great Navy, which did the greatest blockade anyone's ever seen, not one ship got through in 2 months. And we then freed up the blockade because we're close to maybe making a deal. I don't know. We'll make either. Look, we're going to win one way or the other. We're either going to make a deal or we're going to finish the job, okay? And it won't be tough to finish the job. I'd rather make a deal because I don't want to affect 91 million people. We can knock down their bridges in 1 hour. We can knock out their energy supply, all of those big plants that they built, big, beautiful, modern plants. They had a lot of money. They don't have any money now.
All right, let's also talk about the other big global headline. NATO leaders are gathering in Turkey's capital for what is shaping up to be a challenging summit. European allies face mounting pressure from Washington, with President Trump demanding a rapid increase in defense spending. On the sidelines of the summit, NATO members are expected to unveil tens of billions of dollars in new arms contracts at a major defense industry forum in a bid to demonstrate they are following through on their spending commitments. But will these pledges be enough to satisfy President Trump? My colleague Steve Sedgwick reports from Ankara on the accelerating global defense race.
I look at it like this. Back in The Hague last year, everyone agreed on a race, and we're going to have this race, and everyone's got to get to the end of this race by 2035, okay? And the race is to get to 3.5% defence spending, plus another 1.5% of infrastructure spending to get to 5%. It's a marathon, okay? We've agreed an ultra-marathon to get us to 2035, where everyone's got to get to the end by that. Every single person's got to finish and get there. Well, now it's like the US has kind of ripped up the rules in the last year and said, you know what? We're not going to make it a marathon. We're going to make it a sprint. We're going to make it a 100 or a 200-metre race. So all these nations who have been preparing themselves like Kipchoge for a really long run have suddenly got to turn themselves into Usain Bolt and run to the line a lot quicker. That's the analogy I kind of want to use to get people to think about how the conditions have changed.
The US is splitting NATO, isn't it, rather than bringing it together?
It is not. It is, I think, bringing NATO closer together, and having a review regularly, I think, is only wise. And the way it will be organized, with the Supreme Allied Commander being center stage in the review, the fact that the Americans have declared very clearly that they will do this in close coordination with all allies, I think is absolutely important.
The amount we spend on these submarines and the cruise missiles to have that defence capability means there isn't money available for other areas as well. So it is a race, and it's a race that the Europeans have had to change their tactic on in the last few months.
All right, Prime Minister Narendra Modi hailed a golden era in India-Indonesia ties during his visit to Jakarta. The PM was conferred Indonesia's highest civilian honour, the Bintang Adipurna, by President Prabowo Subianto. The two leaders held delegation-level talks and reviewed bilateral relations. They also oversaw the signing of a series of agreements covering defence, space, technology and critical minerals. Indonesia agreed to procure India-made BrahMos and Astra missiles, marking a major boost to defence cooperation. Abhimanyu Sharma joins us with the details of the MOUs signed.
Prime Minister Narendra Modi and Indonesian President Prabowo Subianto have announced MOUs across several areas as both the nations are looking to deepen cooperation in agriculture, technology, maritime security and several other domains. India is going to open an IIM campus in Indonesia. India is also looking to supply BrahMos and Astra missiles to Indonesia. Both the sides are also looking to deepen cooperation in maritime security by virtue of higher collaboration between coast guards of the respective countries. countries. Also, Indonesia has conferred its highest honor of Bintang Adipurn in terms of a medal on PM Modi. Both the sides are also looking to work on cross-border QR payment linkages, and they are going to jointly develop the Sabang port near the Strait of Malacca, which is 100 miles away from India's Great Nicobar project. Now, maritime cooperation is something which is important in view of the fact that the world has been facing constraints in the Strait of Hormuz, and Malaysia and Indonesia are located on both the ends of the Strait of Malacca. Now, that strait witnesses the transit of 40% of global trade, and a few days back, India and Malaysia had reviewed bilateral military cooperation while reaffirming the freedom of navigation in the Indo-Pacific region. It remains to be seen what further announcements are going to be made as part of PM Modi's official visit, even as maritime security, maritime cooperation and a free Indo-Pacific continues to be the cornerstone of the talks which are taking place between India and Indonesia, and several other issues are likely to be discussed in course of PM Modi's visit.
All right, thank you, Abhimanyu, for that. CNBC TV 18 news break confirmed the government has launched an offer for sale in Cochin Shipyard. The divestment drive has been in full swing this year. In fact, stake sale in PSUs has hit the highest level in 11 years, with more than 25,000 crore rupees in proceeds so far in 2026. Sudarshan Kumar joins us with more details on Cochin Shipyard and the divestment drive.
So non-retail portion of the OFS of Cochin Shipyard is fully subscribed as we speak. Remember, yesterday government had launched OFS in Cochin Shipyard to sell up to 5.04% stake, of which base size 2.52%. If government goes ahead and exercises green shoe option, that portion also is of 2.52%. And if government manages to sell entire 5.04%, it will end up raising almost rupees 1900 crore. For non-retail portion, OFS is underway. For retail portion, OFS will open tomorrow. Floor price government is set at rupees 1400 per share, and that was at a discount of almost 7% to yesterday's closing price. Now, remember, government currently holds almost 68% stake in Cochin Shipyard. Now, going beyond Cochin Shipyard, just in 2026 so far, government has raised, if you exclude Cochin Shipyard, government has raised more than 25,000 crore via OFS in 7 PSU companies like Coal India, NHPC, GIC and others. Now we'll have to see if government remains aggressive and launches OFS in more companies. But so far, there are 8 companies that government has launched OFS. And if you include Cochin Shipyard, they have managed to raise more than 27,000 crore.
All right, thank you, Sudarshan, for that. Meanwhile, shares of Tata Group fashion retailer Trent declined over 12% in trade after the firm's first quarter sales growth missed estimates. Trent reported a standalone revenue of over 5,600 crore rupees for the June quarter, marking a 19% increase annually. But this was below analyst expectations. Brokerages have also flagged concerns over rising competition and the impact of store expansion. Trent operates brands including Westside and Zudio with over 1,300 stores across India. And shifting focus now, Titan reported strong business update for the first quarter, with its domestic business growing 37% annually. Company's jewelry segment continued to be its biggest growth driver. Watches and eye care businesses also posted healthy growth of 23% each. Titan further expanded its retail footprint, adding 76 stores in India and 1 international store, taking its total store count to 3,680. Now, India's consumption engines are revving up in the first quarter. FMCG giants report healthy revenue growth powered by steady volume gains and price hikes despite higher input costs. Jewelry brands are also reporting revenue growth in the range of 30 to 60%. Mangalam Balu is here with the consumption report card. Mangalam.
Well, if there's one thing that stands out in the first quarter updates so far, it is loud and clear. There is consumption recovery. In fact, if you look at all the companies that have reported their first quarter update so far, there are 3 things that really stand out. Sentiment has been upbeat across the board. There has been price growth, which has led revenue along with volumes as well. And finally, there is some margin pressure, but that too is transitory. So to understand this further, we've divided that into staples, discretionary, jewelry and retail as well. So if you look at the staples, Marico, Godrej Consumer, Dabur, low 20s to high teens and in some cases double-digit revenue growth, which is the highest that we've seen in the last many quarters. Volumes, double-digit for Marico, high single-digit for Godrej Consumer, Dabur as well, mid to high single-digit that we've seen, the highest in the last many quarters. Yes, there are some margin pressures and we've heard from the companies as well. Case in point, Marico, they've seen gross margin improvement recovery, quarter on quarter, and that's largely because their key raw material for Parachute, copra prices are down 45% from the peak. But barring that, for Dabur, they've actually taken calibrated price hikes, so which is why EBITDA margins would remain stable. Godrej Consumer has said that margins are impacted by higher input costs, but that's just transitory. They expect them to progressively increase as we move towards FY27, and EBITDA growth itself will be in double digit. Now, if you look at some of the larger retail players, there's been 15 to 19% revenue growth. Avenue Supermarts 15%, Trent about 19%, slightly shy of analyst expectations, but definitely higher than what we've seen in the past as well. And then you go down the curve, a lot of these value retailers have done extremely well. Anywhere between 23 to 29% for V-Mart and Bazaar side. V2 retailers up 58%. All of this led by 7 to 8% same-store sales growth, and store additions have been fairly strong for them as well. And add to all of this, if you look at the jewelry space, some stability, relative price stability in gold prices has led to a big surge. Senco on a low base doing 60%, Kalyan doing 38%, and Titan itself on that high base of Tanishq, Zoya, Maya, all of them seeing a 39% growth. And then finally, we move on to discretionary, where Jubilant FoodWorks has reported a consolidated revenue growth of 14%, standalone revenue growth of 9.2%. And if you look at the like-for-like growth, that too is 2.5%. Yes, on an absolute basis, seems a little soft, but if you look at it on a high base, it is actually mid-single-digit CAGR over the last 2 years. And obviously, if you compare it to the fourth quarter, there has been a noticeable uptick, and that's something that the street is fairly hopeful about going forward too. And then you have, Nykaa, consolidated gross merchandise value seen in about early 30s as far as the growth is concerned. Good performance from their beauty business. Obviously, late 20s is the growth that we've seen out there, and that's been a driver for the company. But this time around, what really stands out is discretionary consumption. Their, tie-up with Nike has done well, and their fashion vertical has seen net sales value grow in mid-50s, which is actually at a multi-quarter high. So the message is fairly loud and clear across the board. The first quarter is marking a bit of a turn in consumption, and there is indeed consumption recovery.
Right. Thank you, Mangalam, for that. Ola Electric Mobility's shares came under pressure for the third straight day. This after two suppliers approached the National Company Law Tribunal seeking insolvency proceedings against Ola Electric's wholly owned subsidiary. Now, vendors Sterling and Anevolve Bando alleged unpaid dues of over 40 crore rupees. This is the second time Ola is facing an insolvency in more than a year. A similar petition was filed by one of its registration agencies in 2025. Now, shares of food delivery and quick commerce major Swiggy surged over 7% after the company announced that domestic ownership had crossed the 50% mark. In a stock exchange filing, Swiggy mentioned aggregate foreign investment stands at nearly 49% of its fully diluted paid-up equity share capital as of July 6th. Now, fitness chain Cult Fit has filed its draft papers with market regulator SEBI for an initial public offering. The proposed IPO comprises a fresh issue of up to 950 crore rupees and an offer for sale of nearly 18 crore shares. Investors including Temasek, Tata Digital, Axel and founder Mukesh Bansal are looking to sell stake. The Bengaluru-based company may also consider raising up to 190 crore rupees through a pre-IPO placement. The time for a short break. Coming up next, Samsung surpasses Nvidia as the world's most profitable company. More details on that when we return. Welcome back. A quick look at some more headlines. A massive landslide struck a tunnel construction site in Wayanad, trapping at least 7 workers beneath mud and debris. The collapse followed days of heavy rain in the region. Work at the site had been suspended because of the weather, but some workers were still present when the landslide hit. Rescue teams and Kerala police are continuing operations to reach those still trapped. Delhi High Court has ordered the unblocking of the Cockroach Janata Party's X account. This after the government told the court it has no objection to restoring the handle. The ruling comes after the account was blocked in May, with the government citing national security concerns during today's hearing. Centre said the block was meant to prevent confusion among students and parents during the NEET examination. The auto component manufacturing industry has weighed in on the E20 fuel debate. ACMA President Vikrampati Singhania told CNBC TV18 that there is no conclusive public data to suggest E20 fuel causes damage to vehicle components. He added that it's too early to conclude whether E20 requires a different set of auto components.
Like you rightly said, there's not enough data at this point of time to say whether this will damage or how much it will damage and what will happen. From an auto component perspective, as we see more data, as we work very closely with the OEs, and the OEs will be the first to bear this brunt in some ways. As and when these needs evolve and we start realizing that there is a need for different materials to go in, the industry will continue to be able to respond to that.
Right, let's talk about Samsung now. The company has surpassed Nvidia as the world's most profitable company. Its second quarter profit has crossed 89 trillion won or $58 billion thanks to soaring semiconductor sales. However, despite its preliminary earnings report, the stock declined amid concerns over spending and future demand. Rachna Dhanrajani is here with the details. Rachna.
Samsung Electronics has dropped its preliminary earnings guidance for the April to June quarter of 2026, and the figures are truly record-shattering because the company is guiding for consolidated sales of about 171 trillion Korean won. That's over 129% growth year-on-year, and an operating profit of 89.4 trillion won. That's a nearly 19-fold surge compared to the same period last year. But to put that in perspective, this single quarter's expected profit is higher than what Samsung made in its entire 2025 fiscal year in some estimates. And the star performer here is the Device Solutions division, particularly memory chips. Explosive demand for high bandwidth memory, HBM, and advanced DRAM, driven by the global AI infrastructure build-out, has supercharged these results. Now, this comes on the back of an already record first quarter, where Samsung posted 57 trillion won in operating profit. However, here's the twist. Despite these blockbuster numbers, Samsung shares fell sharply in trade today. Analysts are pointing to profit booking by investors who had built up big positions ahead of the results, along with some concerns over heavy capital expenditure plans and whether the AI boom might be peaking. Now, July 30 will be the day, and more than numbers, the management outlook would be the one to watch out for, because it would give a sense of this AI race, but more importantly, what happens to phones and other devices that need these chips and are seeing a price rise as a result of it. But for now, one thing is clear. Samsung is riding the AI wave, but is also feeling the weight of expectations from the street and its investors. So we'll have to see how it goes for Samsung.
All right, thank you so much, Rachna, for that. Moving on, Alibaba will ban Anthropic's Claude code for its employees from July 10th. The Chinese giant has listed Claude as a high-risk software, citing Anthropic's alleged use of a hidden code that could detect if a user was based in China or linked to a Chinese AI lab. The move comes after Anthropic accused Alibaba of training its AI on Claude's answers and carrying out what it says was the largest known distillation attack. Alibaba is reportedly telling staff to delete all Anthropic apps and switch to its own tool called Coder. All right, before we wrap, let's do a quick recap of the top headlines. Sensex and Nifty snap a 4-day winning streak to end with marginal losses. Mid-caps suffer sharper cuts. Rupee gains over 40 paisa against the dollar to move below the 95 mark. An LNG tanker catches fire after being struck by an unknown projectile off the coast of Oman. No casualties have been reported so far. Iran warned ships to only follow designated routes, but stopped short of taking responsibility for the attack. NATO leaders gather in Turkey for the annual meeting. President Trump expected to pressure allies to increase defense spending. Ukraine's President Zelensky is also in attendance. Indonesia agrees to buy India-made BrahMos and Astra missiles as both nations expand defense ties. India and Indonesia will jointly develop the Sabang port near the Strait of Malacca, deepening maritime cooperation. Government steps up the divestment drive with 5% stake sale in Cochin shipyard. Stake sale in PSUs has hit the highest level in 11 years with more than 25,000 crore rupees in proceeds so far in 2026. India's consumption engines rev up in the first quarter. India's FMCG giants see healthy revenue growth powered by steady volume gains and timely price hikes despite higher input costs. Jewelry brands report a revenue hike in the range of 30 to 60% for the first quarter. Samsung surpasses Nvidia as the world's most profitable company. Second quarter profit crosses $58 billion thanks to soaring semiconductor sales, but stock declines amid concerns over spending and future demand. 2 people are dead and 7 others are missing after a landslide in Kerala's Wayanad. The incident occurred due to torrential rains near a tunnel project site. And Belgium knocked the US out of the Football World Cup following controversy over a withdrawn red card for a US player at the insistence of President Trump. Spain also beat Cristiano Ronaldo's Portugal to enter the quarterfinals. And with that, it's a wrap on this edition of Business 360. News and updates continue right here on CNBC TV.
Hello and welcome to Startup Street. I'm Arundhati Ramnan and these are the top headlines from the startup world. CNBC TV 18 Newsbreak confirmed fitness chain Cult Fit files its draft papers with market regulator SEBI for an initial public offering. The proposed IPO comprises a fresh issue of up to 950 crore rupees and an offer for sale of nearly 18 crore shares. Econovis Packaging bags 40 crore rupees in a pre-Series A round led by Rain Matter to scale sustainable industrial packaging. Funding will drive the setup of a new integrated manufacturing facility in Pune and a dedicated design center to accelerate expansion across Indian industrial supply chains and global export markets. India's Competition Commission approves Upgrad's proposed acquisition of Unacademy. The deal is an all-stock transaction valued at approximately 2,055 crore rupees. Crude co-founder decides to shut his latest startup Pixie less than a year after launching it. Plans to return the remaining capital to investors ahead of pursuing another pivot. Pixie, an AI-powered photo-sharing app, was launched in October last year. Samsung surpasses Nvidia as the world's most profitable company. Second quarter profit crosses $58 billion thanks to soaring semiconductor sales, but stock declines amid concerns over spending and future demand. Those were the headlines that we're tracking for you this evening, but on what's brewing today, and it's a CNBC TV 18 news break confirmed. Fitness chain Cult Fit has filed its draft papers with market regulator SEBI for an initial public offering. Now, the proposed IPO comprises a fresh issue of up to 950 crore rupees and an offer for sale of nearly 18 crore shares. Investors, including Temasek, Tata Digital, Axel, and founder Mukesh Bansal, are looking to sell stake. Rachna Dhanrajani is here with the details. Rachna?
Well, it is a news break confirmed. Culfit has now filed its DRHP with SEBI, confirming what we had first reported in March 2025 about the company wanting to go public, and again in June 2026 when we brought you the news of revival of these listing plans. Now the offer is a fresh issue of up to 950 crore rupees alongside an offer for sale for nearly 17.9 crore shares by existing investors. Temasek's affiliate McRitchie is the largest seller, and co-founder Mukesh Bansal is divesting up to 1.6 crore shares. The total deal size is not yet fixed and will be set only when the price band is announced. Of the fresh issue, the company plans to use around 217 crore rupees toward center lease and rental payments, 120 crore to repay borrowings, and 75 crore rupees on brand marketing. On the financials, revenue rose 42% to over 1,720 crore rupees in FY26, and the company turned adjusted EBITDA positive for the first time. However, Cultfit remains loss-making with a net loss of about 252 crore rupees, having been in the red each of the last 3 years. On the risks, nearly 69% of its network is run by franchisee partners rather than the company directly. And the auditors have flagged an audit trail remark in each of these last 3 years. And the prospectus also discloses a number of pending FEMA and Registrar of Companies compliance matters. Running the issue are Kotak, Access Capital, Goldman Sachs, Jefferies, and JM Financial. The regulatory review now begins, and we will be tracking the price band closely, and we'll bring you more updates as we have them.
All right, Rachna, many thanks for taking us through those details. Now, moving on, the cookware in our kitchens has largely been judged by durability and price. But what if the next big consumer trend is health? The Indus Valley is betting exactly on that. The D2C brand, known for its toxin-free and non-coated cookware, has just raised $17 million in a Series B funding round led by Gaja Capital. Having scaled to a 200 crore rupee annual revenue run rate, the company is now targeting 1,000 crore rupees in revenue by 2030 as it expands across online, offline, and quick commerce. So what's driving the shift in consumer behavior, and how does the Indus Valley plan to build India's largest healthy kitchen brand? Joining us now is Jagdish Kumar, the co-founder and CEO of the Indus Valley. Jagdish, welcome to Startup Street. You know, first up, the Indus Valley started with a simple but powerful idea, right? That what touches your food matters. So what made you believe that Indian consumers would eventually move beyond price and convenience to pay for healthier cookware?
No, first of all, thank you so much for having me here. It's an honor to go live on CNBC TV 18, having been seen as a child to being here. So on the Indus Valley journey over the past 10 years, so we've been very lucky, and we've been very honored to have the customer acceptance to get into more than 10 lakh Indian homes who have accepted us as part of their family. So our idea has always been that what touches the food in every Indian home has to be something that is very health friendly and should not have any sort of chemical coating or toxins, because we are well aware of all the harmful effects on our body when we are cooking and when we are storing and when the food touches something that is unhealthy. So our idea has always been to provide consumers with something that they can use as an alternative to chemical coated products, and that is going to add something to their overall health and well-being. And that was the idea with which we started Indus Valley, and we are very, very happy and proud, and we're very lucky to be here.
Absolutely. And the focus on healthy cookware and the health drive has taken over India. So it's a trend that, everyone's riding on. You've raised the $17 million in a Series B round that was led by Gaja Capital. Why did you see that this was the right time to raise your capital? And where will this money create the biggest impact for you over the next 18 to 24 months?
Sure. So, as a company, like you mentioned, we are currently at a 200 crore annual revenue run rate, and we are also almost EBITDA break even. So, what we are looking to do from here is our journey from 200 crore to 1,000 crores. We need to look beyond cookware and try to touch upon all the points where the food no, the overall wherever food touches in the kitchen, and we try to expand into adjacent categories, like for example storage and hydration. And also we want to strengthen our omni-channel distribution and brand presence and invest in brand marketing, so we can increase from a scale of 200 crore to 1,000 crore in the next 4+ years. That is what is our journey, and for that is where we have raised money in this current round. We're very happy to have Gaja Capital as part of our cap table, somebody who's very aligned in terms of how we want to build the business. So it's a very good addition to our cap table along with our existing investors.
And speaking about this journey from your current 200 crore rupees to your 1,000 crore rupee revenue target, right? What are the biggest growth levers that will help you achieve that five-fold jump? Are you looking at new products? How are you going to achieve this jump in revenues?
Yes. So, like I said, there are three major levers for growth. One is on the category expansion bit. So, we will consolidate our leadership in the existing cookware category and increase our share in the pressure cooker category. And we are also looking to expand into adjacent categories like storage and hydration in the next 12 months. And over the next 2 to 3 years, we will try to expand into some more categories as well. So category expansion would be a major lever. And the second would be strengthening our omni-channel. So today we are available largely online. So I will try to consolidate that, increase our presence in quick commerce, and also increase our offline presence. And third would be investing in our brand marketing, so we are able to position Indus Valley as the safe, reliable brand towards the entire healthy kitchen ecosystem.
Sure. And what is profitability looking like today?
We are breaking even, and in this year we should be a bit positive. So we are in a very good, strong wicket.
All right, on a good, strong wicket. Now, India's cookware market has traditionally been dominated by legacy brands and low-cost, unorganized players, right? How difficult has it been to build this entirely new category around healthy cookware? And are consumers now actively seeking toxin-free products?
So I would say that the demand was already there. So all we had to do was convince customers that we are providing that health-friendly solution, because customers were always looking for a healthier alternative. So we had to just be present wherever customers are. And we had to just tell the story that, we are the better for you, good for you brand, which will overall help in your healthy journey in the kitchen. So when we did that, customers were willing to pay a premium because they were already looking for something that is healthier, something that does not have any toxins or chemicals. So us educating the customers and creating awareness, customers were already willing to make that shift. So
customers were already willing to make that shift. Out of all the products that you have, where are you seeing the most traction right now? And is that what you're going to double down on going forward?
yes. So cookware is our biggest category today, and it will continue to be so in the coming years as well. But we will continue to expand into newer categories. Like I said, pressure cookers are growing. We are looking to enter storage and hydration. So we expect cookware and pressure cookers to dominate our overall business in the next 3-4 years as well as the newer categories will really take off. And that's how we're looking at the next 4 years.
That's how you're looking at the next 4 years. And also, you were talking about your omni-channel presence, and you're mostly present digitally, right? So that's where you're seeing the fastest growth. How soon will we see how soon will we see you in physical stores?
We are there in select locations. We are currently there mostly in South India. So we will continue to expand that more with now this fundraise as well. So in the next 12 to 24 months, you should see us entering more and more brick and mortar stores as well.
All right, more and more brick and mortar stores. You know, now you're seeing more of these cookware brands coming out who are talking about health, safety, and premium products, right? A lot of new startups that are doing that. What is the Indus Valley's moat that you believe competitors will find hard to replicate?
So we've been lucky in getting our customer acceptance as the go-to brand when it comes to healthier, toxin-free, non-chemical coated cookware. So that identity and affinity that consumers have towards us, that is what is creating the trust for Indus Valley. And we're happy to see a lot of action happening in this category. More and more brands are entering this space. So the more education and awareness gets built, overall we feel that it's good for the category because the category disruption has just started. We expect this to become much larger and more Indian homes to be welcoming of that. Because if you look at it, it's largely a very unorganized category still. So the more consumer education happens, more focus on health and quality products, safer products are coming in. We expect the secular trend to continue. And by means of us being the leading brand in this space who have entered and educated the customers, we feel we'll be able to tap into that more.
So you'll be able to tap into that. All right, Jagdish, thank you so much for taking time out and being here with us on Startup Street. And we wish you all the best on this journey going forward.
Really appreciate. Nice talking to you. Thank you so much, CNBC team.
Thank you. Moving on, Broadway, co-founded by Vivek Biani and Sankalp Katuria to give internet brands a physical address, has opened its newest and biggest store yet. 40,000 square feet, 4 floors, over 200 brands right here in the heart of Mumbai. My colleague Rachna Dhanrajani gives you a peek inside the outlet along with a conversation with CEO Sankalp Katuria.
You know, the brands that you're so used to looking at on Instagram or shopping from their website and somehow wish that they had a physical store near you? Well, making that possible now is Broadway. And what you're seeing behind me is exactly that. It's spread across 40,000 square feet, spans across 4 floors and houses over 200 brands. Let's check it out. After Delhi, Pune and Hyderabad, Broadway has finally come to Bombay in Bandra. This one is about 4 floors and the business model is pretty simple. Broadway gives space, physical space to brands that are born on the internet or on Shopify. These are short-term leases between 3 and 12 months, which means without paying a heavy fit-out investment or making one, these brands can come, plug in, set up stores. But to understand more about this business model, I'm joined by Sankalp Katuria, co-founder and CEO of Broadway. Thank you so much, Sankalp, for joining us. Of course, we miss you on ground here in Bandra. But do tell us about Broadway. How did this store come about? You're already in Delhi, Hyderabad, Pune. How did Bandra happen and what's the plan forward?
So I think we wanted to come to Bombay as soon as possible, but we couldn't do any mistakes in Bombay for sure. So I think the first 3 stores were the playing grounds to understand how this business will work. I think we are at a very good place where we have a very good curation and we can tell the consumer, which is the most evolved consumer in India today, that we can offer you something which is very unique that is out there. In my view, retail hasn't been reinvented in ages. A lot of brands that we see today through social media, on our Instagram, are actually not present offline. So we call Broadway an offline Instagram in some way. in amalgamation with a lot of experiences built into the store.
Now that I'm inside a Broadway store, I can see the scale of things here. And I'm guessing Delhi, Hyderabad is also about 30,000 square feet. Take us through the numbers. How much does it cost to build a Broadway store?
So we started, our first store model was in Vasant Kunj in Delhi. And that was a smaller store of 14,000 square feet. We realized that new age brands in India have grown too much, and we need a bigger space to represent the right picture or the right story of Broadway. Right now, we are signing properties between 20 to 25,000 square feet, and the idea is go to up to 30,000 square feet, right? Typically, to construct a Broadway store, it requires a lot of capex, anywhere between, let's say, 5,000 to 6,000 rupees per square feet is the cost that it takes. So you can do the math on it takes anywhere between 12 to 15, 16 crores to make one single Broadway store that is out there. This capex is borne by us, and obviously we try to make it back through a business model that we are working on.
All right, I also see there are these creator studio setups here. Take us through this. Do you see content as a part of this store, and also is it a part of the brand package? Let's say a company sets it up here, is it a part of the package? Also tell us, if I have a company today, how can I get a corner at Broadway, and how much would it cost me?
So we have a very young curation team here at Broadway. Average age of Broadway would be around 22 to 24. And I am not part of that curation layer that is there. There's a committee which we sit every second week, and then we kind of evaluate brands. These are, first of all, the brand should hold on to the claims that they are making. Because we physically sample every brand that is out there, we make sure that the brands, whatever they're claiming on their online portals or social media, they actually stand by them. The second is, what is the brand language? Does it appeal to the new age consumer? These are subjective calls that are taken. And third is that the founder actually, there's a story behind it, and there is a story that the brand is trying to convey to the consumer. So all of these are factors that go into the curation, along with making sure that our assortment is complete. This is definitely an offline Instagram, because all the brands that you see are the brands that are trending on Instagram. Brands are able to express their story very well through their visual merchandising that is out there. We at Broadway, every Broadway store has a stage. So we give this stage out to brands to meet their community, to do various activities.
Well, Sankalp, 4 stores in 3 years. You already have Nikhil Kamath on the cap table. Take us through what's next for Broadway in terms of fundraising and expansion plans.
So the plan is to get to 25 stores in the next 3 to 4 years. We have 2 signed properties already. One in Gurgaon near Galleria, and one in the North Delhi area near the North Campus. This is Delhi. We are actively looking for properties in Bangalore, Ahmedabad, and a couple of other places.
All right, that was Sankalp Kathuria, co-founder and CEO of Broadway. But did you know that India's D2C market is currently valued at about $87 billion and expected to rise 25% annually? So these brands are going to need a physical space, which for now Broadway is providing them. But will Broadway be able to sustain this profitably and scale is what we will find out in coming quarters.
Well, on that note, it is time for us to head into a short break. Coming up next, India's indoor air quality challenge is growing, and Breather is one company that's looking to change the way we breathe. More on that when we come back. Stay tuned. Welcome back. It's with us on Startup Street. As concerns over air pollution continue to rise, startups are betting on indoor air quality as the next big consumer opportunity. One such company, Breather, has built a system that claims to manage everything from pollution and humidity to oxygen levels through a single device. CNBC TV 18's Aishwarya Anand brings you this report.
14 of the world's 20 most polluted cities are in India. Every winter, millions shut their windows, switch on purifiers and hope for the best. But one startup says the problem isn't the air outside, it's the air inside. Their story started with a doctor, an IVF clinic and damaged embryos.
The doctor, she's one of the biggest IVF doctors in India, and she reached out to me and she said, Abhinav, you've been telling me that my air is bad. I know my air is bad. Look at these embryos. They are getting damaged. What can you do to fix it? And that's when the first time I thought that maybe the world needs something that combines everything for a single thing for air. That hospital project was the reason where we started.
What Abhinav built is a single system that manages 12 parameters of indoor air. Temperature, humidity, oxygen, pollution, bacteria, mold, all in one device.
You know, single digit AQI indoors is 20 minutes. In 20 minutes. That's a bold claim that you're making, right? Walk me through what's actually happening inside the system.
When we say that we can give you single digit AQI in 20 minutes, what it does, it will take, as I said, it will take air from outside. So it's taking this oxygen rich air with 300 AQI. It is passing through a series of filters, 5 or 6 filters in it. Removes every possible pollutant. And what it does is it pressurizes the air. So imagine you have like a glass of water which is dirty, and you've put it under a tap which is bringing Ganga Jal, clean, pristine water, and it puts it with a lot of pressure. Eventually all the dirty water will be replaced by this clean, pristine water. That's exactly what Breather does. So it pressurizes, it just pumps in clean, fresh air all the time and then maintains that steady AQI inside. So when a user is sitting inside, it's like they've opened the windows and a breeze of fresh air is coming in. But this air is also removed of all pollutants. This air is also managed for temperature, and this air is also managed for its moisture levels.
So now you've deployed across 1 million square feet, right? Hospitals, IVF clinics, homes. Which of those is the most surprising use case and why?
An international school with an indoor football stadium. So that for me was a little off because, you know, usually when we played football, we used to play outside. But nowadays, because pollution is such, weather is such, we are seeing that even things like football and swimming have become indoors and they need maintenance of air quality. So it's a little sad, but I think that's where the future is headed.
Since launching in January 2025, Breather has clocked $1 million in revenue, targeting $5 million over the next 12 months. The bigger bet is on real estate, working with developers to make clean indoor air part of the home buying proposition itself. And while no external funding has been raised yet, Abhinav says that's about to change.
We have 6 units of the consumer product that we've launched today. They are in the houses of some of the biggest names we know in India and globally. Now the next step is to scale that up. Now we are going to start with pre-orders, and then we're going to officially launch not just D2C but also official retail channels. So official retail channels will happen probably a year down the line. And a consumer product launch around January 2027 globally is going to be the first step towards that large market that we're trying to look globally.
In a country where every breath is a health decision, the market for what Breather is building may be far larger than even they realize. With camera person Lakshman Singh, this is Aishwarya Anand for CNBC TV 18.
And with that, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
grabbing the headlines, but data is powering the revolution. At the heart of that transformation is NetApp, a $30 billion intelligent data infrastructure leader, helping enterprises unlock the value of their data across cloud and AI. After a landmark year driven by record financial performance and growing enterprise AI demand, CEO George Kurian believes data, not chips, will define the winners of the AI era.
When we last spoke, which was about 3 years ago, it was all about the cloud. And now it's all about AI. What do you make of this massive transformation and shift that's taking place?
I think it's built on the foundation of large-scale digital technology being available with an important couple of other ingredients. One is sophisticated computer models, and of course, the ability to harness the power of large amounts of data, which is where we come.
Your thesis on data being at the center of everything is proving right today.
Thank you. Yes. We've long held the view that in addition to talent and understanding your business or your clients deeply, data becomes the competitive moat of an industry. Everybody has access to the same chips. Everybody has access to the same models. And the models themselves are largely trained on the same data. And so your ability as an organization to deeply understand your business, your clients and employees using your data becomes the competitive moat.
So that is the competitive moat, as you point out. But I want to understand from you, it's been what, a little over 10 years for you here at NetApp. So you've seen many cycles. What is specific to this particular wave that we are seeing, the AI wave that everybody wants to get on top of? What is different this time around?
I think it has the promise of a platform shift in a broad sense. Certain industries are already experiencing that, digitally intensive industries. I think for that to become a reality, the technology has to prove out its promise. I think, the organizations that use the technology need to have an understanding of how the technology works. It can't just be a black box.
Yeah.
And you need to be able to change the way people and businesses fundamentally operate. So lots of promise, but lots of work to do.
I started by saying that you've had a landmark year. How do you build on that? How do you top on that? Because you've had a record-breaking quarter in many ways.
I think it starts with strategic clarity, which is what can you do and be the best in the world at? And that gives you the clarity of understanding, the humility to rethink your ecosystem so that you can build complementary capabilities and serve your customers really well. I think the second is customer centricity. To be able to help clients, you also have to understand how to use the technology yourself. And then the third is culture. We have a belief that whenever there's a transformation, that you have to understand its relevance to your business.
Yeah.
And if it is relevant, then you want to lean into it and encourage adoption. And I think in that case, trust beats policy all day long. It's much easier to have a workforce that you can trust and that loves our company and wants to do right for the company. And it encourages use and adoption versus having a big policy manual of to-dos, what to do and what.
So there is no big policy manual of a long to-do list?
No.
No? And what has it done in terms of workforce and workflow for you inside NetApp?
I think we have two perspectives on that. The first is, we're trying to build an enduring institution. And I think at the fundamental heart of every institution and professional organizations is the idea of apprenticeship. And in this case, we actually really believe in bringing young talent to the company because they will be the future generations. And in some ways, what has been interesting is the mentorship in this case has been reversed. The new talent is much more facile with the technology than the more senior talent. And so it's really encouraging and interesting to see the new generations teaching the older ones how to use it. And so that's one view. it's sort of a long-term view of the talent pipeline and the opportunities there. And then the second is you need to be able to get people to think about the skills needed now that they have these powerful tools. So for example, it used to be in software development, the idea was that, you know, the entry-level person would write code and then would have a more senior person teach them how to review code. Now you've got an agent writing the code for you, and as an entry-level employee, you have to be able to learn how to review the code. So you have to upskill people. And then once you do that, you can see enormous power. The third thing we have done is to really measure business outcomes rather than just usage. So, you know, in software development, for example, rather than look at naive indicators like token use, we're actually seeing, hey, are people able to deliver better, higher quality code to the system? In customer support, we're measuring do our customers actually get the information they need better, faster, easier.
You know, it's interesting that you talk about bringing young people in and how young people are a lot more agile with this technology particularly and understanding it and using it. But what does all of this now mean as far as the workforce is concerned from a jobs point of view? And I think that is what is causing a great degree of anxiety at this point in time. I mean, if you've looked at the graduating ceremonies and what's going on with tech CEOs and the kind of backlash that we're seeing at this point in time, how do you respond to that? What do you believe the workforce of the future is going to look like if we do have this hybrid model where digital labor and human labor will coexist?
I think there are broad implications, and I think it begins with having a deep understanding of the technology itself. You know, Aristotle says the most dangerous thing is the illusion of knowledge.
Yes.
And today, I think broadly based, including the tech industry, we have an illusion of how this technology works and learns and understands itself. So we've got to be able to get a lot deeper in terms of truly understanding where it is useful and where it's not. I think the second is, you know, as a member of the technology industry, we haven't always gotten it right. I think social media, remote working have been examples where the tech industry sort of highlighted the promise of something that had downstream consequences of, you know, very negative consequences, right? You know, mental health and all of these other negative consequences of those technologies. And so we need to be more balanced in our view. And then I think thirdly, you've got to make sure that we cross the digital divide. You know, this is where, particularly in India, there is an opportunity for India to lead the world, where I really believe the application of this technology to make available affordable healthcare or better food security or mitigate catastrophic risks from happening is perhaps more important than gloating about how powerful the technology is. And I think we have a responsibility to make sure that the next generation doesn't feel as much despair as they feel right now.
One of the other things that I think is now sort of becoming part of conversations is the fact that you need partners. You need to create an ecosystem. It cannot be one individual company or a few companies that are going to drive this and lead this, or it should not be left to a few companies to drive and lead this. How do you respond to that? And do you believe that will policy or regulation force the ecosystem, or is enlightened self-interest going to force this ecosystem to collaborate much more?
We've been in the data center business for a long time, and data centers are multi-vendor, and we've believed always that it's better to harness the power of collaboration and community to build a better outcome for clients. I think that's true across the globe. And I think that, you know, it probably requires a combination of regulation to protect against some of the risks, but also enlightened self-interest. You know, platforms are better when more people contribute to the value of the platform than a single controlling individual.
So, speaking of partnerships, I mean, you've done a bunch of them through the course of this year, including with Google Cloud, Nutanix, and a whole bunch of other companies as well. What's exciting at this point in time? You've got a pretty solid pipeline of launches. You've launched many products as well. What's happening on the innovation engine that has you excited?
I think it's really to help our clients use their data and to be able to deliver amazing outcomes. You know, we've been fortunate, for example, to work with the European Space Agency to map the universe, right? And I think that that work does not happen alone with us. It certainly starts with the knowledge and insight of our clients, but also the partnerships that we strike with other organizations to be able to deliver amazing breakthroughs. And I think that for us, the importance of partnerships are because it allows us to bring the world's best capabilities that we have, but also to work with other industry leaders. And the joint work brings a much better outcome.
Been very bullish on the Indian market, but how has India changed for NetApp since we last spoke, which was about 3 years ago?
In multiple ways. You know, certainly we've always believed in the talent in India. We have our largest development center, which is now close to 4,000 employees.
And you think that will continue to be the case? Because everyone's talking about, you know, the agentification of the workforce, and that would probably lead to less hiring or maybe not so much offshore work. How do you respond to that?
We think India is a great place for talent, and we are increasing our employee population there. We have highly skilled employees, and so they will be a cornerstone of our research and development organization for many, many years to come.
Okay.
I think the second is we're working with the innovation ecosystem in India, both you know, through our accelerator program, which has been very successful. It's one of the top 10 accelerator programs in the country, and we've seen both women-owned businesses as well as, you know, other innovative startups kind of learn and benefit from our experience. And so that's a contribution to the innovation ecosystem. Plus, we're working with NASSCOM around how to enhance digital literacy. And then certainly we've been privileged to work with large public institutions as well as commercial institutions to help bring capabilities to the Indian population. I think that you know, some of the large digital and mobile platforms, certainly many of the largest government agencies and the large banks and financial services institutions.
So given the opportunity, where does India figure? I mean, outside of being an incubator of innovation as well as a talent hub for you, in terms of growth in the market, where does India stack up?
We see it as one of the fastest growing IT markets in the world. We are fortunate to be the #1 share player in our segment of that market, and we are bullish. We are expanding our investments there. We are working with the local ecosystem in addition to the global ecosystem. So we're excited to be in India.
You said you're expanding your investments. Is there a number that you can share with us in terms of what we can expect?
We've grown our investment in India across all of our functions, and we'll continue to grow that. Over the last several years, we have steadily grown and outpaced the overall pace of investment in the company.
You know, one of the other factors that's weighing on decisions at this point in time is geopolitics. And I think, you know, sovereignty and what that means as far as AI is concerned is gathering momentum. And I don't think there are easy answers. There is a complex problem. How do you look at that issue today? And what will NetApp do when it comes to issues like sovereignty? Do you see that as an opportunity for you?
Yeah, I think, first of all, we are hopeful that there is a uniform sort of commercial and regulatory framework for AI. We think that having a harmonious framework across the countries and across the globe makes it easier for everybody to build safer technologies while continue to bring innovation. And I think there's still work to be done there. With regard to, kind of the fundamentals of how we see the ability to foster sovereignty, I think there's certainly multiple elements to that. There's data residency, which is foundational. We have done that in so many organizations around the world, and part of the partnership with Google Distributed Cloud, for example, is to facilitate data residency without having some of the concerns about, kind of my data crossing national boundaries. The second is we have tools that allow organizations to be able to go beyond data residency to maintain data sovereignty, which is the ability to use the data alongside the innovations that are being available, global set of innovations, but to use the data in compliance with national mandates. And then over time, by contributing to the ecosystem in countries like India, we think that you can bring more technologies to the world. Today, if you think about the AI ecosystem, it's primarily led by one or two countries. And I think over time, for sovereignty to become possible, you need to be able to have more countries have, kind of supply chain independence for these technologies, and we're part of helping make that happen.
Supply chain independence is a great point, but speaking of countries benefiting and also creating their own competitive moat, what will India's competitive moat be in an AI era?
I think India's greatest contribution to the world in AI is actually to lead the world in the applications of AI. You have a young population, you have a large amount of data that can be harnessed because of the role the government can play in fostering that. You have innovative, entrepreneurial, digitally savvy innovators. And I think that my hope is that India leads the world in that, making it affordable, making responsible AI be able to reach a large population. And by doing so, you can teach the world.
Will that be enough? Because the question being asked is, if you're not playing across that 5-layer cake, AI cake, will you be out of the race?
I think different countries in the world are adapting AI to their national strategies, right? So I think when you look beyond the technology itself, I think you can build a competitive moat, for example, by using AI to be the best in the world at advanced manufacturing, or using AI to build the most cost-effective pharmaceuticals. And so when you think beyond the technology industry, I think the way that you build a competitive moat is to lead the world in specific industrial applications of the technology.
So, since we're talking about the future, 10 years on, what are you most excited about now as far as NetApp is concerned? And how different do you believe NetApp is going to look in the next 5 years as you grapple with all of the stuff that AI is bringing to the table?
I think, for me, what's been encouraging is that at NetApp, we have believed in one or two long-term theses, which is that we want to help our clients harness the power of their data to unleash the competitive advantage, the innovative possibilities for their business. And that has been true over the 30-year history of the company, and especially true now.
Yeah.
I think the second is we have navigated major platform shifts and have taught the company how to lean into those shifts without fear or without the pride that comes from having succeeded in one era. And navigating the first one successfully, which is cloud, gives you the confidence that you can do more. And I think that my hope for NetApp is that, looking 10 years out, that we continue to be an organization that helps our client harness the possibilities of whatever next technology shift there is, but also be seen as a player that knows how to work with the ecosystem, is best in the world at doing something, and has the confidence, the quiet confidence, that when technology transformations or platform shifts happen, that we can lean into it and be successful.
From your origin story of where you started coming to the US, for a young founder or a young CEO who's watching you today, what's the message that you'd like to send out?
I think that you need to be willing to learn and adapt to the environment you're in. When I came to the US, the kind of social environment in the US was far more different than India. The development gap was wide. And so I learned to adapt. I learned to respect what America was all about, but also to keep connected with my roots, and what made me the person I was. I think that you want to learn from the people around you. I was fortunate to learn from the people around me, and I think that you want to know that many people paved the path for you. And what that does is it brings respect and gratitude when you're successful, and conversely prevents you from being totally down on yourself when things don't work out, because you know that it's not just about you, that there's an ecosystem around you that made you who you are.
Well, speaking of your roots, how often at tech conferences are you asked about Google Cloud?
Quite often.
Really?
And I would point out that the Google relationship started before my brother got there and will endure after me or he leaves our current roles.
What is it like to have your twin doing exactly what you're doing in a different company? I mean, it's probably, is there any other combination? I don't know of any.
I'm not sure. I think it's an honor to work in the roles that we have. And I think that, there's a sort of a mirror transformation that we are dealing with. We are trying to take NetApp and make it a cloud and AI company. And Thomas is trying to take a cloud and AI company and make it an enterprise business. And so we share notes about what's involved in allowing organizations and enabling them to make that cultural shift.
Yes, well, it's been an absolute pleasure. Thank you so much for your time, and we look forward to seeing more of you in India, and wish you all the very best with NetApp and all that you've spoken to us about.
Born in Mumbai, Jeetu Patel arrived in the United States as a 19-year-old with little money in his pocket, waiting tables at Sizzler for just $4 an hour. Today, he is one of the most influential Indian origin executives in global technology. After spending over 2 decades building and scaling enterprise software businesses, Patel was appointed President and Chief Product Officer at Cisco in 2025. Under his leadership, Cisco has accelerated its push into artificial intelligence, cybersecurity, and enterprise software, helping drive record-breaking growth in recurring software revenues and AI infrastructure demand. As businesses race to adopt AI, Patel's mandate is clear: transform Cisco from a networking giant into the software and security backbone of the AI era.
Hello and welcome to this edition of Young Turks. I'm Shireen Bhan. We're celebrating our 24th year at Young Turks and our 14th year of bringing you voices from the Valley. So it's our great pleasure to have with us on the program a man who's quite literally at the center of things here in the Valley related to all things AI and tech. The man leading products for Cisco, the CPO. Thank you very much. And President Jeetu, it's great to have you here.
Welcome to Cisco.
Thank you very much for having us. And wow, I mean, this gives a seat at the table an entirely different meaning, doesn't it?
There's a lot of seats at this table.
There's a lot. But are there really that many seats at the AI table today?
We just actually had our Silicon meeting here with our entire Silicon leadership team, and every seat was filled. But it was a fun day. We spent 2 days over here.
But what about the AI table? Is the AI table shrinking or is the AI table expanding?
Ever expanding.
Ever expanding.
Yeah.
What's the most exciting thing? I know you've been talking a lot about the fact that you believe we're in networking super cycle. And what does that mean exactly for all of us?
So as you and I have talked about before, we're moving from this world of chatbots to agents. And these agents tend to be far more consumptive in their network consumption patterns than humans are. So for example, we just did a study. An agent consumed about 450% more bandwidth than a human for the exact same task.
Because they're not sleeping.
They're not sleeping, they're working around the clock. And by the way, what is an agent? An agent is basically a file that uploaded to the model. So there's a fair amount of kind of network bandwidth because of the chattiness of the system. So what we have here is an infrastructure that's completely going to need to be reimagined to accommodate agents. And we're not even at the physical AI realm yet, where the moment physical AI takes off in a big way, you'll see an even more consumptive pattern on that front. So the reason it's a networking supercycle is because you're going to see this not just in the data center. Now what you're seeing is these agents are also running on your desk side. In fact, there's a whole new class of computing called desk side computing. I don't know if it's actually been something you've talked about during your trip over here, but think about an agent not just running in the cloud.
Right.
You now have people saying, hey, I have a laptop for the human to work on. And then I have like a Mac Mini or a Mac Studio or an NVIDIA PC or an AMD PC. And that's what they call a desk side computer. And that's where the agents run. And you might have hundreds of agents running over there and doing and conducting tasks for you. And that's going to have an enormous amount of bandwidth consumption because for every human, you might have 10, maybe 100, maybe 1,000 agents.
Yeah.
And they're working 7/24. They're 450% more consumptive in their infrastructure needs. So think about what that does to the network, to the compute, to the power.
Yeah.
It's going to be enormous.
It is going to be enormous. So how do you reimagine the network when we're talking about this kind of surge in traffic and consumption? And what are the numbers telling us? I mean, what is the kind of traffic surge that we're already starting to see?
Well, I'll give you some numbers that'll actually just be completely eye-opening for you, which is if you think about our campus branch networking, which is what we call our workplace networking, in offices like this, when you have Wi-Fi access points, you've got switches, you've got routers, that business for us grew at about, it was pegged to inflation. It grew about 3 to 4% a year.
Right.
Last quarter, we had 25% order growth. So imagine that.
Yeah.
And that's not something that's a blip for a quarter. I think we can see sustained level of double-digit growth for a while. And that's because of this kind of pattern shift that's going on in the architecture of the networks itself. So when you look at the numbers from the financial standpoint, there's a fair amount that's going to be spent on these networks because everyone wants to modernize their workplace. When you look at it from agents and what they're doing, every human is going to be a manager of agents. And we now have at Cisco our first product that is completely written with AI. Okay. No human lines of code.
At all?
At all.
Okay.
Humans will verify the code, but the agents wrote the code, right? By the end of the year, we'll have about 6 products that are completely written with AI.
Wow.
By the end of next year, get this, we will have 70% of our products that will be 100% written with AI. Cisco will have no legacy code. We will have refactored all of our code. So when you start thinking about that level of implication on of agents on the workplace, there's going to be a tremendous amount that changes in the campus. Of course, we've been working with data centers, as you know, on the numbers. 3 years ago, there was barely any revenue with AI-related, kind of data center revenue. last year, Chuck Robbins, our CEO, said, hey, let's make sure that we actually let the market know what we think we're going to be able to do. So we put out a number. We said we'll do $1 billion in year one in AI revenue for data centers. We ended up at 2.3.
Yeah.
So we said, next year, what do we do? Which is this year, this fiscal year for us. We said, let's do 5 billion. Let's double it.
Yeah.
We're going to end up at 9.
Wow.
And so there's this kind of massive exponential curve of increase in infrastructure. And then you add on top of that things like security because of Mythos and what's happening over there. And you see different models that are going to be there from OpenAI and from Anthropic that are going to be very, very potent. I think there's going to be a tremendous amount of emphasis placed with every class of customer we have, whether it be a hyperscaler, whether it be a neo cloud, a sovereign cloud, a service provider, or the enterprise, in completely kind of changing their architecture to go out and accommodate for these new patterns of work, the new ways that security is going to be implemented, the new kind of exploits that the agents are going to be participants in and drivers of sometimes, and they'll also need to be participants of the defense against the agents through machine scale.
Yeah. You know, I'll address that and what you're doing on that front in just a second. But that was pretty mind-boggling what you just said, that in 2 years, all legacy code will be re-architected as far as Cisco is concerned.
There will be no such thing as legacy companies anymore. That's a thing of the past. Because.
But what does that mean exactly?
So what does a company, by the way, this is an interesting thing because legacy used to be where I, as a company, have actually enjoyed so much success. And products have been used so much by so many people that I need to now make sure that I slow down my innovation so that I don't go, because I've accumulated tech debt over time.
Right.
And so large companies had a harder time in moving as fast and with the level of agility like a startup would. Now what's happened is we are starting to see that when you actually do write this code and you do have success in the market, you can continue to keep refactoring the code. So for example, in our security business, we had our firewall. I'll give you a couple examples. It's just mind-boggling. So we have our firewall management console. And what we did was we said, let's refactor the code here. 8 million lines of code. Within 6 weeks, the teams were able to refactor it to less than 1.5 million lines of code. So firstly, you've compacted the code. What does that mean? Performance is faster. It's more efficient. It's actually got less security vulnerabilities. The way in which we've designed the product can be updated faster. All of these things have a profound effect on the customer. And now, all of a sudden, our scale of being with all those customers, but being able to go out and innovate at a very, very fast speed becomes our very asset. And so I feel like as time goes on, you're going to have very little legacy code because everyone's going to write code using agents. And what you're going to then do is we have about 32,000 engineers right now.
Yeah.
I think in 2 to 3 years, they're not going to be writing code. So then the question is, well,
what are they going to do?
What are they going to do?
Yeah.
Well, they're going to review the code. And in a world where you can write anything, what you choose not to write and what you choose not to build is actually far more important. So the product judgment and the product intuition is going to be really important. The other thing that these engineers will do is they will actually be the front lines for our customers because they will help our customers adopt better. So every engineer will become a forward deployed engineer at some point for a certain percentage of their time. And so you'll see the configuration of the entire workforce change, where a product manager is going to actually become a product developer of some sort. So the first prototype will actually be built by the product manager and the designer. The engineer is not even involved. The engineer gets involved in the architecture. And then the engineer is involved in the front lines with the customers. And so I think you'll actually start to see a workforce shift, which is very different from what we've been used to. But I don't think it's going to be around this notion that there's going to be fewer jobs. What I've started to see and observe is every single time we've seen a massive step function improvement in AI, actually the bottlenecks have been largely human. So when we have much, much higher volumes of code, now my bottleneck is code review. So I say, okay, I'm going to automate code review. My bottleneck then is going out and building a test harness. So I automate that. My bottleneck is going to be what kind of products do I build, and do I need to do the right kind of market research, and do I need to do deep thinking and apply intuition to it? So I think there's going to be a snowball effect, and I think you're going to need more people.
Really?
I think over time you will have a shortage of people that are dexterous with AI and have fluency in AI. Now, by the way, the gap between someone who is really fluent in AI and someone who is not fluent in AI is not going to be like a 10% productivity gap. I think it's going to be 50x or 100x. What does that mean? That means it's going to be very hard to justify someone who's not AI fluent to be in a job. It would be like saying, let's hire someone that doesn't know how to use the browser or the internet today. It would be an absurd concept in knowledge work. So I think that'll be an area that we'll have to make sure that collectively, between public-private partnership, we will have to make sure that we raise the dexterity level of people with AI. But if you look at every single person that we hire today that is fluent with AI, they get paid really well. In fact, I would say if I was in my 20s getting paid that kind of money, I'd be in trouble. So they get paid really well. They have a tremendous amount of shortage of those people. And the value that they add is enormously high compared to what they're getting paid. And I think you're going to see more and more of the workforce get there. So there's going to be more of a demand, but there will be this painful period where the retraining of the workforce will require some displacement, and there will be some people that'll lose their jobs. I think every job is going to get refactored, and there'll be entirely new industries created.
Have we moved now to production cycles, production stage in companies, or is it still sort of, okay, let's sort of experiment and figure things out before we actually make those big calls?
No, it's completely a non-controversial issue at this point in time, that chances are you're not going to lose your job to AI, you're going to lose it to someone that uses AI, but actually that's not even the most non-controversial thing. Now what people are saying is, if I don't use AI, I don't even know how I'm going to get my job done. Right? And so that I don't think, now that's not an evenly distributed viewpoint yet. I think you go to different geographies in the world, it's different. I think we live in Silicon Valley, we tend to live in a bubble. That's why I tend to travel a lot, because I want to make sure I keep my pulse on the ground and like what is actually happening in the field with the customers. And what